the commodity space. Manisha, good morning. Final trading day of the week. But what are the commodities indicating today?
Thank you for that, Hormuz. Well, I'll start with the crude oil prices, which are headed for a weekly decline, down 2% in this week, while the U.S. president continues to reiterate increasing oil supplies. The U.S. inventories also have increased, and the markets believe that there will be an increase in the non-OPEC supplies as well. There was a report from Citi overnight which says that the Brent prices could decline to $60 or $65 a barrel in the second half of 2025. The strength, though, has continued when it comes to metals as a sector. Copper is trading at a 4-month highs in the Asian markets right now. The fall in US dollar, slightly easing concerns over global trade war, and positive PMI data coming in from China and US have supported many of these industrial commodities.
Manisha, thanks a lot for that. Important updates there coming in on the commodity front as well. But with that, it's a wrap on this edition of Power Breakfast for the week. From me and the team that put this show together, thank you so much for watching. Bazaar Morning Call sets you up for this big trading day.
Continues to watch it closely. These probabilities can change as more data comes in, and many asteroids that have appeared risky at first have later been deemed harmless. Right now, no other large asteroids pose a threat with impact probability above 1%. So, while Asteroid 2024 YR4 is something to keep an eye on, you may not need to lose sleep over it. For now, NASA's Planetary Defense team is on the case, and we'll keep you informed whenever there's new information available.
For the first time in nearly 5 years, the Reserve Bank of India could kick off a rate-cutting cycle, making Governor Sanjay Malhotra's debut policy meeting one of the most closely watched in recent history. Now, RBI has been injecting massive liquidity into the banking system in recent days, which some interpret as a precursor to a rate cut, despite the relatively high inflation. So the CNBC-TV18 monetary policy poll shows 70% of market participants and economists are betting on a 25 basis point rate cut this time, driven by the need to support growth. But ignoring the rupee's depreciation can prove tricky, which is why 30% of the respondents still voted for a dovish hold. Now, liquidity remains tight in the system, but a cash reserve ratio cut at this point seems unlikely. But 60% of the respondents do expect additional liquidity easing measures like more OMOs, longer duration repos, or a cut in the incremental CRR for NRI deposits. Of course, markets will also watch closely for any clarity on the new LCR norms, which are set to kick in from the 1st of April. Now, external factors are going to add a lot of complexity to this policy. RBI is likely to acknowledge the risk from the tariff threats and stay nimble, but a small section of the market believes that inflationary tariffs and a weakening rupee could be used as an argument to push out rate cuts. But the broader consensus is RBI will allow a gradual rupee adjustment while ensuring stability. Now, markets are already pricing in steeper rate cuts beyond February, with most expecting anywhere between 75 to 100 basis points cut in this cycle to give a helping hand to growth. Now, despite these expectations of rate cuts, the monetary policy stance is likely to be left unchanged at neutral. But as for the tone, 40% do anticipate a dovish tilt, while the majority expect it to be neutral. Now, growth expectations are softening. 90% of our respondents predict that RBI will lower its FY25 GDP forecast to 6.4 to 6.5%. That could further strengthen the case for easing. But the inflation forecast is unlikely to be tinkered with in this policy. So all eyes are going to be on Governor Malhotra's debut policy move. Will he pull the trigger on a rate cut or stay cautious amid global risks? The stakes are high and the market.
Welcome to India's #1 budget headquarters. Decoding key policies, delivering market-shaping insights, and unlocking the potential of India's growth blueprint. Beaming live from the CNBC-TV18 Motilal Oswal Budget Headquarters.
Good morning. It's a Friday morning. We are coming to you live from the CNBC-TV18 MotoCorp budget headquarters. I'm Prashant. With me, my colleague Surbi. It's a big day. It's the last day of the week, but it's also perhaps the most important for us here in India with the RBI MPC meeting decision, which I think is going to be prime, center and focus. Surbi, hi, morning.
Hi, Prashant. Good morning. And it's a Friday when the next day is a holiday. We're not working tomorrow, the Saturday.
Last Friday, we were saying that maybe we shouldn't say thank God it's Friday.
It never felt like a Saturday. It never felt like a Friday, absolutely. Yeah. But yes, the good thing is that tomorrow is not a working Saturday. But like you said, lots and lots of events lined up, right? Lots of global headlines. There is, of course, the policy. There's, who knows, we might get, the new income tax bill also, tabled. So plenty of action ahead.
Absolutely. And so let's take it from the top, as we always do, and tell you the most important things which you need to sort of be cognizant of. So the RBI rate decision, I think, we'll get to a slightly reverse order, not starting from what happened overnight, but the RBI decision. And of course, it'll be out at 10. You'll hear from the governor. I mean, there's short commentary from the governor at 10 o'clock. And then, of course, later there'll be a chance for question and answers. And a 25 basis point cut is in the price. Markets are absolutely expecting it. It should happen. But could there be more measures? And then, of course, we'll hear from the governor, because very little is known about the governor and what his stance is on a variety of issues. And so much has happened over the last many months in terms of the macro environment. Rupees, of course, just one thing. So that's, really the big one. Now, overnight, U.S. equities were higher. It was an okay session, about 0.5% higher on the NASDAQ. Amazon reported numbers, and they were a little soft. And some commentary that it largely is because of the capex that they've allocated for AI. Stock was down 4% post-market. So maybe it'll show up in futures, the S&P E-minis, etc. The 10-year yield, 4.43, just about a 2 basis point change. You had the dollar index, which was flat around 107.67. Again, a lot to do with President Trump. So this is what he said about oil prices. He said, we will drive the price of oil down and everything will follow. So that is coming in from Trump. Then he went on and reaffirmed the progress made in stopping the Russia-Ukraine war. Remember, there have been lots of reports that U.S. allies are expecting a plan to be put out next week. And this is going to be a big one after what's happened in the Middle East. Now, in terms of meetings, the Japanese Prime Minister is expected to meet Trump in person today, although expectations are low. The Panama president is also going to be speaking to Trump on a phone call. We'll see what happens. Remember, Trump has said he's going to take back the Panama Canal. And so those are things. I don't think they're market moving, but you'll see headlines around this. No details about the all-important meeting between President Trump and President Xi. And I think that's a big one, because both have imposed tariffs on each other and negotiations, etc. But we don't have any firm timelines on it. Treasury Secretary Scott Bessent also sort of said that he had a very constructive meeting with Fed's Powell. And this is interesting. He essentially was commenting about the 10-year the 10-year paper, U.S. bond. And he said that Trump's goal of energy dominance, deregulation and non-inflationary growth, the 10-year yield would naturally come down. I mean, the reason it's interesting is because he's not talking about the Fed and what the Fed will do in terms of interest rates. He's talking about the 10-year market interest rates. And he's saying, well, eventually that will continue to come off because of these three reasons. So more on this later. U.S. monthly jobs data to boot later tonight, and that typically comes out around the time that U.S. markets are starting to trade. Okay, so just tying the levels here. Yesterday, of course, the market came off the highs and we had a slightly sort of negative close, about a 0.4% lower close. Support comes in at 23,532, which is the immediate 70 points away from where we left off. That's a 40-hourly exponential average, and below that, you're looking at 23,445. That's a 61.8% retracement. And resistance at 23,807, which is the high that we saw recently. Bank Nifty has not seen, in this phase, has not seen a negative close yet, unlike the Nifty. And here, first resistance, 50,893 is the first, and then 51,119. I mean, same numbers. It's basically just the retracement levels. And support, like for the Nifty, at the 40-hourly, which comes in at 49,891. I think, at least as markets opened 9:15, till the time that you start to hear from the governor, the rate decision is one thing, but I think markets will wait to hear from the governor, the tonality, etc., in terms of what he'd like to do. And then maybe we'll see more consequential moves. GIFT Nifty will come up on your screen, giving you a sense of how we are likely to start this morning. It's about 20 odd points higher. So be high.
Hi, Prashant. I was still trying to wrap my head around the Amazon headline. They're spending $100 billion in AI in 2025. But $100 billion. That's just, that's quite something. Morning, Nigel.
Well, morning. Yeah, I mean, and that's going to be a bit of a drag, I think, today because, the commentary was very, very great. I think numbers came post-market, so we'll have to keep an eye out on that factor as well.
No, absolutely. But to talk about the cues here at home, the thing is Asia is trading slightly mixed and there's some caution out there. So it's not entirely a straight line up in Asia. Some of the markets, actually China's doing pretty okay. China, Taiwan and the mainland Chinese markets, the Shanghai Composite, they're all up and about. But the Japanese market, that's under a little bit of stress. The Nikkei is down about 0.5%. There's been fresh updates out of Japan this morning. The data there continues to look very, very strong. In fact, there's household spending data that came out of Japan for the month of December, and that's just blown past estimates. I think Reuters estimates were around 0.2% or so. The spending number is 2.7%. That's telling you the strength in the Japanese economy. And again, it's reiterating all those expectations of more rate hikes by the BOJ and the yen move that we've spoken about in the past as well. The yen being relatively a lot stronger versus the dollar. Anyway, in speaking of rate cuts, the BOE moved yesterday. Bank of England did lower rates by about 25 basis points. They've come down to 4.5%. And now it's all eyes on the Reserve Bank of India with the new governor in the house. And if they decide to do 25 basis points, it's the first time that the RBI will cut rates in nearly 5 years. The last time we started that rate cut cycle was just after COVID. May of 2020 is when we first had a repo rate cut. And then it was sort of, steady to increases, and then now we're talking about a rate cut all over again. Let's talk about the other internal cues, which are very important. On the FPI front, there's actually no great support because after that one flash in the pan kind of a day of buying, the selling is pretty solid. Once again, look at that 3,500 crores of cash market selling, offset to an extent by domestic institutional buying of around 2,700 crores. Today, it's really going to be about the RBI policy, so I'll watch out for banks and how the positioning there is. Remember, yesterday, the bank Nifty was outperforming the Nifty. And if the rate cut comes in and if more measures come in on liquidity as well, that could be boosting banks and financial stocks in general. So that's one area. And then there are lots and lots of earnings in focus. Just to give you a sampling, and it's a mixed bag, but there are more good headlines than negative headlines, must say. Bharti has been a rock-steady, solid show. The revenue is up almost 9% sequentially, and the ARPU is jumped big time. There's a 5% increase in ARPU. That number's touching 245 crores. And a lot of the internals are actually even better than Jio for Bharti. So let's watch out for this stock. ITC is a very mixed bag. Yes, the cigarette volume growth is better than estimates. But if you look at the the FMCG business, that's not been that great. It's a drag. There's a margin pressure there coming in. Volumes are lower than estimates. So let's see. And there are a couple of acquisitions, by the way, for ITC. So we'll see which way the market goes on this one. Hero Moto is steady. There's some margin improvement as well. No problems there. Blowout numbers from PG Electroplast. Today, I'll watch out for this mid-cap stock because not only is the growth chugging along at over 80%, they've done really well. Margins up almost 90 basis points. They've upped their guidance. And this is a very hot space in the market, EMS. So watch for this stock. This, for me, was the standout result, post-market. BSC, another well-tracked stock. Numbers are okay. They've had to spend a little more on this settlement guarantee fund, which is why the profit got impacted. But otherwise, the internals look okay. So lots of earnings to go over. There's Britannia as well. And if earnings aren't enough, that big, boardroom battle for Religare, that's in sharp focus as well today because the new man who's thrown his hat in the ring, the US-based investor, Mr. Digvijay Gaikwad, he's now moved to the Supreme Court. He's saying, stop the Burman's open offer. I'm making an open offer. Consider mine as well. It's getting really hot in here to quote this song because Nigel's always quoting songs this morning. So I'll go with this one for today.
Well, let's take stock first of the global cues. And you look at the dollar index, you look at the US yields out there, as well as Brent crude prices, all well behaved. So hygiene check. No worries on that front. We have got big cues, though. Starting in the first half of trade today, you have the RBI. Later this evening, you'll have the US jobs report. And over the weekend, you'll have the Delhi election verdict as well. So those are the top cues for the next 72 hours or so. What did the FIs do yesterday? Well, they unwound some of the long positions that they added in the previous trading session, and they added some shorts. That causes the short position to go back up to around 84%. And in absolute terms, they're holding net short positions to the tune of around 1.6 lakh contracts. It's at elevated levels in absolute terms because of the contract, resizing. That's why it doesn't look that large. But otherwise, in absolute value terms, it's very, very high. Clients are on the flip side. They're at around 1.4 lakh contracts on the long side. Pulling up the options data, we start the new contract because you'll have the weekly expiry that will play out on the coming Thursday. And at the 23,600 strike, you have the call as well as put that was fairly active. That gives you a sense that maybe there was a short straddle at play out here. What is that? You write the same strike, call as well as put. In this case, you'll pocket a premium of close to around 400 rupees and you'll want the Nifty to stay in this range if that is the strike. So 23,200 important on the downside, 24,000 on the upside. And incidentally, if you look at the 20 DMA, that becomes the reference point on the downside. And on the upside, the 200 DMA. So we're in this 800-point band. The bulls and the bears will be battling it out to see which side it can swing. On the Nifty Bank, well, that was quite resilient in yesterday's trading session till the final hour of trade once you got the SBI numbers. But 50,800, that's a bit of a resistance zone. But since, the RBI action is something that will be tracked, things will be volatile. But stock-specific action is going to be a buzz. So I'm looking at three, parts today. One is REC. The numbers yesterday appeared a little bit softish and the stock ended at the low point of the day. And there's an open interest build up out there as well. So shorts in the system. So the growth, yes, it was softer than expected, but there is high recoveries that we saw and return profile as well is fairly good. So I'll keep an eye out on this stock because there was some shorts that got built into the system towards the end. Next is the battle for the control of Religare. That's moved the Supreme Court, so we'll wait by for the verdict at around noon today. The Delhi High Court, though, has rejected Rashmi Saluja's plea to halt the AGM. So I think that's moving in the right direction, so we'll keep an eye out on this stock. And finally, ahead of the Delhi elections, if the BJP comes out on top, there's been a conflict between state as well as centre with regard to the liquor market out there. So if there is a resolution, I'll keep an eye out on these stocks, namely United Spirits, United Breweries as well. You'll always want the state and centre to be on the same page like we saw in UP, and you have the UP liquor policy that played out. So keep an eye out on a couple of these stocks.
All right. All right, let's get in Ben Powell, who's with us now. He's running us through what is the top of mind cues for markets globally. He's Chief Middle East and APAC Investment Strategist at BlackRock Investment Institute. Ben, great to have you with us here. Thank you very much for your time. I mean, let me start, maybe not very important for the market, but this entire Middle East bit, what do you make of it? If you have any thoughts, not from a market point of view, but just like, what President Trump has said about Gaza and things like that. Would you take it seriously?
Good morning, guys. Great to be with you. Yeah, look, the president has started at an extraordinary pace, I think, across pretty much every dimension, foreign and domestic. So I think every leader, business, government, investment leaders, economists, we're all scrambling to adjust to a very new reality and a new approach, I think it's fair to say, from a U.S. administration who seem very focused on American interests and are quite content to rewrite what have been thought to be kind of historical norms. So those historical norms started really earlier this week with the seeming tariffing of Mexico and Canada. Canada, obviously, a huge close ally of America, but that didn't save them from being on the list, at least for some period of time. Those tariffs subsequently didn't come to pass, at least for now. And to your question, yeah, the Middle East, like everywhere else, we're all looking, I guess, tweet by tweet, Truth Social post by Truth Social post as to what's going to happen next. And that would apparently include some historically astonishing proposals, at least. That's how far they can go in terms of significant changes here in the Middle East.
Ben, hi. Good morning. Great to have you in with us this Friday morning. On tariffs, I just wanted to get your sense because the market seems to be now veering around to a view that this is not going to be that bad. I mean, that disruptive. It'll be volatile, yes, but it won't kind of, not the end of the world kind of a scenario because I was looking at the Hang Seng and believe it or not, the Hang Seng has had actually a great month. The index is up almost 7-8%. The Chinese markets after their holiday, they've been moving higher. So investors don't seem that worried about an Armageddon situation with respect to tariffs. So do you feel that to some extent we've kind of seen the worst?
Maybe. I think on China, the change has been because they were super worried, right? So they are now only quite worried, which is a positive improvement, I suppose. When now you compare that with Canada, I think Canada, 10 days ago, didn't really expect to be at the kind of front of the queue in terms of proposed 25% tariffs. So as we all understand, life's all about expectations. And then what happens? It's the change in. So China, I think, was really expecting hyper-aggressive approach. And so far, actually, the approach, I mean, it's been meaningful, right? We've had new tariffs slapped on China from the US, so stuff has happened. But so far, it seems like the market was discounting even worse. The big kind of unknown is if and when President Xi and President Trump might meet. So today, we've got the Japanese Prime Minister at the White House. It's sort of a parade of leaders going across to either the White House or Mar-a-Lago to meet President Trump. I think it's not just the Chinese. We're all waiting for kind of the big one, which is, can there be a grand bargain, if you like, struck between the two hyperpowers of our time or not? And that is unclear at this stage. President Trump has given some kind of positive noises around that. I think that's also helped Chinese risk in the short term, but that is a big unknown. Can they get together? Can there be some sort of agreement across different dimensions, which can give us a bit more clarity? We'll have to see.
All right, Ben, we'll leave it there. Thank you very much for joining us. Good conversation as always, shorter, but always useful. Well, let's get the editor's take, right? RBI policy decision today. Lata is here with what to expect. Lata, over to you.
Well, a rate cut is expected, and the question in the market really is, or kya? Because rate cut is so much discounted that now people are starting to expect a double rate cut. That is, a 50 bips. Then the CRR cut is not expected, but the market will very closely watch what he says about liquidity. Because does he say, I will give liquidity as required, or will I keep the market surplus, the interbank market surplus in liquidity? That's all the difference between adequate liquidity and ample liquidity. Ample will, of course, make banks extremely happy. It'll bring rates down faster. And then does he indicate a rate cut in April? So if not double rate cut, does he indicate a rate cut in April? Would be another question. Would he sound that dovish? The other things, non-rate things, would be the credit deposit ratio. The Reserve Bank has been warning deposit is not running as fast as credit. Your credit deposit ratio is too high. Will they now say, okay, now we are happy. The credit deposit ratio has reached the level of comfort. If they say that, again, banks will be more emboldened to give loans thereafter and push up the credit growth. Then the other three big regulatory rules, LCR, higher liquidity for unstable deposits, liquidity coverage ratio, new rules for provisioning for project financing, and expected credit loss accounting. Those are the three things waiting to happen. If he says they are postponed for now, and we are going to discuss more, which is what they are expecting him to say, because these are peacetime proposals, structural reforms. You don't do it when things are a bit like they are in the external front. So that is also an expectation. And finally, whether he says that the risk weights on bank loans to NBFCs, which was raised from 100 to 125 percentage points in November 2023, is that lowered? That's another thing which the market will watch out for. Now, my two-bit, I think it will be a single rate cut because, look at what's happening in the rupee. If you assure ample liquidity, surplus liquidity and two cuts, it becomes easier to short the rupee. It's cheaper to short the rupee. And I don't think, he can swing so much from the December policy. My sense is that he will take one step at a time. He will definitely clarify that I'm waiting for more reaction on LCR rules and ECL rules. So they are not going to start. The LCR is not starting on April 1. That will be a categorical assertion. On this risk weight for NBFC loans, which they take from banks, I doubt he'll do it that early. I mean, after all, unsecured loans have been a problem. So my sense is that will be postponed for another day, if that. So we have to wait and see how much of this happens. I think a rate cut is priced in. The market will rise a little. But if it's anything more than that, then the market will rise much more.
Absolutely. And, we'll hear from the governor on a variety of issues, as Lata said.
Initially, the banks will have a negative.
My worry is if he surprises us, because the market's so primed to get that 25 bips. If for whatever reason he decides to hold, let's not even think about it.
Let's all right, well, let's take a quick commercial break here. It's the top stocks to watch out for lined up next with our research team. That's coming up.
I'm still generally pretty constructive on the Indian market. Obviously, the valuations are higher than many other EMs, but generally speaking, stronger fundamentals, at least long term, to go with those higher valuations. India is also, at least at the current time, less in the crosshairs of some of these potential tariff announcements. There's lower overall export risk to the U.S. in terms of the size of the numbers compared to China, compared to Canada, compared to Mexico. And so that keeps India fairly well positioned in this year where there's a lot of headlines that investors can wake up to and find various disruptions on their positions. It doesn't mean that there's no headline risk, but overall, I think it's rather well positioned and still has all the structural uptrends.
I think the underlying innate technology is just right on the threshold, and we'll get there with the next models. But now people have got to go off and build all these services. So someone in this room hopefully will figure out what the AI tutor of the future looks like, and that'll be a population scale thing, and it'll think what that would do if every kid on Earth, this year got an AI tutor that was provided like a better education or helped to provide a better education than anybody could get last year. Think what it would mean if we could have like an AI medical diagnosis system that was better than anyone could get last year. Think what it could mean if scientists could go cure every disease faster. And so, we've been waiting for this moment for a long time. I think we're going to deliver something that can help with it, and now people have to go build with it. Other side of it, the cost for a given unit of intelligence 1 year later seems to fall by about 10x. Moore's law was a 2x every 18 months for the number of transistors on a chip, and that changed the world if you waited a few decades. But what's happening with the reduction in cost in AI models is extraordinary. Now, I don't think it means that the world's going to need any less AI hardware because you bring the cost down and just the people are going to use it for a lot more things. The total number of dollars will go up. But that's a really exciting thing happening.
Welcome back. So we've been telling you that cues across Asia are mixed. It's not a one-way move that we're seeing. Some of the Chinese markets, mainland China, Hong Kong, they're higher, but Japan's down. So let's see. We'll get the implied open up for you on the screen. The global backdrop is slightly confusing this morning, 25 points higher as far as the implied open is concerned. It's all about individual stocks, and there's so many of them to go over. So let's straight away go across to our team for the CNBC-TV18 list of top stocks to watch. Guys, morning to all of you, and happy Friday, first of all. Manglam's been looking at lots and lots of numbers coming through. Let's start off first with ITC, Manglam.
Well, for ITC, I expect the stock to be in the green largely because of the one key factor. The cigarette volume growth in the company this time around has been 5 to 6%. The street was working with a number of 3 to 4%, so that's a positive surprise. Though the negative, if you look at it, the FMCG revenue grew just 4% versus expectations of 5 to 7%. And out there, the margins collapsed by about 240 basis points because of high inflation. But that was something that the street was expecting given the other FMCG company numbers as well. Agri-business revenue grew about 10% with margins at around 12.3%. The margin improvement out there was a positive even though the revenues were shy of expectations. The paper business has been subdued but does not account for too much in their overall business as well. The net profit was boosted by 528 crore exceptional gain on account of them acquiring HLV shares from one of their subsidiaries. The demerged entity, the ITC hotels business, showed a revenue growth of 15% and margin expansion of 450 basis points as well. So ITC hotels likely to be in the green today as well. Apart from the numbers, the company has gone ahead and acquired Mitigo and Prasuma. The combined revenue of these acquired entities is close to 131 crores. They will be paying about 131 crores, in terms of 44% stake upfront, and thereafter they'll, acquire the remainder over the next 2 years. But the positive surprise on cigarette volumes should keep the stock afloat today. See green there.
All right, Mangalam, thanks a lot for that. Well, let's hop across to Reema. She's tracking the Bharti twins, Bharti Airtel as well as Hexacom. Reema, tell us more.
Well, both the numbers are strong. So the industry is still benefiting from the July tariff hike. So first on Bharti, top line growth of about 8% on a quarter-on-quarter basis, margins expanding to 54.5%. Big jump in the company's profitability by more than 300% sequentially, but that is aided by an exceptional gain of 7,500 crore due to the consolidation of Indus. Look at the internals. Now, the India mobile revenue, which benefits from the July tariff hike, second consecutive quarter of strong growth, top line growth of 5.8%. Now, this is ahead of Reliance Jio's growth of about 3.5%. ARPUs are now at 245. So now they're getting closer to the aspiration of 300 rupees. And the positive is that subscriber growth, which declined in Q2, has picked up to about 5 million sequentially. Hexacom too is benefiting from those tariff hikes. Again, strong top line growth, 7% quarter on quarter. There is a jump of nearly 20% in their ARPU on a year-on-year basis. The company is adding subscribers by 0.8 million. So again, that is a good set of numbers. And just one final word, there is an announcement that Indus Towers will be acquiring 16,100 towers from Airtel and Hexacom, and they will be paying about 3,300 crores for the same. Back to you.
All right, Reema, thank you very much for that. So keep an eye out on these names as we open up. Well, Britannia is the next one. We were talking about the expectations yesterday. Mangalam is here with the numbers. Mangalam, morning.
Good morning. So, Britannia seems to be one of the best numbers that have come by in the large consumer companies so far. It's a solid beat across all parameters. Revenues closer to 4,600 crores. Street was working with a number of 4,500 crores. EBITDA 845 crores. We were working with a number of 780 crores. So margin was a beat, and the net profit on account of that 582 crores versus expectations of 534 crores as well. Domestic volume growth came in at 6.5% versus expectations of 4 to 5%. So that's telling you, this company is doing well, at least in the rural areas. The only important thing to track is one, gross margins. They've compressed by about 500 basis points, and employee expenses have halved. So, it's halved both quarter on quarter and year on year. That's aided the EBITDA. So how much of that is sustainable or not, or what was the reason behind that is something we'll be tracking. There has been inflation in key inputs, and the management said that their focus states, which is Bihar, Uttar Pradesh, Rajasthan and Madhya Pradesh, all of them have grown 2.5 times their company average, and their adjacencies, the likes of croissant, dairy drinks and wafers, doing well too in double-digit growth. So expect Britannia shareholders to have a good day.
Absolutely. I think they will, considering volume beats are a rarity in the FMCG space these days, and Britannia has managed that. Mangalam, thanks very much for it. Let's go across to Vinny. Vinny, how were the numbers for Aurobindo Pharma?
So Aurobindo Pharma revenues were largely in line, but we saw a miss coming in on the margin as well as the profit front. So let me take you out to the key negatives and positives. What we're seeing is PAT was a miss because higher interest costs is what we saw coming in, and lower other income impacting the profitability of the company. UGR US sales, that doesn't seem to be that great. We're seeing a bit of a decline that has come in on a sequential basis, and API sales are seeing a decline. The pricing pressure continues, 1.6% decline on a year-on-year basis. Sequentially also, we're seeing a sharper fall coming in. API accounts to around 13% of the total sales. Now positives, the ARV sales, that's a very, very strong growth, 72% growth on a year-on-year basis. Europe as well as the rest of the world performance was very strong, whether you look at it sequentially or on a year-on-year basis. Delivered strong growth in its US oral portfolio. Now that has managed to see a good growth, so supporting the overall growth for the company. So overall, when you look at it, largely the positives are outweighing the negatives, and that is why we're expecting green coming in the stock. Do not forget, Aurobindo Pharma had seen a fall coming in the last 1 month also, so maybe we could see that positive sign coming in for Aurobindo Pharma.
Vinny going with green on Auro Pharma. Noted that. Vinny, thanks a lot. Well, let's hop across to Sudarshan. He's here to tell us about Hero MotoCorp. Sudarshan?
Good morning, Nigel. So it's a good set of numbers from Hero MotoCorp for Q3 FY25. And remember, in the last few months, stock has fallen more than 30% from its record high. And what has worked for the company, it seems that company has taken price, and because of that, realization has improved both sequentially and year on year. And also festive season demand has worked most for Hero MotoCorp because it holds a large chunk of market share in the entry-level segment. And this segment, market share for entry-level segment, has gone by 6.5 5% if you compare year-on-year. Talking about the main numbers, revenue was up 5%, EBITDA has increased 8%, and margin too holds above the level of 14%. It has come in at 14.5% versus 14% same quarter last year. Earnings call is scheduled at 10:30 a.m. So we'll have to see what exactly company says on demand front. But on the back of earnings, I'm going with green for Hero MotoCorp.
All right, so thank you very much for that. PI Industries is the next one. A well-tracked, well-owned name. Vamakshi is here with numbers. Vamakshi, morning.
Good morning, Prashant. The weak set coming in from PI Industries this time around. When you look at the revenue, it came in at 1,900 crores. This is largely flat on a year-on-year basis and has come in nearly 2% below consensus. When we look at the EBITDA margin, that has contracted by nearly 224 basis points to 26.9%. This is again lower than what the street was anticipating, and this decline in the EBITDA margin is largely being led by cost of goods sold, which have seen an uptick of nearly 2%, and other expenses, which are seeing an uptick of almost 8% as compared to flat revenue growth. When you look at the net profit, it has come in at 373 crores. This is a decline of almost 17% on a year-on-year basis, so not boding well for PI Industries. Segment-wise, agrochemical segment saw an uptick of 4%, but the pharma segment saw a very substantial dip of nearly 50% from 127 crores to 63 crores. The agrochem EBIT margin also came in under pressure, down nearly 154 basis points, and the pharma business reported an EBIT loss of almost 56 crores. This has expanded from the same quarter last year. So overall, when we look at the numbers for PI Industry, not a great set coming in, and resultantly, I'm going with a red for this counter.
Yeah, so absolutely, Vamakshi got right about this quarter's told us that it's not the same situation for all chemical stocks. It's different for different sectors and different chemical industries, and PI has not had a great quarter. Got it. Quickly moving on to Apollo Tyres. We've got Sudarshan back with us. How are the numbers, sir?
Good morning, Surabhi. So it's a weak set from Apollo Tyres. Company has missed even muted expectations. So basically it has two major segments. One is APME, that is basically Asia, Pacific, Middle East and Africa. And second is Europe. So APMEAC region, for this EBIT has almost halved. It's down 50% if you compare with the same quarter last year. Europe business EBIT has come down but remains steady. Now talking about the numbers, profit was down 32%, revenue has increased 5%, but overall EBITDA has fallen 22% and margin has come in below 14%. It's at 13.7% versus 18% same quarter last year. Even it has missed expectation, and expectation was of 14.4%. For Apollo Tyres, earnings call is at 3:30 p.m. So we'll have to see what exactly company says on APMEA region, because that is one reason which is a major drag for the company in Q3. I'm going with red for Apollo Tyres for that.
Got it, sir. Thanks for that. Upasana, let's wind this down with Kochi Shipyard and PG Electroplast.
Good morning. First up, let me start with Cochin Shipyard. Company has reported weak set of numbers. This was mainly dragged down because of the company's key segment, that is shipbuilding segment, while company's ship repair segment outperformed this time around. Now, overall revenue growth stood at 9%. Mainly, this was because of the shipbuilding, the revenue, which was down about 14%, while ship repair, as stated earlier, saw strong growth. Revenue was up about 65% on a year-on-year basis. Now, EBITDA margin saw a downtick of 870 basis points, stood at 20.7%, and PAT also saw a degrowth of 27% on a YoY basis. On the flip side, PG Electroplast reported a strong set of numbers. Numbers were above street estimates, driven by the company's product business. Revenue EBITDA margin was above, while PAT was in line with the street estimates. Mind you that the company has raised its revenue and PAT guidance for FY25. Coming to the numbers now, revenue stood at 968 crores, which was up 82% on a YoY basis. EBITDA margin saw an uptick of 90 basis points, stood at 8.8%, which was much above the street estimates of 8%. And PAT saw an uptick of 1.09 times and stood at 40 crores. Now, as highlighted earlier, company has raised its guidance. Now, there is a 7% upward revision in the revenue guidance, which now stands at 4,550 crores, and 12% increase in the PAT guidance, which now stands at 280 crore. So, strong set of numbers from PG Electroplast, while Cochin Shipyard, weak set of numbers.
Okay, all right, got it. Thanks very much, Upasana. So both of those on our radar as well. Well, with that, let's quickly dive straight into a conversation with REC. The numbers came out yesterday, and the loan growth has come in slightly below the FY25 guidance that the company had put out. AUM growth is also at a 7-quarter low. It's not bad, but I mean, just historically speaking, it's come down a little bit. We have the company's management with us, the chairman and MD, Mr. Vivek Kumar Devangan, joining in for a couple of questions. So that question first, I mean, this loan growth, the market's expectation is slightly higher because you've been guiding for higher numbers. What is the outlook ahead?
Our loan book has grown by 14% in Q3. Now it stands at 5,65,000 crore as compared to 31st December 2023 level, that was 4,97,000 crore. This quarter, actually, some prepayment and had happened and some recovery happened. But you might have noticed that our disbursement was the highest ever. We disbursed about 54,692 crore in Q3. We hope that in Q4 our disbursement will increase substantially and or will be able to achieve growth of loan to about 15 to 17% in Q4.
All right, so let's focus on the non-power vertical. Which segment do you see growth out there? You were exploring opportunities in the international transmission projects as well. Give us some thoughts out there.
Actually, our growth is coming basically from traditional, conventional transmission, distribution and generation and renewable energy projects. Actually, our hands are full with the proposals from power sector and renewable energy sector. That's why we are going slow on non-power infrastructure logistics. We are targeting only those non-power infrastructure logistic projects where revenue cash flow is ensured, which will be able to meet our repayment obligation, where the entity is good, where the asset quality is good. So, we are a bit choosy. So far, we have sanctioned about 40,000 crore for non-power infrastructure logistics. We are targeting a road sector HAM project. We are targeting ports. We are targeting airports, where revenue cash flow should be sufficient to meet our repayment obligation. Otherwise, there's sufficient number of projects are there from conventional generation, like coal-based power plants are coming up. Now, in the budget announcement, nuclear power has also been added. 100 gigawatt capacity of nuclear power capacity has to be added by the year 2047. So there is tremendous growth opportunity available for financing renewable non-fossil fuel sources, including nuclear power plants.
No, absolutely. What's the guidance on margins and spreads going forward, sir?
Yeah, in fact, in the first 9 months, my spread has improved by 12 BPS from 2.8% to 2.94%. Net interest margin has also increased by 12 BPS. It has increased from 3.52% to 3.64%. So by the end of this financial year, we'll be able to hold on to net interest margin of about 3.65 to 3.7%, and spread would be around 2.95%.
All right, so we'll leave it on that note for this morning. Quick conversation, but thanks very much for sharing the outlook with us. We do have to take a very quick break, come back on the other side, and lots of those earnings stocks to go over. We'll have Hemang Jani joining in for some fundamental ideas.
कुछ लोगों को अब जब एआई की बात होती है, कुछ लोगों को अब ये शब्द फैशन में है तो बोला जाता है, लेकिन मेरे लिए सिंगल एआई नहीं है, डबल एआई। भारत की डबल ताकत है। एक एआई आर्टिफिशियल इंटेलिजेंस, दूसरा एआई एस्पिरेशनल इंडिया। हमने स्कूलों में 10,000 टिंकरिंग लैब्स शुरू किए और आज उन टिंकरिंग लैब से निकले बच्चे रोबोटिक्स बना करके लोगों को चकित कर रहे हैं। और इस बजट में 50,000 नए टिंकरिंग लैब्स उसका प्रावधान किया गया। भारत वो देश है जिसके इंडिया एआई मिशन को लेकर के पूरी दुनिया बहुत आशावादी।
Welcome back. Like we've been saying, there are so many stocks to discuss, lots and lots of earnings. But before we get to all the earnings reactions, there's one more stock that's in news today, and that's Zomato. Very, very soon, Zomato would be undergoing perhaps a name change. Eternal is the new brand identity that the company is going with. Now, this is at the corporate entity level. And within that, they will have 4 different lines of business. Zomato, which is food delivery, Blinkit, which is quick commerce, and then there is Hyperpure, and District, which is their outgoing or going out business. So 4 different businesses, Eternal, and they have applied now for shareholder approval. Board has approved it. If shareholders approve it, there is a name change. The stock you see on your screen will no longer be called Zomato. It will be called Eternal. Let's go across with that.
When I first heard it, I thought, is it Eternal? E-A-T.
Like eat. Eternal.
That would fit with food delivery and, but it's Eternal.
It's Eternal, yeah. I think, apparently they've been, doing this in-house for a while now. Just now they're taking it out public and complete
My
brand
only thing is,
identity change.
so much money spent on building up Zomato as a brand.
Yeah.
So, and then I don't know. I mean, I'm sure we'll get the opportunity to put some of these questions because it's an important one, right? I mean, it's a consumer brand.
It's probably the way some of the global giants have been going. Amanglam pointed out, for instance, Meta. So, I mean, the corporate entity has a different identity, and within that, it's a different lines of businesses.
Soon you could have a stock in the Nifty named Eternal.
Eternal. Wow, exactly. That's a thought, right? Okay, let's quickly go to Hemang. Now, whether it'll be an eternal wealth creator or not is the question. Hemang, morning. We are quite fired up in Friday mood, as you can figure out. Your thoughts on what will soon be called Eternal?
Morning, Sanvi. I think the name sounds quite positive. In fact, when you grows in a big way, there is always a challenge for the teams to come up with something that will create new excitement. We saw that in case of many companies. I think Twitter, when the logo was changed to X, I personally didn't like it, but that's how the companies operate. So this looks quite interesting. I think what market would want to say is that apart from the name change and the branding that goes behind it, are we really going to see any surprises in terms of growth? I think between Zomato and Swiggy, the numbers that Zomato delivered on the quick commerce were better. But I think the fact of the matter is that these companies will have to go through a bit of a margin compression cycle given the investment in dark stores. So as a theme, as a company, we do like Zomato. We think that a large part of the pain is behind us. And from a 6 to 12 months perspective, the stock can deliver decent amount of return.
All right. Zomato Springs Eternal. I like it. The title of the graphic. A trend is the other one I want to talk about, Hemang. I think it sold off sharply. Numbers and we'll have brokerage notes, etc. on it with Mangalam a little later. But what did you make of it, and what of the stock from here?
So, Prashant, the deep cut we have seen, and the numbers were not that bad. Actually, a slight miss, maybe 2-3% miss in terms of revenue. Overall, growth outlook also continues to look quite good given the new store opening, etc. So I think we have gone through a cycle where some of these fancy stocks, Dixon and Zomato and Trend and Polycab, they have gone through a bit of a compression in the P multiple for some reasons. But at the end of the day, the market would want to really go back to them once you see a little bit of stability and money coming back into the market. So I do like Trend. I do like the fact that it's corrected 30%. It might do a little bit of volatility here and there, but I don't see a significant downtick from here on.
Okay, all right. Hi, Hemang. Good morning. Good to see you. Hemang, what about the big boy ITC? Went a little bit weakish into its numbers. The numbers don't look too bad. And also, I wanted your view on ITC Hotels, if at all, because that one has seen big volumes. And post that corporate action, it seems bulk of that selling that was there seems to be getting absorbed. Your take?
Yeah, so Nigel, ITC, the cigarette volume growth 6% looks quite good. I think the FMCG business and the margin contraction was a bit of a negative. But overall, I think ITC at current levels and valuations is looking quite attractive to us. So definitely a positive view there. ITC Hotels, I think the sell-off was typically when you see the demerger and the new entity getting listed, some companies who are holding this stock, they have to necessarily exit. So I think the selling pressure was on account of that. But overall outlook on ITC Hotels at current valuations is quite positive. So positive view on both ITC and ITC Hotels.
Hey, got it. Hemang, since we're discussing all the earnings, let me round up with Bharti Airtel as well. It's been a solid quarter, right? I mean, 5.1% increase in ARPU. That's saying quite a lot. So those tariff hikes have managed to really boost things. What are your thoughts on the stock?
I think, if you see this entire earnings season, if you were to name a few companies that surprised you and that delivered good growth and outlook both, Bharti would surely be on top of that list. And we do like the fact that correlation between the ARPU increase and the EBITDA for Bharti is way better than Jio. So definitely a positive view. I do think that this will be one of the companies in 2025 that would stood out and would give much better return than the indices.
Okay, I got that, Hemang. We just had the management of REC with us. They're seeming pretty positive, at least in terms of what they think of fourth quarter and maybe just ahead into FY26 as well. Any thoughts? Stocks come off quite a bit.
RTC, I don't track it, Prashant, so not looked at the number in detail, so don't have a view over there.
Okay. Just maybe a few other things then, which have been in focus, right? The capital market plays day before yesterday had a very large sort of move higher, and the brokers, etc., AMCs, RTAs like CAMS, anything you like here?
Prashant, if you see the BSE numbers that came out yesterday, overall they were extremely good, except for the fact that there was a significant amount of SGF contribution. Again, the management said that it would be more like a one-off and you will see it stabilizing. So this is one stock where you're seeing a quarter-on-quarter growth also in cash segment, and on the options part, the interesting aspect is that premium turnover is not actually going down much vis-a-vis the overall volume downtick. So this would be one stock that we would have a positive view on, and of course we like some of the asset management companies or wealth companies. I think discount broker, like Angel One and a couple of others. We don't have so much of positive view because I think we are a bit away from seeing a bit of a stability and revival in the derivative volume given the new norms. So we would stay away from those names even though they have corrected quite a lot.
Okay, all right. I wanted to ask you about one stock that has seen a correction from the top, but the numbers look rock solid. PG Electroplast. What's the view on that one?
Outstanding performance, Nigel. I think if you look at the quarterly performance, almost 100% growth in the profit, 80% growth in the top line, and most importantly, when you look at the management con call, I think they have upgraded the guidance for next year across the segment. So I think this would be one stock that we would have a very positive view on, though it's not cheap exactly. But you will find very few companies, where you see a very strong growth on a quarterly basis, and more importantly, the management sounding so positive for the next year.
Got that. Hemang, we'll leave it there for now. Thank you very much for joining us. Lots of stuff lined up here leading up to that RBI decision. So shorter conversation than usual. You have a good weekend. We'll see you again soon. We take a break. Technical trading ideas coming up. Mitesh and Sudarshan. Srikanth is going to be with us today on Friday. So that's the conversation coming up in just a bit.
और विश्व के एआई प्लेटफॉर्म में भारत की मौजूदगी एक महत्वपूर्ण स्थान प्राप्त कर चुकी है।
This was the third consecutive year that the BMC budget was presented to an administrator and not to a standing committee. Why? Because the term of the corporators ended in March 2022 and the elections for the new term and the new corporators are yet to be held. Now the 74,427 crore rupees budget, out of this, an allocation of 43,162 crore was made for capital expenditure. 5,100 crore rupees for roads and traffic department, 5,807 crore rupees for Mumbai Coastal Road project, 3,039 crore rupees for storm water drain department and 650 crore rupees for sewage operation department. For key public services, over 4,000 crores were allotted to education department, over 7,000 crore for health department, 261 crore rupees for fire department, 309 crore rupees for disaster management and 220 crore rupees for the garden department. BMC announced that it's going to start 250 new public clinics, also known as Apla Dawakhana, all over the city. One interesting initiative announced by the BMC was the introduction of cyber awareness program for students. It will serve two key purposes. One will be to ensure that the students learn how to use the internet in a safe manner and to keep them safe from cyber fraud. BMC also focused on environment initiatives and projects like promoting eco-friendly cremation and proper disposal of residue from idle immersion. These are the projects which will take place under environmental related initiatives in the next few months. We also spoke to Bhushan Gagrani, the BMC commissioner himself. This was the first time that he presented the BMC budget. Listen to what from when this new tax will be levied.
It is actually not a new tax. In fact, we are enhancing our assessment net. Under the assessment net, the properties which are in the slum, however, which are being used for the purpose of commercial, they were not covered. So this is for the first time we are doing the survey and bringing them in the tax net. Not necessarily that we will be imposing huge tax. It's a normal tax. It's not a very huge tax. However, the coverage will be given to or commercial properties.
So BMC has not introduced any new project this time. In fact, you have focused. Correct. Yeah. But sir, does it mean that is there any cause for fiscal concern, sir?
Sure.
Welcome back. Today is going to be a little bit of a tricky session because the first couple of hours belong to the RBI and then we chart our course from there on. But Mitesh as well as Srikanth join us this Friday morning. Good morning, gentlemen. Hope you're having a good Friday morning and an even better Friday evening. For the time being, Mitesh, you go first. Tell us, what about the Nifty? Yesterday, we had a consolidation day, so to call it. We came off the lows of the day. But what do you think? The uptrend is still intact?
Morning, Nigel. So, I've been maintaining a positive stance, and yesterday was another day which looked like a pullback kind of a day. There is an impending event, and the structure is positive. So my bias is still positive, but I would, want to be slightly more flexible given that the event could bring some kind of volatility. So watch out for levels of 23,520. That's the first support pivot, but the bigger support comes in at 23,400, and I don't expect that to be broken. So even if there's something negative, the market finds, a bit more decline in profit booking. I think 23,400 is likely to hold. And from
Nigel and everyone. Well, I feel that till the markets are not closing below the levels of 23,500, we could see upward activity in the market. And the overall trend will get disturbed if it breaks the levels of 23,200. So in case if we see the market is closing below the levels of, or let's say sustaining below the levels of 23,500, then we could see furthermore retracement on the downward side. But otherwise, the overall pattern is suggesting us that the Nifty is heading for the levels of 24,000 or 24,200. So today I'm expecting rebound after hitting maybe 23,500 or 450 on the downside.
Okay, so 24,000 perhaps on the horizon. Playing long. Got it. Gentlemen, morning to both of you. Let's get to individual stock names and ideas as well. Shrikant, what would you go with?
Good morning, Sarvi. Yeah, I would like to go with few NBFCs. There, the overall trend is showing a lot of strength. In that, we like Shriram Finance, which is around 560, 565. There, I'm expecting furthermore upward activity towards the levels of 600. It's a buy at current levels with a stop loss at 554. And the other stock which we like is Bajaj Finance. And there also we feel that it is consolidating, but otherwise 8,400 should be the final stop loss for creating any long position. And we can expect on the higher side 87, 87.50.
It's a breakout, right, Shrikant, with Bajaj Finance? I mean, after 3 years.
Yeah, absolutely. Like it has spent a lot of time below the levels of 8,000, 8,100. Since 2021, and after specific news flow, I'm going to say positive news flow, the stock has broken the resistance level, which is something technically very, very positive for the stock.
Okay, all right. So that's on Bajaj Finance. Mitesh, morning. Let's get to your stock picks as well, and maybe if you can just throw in a line on Trent as well. Huge dropping on the index yesterday. If there's any advice on that one.
Yeah. So on the stock side, after a long time, I have a mix of buys and sells, equal buys to equal sells. The market has been good, but yesterday some of the stock structures I didn't like, so I've got some sell ideas as well. And Trent is one of the recommendations, so I'll come to that. On the buying side is PI Industries. Keep a stop at 36.10. Look for targets of 3,700. SBI Cards, which we've been very positive, has given a 2-3 day kind of a pullback. Now at support levels. Good levels to enter a flush with a stop at 799 for a target of 835. HUL is a sell with a stop at 2400 for targets of 2320, and Trent on a mild pullback around 5300 to about 5315. Sell with a stop at 5400 for a target of 5100.
All right, well, more with both of you gentlemen, but good getting those trades and that view out of the way. There's 4 minutes to market pre-open. We're going to take a quick commercial break here, come back. We'll also have the management of Sonata Software to talk about their third quarter earnings. Stay tuned.
Fiscal constraint, we have enough adequate cash flow as well as resources.
Make informed decisions with comprehensive analysis on the go.
Strengthen your portfolio with real-time market updates on the go. Create effective strategies with insightful expert opinions on the go.
Grow on the go with CNBC-TV18, now streaming live 24/7 on YouTube. How about listening to global market maestros before crafting your investment strategy? How about getting deep insights into their businesses from top Indian honchos before putting your money on the line? How about making every trading day profitable with strategies from the market masters, macro pundits and chart wizards? Only one show gives you a head start to your trading day. Get ready to profit. Get ready for business with Bajar at these times on CNBC-TV18 and CNBC-TV18.com.
What does it take to build India's largest startup platform? It takes a journey of starting out as an unknown and ending up as unforgettable. It takes more than 2 decades of celebrating the most influential and influencing the most celebrated entrepreneurs. From chronicling the stories of India's startup universe to becoming a success story in itself. as India's longest-running show on startups and entrepreneurship. Celebrating 21 action-packed years of building India's biggest startup community. Young Turks at 21. Only on CNBC-TV18 and CNBC-TV18.com. CNBC-TV18's most comprehensive and award-winning news show, India Business Hour, drops first on YouTube. So get the first access to the most influential architects of policies and politics, the key newsmakers of the day. Discover the big themes as we decode the business of markets, macros and more. Be the first to go to the heart of all the top stories that drive the day's agenda. Catch the award-winning India Business Hour live every night on YouTube with me, Shireen Bhan.
India Business Hour live on YouTube at CNBC-TV18 weeknights at 7 p.m.
Well, the pre-opened rates are trickling in, but in that time, let's get in another management. Sonata Software reported a good performance in Q3. Healthy constant currency revenue growth. We're now joined by Samir Dheer, the MD of the company, to help us out with the past quarter's numbers and how is he seeing things shape up from here on. Hi, Mr. Dheer. Thanks a lot for joining in. Well, Q3 was good for you. Will the momentum continue in Q4? And also, what are the early indications you're looking at with regard to FY26?
Let me give a broad-based commentary as to how we're seeing the market. Clearly, we're very excited about the growth we're seeing in the banking, financial services and healthcare sectors. I think both the sectors have done quite well for us. And that's probably the reason that we have grown 4.4% Q-on-Q in constant currency terms. So very excited about that. But while we are very excited about the growth in banking and healthcare sector, we have seen flattish to slightly up growth in our retail and manufacturing sector. And TMT has been in the decline for us during the course of the quarter, specifically due to the largest high-tech customers that we have. We saw some unplanned ramp down in that sector, in that customer during late November, early December timeframe. So as a result, while the Q3 quarter has been good, we expect a Q4 quarter to be a sequential decline quarter. We're expecting between 2.5% to 3.5% sequential decline quarter coming up, only because of one single large customer decline. But if you back that one customer out, I think the growth in the other part of the business is pretty robust. We think we'll continue to gain market share in both the banking and healthcare sector overall.
Okay, got that. Now, X of the client ramp down in high tech, will Q4 see positive growth?
So for this client, I think we'll definitely see the impact in Q4. Maybe it might trickle into Q1, hard to predict right now. And in Q4, we also have the seasonal impact of Quant, because seasonally for Quant, the acquisition we made 2 years back, it's a weak quarter for them. But if you back the Quant out, as well as the one single large account, I think we'll have a pretty much a robust growth. Don't have the numbers right now, but we'll still be in the 3 to 4% for the rest of the business. So I think the rest of the business is doing quite well. It's just an isolated event that we are a bit hit by in this quarter and next, and maybe in the first part of Q1.
All right, Mr. Dheer, I need to push you a little bit. Do you think that FY26 will be better than FY25?
Overall, the markets continues to be a little choppy right now. I think the uncertainty, specifically with the regime change in US, I think is very much upon us. But we do expect industry trends. We think we will continue to do well in banking. We expect to continue to do well in healthcare. We think retail might bounce back in the second half of next year, definitely not in the first half. Our high-tech customer in general will bounce back in probably in Q1, Q2 timeframe. So overall, pretty optimistic about how the year is coming up. But we'll have to continue to watch the space, because the commentary from our customers by industry is changing almost in a quarterly basis right now. So it's very hard to predict where the year will land, but overall remain very optimistic and positive about the growth in the coming year.
All right, Samir, your international EBITDA margins have dropped quite sharply. Wage hike impact is, of course, one of the reasons. But is there anything else? And what about recovery? Will you see a recovery in Q4 itself? or will this drag continue in the coming quarter as well?
Our EBITDA has declined by 3.6%. Roughly about 70 to 80 bips is coming from the salary increase, and close to about 3% or maybe 2.5 to 3% is coming from this one-time ramp down that we had in this large client, because the ramp down happened in an on-site location. So we had to take the cost of the people as well as have the severance impact in the course of the quarter. But that will recover fully back. The impact because of the large client will recover fully back in next quarter. So we're actually quite happy about the recovery back. Of course, the impact of 70, 80 bips because of the salary will take 1 or 2 more quarters to recover fully back. So overall, from an EBITDA perspective, we're quite optimistic about what will happen in Q4.
All right, Samir, what about the cash in your books? I think it's around 670 crores. So what do you do with that? And how was the domestic business as well?
We will do acquisition for the right reason. We'll continue to look for properties. We are a growing company. In the last 3 years, you've probably seen our growth trajectory has gone quite well. We'll probably do it for the right reasons. Are we looking for an acquisition? Yes, we always look for an acquisition. But is there anything which is bubbling up in the near future? Probably not. I think we might take our own time to get to the right property. But as a good corporate governance and good corporate development framework, we keep evaluating companies that might be of interest to us. But right now, there is no active conversation which is maturing. So we'll wait for the right property to come around, and then we'll not be shy of taking that decision at that point in time. To your second part of your question on the domestic business, we were very, very happy with the progress that we made in the domestic business in the most recent quarter. We grew sequentially our gross contribution. We measured gross contribution for that business. It grew quarter on quarter about 16%. It was a seasonally strong quarter. So it had a one-time impact that we saw, and Q4 is generally a seasonally weak quarter. But we're very happy that we could grow quarter on quarter sequentially 16+% in that business. So very, very good momentum in that business. We remain optimistic about that business overall.
Samir, you have stated your ambition to reach $1.5 billion in revenue by FY27. Now, given the expected softness in the fourth quarter or the general slowdown in spending that we've seen last year, is that ambition getting, well, slightly shifted?
I think we have always maintained that we will hit the run rate. We aspire to hit the run rate by the last quarter of that fiscal year. It might be 1 or 2 quarters off given the current issues that we are seeing. But I think we, by and large, directionally want to get there in a plus minus 1 or 2 quarter time window, Rima. We are very much bullish about it. For the long-term prospect of where Sonata can be, we're absolutely running towards that. And the 1 or 2 quarters loss that we're just seeing right now because of this large client, hopefully we'll recover it. Otherwise, we might have a 1 or 2 quarter delay towards that overall vision that we have set for ourselves.
All right, Mr. Dhir, thanks a lot for joining in and giving us all those details. For the time being, the stock is down a little bit. Quarter 3 was good. I think now it's more or less flattish. In pre-open, I think it was all over the place. But quarter 4 could be a little bit softish. And in quarter 3, we did see some margin compression. Let's move on. Let's get in Dheeraj Agarwal, the Managing Director at Ambit Investment Managers, who joins us on the show. Hi, Dheeraj. Good morning and good to see you win. How are you feeling about the market? Well, the stock markets, the economy was calling out for attention. Budget 2025 seems to have provided that, and now hopefully the RBI as well eases liquidity. How are you feeling about the market and anything that you're betting on for as a sector for 2025?
So I mean, my view is that what the budget has done is fantastic, and hopefully RBI will also be pro-growth at this point of time. But I doubt if it will take away from the fact that we are looking at potentially a very tough year for equities. Largely because while these measures are necessary, they're not sufficient at this point of time to take the earnings growth for equities back to 13, 14, 15% range, which is where a small trajectory or upward trajectory restarts. So my base case view is that the 12% consensus earnings forecast for FY26, there will be disappointments on that despite all solid and brave attempts coming in from regulators and the government. And hence, this year is going to be a tough market, high degree of polarization. So basically, remember what happened in either 17 to 19 period or 2010 to 13 period, where a very narrow bunch of stocks tend to outperform or perform reasonably well, and bulk of the market will have to go through a little bit of a stress.
Dheeraj, the Gen Z that entered the market post-COVID doesn't know what you're talking about. Which are these periods? Does this even happen? So, well, if your forecast comes true, then it's going to be a learning lesson, I think, for a lot of the newer investors who got used to superlative returns after COVID, one-way returns. So take that point. Just allow us 1 minute. I'll quickly run through some of the important earnings reactions that have come through. The pre-open is there. And Hero Moto is a stock that's reacting the best. It's about 2% higher. Bharti is up 1% on very good numbers. ITC is absolutely flat. So these are large Nifty reactions that are playing out. Bharti is actually flipped. Okay, on my screen it was up about 1%. We'll just refresh that rate. Hero is up about 2% for the time being. Dheeraj, so if we are going to be in the kind of market that you described, it's going to be challenging. So where will you look to for whatever little wealth creation, even if it's, like you said, even it's single digits? I don't know if that's the kind of return you're expecting from the market, but what will the strategy be?
The strategy is to look for companies which can deliver earnings growth superior to Nifty. So let's say if the base case for Nifty earnings growth is about 10%, then look for companies which can deliver predictable or safe earnings growth of at least 13, 14, 15% range, and not trading at obnoxious valuations. So that becomes a little tricky because there are a bunch of companies still capable of generating 20% plus, 25% plus kind of earnings growth this year. But the valuations have no room at this point of time for the stocks to appreciate. And my view is that you will see a huge amount of dispersion even within a sector. So not necessarily that one will be able to identify one or two sectoral themes which can do well in this kind of a market environment. But even within a sector, companies which are trading at reasonable valuations with mid-teens or early teens kind of earnings growth can deliver reasonable upside. And the companies struggling for earnings growth or the valuations are obnoxious or very high can actually see a downside this year. So this year will be a test of stock pickers' capabilities. This year will be a test for one's capabilities to accurately forecast the earnings. Because as we have seen in this earnings season and the previous one, every single miss is being harshly punished by the market.
Dheeraj, what about the sector that used to get very high multiples, and then in fact, in comparison to their 5-year averages, it's come down? I'm talking about the consumption, the FMCG pack. Now you have more money in the hands of a lot of Indians, so that's why that sector initially did see a bit of a bounce up. But it's still far from those growth rates that we have seen in the past. Will you advise rejigging the portfolio more towards consumption?
At least I won't. My view is that the tax cuts will probably limit incremental downside from here, but there is still downside. So, I'm just going back to the statement that companies need to deliver earnings growth superior to Nifty's to be able to perform in this kind of an environment. Now, let's take consumption as an example in the previous cycle. So between 2015 to 20, or more importantly, between 18 to 20, when we saw a similar market with high degree of polarization and a very tough market, consumption sector was growing earnings between 13% to 20%. I'm not talking about outliers like Titan or Trent, but in general, 13% to 20%. But the Nifty earnings growth was more like 6 to 7. So they were growing at double the pace of Nifty. And predictably so. It was not that difficult to say Unilever or a Nestle or an Asian Paints will grow earnings at least in the teens next year. That theory is now being challenged, right? For the first time in certainly a decade, and for many companies for the first time perhaps ever, we're actually seeing earnings decline in many of the consumption names. Asian Paints has seen 2 or 3 consecutive quarters of earnings decline. And while the valuations have reverted back to 5-year mean, it sort of means nothing because we have never seen such a high degree of earnings unpredictability for consumption sectors. More important than the decline, one is no longer sure. Next year will be 5% or 10% or minus 5 again.
Dheeraj, I know, absolutely point taken. I'm sorry to interrupt. We're just running into market open, Dheeraj. And short a conversation today. Thank you very much for joining us with that perspective today. Well, what we're going to do is look at Britannia once again because the numbers came yesterday. Mangalam is back with us. Mangalam, Take it away.
Well, Dheeraj was talking about how there was, weakness in the consumer sector, etc. Not for Britannia. It's one of those rarities where there has been a solid beat across all parameters. Revenue closer to 4,600 crore. The street was working with a number of 4,500 crores, and the net profit coming in at 582 crore versus street expectations of 534 crores itself. Domestic volume growth coming in at 6.5%, much above street expectations of 4.5% as well. In a weak consumer environment, some of their products are doing well, and in their geographies too. So the focus states in which the company is looking to expand their market share and accelerate growth, that has actually grown nearly 2.5 times the average of the company. And their adjacencies, dairy, drinks, croissants, wafers, all of them have witnessed double-digit growth. So expect the stock to see some green today. The only thing that we'll have to keep an eye out on is the employee costs, which have halved both quarter-on-quarter and year-on-year, whether that's sustainable or what explains that.
Okay, all right, Mangalam, thanks very much. I just want to put one stock on the radar as we hit open. Look at Sonata Software.
Yeah.
You just heard the management, and that pain in one client is going to continue in Q4 and maybe in Q1 as well. 14% down.
And I will just look at the stock as it comes up on our screens. One of the first to come up. We've got the market open, the basic indices coming up on your screens. What do we have? I think it's Nifty 23,652. We've got the Sensex, which is starting at 78,240. That's about 0.25% higher. So actually, it's a decent start this morning. But, in about an hour's time, we'll hear from the RBI. We won't hear from we actually will hear from the RBI as well. There'll be the decision, and then, of course, the governor will read out that prepared statement. And, of course, Q&A later. So, in that sense, the session is interrupted by an important event. Bank Nifty is up about 60 points. That's about 0.12% higher. The IT index is starting about 0.25% lower. But all told, I mean, it's a flattish start, and why not with that RBI bang in the middle of trade. I think it's all about stocks, and I think Sonata we should look at straight up. Surabhi.
Absolutely, it's down 13.5% because the pain that we've seen in Q3 that could extend, the margin pressure could also extend in the fourth quarter. So, and there's PG Electroplast on the other side. We called out the stock right at the start when we were chatting about the Qs today. One of the best reactions that we've seen on earnings, very solid numbers. So PG is up, Sonata is down. On the Nifty, let's go through the earnings reactions as well. Bharti Airtel's numbers are being very well received and a very solid performance by the company in Q3, 2.5% up. Britannia is also getting a thumbs up from the market, about 1% up there. Hero Moto was a steady showing, so about 1% up there as well. Pull up ITC. ITC is muddling along, just like the numbers, because the performance was mixed. So is the stock price this morning. Let's look at what's happening to Trent after yesterday's major drubbing. It's trying to find some stability. 0.5% of a gain on Trent, at least at this point in time. Now that the earnings reactions are out of the way, just a quick look beyond Shriram Finance, Ultratech Cement, M&M, Apollo Hospitals, and Tata Steel. These are some of the stocks on the way up. On the way down, there's Lever, there's Reliance, there's SBI, very, very flat trends, TCS, Titan, Wipro. So it's very mixed on the Nifty with no clear directional, sectoral bias at least.
Well, that's right. Surabhi, and just a few more stocks to bring to your attention. Sonata was one that you pointed out. Bikaji is down close to around 10%. So big down move is what we're seeing on that one. NCC is another one that's taken a hard knock, in just the first couple of minutes. And the volumes are very, very large. So just keep an eye on that. Avalon Tech, the numbers look quite good. Well, that stock yesterday was up close to around 5%. Today, it's building onto the gains a little bit because yesterday it went into that circuit. KPIK Green, another good set of numbers. What we saw, the stock had half from the top. That one is bouncing back in today's trading session. Sagility, another stock that's up close to around 4.5% and volumes rather large on that one. And Invero Infra as well, that one as well, mildly higher in today's trading session. So it's a flattish start to trade. We started off with the green, but now we're more or less flattish. I think the markets will wait for a cue from the RBI governor and then chart their course from there on. Remember, big cues coming up. RBI governor, you have the jobs report later this evening, and then over the weekend, you have the Delhi state election results. So plenty of cues in the next 48 hours.
Absolutely. And let's just look at the market open on your screens now. So absolutely nothing on it. 15 points lower is what we have. I think we've mentioned the big volume-led moves. NCC, Power Grid, PI Industries, Sonata. That's about it. Maybe you can throw in a Manappuram there as well, which is down about 2%. Bikaji, I don't know if you guys mentioned, Bikaji is down 10%.
Yes.
659 on Bikaji. So that's a smackdown. GAIL, Cochin Shipyard, ONGC. These are all sort of oil and gas PSU names. They're all down 4%. I'm not sure if there's anything. BEML is down about 3% as well. But BEML reported numbers recently. Not very much by way of volumes here. but they are down 3-4%, which is unusual, right at the word go. So just mentioning that here. And of course, I mean, there is stuff coming up, newer stuff coming up on the upside as well. Sagility is something which is up about 4%. And solar industries, big orders last couple of days, 2% higher. And so on and so forth. Well, let's get into our next discussion here, and it's all markets. We have Stephanie Holzen, Chief Investment Officer, Asia Pacific Private Bank at Deutsche Bank. We have Mayank Khemka, Chief Investment Officer, India, and Head of Discretionary Portfolio Management at Deutsche Bank here in our studios. Thanks very much, Stephanie and Mayank, for being here. Appreciate your time very much. So let's just start with the global stuff, which I think is the bigger overlay, macro overlay in that sense. And I think the general kind of consensus expectation is that markets have done very well, especially the US and India. Both markets have done, they've been some of the best performing indices amongst large markets over the last few years. We in India have got a bit of a cyclical, seasonal slowdown. US is chugging along very nicely, 3% growth. President Trump is saying America first. So they're trying to juice up the economy and things should look good. So why should money go anywhere but the US? That's the broader thesis that you kind of begin with when you speak with, and that's a consensus view. Would you disagree? And what are your thoughts?
It is a very challenging backdrop, as you just explained, and especially for here in the region. Every region that does not have a sufficient interest rate gap that is positive to the US will suffer even more. Like India is not part of that right now. So from that angle, this should not be the kind of backflip for not investing in India at all. India has been a very important investment call for us. From last year, we carry this forward into this year. But I have to admit, US and equities in particular remains the first port of call for us. You
mentioned interest rate differentials, but in the US, there is a very concerted effort to bring down, the size of the government, cut spending by about trillions of dollars, basically. We'll see what happens.
Yes.
And I think last night the Treasury Secretary in the US said that his focus is the 10-year, and he wants it lower, and it'll happen. So, I mean, that the interest rate differential how much will that matter if they are successful in any of that?
Well, and that again, there's a problem in the US right now because they also want to put out more spending, right? And that will be something that will have, and the tariffs, of course, that will be very inflationary. It will result in a higher budget and so on and so forth. So the market is already playing this playbook that we will have a higher inflation situation, a higher for longer interest rate situation. So of course, ideally you want to, if you have a debt to that extent, you want to take interest rates down, but you're likewise in that dilemma. This is why they're also trying to trade very carefully and working on all sides to make this happen.
You think market interest rates in the US will head higher, Stephanie?
No, we think that the US is very much in a position to be able to cut. But we have always been on the position that it's not cutting as much as the market projected in the past. Now we're coming to a very quickly repricing. Every day is a new day. On this one, the market is even talking about no cuts. Some are even talking about a hike now. We think we will see 1 or 2 cuts for this year.
Stephanie, since we're talking about central banks and rates, we have to talk about India as well. And that kind of brings me to a bigger question on India. This whole FPI selling, foreigners have been selling that like there's no tomorrow. Well, yes. A lot of that would be perhaps because of the fact that the US market is doing very well. I want to understand from your perspective, how much is it linked to the India slowdown? And do those concerns at least start getting addressed with what we've seen in the budget and maybe with the rate cut that we get from the RBI today?
Yeah, so the investments from overseas investors into India have been very strong, and as you point out, they've been slowing down. Part of the story has been the slowdown that was seen on the growth side. Another part has been the very big efforts that China is undertaking to make sure their equities market is looking better. So I think we have also seen a bit of a rotation trade going on, but that is not necessarily coming from a macroeconomic concerns backdrop. That's also coming from a valuations concern, because you have been able to ride this wave and then you come to a point where valuations were not as attractive. But then you look at what else you can rotate into the region, and then Japan looked more interesting, and also China is looking more interesting at this point in time. So I think that's a challenge we will have for the time being, and will always be a discussion. But again, once we have a better valuation, and to your point, we're now getting also the growth backdrop addressed with the fiscal policy, maybe with the monetary policy today, then this will be good reasons to go in at better levels.
Okay, all right. Hi, Stephanie and Mayank. Thanks a lot for coming down to the studio. Mayank, let me come across to you then. You know, we have earnings that were looking very, very good till lately in the Indian markets. That slowed down a little bit. economy is a little bit softish, and the FIs, they've been selling lock, stock and barrel. We haven't seen selling like this over the last 4 months or so. It's the most severe selling that we've seen. Do you think at current reckoning, with the problems being addressed both in the budget and hopefully the RBI eases some liquidity, do you expect the FIs to gradually start coming back into India?
So just to carry on the global narrative, I think if you plot the US 10-year and then you plot the emerging market indices or the Indian index, it's pretty much a very, very high negative correlation. Okay. They almost mirror each other. And whenever you see the US 10-year go above, let's say a 4.3, 4.4, that's pretty much an inflection point for money to sort of go into the US bonds.
Yes.
And I think from September, when we hit 3.6, and then now we went back up to 4.8 on the 10-year.
Yes.
You've seen this massive flow that's gone into the US, which is why the dollar is so strong as well.
Indeed.
And I think that's a very large reason why you've seen such massive FII selling, because they were really not positioned for this sort of a rise.
Yes.
And therefore, if you're getting 4.5 risk-free rate globally, you sort of go and take your money out of emerging markets. India, of course, bore the brunt of it because valuations were higher than many others.
Indeed.
But this really was sort of the playbook that happened. Going ahead, I think it largely depends on their own domestic markets, their own domiciles, as to what other opportunities they have.
Indeed.
Rather than whether really earnings recovers or not. We're not talking over here that we'll grow 20% from here. We'll probably, if we do well, we'll be double-digit earnings growth.
Indeed.
And therefore, valuations probably come down on the large cap side, but I think the mid and small still remain very, very expensive.
So, Mayank, to just press on that point, interest rate differentials beyond our control, if another market is doing better or has better valuations beyond our control, the only controllable for us is addressing the growth slowdown, right? So can you expand on that point on earnings growth, the realistic level to have? I think FY26, a lot of people are still talking 12, 13%. A, do you think that will be delivered? And B, if yes, then what are we talking about in terms of a market recovery?
So if you look at the macro backdrop, I think earnings growth is probably going to be delivered because we've seen the government act on policy in tandem. The fiscal policy we saw was very, very non-inflationary, and they've continued with all the capex, they've continued with all of that with tax cuts, etc. And monetary policy, it's not just about today, but if you look at the past month or so, RBI has come up with a lot of OMOs, VRRs, and liquidity into the system. So both monetary and fiscal policies were very tight, which have been already loosened up by the government. Capex spending is coming back. We are seeing lesser cash balances of the government with the RBI, which means that they're spending more. So all of this obviously has a lag effect, but over the next 2 quarters, the earnings growth should come back.
12-13% maybe can be delivered. Yeah. Mayank, because we'll hear from the RBI governor today, how much can they really go out and ease? Because there is a currency as well, right, which has been depreciating. And if you do too much, you risk the currency falling faster. It's adjusted from 84-ish kind of levels where they were trying to hold it. It's come off now. And many say, well, it's much better adjusted to the changed environment globally. But what's your sense?
So the currency is already, I think, down 3% from what it was in October. And that could be a precursor. But I think the imponderables on the global side still are very, very high. You are still at risk of tariffs. You're still at inflationary risk from a lot of actions that could happen globally. And the RBI just might want to be a little circumspect before,
doing too much.
Yeah.
Stephanie, you have a view on gold. I wanted to get that before we run out of time.
Yes.
And that's something which is done so well.
It's been a very strong call next to the positive India call. We've been carrying on the positive gold call from the beginning of last year already, when everybody was still shaking their heads.
So where is it headed? We're at just under 3,000?
I think we have to revise up our forecast as well, because the gold story is very much intact. So there's actually a few very important drivers, and I think it's more or less also an Asia story. So of course you have the central bank kind of diversification. The Chinese have just started to come back meaningfully, even despite the higher prices, and restart the buying. So it's a strategic asset you want to hold from a central bank perspective. But I think one of the big drivers also has been and continues to be the Chinese retail investor. And I think that's in the kind of narrative of you have a situation where you're looking for store of value, and the property market is still in a stabilizing phase. Stock market is undergoing a stabilization phase right now, but your currency is still under pressure because there's this notion of tariffs coming, and the way you offset it is by lowering your currency. So gold will continue to be a very big investment vehicle, and as long as this continues to be the place, then we need to carry on with our
Where is it headed,
goal.
though? You could give us a level on that. We're at around $2,850, and no one would have ever thought that. But
yes,
how much higher do you think we hit from here?
So our forecast was just hit around the 2,800, but I think the 3,000 is most probably more realistic.
Indians are big buyers of gold as well, big importers.
Exactly, it's an Asia story.
And I think if you look at a gold price chart and look at the dollar rupee, it's actually almost exactly positively over a long period of time. It's positively correlated because we're so big importers.
Yes.
So yeah, but we're also big holders.
Just since we're talking commodities and you mentioned gold, just want to round off with if you've been able to model, and this would be hard, what all this tariff talk and the Trump administration's policies are going to mean for commodities in general. Drill, baby, drill. Does it mean that we start penciling in maybe oil at 70 or maybe lower? Have you been able to sort of decipher what that could mean for other materials, commodities, other metals? Though it's a moving target, right? We wake up to new headlines every day, so not easy, I'm sure.
Thanks for the prompt. I think on the commodities front, it's especially interesting. I just want to highlight two things. On the oil side, I think we know what the objective is of the US, because that's one way of keeping inflation down, if you're able to suppress the price, and there's different ways of doing it. We don't think we can yet talk about much lower prices unless we understand more to the picture. But what I find extremely interesting right now is on the rest of the commodities complex. You have a situation where, especially when you want to bring more of your production onshore, you will have to rely a lot on commodities. And we've been seeing how the commodities complex is also something that has been used in retaliation of tariffs right now. And there is a big import dependency from the US if you want to bring some of the production onshore. But a lot of these commodities are actually in the hand of Asian countries, especially the BRICS Plus. They have been enlarging, and if you look at graphite, nickel, not just what was been used to retaliate, like ammonium, gallium, etc. These are very much supplied to the tune of 70–80% out of these countries. So I think there's an underlying ability to kind of control the supply. At the same time, demand will stay high. So the commodities complex, even in a slower growth environment overall in the world, will be very well supported.
Absolutely.
Okay. That makes sense.
All right. And Mayank, thank you very much, both of you, for joining us. And do come more often. We enjoyed the chat. I hope you did too. And I hope our audiences did as well. I think the market, just to take a quick look, is it's like a traffic light. 5 points down. Nothing. Green, red, 23,600 is where the Nifty is at this point. But we've got our earnings treadmill on. Thermax in focus.
Well, that's right. Let's get straight to the next company on our radar. We are looking at Thermax, and that one reported a subdued order intake in Q3. But as we know, the economy is a little bit softish, and things should recover from here on. To understand what's going on ground, we have Ashish Bhandari, the MD and CEO of the company. Hi, Mr. Bhandari. Good morning, and thanks a lot for joining in. Well, tell us, order inflow was a little bit softish in the past quarter, but the hope is that things have recovered. Are you seeing signs of a recovery? And could you tell us from which particular segments are you seeing demand come back?
Good morning, and thank you for having me on the show. I'll take first a look at the quarter that went by, and then I'll talk about Q4, if that's okay. We had a weak Q3. You can see that from the numbers very clearly, and the quarter overall was below our expectations. That said, I think we are in line for a very good Q4, and would request that we look at the performance over the half as a whole. And I've got 3 reasons why I have this confidence. First, on the revenue side, we had a miss of 500 plus crores on revenue, with more than 60 crores of profitability sitting out there, which in the last 2 weeks of the last quarter, we were not able to ship out. Small reasons, but a very good January to back that we could have delivered that, realized that profitability, and build it up towards a good Q4. Second, there are 2 portions of our projects business that have been going through difficulty, and both of them have gone through their worst portions in this last quarter. The first was FGD projects, where our worst FGD project is now finishing completion. And second was this whole space of bio-CNG, which is a growth area for Thermax, where relative to what we thought getting into the market, fixing a lot of the design challenges, etc., that we went through, took a lot of money. We have invested more than 100 crores beyond what we had expected in this segment. And we are now finally reaching some point where we have some clarity of what that end looks like. On the orders side, it was soft. The good part of the orders book was that the place which is relatively profitable for us, which is our industrial products division, there our numbers grew by 40%. It is on the project side, which is where our profitability is low, and we are looking for profitable orders to come in,
right,
where we had practically very little. And that I expect to get fixed in Q4 and beyond.
Okay, all right, Mr. Bhandari, got that. By the way, we just had some visuals there. The RBI governor was walking in. We're about less than half an hour away from getting the policy announcement now. So, Mr. Bhandari, you do sound fairly confident of seeing a revival perhaps in Q4 itself. Could you tell us in terms of an exit, FY25 exit level for the order book, where could you be in light of the fact of what the government has said, I mean, what the budget has done in terms of capex, because there's been some chatter around how they're not going slow, but maybe it'll be different segments. In your earlier conference call, in the Q2 call, you mentioned that you want to stay away from certain large, complex government projects. So just tell us, where will you be in terms of the order book, end of the year, and what role will government projects play in it?
Sure. I think I won't take an estimate on the orders situation this early. We've got still 2 months to go. And the reason I won't do it is because on the large project side, we have a very good pipeline now. The win rates remain to be seen. Yeah, so it's best to just wait the quarter. But I do expect we will do more than zero. Even in January, we have closed one order, which is more than 200 crores. We've got one more, which is likely. So I expect a very good Q4 in that sense. We have stepped away from government projects. Yeah, government projects that are long duration, significant amount of civil and construction. We have seen that we have lost money on many of those projects. So now, whatever projects we will choose, we want to get into a place where the assurance of making money is somewhat there. We don't mind doing government projects, especially central government projects, but we won't bid them at the pricing that we have done in the past. Yeah, and a lot of the pain that we are going through on the project side is driven by that portion of the business. That said, we get a lot of business from second-order government projects, like government investing in ethanol through the marketing companies that it has. Yes. We get a lot of business from the ethanol segment, sugar, distillery. So we get second-order business from a variety of different segments. The first one may not.
Yeah, basically not dealing directly with the government, but maybe the government gives a contract and then sort of, that entity then gives an order on to Thermax. But you're the second company today, Ashish. Good morning, Prashant here, telling us that you'll be choosy. REC was with us, but then they said something similar in the same context on the infrastructure project financing side, that they're going to be very choosy. But as one, of course, is, the issue of payments and things like that. The other is, of course, just the flow of government contracts coming off. And that's the broad expectation, and that's a debate which continues after the budget which has happened. And I think it's, if rate of change is, incremental rate of change is what matters to the market, then it is clear that it is coming off. The focus is a little bit more on consumption. Will private sector capex make up for everything? As you were saying, you focus on private sector, or you think the pipeline itself is going to thin out a little bit? Go on.
See, the private capex is where I think the biggest question will be. It did slow down. I think we have had a much better January. We see a reasonable interest across segments. Our pipeline of quotations and order activity overall is nice. It's picked up. But you need to see this over a much longer run to come back and say, look, we have turned a corner. Overall, the fundamentals, I think, of the industry are still strong. And this is macro, I would say, multiple sectors where there is cash out there available. Overall debt is low. Demand is reasonably healthy, I would say. I think, but we need to see private capex coming. Yeah, more than government capex.
Has the rate of change turned slightly slower? That's the question.
I would say it has actually lately, January, beginning of February, slightly gotten better.
But
it was low in Q4 post Diwali, which is typically a very busy period. A lot of handshakes, but not enough closures. Some of the misses that we had in revenue were also related to people not picking up equipment that was ready and at the factories, and people not picking those up.
That's really important, and thank you for clarifying and sharing that, Mr. Bhandari. So, what gives you the optimism that this will improve, and when does it improve? In Q4, in Q1, and if you could give us some sense, while I know you can't give us an absolute number, in terms of growing the order book, I mean, what sort of a CAGR would be a reasonable expectation for FY26?
For FY26, we are going in bullish. Yeah, teens level of growth is what we are planning, mid to potentially even higher teens on the order book side. And this is on the basis of a pipeline that we see, but also a lot of new things that we have been working on which we haven't really pulled the trigger this year. But next year, with more confidence, we can do. We have got areas of the industry, including petrochemical, where we got 0 orders this year. We expect more activity. Steel also, which we've been calling out for a while, we expect to see more activity next year. And even Q4, I'm not waiting till next year. I expect a much better Q4. And when I talked about people not picking up the orders and the revenue miss, a good chunk of it we were able to clear in January itself. What we need to do better now, because the backlog is still reasonably good, is to be able to understand which customers will be picking up and which won't be much earlier in the quarter, and to be able to manage our quarter accordingly, which is what we will be doing now.
All right, Mr. Bhandari, before we let you go, double-digit growth is what you're guiding for FY26. What about the margin outlook? It was a little bit, it's been in that vicinity of around 8% or thereabouts. Could you tell us what is it likely to be?
Improvement there as well. I would say that this is also a period where we are investing heavily. Yeah, a lot of the areas, including hydrogen, building up our services capability.
Okay. So it'll improve from here?
R&D. But net, grow margins, grow top line, grow orders.
To around 8.5% to 9%? Should that be the margin band we work with?
Give us how Q4 ends, and perhaps I'll come back answer the question.
All right.
And just to clarify, you said mid to high teens growth in the order book. What can that translate into the top line growth for FY26? And that will depend, of course, on.
Give us time for Q4 and let's see where we finish in Q4, because our backlog determines revenue to a large extent. We have a reasonable amount of book and bill, but we need to see how we finish Q4.
All right, Ashish, we'll leave it there, and we'll ask you those questions with specifics next time we speak. Appreciate it very much here on CNBC-TV18. I mean, absolutely nothing on it. 3 points on the Nifty, but you got so many stocks with big moves, right? I mean, just 3 names I want to mention before we take a break. NCC is down 11, Sonata is down 15, BKG is down 12. So this is the top 5 volume, within the top 5 or 6 volume sort of losers list. And you got 3 10% movers on the downside. So no dearth of stock-specific action one way or the other is how I describe it. Well, it's a early wrap on Bazaar, but our policy coverage starts right here. On the other side of the break, we connect with a host of experts, much awaited RBI Governor address at 10, and we'll prep you for it in the next 15-20 minutes or so. So that's the clock, 17 minutes to go, and you'll hear from the RBI Governor. Stay tuned.
Tensions between employees and management at Samsung's Sriperumbudur plant just outside Chennai have surfaced yet again. For well over 24 hours now, over 100 employees, we're told, have been staging a sit-in protest at Samsung's plant just a few meters from where I'm standing. In fact, this line of company buses and these barricades have been erected by Samsung so as to prevent members of the public and observers, much like myself, to see what's been going on through the gates of Samsung's plant just a few meters from where I'm standing. Now, the issue is simply this. A few days ago, 3 members or employees rather of Samsung's plant were suspended after allegedly engaging in activities deemed detrimental to the interest of Samsung's operations in India. However, employees of the plant, a section of them, and members of the Samsung India Workers Union claim that this suspension was not on account of disciplinary action or disciplinary reasons, but simply because they were affiliated with the Samsung India Workers Union in the first place, also claiming that Samsung does not want any employee to be actively engaged with this recently established workers' union. Now remember, this isn't the first time that issues or a face-off between Samsung's management and employees have cropped up. In September, nearly 1,100 employees of this very plant staged a protest outside plant premises, claiming for better privileges, more representation, better pay, and also representation by way of
Hello and welcome to our monetary policy coverage, coming to you straight from Mint Street. This is a very crucial policy because there has been a regime change in terms of the leadership at the Reserve Bank, in terms of the ecosystem as well. While we did have a slightly troubled rupee in December as well, the growth was not seen as that weak. Now there is a fear of softening growth. There is less fear of inflation because in December the last number that we had was October at 6.2. Now as we look ahead, the inflation number is expected to be tame because of a good Rabi harvest, as well because crude prices have fallen. So all told, we are expecting a lot from the policy this time around. Joining me is my colleague Ritu Singh from the Mumbai studios, and Ritu has done her poll, so best placed to tell you what's the market expecting. Ritu.
Well, at this point, Lata, the 25 basis point rate cut is priced in. 70% of our respondents said that is a given. The big question mark is what RBI does on liquidity. Again, the cash reserve ratio is not something most of the market participants believe that RBI will tinker with just yet. They've just cut it by 50 basis points in the last policy, and it's too big a tool to just use in a period of no crisis, really. Apart from that, yes, there are expectations that the RBI will give some comfort on liquidity. A lot of the respondents that we polled said whether they announce more OMOs, maybe longer repos, or perhaps, an incremental CRR cut for NRI deposits. All of those things they'll watch out for. And of course, very importantly, what RBI indicates as to the new LCR norms kicking in from the 1st of April. Are those going to be pushed away? Project finance rules, ECL, like you were talking about. Those are, that's the commentary that the market will really watch out for. The total quantum of rate cuts in this cycle, the expectation is 75 to 100 basis points, larger than previously because, of course, the helping hand that growth really needs from the RBI. Stance change is not really expected in this policy. The tone also more or less even. And as for the macro forecast, the GDP growth forecast at 6.6% is likely to be brought closer to NSO's 6.4% level. But the CPI forecast unlikely to be changed.
Okay, fair point. At 4.8, I think it has all that is needed in the price. And if anything, the December inflation was lower than what the market expected. Let me invite our guests. We are joined by Lakshmi Iyer of Kotak AMC, by Kaushik Das, the chief economist from Deutsche Bank, Indra Nilpal, the chief economist from Yes Bank, and Parul Mittal Sinha, the head of treasury at Standard Chartered Bank. Ladies and gentlemen, it's an even house. Welcome to the show. Let me start with Parul. Before I came in, there is this chatter that there may be a stance change as well. What are you going with? And if there is a stance change to accommodative, what may that mean for the markets?
Hi, Lata. Thanks for the question. So yes, there is a lot of excitement. I think more excitement about the stance this time because market is fully along the consensus lines that 25 basis points of repo rate cut will be delivered. Now, if the stance has changed to accommodative. That would signal that RBI is actually looking at a bigger cycle than a 50 basis points of repo rate cut. So that will allow and give the confidence to market to move rates further lower from where we are today. Mind you, markets have already priced in almost 65 basis points of rate cuts cumulative in this cycle, if I look at the interest rate swap pricing. So accommodative stance change will give market the confidence that the cycle, the interest rate cutting cycle, is bigger than the 50 basis points cut. So that's one. And looking at the polls, nobody is voted for a stance change, and therefore that will give a big impetus. RBI has already delivered a lot. They have shown their hand to the market and given the liquidity through OMO purchases, through buy-sell swaps, through secondary market OMO purchases as well. So a stance change after giving all those measures will really give a positive boost to market sentiment.
Okay. Thanks for that, Parul. Let me get the economists in. Kaushik, what is your expectation that they may do to boost credit growth? I'm only asking you all outlier questions because Ritu has already given you what the poll is saying, or the big market expectations are. The worry in, at least in government, has been that credit growth at one point in November was below nominal GDP growth. So do you think they may go to the extent of reducing the risk weights on bank loans to NBFCs, for instance? Can it go that far to boost credit growth?
Hi, Lata. We are expecting a 25 basis points rate cut and, commitment towards more liquidity. And you need both of these measures, both rate cuts as well as, more liquidity measures to ensure that, the transmission of rate cuts feed into the credit channel and the, real economy. And these things normally take 2-3 quarters lag to happen, properly. So, RBI has already waited for 24 months, almost 2 years before doing anything from the last rate hike. So this is an opportune time for RBI to start cutting rates and also keep on talking about liquidity so that short-term rates stay aligned to the repo rate. I don't see, risk weights changing right now. I'll be surprised if they go that dovish, because April is the big monetary policy where they'll get more time, and probably that is the opportune time to announce more changes to macroprudential norms, not right now. At this moment, what you require is probably commitment from RBI to continue with the liquidity measures. They've announced most of these measures. I don't expect a CRR cut. I'll be surprised if they give a CRR cut. But a 5 billion, USD buy-sell swap is a possibility, beyond what they've already done. And, the OMOs continue till 20th February. So for the March OMOs or April, I don't think they announce right now, but they say that they continue with the liquidity measures, which I think both liquidity and rates coming down will be important for credit channel to pick up. And we should also think about the next 3 quarters, 4 quarters inflation, not just this year's inflation forecast. If you've seen, RBI has given an inflation forecast of 3.8 for FY26 and 6.7% growth for FY26 in the December monthly bulletin. We want to see whether those forecasts for the growth gets revised down to 6.5 or something, or the inflation, whether they remain at 3.8. So if you're having 3.8% average inflation next year, you could easily have 50 basis points rate cut and probably more. But at this stage, we want the 25 basis points rate cut, more dovish commentary. But if you change the stance to accommodative, remember, it's not just a rate signal. What will also happen is that RBI will have to align the liquidity stance along with the rate stance, which would mean that the short-term rates need to be between the SDF and the repo rate. I don't think RBI is ready to do that at this stage. So probably the stance change comes more in April rather than right now.
Okay, a very quick question on the rupee. I mean, Indranil, would the Reserve Bank want to give a signal that we will move to surplus liquidity? The argument on the other side is that that will make it easier for speculators to short the rupee. And we are still in a slightly tense situation on the exchange rate. While one likes some orderly depreciation, you don't want speculators to take advantage. So your guess on what they may say about liquidity. Will they say adequate, enough? We will provide enough liquidity. Will they say I will keep it surplus? Thoughts?
Okay. Since my fellow economists started off with the expectation of the rates, I think I stand away from the crowd today to say that I am not expecting a rate cut. And I think you have raised the right question in terms of the currency and the tail risks that are there in terms of the policy prescription from the Federal Reserve and what it does in terms of the supply chains and therefore the overall inflation atmosphere globally and including India. So that's one belief that I have, that they will actually sort of tend to stay up. Secondly, you did raise a question about credit growth, where I also tend to differ in the sense that at 80% credit deposit ratio, and the average for the historic average being at 74, 75, I'm not sure whether a credit push without a deposit side increase from the banking sector that makes any sense from an RBI's perspective. Therefore, coming down to the liquidity, I think the RBI has done significant amount on the liquidity. If you look at on an historical basis, in the fourth quarter, liquidity generally remains on the tighter side. The incremental tightness this time is obviously on the account of the currency sale that has happened, which actually continues even today because of the external atmosphere being volatile. And to that extent, there can be more liquidity measures, but I am not sure whether immediately within the policy they do something, because the last OMO happens, which is the liquidity measures that they had announced in the last policy. That is on the 20th of Feb, and they'll possibly be wanting to wait and see what happens to the liquidity and do it beyond that. In terms of the system liquidity, I think they have done a good job to keep the TREPs and the weighted average call money rate at the sort of signaling rate. And they will continue to do that. And they have been very effective in doing that through the overnight VRR. Plus today we have a 56-day VRR. Which also is a very positive signal in terms of the liquidity. My sense, therefore, is they will look at a more neutral liquidity position, which broadly should be in the range of -50 to a +50. And I don't think they will do very aggressive anything at this point in time, because anyways, from April onwards, we are expecting liquidity to correct itself and sort of with government expenditure and all the stuff.
Okay, Indranil Pan, what is your expectation as far as some of the macro indicators are concerned? GDP at 6.6%, what sort of revision, if at all, do you expect there? And CPI at 4.8, unlikely to be changed?
I think the inflation obviously for this year is unlikely to be changed. We should be looking at the inflation expectations from the RBI for the next for the quarter hence that they put out. Yes, Kaushik did point out about the bulletin and the sub 4% that they have projected. Whether they continue with that and bring that up in the public space more openly is something that we really need to look at. Growth may be a shade lower. They have a 6.6, the government has a 6.4. So I think there is a bit of a chance to reduce it. But more importantly, what is the growth projection for the next year, given that the economic survey has pointed out to a 6.3 to a 6.8?
Lakshmi, what kind of indicators will you be looking at from the governor to indicate what happens beyond February, since this 25 basis point rate cut is already priced in? What sort of indicators or what words will you look out for in his speech?
Ritu, I'm more worried about the fact that if at all, contrary to the popular belief that there is going to be a rate cut, if the rate cut doesn't happen, that will have broader implications for the market. So should it be a status quo with a benign outlook saying that we are ready to act? I think we are more of that camp right now, rather than giving a rate cut and probably, sounding slightly more hawkish, because we are not in a deep rate cut cycle. We are in a more shallow rate cut cycle. So I think those are going to be the specific cues that we would be watching out for in this policy. That's going to be very critical. And mind you, see, markets do tend to be exaggerated at certain points in time, as Parul rightly alluded to. The swaps are, the entire yield curve is crunched at under 7% or just about there. There's nothing wrong about it, but we need to be mindful that we are slightly more vulnerable right now to external shocks, given the fact that commodity prices are rising relentlessly, and we are price takers for most of these commodities. So I think durable liquidity could be one area of watch out. We've already seen a slew of liquidity generation measures, which is good for the markets. And I think that is where one could see probably some more nuanced action likely.
Okay. Parul, I wanted your view on Forex. Actually, you are the Forex trader in this group. Do you think if he will sound very generous on liquidity, if he does, do you think there can be more shorting? It becomes cheaper to short from a Forex angle, and someone who is worried that the rupee should depreciate but not in a disorderly fashion. What may be the constraints?
Yes, I think the FX world and the way dollar rupee has behaved over the last few months, that can weigh on the sentiment of MPC. So while the rates market has been very exuberant and expecting and wanting more, I think from RBI, we will see a more balanced approach, not give extra liquidity boost to the market, not change the stance, be more neutral and retain the ability to react to market movements. The external factors that are impacting the overall dollar moves, the dollar strength, which is going on in the broader global markets, that has implications for us through dollar rupee channel as well. So dollar rupee has depreciated by almost 3.5% since the last MPC. And that has knock-on effect for both inflation and growth prospect, positive for growth, but is slightly inflationary for the economy as well. So RBI will, we don't expect RBI to be extremely positive or give an extra boost on liquidity. We don't expect the stance change to go to accommodative. We think RBI would want to continue and retain the space to react to developing market conditions. To just give some context, right? So US rates had gone to where they are today. They were almost 30 basis points higher in January month itself, 2 weeks ago. Oil has come down dramatically from the highs seen. So the level of volatility we are seeing in global markets, we have to be careful and we have to pay attention to that. And given the governor is also new, I don't see a reason why they would want to bind themselves to a defined path by changing stance and committing to a much larger.
The Monetary Policy Committee met on 5th, 6th yesterday, 7th today of this month. You are all aware that the governor's statement after the MPC meeting contains the resolution of the MPC with regard to the policy rate and stance. It also contains announcements and measures which have a bearing on the monetary and regulatory policies. The Monetary Policy Committee resolution is, of course, of interest to a large number of people from various walks of life. It impacts the lives of virtually all citizens of the country. The resolution also provides the rationale and the thought process of the MPC, and therefore is of relevance to businesses, economists, academicians, and the finance world. Apart from these MPC-related announcements, the governor's statement has become an important medium for the Reserve Bank to highlight its priorities on which it would like its regulated entities to focus their energies on. It is an opportunity to point out areas of concern and challenges for the stakeholders to address their attention to. It is an occasion for the Reserve Bank to articulate its views on critical areas of interest. I will continue with this practice of a detailed statement after each MPC committee meeting. Now, before I come to the resolution of the MPC, kindly allow me a moment to reflect on the experience of the flexible inflation targeting framework. You are all aware that this inflation framework was put in place in the year 2016 and it was reviewed in the year 2021. You are all also aware that this is a monumental change in the monetary policy history of our country. And so I thought it fit that I reflect on the experience of the flexible inflation targeting framework. Well, I believe that it has served the Indian economy very well over these years, including the very challenging period since the pandemic. The average inflation has been lower post the introduction of this framework. Moreover, CPI has mostly stayed aligned with the target given under this framework, barring a few occasions of breaching the upper tolerance band since its inception. We in the Reserve Bank and the Monetary Policy Committee will continue to improve the macroeconomic outcomes in the best interest of the economy, using the flexibility which is embedded in the framework, while responding to the evolving growth inflation dynamics. Moreover, we will strive to further refine the building blocks of this framework by making advances in the use of new data, improving nowcasting and forecasting of key macroeconomic variables. We forecast, you are aware, growth, inflation, etc., because this is actually a forward-looking policy. And so we'll continue to do that and develop more robust models. On the regulatory front, I would like to mention, and especially there has been a lot of media attention with regard to some of the proposed regulatory changes pertaining to liquidity coverage ratio, expected credit loss framework for provisioning by banks, the prudential norms governing projects under implementation. We will continue to strengthen, rationalize, and refine the prudential and conduct-related framework. I think this is very important in the overall interest of our economy. The interest of the economy demands financial stability and consumer protection. Our mandate in the RBI is to enhance both of them. At the same time, I would like to emphasize that the economic interest also warrants increasing efficiency in the economy, and this too is our duty. We recognize that just like there are no free lunches, regulation to enhance stability and consumer protection too is not devoid of costs. There are trade-offs between stability and efficiency. We will keep this trade-off in mind while formulating each and every regulation. It will be our attempt to strike the right balance, keeping in view the benefits and costs of regulation. I also want to reassure all stakeholders that we will continue with the consultative process which the RBI has been doing over the years in this regulation-making process. The suggestions of the stakeholders are very valuable, and we will continue to give serious consideration to them before taking any major decision. We will also ensure that the implementation of such regulations is smooth. We will give sufficient time for transition, and where regulations have major implications, the implementation will be done in a phased manner. Coming to the global economy, the global economic backdrop remains challenging. The global economy is growing below the historical average, even though high-frequency indicators suggest resilience, along with continued expansion in trade. Progress on global disinflation is stalling, hindered by services price inflation. With receding expectations on the size and pace of rate cuts in the US dollar has strengthened, bond yields have hardened, emerging market economies have witnessed large capital outflows, leading to sharp depreciation of their currencies and tightening of financial conditions. Divergent trajectories of monetary policy across advanced economies lingering geopolitical tensions, and elevated trade and policy uncertainties have exacerbated financial market volatility. Such an uncertain global environment has posed difficult policy trade-offs for emerging market economies. The Indian economy, though continuing to remain strong and resilient, also did not remain immune to these global headwinds, with the Indian rupee coming under depreciation pressure, as you would have noticed in the recent months. At the Reserve Bank, I would like to assure all of you we have been employing all tools at our disposal to face the multi-pronged challenges. With this backdrop, let me now come to the Monetary Policy Committee resolution. As I mentioned, we met these last 3 days, concluding today. And after a detailed assessment of the evolving macroeconomic and financial developments and the economic outlook, as I mentioned, we are forward-looking, the MPC decided unanimously to reduce the policy rate by 25 basis points from 6.5% to 6.25%. I repeat, the MPC unanimously decided to reduce the policy rate by 25 basis points from 6.5% to 6.25%. Consequently, the standing deposit facility, SDF, the SDF rate shall be at 6.0%, and the marginal standing facility rate, also called the MCF rate, and the bank rate shall be 6.5%. The MPC also decided unanimously, again, to continue with the neutral stance and remain unambiguously focused on a durable alignment of inflation with the target while supporting growth. I shall now state the rationale for the decision in brief. The MPC noted that inflation has declined, supported by favorable outlook on food and continuing transmission of past monetary policy action. It is expected to further moderate in 2025-26, gradually aligning with the target. The MPC also noted that though growth is expected to recover from the low of Q2 of 2024-25 this year, it is much below that of last year. Last year, you are all aware, it was 8.2%. This growth inflation dynamics opens up policy space for the MPC to support growth, while remaining focused on aligning inflation with the target. And accordingly, the MPC decided to reduce the policy rate, by 25 basis points to 6.25%. At the same time, the MPC felt that excessive volatility in global financial markets and continued uncertainties about global trade policies, coupled with adverse weather events, pose risks to the growth and inflation outlook. This calls for the MPC to remain watchful. Accordingly, it decided to continue with a neutral stance. This will provide MPC with the flexibility to respond to evolving macroeconomic environment. With this, now I come to the assessment of growth and inflation. First of all, growth. As per the first advanced estimates, real GDP growth for the current year is estimated at 6.4%. The numbers were released by MOSPI recently. This is a softer expansion after a robust 8.2% growth last year. Going forward, economic activity is expected to improve in the coming year. Agricultural activity remains upbeat on the back of healthy reservoir levels and bright Rabi prospects. Manufacturing activity is expected to recover gradually in the second half of this year and beyond. Early corporate results for Q3, and we have more than 50% of the results now as we speak, It indicates a mild recovery in the manufacturing sector. Mining and electricity are rebounding from monsoon-related disruptions in Q2. Business expectations remain upbeat, as evident from the PMI Manufacturing Future Output Index. Services sector activity continues to be resilient. PMI services, however, declined from its recent peak. On the demand side, rural demand continues to be on an uptrend, while urban consumption remains subdued, with high-frequency indicators providing mixed signals. And we are aware, we got the Nielsen survey report also just yesterday. Going forward, improving employment conditions, tax relief in the union budget, moderating inflation, together with healthy agricultural activity, bode well for household consumption. Government consumption expenditure is expected to remain modest. Higher capacity utilization levels, robust business expectations, and government policy support augur well for growth in fixed investment. Continued buoyancy in services export will support growth. Global headwinds, however, continue to impact uncertainty to the outlook and pose downward risks. Taking all these factors into consideration, the RBI has estimated that real GDP growth for the next year to be at about 6.7%, with Q1 at 6.7%, Q2 at 7%, Q3 at 6.5%, and Q4 too at 6.5%. The risks are evenly balanced. Coming now to inflation, headline inflation, after moving above the upper tolerance band in October, has since registered a sequential moderation in November and December, standing at 5.2% now. Going ahead, food inflation pressures, absent any supply side shocks, should see a significant softening due to good Kharif production, winter easing as we witness every year in the vegetable prices, and a favorable Rabi crop prospect. Core inflation is expected to rise but remain moderate. Rising uncertainty in global financial markets, coupled with continuing volatility in energy prices and adverse weather events, presents upside risks to the inflation trajectory. Taking all these factors into consideration, CPI inflation for the current financial year is projected at 4.8%, with Q4, the current quarter, at 4.4%. Assuming a normal monsoon, CPI inflation for the financial year 2025-26 next year is projected at 4.2%, with Q1 at 4.5%, Q2 at 4%, Q3 at 3.8%, and Q4 at 4.2%. The risks are evenly balanced. I will now come to the external sector. India's current account deficit moderated from 1.3% of GDP in Q2 of last year to 1.2% in Q2 of this year, 24-25. According to the World Bank, India, with an estimated inflow of $129.1 billion, continues to remain the largest recipient of remittances globally last calendar year 2024. The current account deficit for this year is expected to remain well within the sustainable level. As on 31st January this year, I may inform you, India's foreign exchange reserves stood at $630+ billion. This provides us an import cover of more than 10 months. Overall, India's external sector remains resilient as key indicators stay robust. I would like to mention over here, and especially because there has been commentary in the media about the Reserve Bank's exchange policy. Well, the Reserve Bank's exchange rate policy over the years has remained very, very consistent. Our stated objective is to maintain orderliness and stability without compromising market efficiency. The Reserve Bank believes in the market efficiency of the markets that we have in India for Forex. Accordingly, our interventions in the Forex market focus on smoothing excessive and disruptive volatility. It does not target any specific exchange rate level or band. The exchange rate of the Indian rupee is determined by market forces, and we will continue with this policy. Coming now to liquidity and financial market conditions, I may state that after remaining in surplus from July to November 2024, system liquidity as measured by the average net position under the liquidity adjustment facility did turn into a deficit during December 2024 and January 2025. This drainage of liquidity is mainly attributed to advanced tax payments in December 2024. You are aware there are quarterly advanced tax payments to be made, December being that particular month. For the advanced tax payments for Q3, that did have an impact. Capital outflows, again, one has witnessed some capital outflows because of various reasons. Forex operations and a significant pickup in currency in circulation as we witness every year in January. It has been, however, I would like to mention over here that we have observed that some banks are reluctant to on-lend in the uncollateralized call money market. They are passively parking funds with the Reserve Bank. I take this opportunity to all the banks to urge them to actively trade amongst themselves in this uncollateralized call money market, so as to make it deeper and vibrant for better signal extraction from the weighted average call money rate. The Reserve Bank is committed. I want to assure everyone that the Reserve Bank is committed to provide sufficient system liquidity. We have taken a number of steps in this regard, and we will continue to monitor the evolving liquidity and financial market conditions and proactively take appropriate measures. I repeat, proactively take appropriate measures to ensure orderly liquidity conditions as may be required for the system. And when I say liquidity, it means not only transit, overnight liquidity, but also durable liquidity to meet the requirements of the system. I now come to financial stability. The system-level financial parameters for the scheduled commercial banks continue to be healthy. The credit deposit ratio for the banking system at the end of January 2025 was at 80.8%, broadly similar to that on 30th September 2024. Bank liquidity buffers are sufficient, though the net interest margin moderated, return on assets and return on equity are robust. The system-level parameters for NBFCs too are very healthy. I also take this opportunity today to mention that the Reserve Bank has been observing Financial Literacy Week annually since 2016. This is with the purpose to enhance financial education in our country. Last year too, we did this campaign. This campaign was focused last year on empowering youth adults. This year, recognizing the critical and multifaceted role of women in society, this campaign will emphasize on women's role in financial decision-making and household budgeting. I sincerely urge all banks to actively participate in this campaign on the theme Financial Literacy, Women's Prosperity. It starts from 24th of this month. Now, before I conclude, I shall be announcing some additional measures. Necessary directions and circulars for these shall be issued separately. First of all, on digital security, the rapid digitalization of financial services has brought convenience to all of us, at the same time efficiency, but it has also increased exposure to cyber threats and digital risks, which are again getting sophisticated day by day. The surge in digital frauds is a matter of concern. It warrants action by all stakeholders. The Reserve Bank has been taking various measures to enhance digital security in the banking and payments system. Introduction of additional factor of authentication for digital payments is one such measure. It is now proposed to extend this to online international digital payments made to offshore merchants who are enabled for such authentication. Second, the Reserve Bank shall implement the bank.in exclusive internet domain for Indian banks. Registration for this domain name will commence from April this year. This will help avoid banking frauds. This will be followed by the fin.in domain for the whole of the financial sector. The banks and NBFCs, I would urge them to also continuously improve preventive and detective controls to mitigate cyber risks. They must develop robust incident response and recovery mechanisms, reinforced through periodic testing for operational resilience. Third measure that I am announcing today, over the past few years, we have expanded the suite of interest rate derivative products available to market participants to manage their interest rate risks. We shall now, to this suite, include forward contracts in government securities. This would facilitate long-term investors, such as insurance funds, to manage their interest rate risk across interest rate cycles. It will also enable efficient pricing of derivatives that use government securities as underlying instruments. Fourth, to enhance access of retail investors to government securities, the Reserve Bank has taken a number of steps earlier. There's another step, that I am announcing today, and this pertains to expanding the access of NDS Home, our platform for trading in the secondary market transactions for government securities, to non-bank brokers who are registered with SEBI. A number of them are registered with SEBI. They will also get an opportunity now to participate and trade through the NDS Home, the electronic trading platform of RBI for government securities. Fifth, in view of the various developments in financial markets and market infrastructure over the past few years, we shall be setting up a working group with representation from various stakeholders to undertake a comprehensive review of trading and settlement timing of markets regulated by the Reserve Bank. There are some 5 such markets which have different timings. The group shall submit its report by 30th April this year. To conclude, considering the existing growth inflation dynamics, the MPC, as I mentioned earlier, while continuing with the neutral stance, felt that a less restrictive monetary policy is more appropriate at this current juncture. The MPC will take a decision in each of its future meetings based on a fresh assessment of the macroeconomic outlook. We are committed to conduct monetary policy and take such measures as appropriate, which are timely, carefully calibrated, and clearly communicated to facilitate conducive macroeconomic conditions that reinforce price stability, sustained economic growth, and financial stability. Thank you, Namaskar, and Jai Hind.
Okay, as expected, there has been a rate cut and not a CRR cut. But that is just one of the things that the governor announced. I think we have to concentrate on what he said first, a more flexible interpretation of the flexible inflation targeting. I think that's an extremely important statement he's making, and that also means what is missing is aligning the CPI to the target of 4% is a phrase that was repeatedly there last year and in previous policies. That is absent, and what they're saying is a more flexible interpretation, which means perhaps that they will not be that strict about 4%. That's a very important revelation of his thinking. The second one, that they're going to look at the, blocks, the fundamental blocks of forecasting. So I think the forecasting models are going to be looked at again. I think the second biggest takeaway for the markets, especially the stock markets, is that the regulatory framework comes with a cost. That when you want stability and inclusion, it will also mean a lesser efficiency. Basically, you take away money for LCR, you take away money and lock it in government securities for SLR. For these purposes, the priority sector, that also takes away from efficiency. So my sense is it's a veiled way of indicating that LCR is not going to be effective on April 1st. We will, of course, ask him that in the monetary policy. On CRR and liquidity, he has only said he will give as much liquidity as needed. There is no indication of surplus. Very clearly, we will take proactive steps. But he is not saying surplus liquidity, which means liquidity as and when needed is the message that's coming. So my sense is it's very clearly on regulation. They will go soft. Flexibility of the flexible inflation targeting will be more adhered to, and there is going to be a redefinition in terms of the macros. They're going to make it smoother or perhaps more accurate. Then I think a very big takeaway is that many banks are unwilling to lend in the call market. They lend in the repo market, not in the call market. There is a fear in the market, in the banks, that if you borrow from repo and lend in the call, then the auditors will ask questions. I think he's, telling the bankers, please come and lend in the call market. Auditors will not ask questions. I think that's again a very, very big signal that banks were waiting for, and I'm glad it has been given. But basically, for the markets, a 0.25% rate cut and a more flexible interpretation. I would interpret that as almost accommodative, but the stance is still neutral. Let me get to the experts before I come to Ritu, who will have more things to contribute. Upasana, what would you surmise from what you have heard? Do you expect a rate cut in April, for instance?
Yes, of course, Lata. I think it's a very much in line with expectations policy across the board, if you look at. Just want to highlight one thing, that as you mentioned, the flexible inflation targeting. I think earlier we were in doubts whether we will have to wait for 4% to be achieved before an action is taken. I think today's emphasis on flexibility of inflation targeting kind of provides cues on the fact that if inflation is broadly looking ahead in line with 4% target, then growth can be considered as a primary objective. And in this environment, when the growth inflation dynamics was looking fairly benign, I think this was the perfect time for RBI to have acted. And I think more than that, on the second leg is the liquidity angle, wherein the liquidity stance has to be more or less in sync with RBI's policy stance. They have already acted ahead, and that kind of had sets the stage for a repo rate cut. So, the liquidity easing measures which have been announced, and we believe that there will be more coming, but they will have to be on a wait and watch mode. Clearly, they will have to be watching that closely, but liquidity will be playing a much more important role going ahead now that RBI has delivered that 25 basis of rate cut, which was broadly in line with what I think everyone in the market was expecting.
No, but since he says more flexible, are you expecting April cut?
Yes, Lata, we are cumulatively looking at 50 basis of rate cut. With one gone, I think we have now one more rate cut to go, and it is better to go ahead with back-to-back rate cuts, because the room, I think, for incremental rate cuts more and more will be limited.
Okay. All right. Just coming back to all of you, let me get Kaushik's first thoughts and then go to Ritu. Kaushik, what were your key takeaways, and more importantly, what next?
Hi, Lata. This is, I think, excellent policy decision to cut 25 basis points and don't go overboard on liquidity. RBI has already announced liquidity measures. Governor mentioned the word proactively and stressed on it. So as and when it is required in March, after the OMO purchases are over, if they feel like they need to give more, they'll definitely give more OMO purchases, or FX swap, another 5 billion, all those will be coming. As I told you in the expectations part, that I don't expect CRR to be cut, so they haven't touched. At a later point, if it is required, that may be seen, but I don't think CRR will be required, given that in May, RBI will give a very big dividend, 2.3, 2.4 trillion to the government of India. That will also add to liquidity as the government spends. The other thing that caught my attention, and I liked the fact, is that the governor stressed on the part of being monetary policy being forward-looking. So you do not need to wait for 4% inflation to start cutting. You have to start in advance seeing the runway. And if the runway is showing you that inflation will average about 4.2 in the next fiscal year, even at say 6% repo rate, your real policy rate is still 1.75 positive. So I think RBI has done the right thing. April, there's another rate cut for sure. And after that, I think the stance will change to accommodative, simply because after 50 basis points rate cut, RBI may not want to reduce the repo rate too much, because the Fed has only cut 100 basis points. But if you still want to give some bit of easing, that time you can bring in more liquidity and drive an effective easing by driving short-term rates closer to the SDF rate. So the short-term rates can fall to 575 with the repo rate staying at 6%. And that is how you achieve that, by changing the stance to accommodative, because once you change the stance to accommodative, the liquidity stance also has to be aligned with the rate stance. And in that scenario, you can only pause or cut rates, and then short-term rates need to come to the lower end of the corridor.
Yeah.
That's my view.
Yeah. Very important to note that the rupee has actually not moved much. Before the policy started, I noted the rupee, it was 87.46, now 87.48. So despite the fact that the rate cut has come, it's largely priced in and there isn't any further reaction. Let me invite the biggest banker in the country, SBI's Ashwini Tiwari is also joining in. Mr. Tiwari, good morning. Thank you very much for your time. Can you tell us the key takeaways from a banking point of view? They've asked you all to lend more in the call and not keep away. No questions will be asked by your auditors or by the supervision department. Also, more derivatives for insurance companies, to hedge longer term, G-Secs, more retail participation, can come into the NDS home market. Those are also been announced, but from a banking point of view, what's your takeaway?
Good morning, Lata. Thank you for having me. I think the rate cut is broadly in line with our expectations and our house view, so no surprises there. The balance point, which he talked about, balance between policy and growth, I think that's very welcome. In terms of banking, I think you already listed out the things which has been there, but the only thing I would like to correct is, it's not that we are not participating in the call money market. We are very much there. And this gives a far more flexibility, the derivatives which have been announced, and more importantly, the cyber things he talked about in the bank domain. We are engaged with them and we'll work with them. I think RBI is very geared up to protect customers from digital frauds. And therefore, overall, in terms of having a system, whole of system approach with RBI and the government, this is also a step in the right direction. So overall, I would say that the takeaways are that the banks should continue to be cautious, yet be focused on lending and doing the job which they are supposed to do. So that way, the RBI has made our job more simpler and given us the enablements.
But very quickly, Mr. Ashwini Tiwari, a 25 basis point rate cut you had factored in. What does that mean for banks like yourself? Your external benchmark linked book is less than a third of your total assets. But broadly, what do you expect now going forward, the impact on your business thanks to these cuts, and the indication that RBI is going to be forward-looking, target the band and not the 4% central level, leaving more room for rate cuts going forward. What will that mean for banks like you?
So generally, when the rate cut initially happens, the deposits gets repriced with a lag because the people are, especially in TDRs, are locked in. And the loans, especially this 1/3 you talk about, the external benchmark linked rate, that will be changed immediately. So in the beginning, there'll be some margin pressures, but going forward, as we realign our deposit rates also in line with the rate cut, this will settle down. And we have always given a NIM guidance of between 3.1 to 3.3. This quarter, we were a little lower, but we expect to get back there soon. So therefore, for us also, we'll have to realign a little, both in the deposit and the lending rates as we go forward. And it will settle in after some time.
Sir, Mr. Tiwari, the market analyst interpretation was that your NIMs will be impacted by 5 basis, which is the least amongst all the other banks. I mean, HDFC, ICICI all have like 6 or 7 basis. Yours is 5 basis. Is that a correct calculation?
No, I really
just
have not
because of the rate
calculation. No, I have not looked at that calculation which the analysts have done. So therefore, I can't comment on that. But my basic point is that we'll realign as we go forward by adjusting our deposit rates and also the lending rates. So to look at the rate transmission and also to look at where our margins need.
Mr. Lakshmanan, what did you make of the governor's very, very calibrated comments coming in on the liquidity front? Not promising ample liquidity, but just making it very clear that they will proactively manage it as and when required. Are the markets going to be disappointed, or was this factored in? What were your additional takeaways from his speech? Mr. Lakshmanan, I think you're on mute.
My apologies. No,
yes,
so this was definitely as per the predominant market expectations. If you look at the markets and the response thereafter, markets have not moved much. You would note the currency levels, but importantly the wires levels, the G6, of course, the yields have moved up a bit. But overall, this being a predominant expectation, I don't think market is disappointed by any means. And in many manners, the way RBI had alluded to supporting liquidity even much before this policy, as well as the governor's speech over here, has given enough confidence that liquidity is clearly a focus and they will not let the markets down should there be a liquidity requirement at all. So overall, I don't think there is anything beyond balance that has been spoken of by the governor's MPC, and I think market would gradually move into an April expectation, potentially for a rate cut. Of course, keeping the inflation dynamic expectations, and of course also looking into how the global macro is developing. With the rate cut expectation coming by, maybe the rates may smoothen down a bit. But overall, I think there is not much to be either overly euphoric or disappointed about.
Okay. Well, the call rate has already fallen, obviously. It's now at 6.35. Midpoint between 625 and 650, and I would assume it will eventually go to 6/4. And Mr. Tiwari says we have no objection to lending in the call, but call volumes are in 5 figures. They are in thousands, 10,000s of crores, whereas the TREPS volume is going to 1 lakh crore. So clearly you are preferring the collateralized lending market and not the uncollateralized lending market, and the governor is requesting you all to lend more over there. Call has come down. Naturally, because the repo, the MSF rate, everything would be down by 25 basis. Shobit Mehrotra is also with us. Shobit, lots of announcements for your market actually. You all can now participate in the NDS home, and there are also these derivatives available. How does life change for you all? What is also your call on the 10-year bond yield?
Yeah, thank you, Lata. I think initial reaction of the market on liquidity measures has not been too positive. I think market was expecting a change of stance to accommodative. If RBI is confident of providing liquidity, then might as well go ahead and change the stance from neutral to accommodative. So that has been a little bit of a disappointment. I think market was also expecting some more forceful measures on liquidity. So rate cut without liquidity being in surplus on a durable basis may not lead to good transmission. So if we want transmission of rate cut to happen in the economy and growth to improve, I think it has to be accompanied with far more liquidity to be provided to the system. I think from that point of view, I think market is a little bit disappointed from the policy. I'm not too confident also on the next cut happening in the April policy. There was a lot of reference to global headwinds, uncertainty, global financial markets, volatility. So if that were to increase, I think RBI may choose to wait and watch and then go in for further deciding on the rate trajectory. So I think confidence of the market may be a little bit shaken post this policy. I think change of stance could have been done. More forceful liquidity measures could have been provided. The transmission of rate cut would have been far better. But unfortunately, that hasn't happened. So let's see what kind of measures come out after this 3 or 4 measures which RBI has announced on liquidity, whether we continue to see more of those or, we have to wait and system has to go again into negative and deficit and then something comes up. So I think a little bit of a proactive approach would have helped the system far better.
Well, absolutely take your point. The stance remains at neutral, not accommodative, and no overt promises of ample liquidity at all. But Mr. Ashwini Tiwari, quick question to you about the initial comments made by the governor. Very clearly stated that they will give sufficient time for transition when it comes to big changes, in policies and guidelines, and where the implications are large, the transitions are going to be done in a phased manner. Now, what is your reading of these statements in the context of the LCR rules kicking in from the 1st of April? Of course, then there's also the ECL transition and the project financing norms. You think the governor's indicating that, that timeline may be extended?
We really can't interpret on what RBI wants to say because all these three have been around, these draft notifications have been around for some time. And we have already given our inputs to RBI on what we think about each of these and what the improvements could be. So therefore, we will wait for RBI to actually announce a date as to when they will implement. And if and when decided to implement, then clearly the window of implementation will be adequate because some of these like ECL and all will need substantive IT changes and system changes, which will require a long time. So therefore, and of course, the additional provisioning which will be required. So I think the time factor which the governor is saying, we will see how that happens because we will wait to hear from them finally as to when they want to implement this.
Okay. No, Mr. Tiwari, but I think Ritu is asking a very relevant question. He's for the first time we are hearing the Reserve Bank say that regulatory intent for higher financial customer service or for financial stability like CRR, SLR, LCR, while they have serve a purpose, they come at a cost. We've never heard the Reserve Bank say that, and certainly not on the policy day. So is it a reasonable bet to assume that it won't be April 1st, LCR rules?
No. As banks, we don't bet on any...
We will ask him. We will ask him on your behalf.
Please ask him. So we will wait for...
No, we will ask him on your behalf.
No, thank you for that. But we will wait for the formal announcement. Because we will be ready. I mean, we'll make ourselves ready if and when this is announced. So right now, I don't want to conjecture on it.
Okay. I want to follow up on what the Federal Bank Treasurer, Mr. Lakshman, is saying, that they could have been more generous with liquidity. They could have indicated an accommodative stance. I think that will be kudos to the Reserve Bank that they have maintained the continuity from December. It is not looking like it is another, Reserve Bank altogether. It is the same economy and it is the same caution. So, Kaushik, your thoughts. Do you think that the market would be disappointed in terms of the governor not being very generous in his liquidity statements?
Lata, I think the governor gave a lot of assurance that he'll be proactive. So RBI is watching this liquidity situation very closely. I don't think, you need to get everything on one day. Obviously, markets will want as much as they could get. But there's a sequencing that you need to keep in mind. So October, we changed the stance to neutral. December, we had a CRR cut. And then we had more liquidity measures before the rate cut. So you had the rate cut. Don't expect everything on the same day. So on April, you'll get another rate cut. And along with that time is the time when you should change the stance to accommodative, because at that time, once you had a rate cut, you will not have a rate hike, right? Neutral means you can hike, you can cut, you can pause. But now that you had a rate cut, April would be a good time when you say, I can either pause or I can cut rates. And that is the time to announce a rate cut and give the accommodative stance. After that, people will take a bet whether RBI will cut more than 50. I'm in the camp thinking that RBI will not cut more than 50 unless the Fed does more than 100 basis points, and it doesn't look like the Fed will do anything immediately. So you could get an effective easing after April, and that you can achieve through more liquidity coming in and driving the short-term rates to the SDF rate. Then your accommodative stance on rates and liquidity will be at sync. And that is why I think, RBI, once the OMO purchases are done for February 20th, which is the last one, for March, if RBI sees more tightening, suppose RBI sees, as Shobit was saying, they will go ahead and announce more OMO purchases or FX swap in March. Why announce today for March when you have 90,000 crore of liquidity is still yet to come? VRR is there today afternoon, and then 40,000 crore more of liquidity. So you'll have to just wait it out. And it's not like RBI has to announce everything in the next April policy. They can come in between as well as far as liquidity is concerned.
Okay, let me just pose one more question on similar lines to Upasana. Upasana, are you getting a sense that they will be niggardly, or they will be very, very careful with liquidity? Or you're getting a sense that they will provide adequately? For the banks at the moment, the policy is negative. That is, the repo rate has been cut, and so at least between 5 and 7 basis points, there is an impact on margins, and they cannot, pass on they will not pass on the rate cuts to the non-EBLR loans at all. Do they have enough comfort on liquidity from a banker's point of view?
Yeah, I think to begin with, he did mention that proactively he will provide durable liquidity as and when required. So, and already, as Kaushik mentioned, there are a lot of measures which are yet, this week, next week. We have the OMO purchases, we have the, VRR 56-day. All of that is still pending. So, RBI does not have to wait for a policy to announce liquidity easing measures. And at this point, February, in terms of durable liquidity, because of the measures which have already been announced, is looking kind of comfortable. So I think it's only in March where we start seeing again, even frictional liquidity tightness because of advanced taxes, accumulative year-end tax collections and all of that. So the scope for liquidity easing measures coming in March is much more. At the same time, the disappointment which probably markets are getting because of no change in stance, this is not warranted at this point because liquidity is tight. And in this environment, they could not have changed the stance to accommodative when, for that, they will have to do much more aggressive liquidity easing. When the global environment is so uncertain, I don't think it is the right time or opportune time to go all aggressive across all the board, across all the spectrum. So they need to necessarily look at every aspect and go slow. Liquidity, I don't see any reason why markets should be worried about. RBI is providing and they will continue to provide. They will need to provide as well. And I don't see any reason why the statements anywhere were cautious. They were all comforting to the market that we are there and we will be proactively looking at durable liquidity.
Okay, comforting, not comfortable, as Lakshman wants. He just wants an assurance or even actual announcements of liquidity, probably expecting FX swap announcements or, OMO auction announcements. But for all you know, Mr. Lakshman, they may come even by end of day or, very soon. Just a last word from Mehrotra that I wanted. Mehrotra, Shobit, you don't think that the NDS home market entry that you all are getting is big deal?
So it's already there with us. As mutual funds, we have access to NDS home. I think what he mentioned was certain brokers registered with SEBI will get access to NDS home. Yes, it will improve liquidity in the market. Anyways, government bond market liquidity is very good. The NDS home platform is a great platform for trading by banks, insurance companies, mutual funds. So we are already there on it. Insurance companies, banks, everybody is already on it. Now there'll be some additional brokers coming onto it, which perhaps may lead to some bit of improvement in liquidity, maybe in some, off-the-run securities and, that kind of a demand could get channeled through these brokers on NDSO.
That's right. I mean, RBI said that they will allow access to SEBI-registered non-bank brokers to NDSO, like you were clarifying. But Kaushik, if you look at the fine print again, it was a very quick, 30-minute speech from the governor, very short compared to what we're used to seeing. Any additional takeaways, anything we've missed talking about that you also want to hear in the press conference detailed?
Yeah, so you can ask if you get the opportunity with what kind of real interest rate the RBI is looking at, forward-looking policy. If you remember, under the previous regime, they had specified 1.4 to 1.9% positive real rates for, kind of deciding how much rate cuts can happen with respect to forward-looking inflation. Whether any thought, has changed at RBI with the growth numbers that we've got, are they willing to look at lower real interest rate, which could then, make up room for further rate cuts? I'm sure RBI will not give you that answer, but you could, kind of ask that question. The other thing is that I think the forecasts have become very realistic now. The growth forecast is at 6.7, which is on the higher side of the economic survey band of 6.3 to 6.8. At Deutsche Bank, we have a forecast of 6.5% growth for next year, but this is more or less in line. On 28th February, that the CSO will give the October-December GDP number. So those things can change. But generally, the growth number is pretty realistic. And inflation at 4.2%. Also, I think it's very realistic. We have a 4.3% forecast. But the positive real rate, whether anything has changed at RBI, that could be a good question to ask.
Sure. Just very quick forward-looking summaries from all of you. Upasana, starting with you. At 4.2% sort of CPI outlook for the rest of the year, 6.7% GDP. What is the total quantum of rate cuts you're expecting in this cycle after the 25 basis points?
Maximum 50, but we are at, we can say 25 to 50.
25 to 50. Okay, Shobhit, what is your expectation?
I think my expectation is for a shallow easing cycle. I think growth number of 6.7 is still a little bit on the higher side. If growth disappoints by a big margin, only then we would probably get more than 50 basis points. But my sense is I don't think April will get back-to-back rate cut. Perhaps in the later part of the year, we'll get the second cut.
Sure. And very quickly, Mr. Lakshmanan, what is your sense, total quantum of cuts?
Yeah, well, largely the growth number dependent. 2 rate cuts for sure, maybe a third one, should the growth numbers be disappointing.
All right. So not a very steep rate cutting cycle is the expectation from here on out after the 25 basis point rate cut. On that note, Kaushik Das, Upasana Bharadwaj, Shobhit Mehrotra, Mr. Tiwari, of course, Mr. Lakshmanan, thank you very much for joining us here and helping us parse through this very important policy. We've kick-started the rate cut cycle with an expected 25 basis point rate cut. On that note, from Lata and me, it's a goodbye and thank you very much for watching. Lata, to you for your final comments.
Well, I think the Reserve Bank governor has played for continuity excellently well. Continuity and change beautifully blended. Continuity in terms of, that phrase which I was looking for is there, to align inflation to target. It's there, so very much keeping with that continuity that we are focused on the target, but giving himself that room by saying that we will concentrate on the flexible part of the flexible inflation targeting, also adding that regulation should also not take away too much from efficiency. I think it's a brilliant blend of continuity and change. For the markets itself, at the moment, the disappointment is there's only a rate cut. There is not that much of an assurance on liquidity or on the next rate cut by changing the stance. But I think that may be clarified in the upcoming press conference. That's what we will wait for. Whether there is more generosity in the way he tackles the liquidity questions and whether there is more accommodation in the way he tackles the interest rate questions. Excellent policy, I would say, and excellent use of language. With that, it's a break now, over to the stock market coverage and how the markets have interpreted it. And at 12 o'clock, back to the Reserve Bank.
Samsung said all that while that it was averse to forming in the first place. However, following the Madras High Court's intervention, Samsung India Workers Union became a registered union under the Tamil Nadu Labour Department, thereby ensuring that some of these workers' demands pertaining to representation by way of a union was summarily met. However, these issues clearly have not been laid to rest, simply on account of the recent suspension of those 3 employees. Now, the issue is simply this. While these employees claim that they were suspended for their affiliation, Samsung in a statement has said the employees in question violated the company policy and have been suspended temporarily and will be subject to appropriate disciplinary action following a formal inquiry, end quote. Now, while it's a case of he said, she said between Samsung and its employees, the fact is that these outstanding issues between Samsung and its employees don't seem to be going away anytime now, given the fact that both the employees and the management seem to be heading in different directions with regard to what they expect of each other pertaining to both representation and a basic disciplinary expectation.
You're watching us here on Trading Hour. I'm Mangalam Malu. With me is Reema Tendulkar. In case you've just joined in, the important news of the day. The Reserve Bank of India has cut interest rates or repo rates by 25 basis points for the first time in the last 5 years, though they've maintained their stance, and the announcements around liquidity were also fairly calibrated, much against street expectations of a lot more liquidity to be given. Seems like the RBI is balancing out its action with commentary itself. The MSF rate, etc., have adjusted on account of the reduction that we've seen in repo rates. What has the market made of this? Well, not too much on the good or the bad side. The Nifty is marginally in the green after ending marginally in the red in yesterday's trading session. The Nifty Bank was marginally in the green yesterday and now is marginally in the red. The good part is the mid-cap index is doing a lot better as stocks are coming off the lows that they hit yesterday. I'm Mangalam Malu. With me, Reema Tendulkar. Hi, Reema.
Hi. I think the two key words from the RBI this time is one is flexible and the other one is forward-looking when it comes to inflation targeting, because that sets the stage for Sanjay Malhotra's term as the RBI governor. And economists are quick to point out that perhaps in April also a rate cut is coming. But finally, I think, Mangalam, we can say thank God it's Friday, right? Like, this has been a long week because it was a continuation of last week, the budget in the middle squeezed in. So finally, done for the week.
Notwithstanding the results, the slew of results,
especially on the consumer front.
Yeah.
A lot on the consumer front. But we're wrapping up this week. Well, you've still got about 4.5 hours to go, but we're counting down. And for the week so far, it's been a gain of close to about 0.5% on the benchmark indices. Banks are soft today. The Nifty Bank is down about 0.2%, but for the week, it's already clocked in about a 1.5% gain. Ajay Srivastava, Managing Director at Dimensions Corporate Finance Services, is with us on the show as usual. He always joins us unfailingly on Policy Day. Ajay, your first words, wise words?
Good morning. I have no wise or unwise, but he has done what he was brought here to do, is to give this symbolic cut. I think we all knew the RBI governor, the X1, did not want to push in, which is very correct decision. There is no reason to have pushed in a very symbolic rate. It's not that the banks are going to cut down the interest rates of anybody at this point of time. It's not that the people who want to put money into the bank as deposits are going to be happy if they cut down anything. So I think it's been a pure symbolic gesture if you ask me to say, okay, we want to cut down the rate. Now, why do we want to cut down the rate? Because inflation has not gone down. The liquidity situation is tight in the market. The rupee, the parity with the US interest rate is worse compared to last year. So if you look at the parameters of why he's done it, I think the whole market knows it's symbolic. Okay, let's push one more button and see if the growth comes in. But I think, we are more focused on the results which are coming through. We are more focused to see what's going to happen to the rupee dollar gap, which has now opened up for people who borrowed in foreign currency. And largely speaking, as you see, the market is very, very indifferent to this 25 basis point, because I don't have a terminal right now here with me, but I don't think the yields have gone down at all based upon this rate cut. So, symbolic rate cut, be happy that there's so-called rate cut, but nothing much will change in terms of stock market, my friend. Results will still count, and what happens in the US and the Europe markets is going to make a difference to us. So it's not going to bring FIs back in a hurry, certainly. That's the problem.
Yeah, Ajay, thank you very much. I wanted to stay back to understand from you, how you understood the policy. Thank you very much for that excellent wrap. And your point about yield is well taken. It was at 6.65 before the policy cut. After the policy cut, it went to 6.69 because the expectation was maybe he will say accommodative stance. He didn't. He only gave a cut. So it's exactly where it was yesterday, 6.69, the 10-year bond yield, that is. But, if you can tell us how you will interpret it as a bank investor, in case you are holding a bank share, how would you look at it? On the one hand, the repo cut will mean the external benchmark loans will have to be marked lower. So there is about a 5 basis point drop in NIMs for most of the banks. But the governor is also promising more liquidity. He has told them that he is happy with the credit deposit ratio. I mean, in approximately those words. That is, you don't have to, scrounge on credit anymore. He's also said that he wants them to lend actively in the call. So regulation should not be all about prudence. It should also look at the efficiency cost, giving the impression that the LCR is definitely pushed out. It will not start on April 1. Is all this making you bank positive?
I think the fundamental flaw in all this, Lata, is that people who invest money in capex, in the private capex, look at 0.5, 0.25% interest to make a differential to the project. They don't. Believe me, they don't. None of them look at it. Yes, interest cost is relevant, but interest is a very small percentage of your capex cost of any large project at this point of time. What they need for is the demand will go up. What they need for is there is a requirement of credit in the market. That's where banks' fortunes are made. Now, we all know the story of unsecured credit. That segment is gone. We all know the story of mid-cap companies. Most of them, a good part, have raised equity in the last 2 years, which the QIPs are coming through, the IPOs have come through. Requirement of bank loans has gone down in the system of the credit-worthy bank who could have been lent the money to. Banks have a fundamental problem. They got people who want to borrow who they don't want to lend to, and the people who they want to lend to don't want to borrow from the bank. There's a fundamental, and it's a spin-off of what happened in the equity market. Our companies capitalized it so well.
Okay, may I ask, just as a counter, I agree with you that a large part of the unsecured loan constituency is hurt, but there is one borrowable constituency which has now 1 lakh rupees more in its pocket because of lower taxes. So while capex cycle may not have started off in the way in which one would like it, the retail borrower has more, the potential retail borrower has more money in his pocket, and therefore instead of taking an EMI of 90,000, he can take an EMI of 1 lakh, because there's 10,000 more rupees by way of tax giveaways. As well, banks have been told to lend. Credit deposit ratio is fine, is what the governor is saying. And he's saying that we will give more liquidity. The neutral question is, what is your attitude to banking stocks? Are you attracted to banking or NBFC stock now?
For the last 2 years, we've told you we have not held a single bank stock. We don't hold the banking index at all, zero. And the reasons we just outlined is, and I will not buy the bank stocks again for the same reason. 3 reasons. 1, whom you want to lend to don't want to borrow. Number 2, look at the number of banks compared to requirement. The competition is severe for the good quality names, and therefore it's very difficult to make money in the market. Maybe the banks which have got subsidiaries, which is insurance, mutual fund, etc., will do better. But a pure banking company today really has no way to generate value for your shareholders compared to many other segments of the economy. So for an investor, I think banking still remains a no-go territory as far as we are concerned. Nothing has changed in the whole scenario as far as we are concerned, and therefore their ability to give you shareholder return excess of 15-18%, Lata, is very difficult. The growth rate is 6.6% as the RBI has already mandated. So, how do you generate superior returns for a banking company at this point of time? If I sell some product, maybe I can. But money back, commodity money, I doubt it is the place where you're going to make money for the next year or so. I may be wrong, but 2 years it has done as well. Maybe next 1 year also, banking will become a problem area. The problem with interest rate cut is the borrowers now start expecting and saying, listen, why can't you cut it? The RBI has cut interest rate. The guy who's lending, the FD guy, is saying, listen, I'm not going to give it to you. I'm going to go to the X bank who's going to give me a higher rate. So banks are now caught in a worse jam. The borrowers want it to be lower interest rate, and the depositor saying, if you don't give me the same rate, I'm going somewhere else. Imagine the plight of the bank. Okay. Not a good place for shareholders, right?
Okay. From a shareholder angle, my final question, I'm being very unfair to Malu. I know he's bursting with questions himself. If you take a combination of the budget and the monetary policy, do real estate stocks become attractive? Do consumer durable stocks become attractive because of the BNPL, uptick that may come?
See, real estate stocks have peaked, and I think real estate prices have peaked in the market. Just like any index peaks, all these things happen. 1 lakh crore, 100 crore flats will get sold, and so on and so forth. Just like what happens in a stock market, all of us buy crazy P's or hold on to the stocks. Real estate sector is in for a correction for the simple reason it's too overbought, too many investors sitting in real estate, actual holding who will want to dispose it off. So if you look at the next 3-year scenario, what we have analyzed, there'll be almost 50 to 60% of real estate bought in the last 2 years will come back to the market to be sold. And you know what happens once the prices plateau in real estate? Everybody wants to sell faster and faster. So that's why we said real estate sector, not only for interest rate, leave it aside, but the reason is overbought by financial investors who will want to dispose of properties, squeezing out primary sales out of the market for the real estate developers. So it's peaked, my friend. Unfortunately, if you're still there, whoever gets out, if you're an investor in the share, you're good enough. But I think for the next 1 to 1.5 years, real estate prices, underlying real estate stocks have peaked and will show a decline in our view. Maybe wrong, but that's what our view is.
All right, we take that point, Lata. Thank you for those questions. A lot of them we thought of, you'd asked. We will wrap it up on just one note. You said that you are not looking at the RBI policy or anything. It's the earnings that matter the most. Of the earnings that have come by so far, what is it that you liked, in particular, any sector which you think is on the cusp of a turnaround?
I won't say turnaround because it's already grown up. I think the hotels have surprised on the upside to say the kind of resilience they're showing, and still the rates in the market are absolutely phenomenal. I think that's one sector which has given us a great comfort that for 2 years time frame, you are in a good sector by and large. As a whole hotel, 6-7 companies listed, so you don't have too many choices of that, but also means that the segment is fairly concentrated. So hotels is one. Aviation is definitely the second one, which has surprised to the strength. Yes, there is issues on rupee dollar, which will keep coming in, but I think the demand supply is going to be in favor of these companies. So aviation, hotels, I think is very good. Capex at this point of time has corrected dramatically. So MNC Capex companies, now perhaps the results have been good. As always in market cut down, everything gets sold. But I think the MNC Capex companies represent a phenomenal turnaround scenario for the next 2 to 3 years, in spite of government lower Capex, because they supply to a different part of the industry. And the last one is, I think, auto ancillaries. I think they will be doing well. And the final one, where we have a large holding, is commodities. With rupee at 88, 89, now they can price their commodities 5% higher than they could last year, even if volumes are same. And that all that 5% will go to the bottom line. So I think commodity companies, they are very few in this country, will reap a huge bonus dividend in the next 12 months. Nothing to be done, just thanks to rupee dollar.
Indeed, the weakness in the currency has made the domestic companies far more competitive. That point is well taken. Thank you very much, Ajay, for joining in. He likes hotels, he likes aviation. They've surprised him with the kind of resilience across the last few years. MNC Capex companies, and then you've got commodity names. Get into a break, and that gives us a cue to talk about commodities on the other side of this break with Manisha Gupta.
Did you know there's an asteroid headed towards Earth and there's a more than 1% chance of an Armageddon-style threat to the planet in 2032? In fact, NASA has said the chances that the asteroid 2024 YR4 will impact Earth in 2032 has risen from 1.6% to 1.9%. While it might sound surprising, it's not time to start panicking just yet. NASA was also quick to step in with some reassurance. Paul Choris, who heads NASA's Center for Near-Earth Object Studies, said, and I quote, "We are not worried at all, because there's a 99% chance it will miss, but it deserves attention." The space rock that's between 130 to 300 feet wide was first spotted on December 27, 2024 by a NASA-funded station in Chile. It quickly made its way to NASA's risk list, which tracks any objects that could come close to Earth. While the chance of impact is still low, NASA continues to watch it closely. These probabilities can change as more data comes in, and many asteroids that have appeared risky at first have later been deemed harmless. Right now, no other large asteroids pose a threat with impact probability above 1%. So, while asteroid 2024 YR4 is something to keep an eye on, you may not need to lose sleep over it. For now, NASA's Planetary Defense team is on the case, and we'll keep you informed whenever there's new information available.
I think the underlying innate technology is just right on the threshold, and we'll get there with the next models. But now people have got to go off and build all these services. So someone in this room hopefully will figure out what the AI tutor of the future looks like, and that'll be a population scale thing, and it'll think what that would do if every kid on Earth, this year got an AI tutor that was provided like a better education, or helped to provide a better education than anybody could get last year. Think what it would mean if we could have like an AI medical diagnosis system that was better than anyone could get last year. Think what it could mean if scientists could go cure every disease faster. And so, we've been waiting for this moment for a long time. I think we're gonna deliver something that can help with it, and now people have to go build with it. Other side of it, the cost for a given unit of intelligence 1 year later seems to fall by about 10x. Moore's law was a 2x every 18 months for the number of transistors on a chip, and that changed the world if you waited a few decades. But what's happening with the reduction in cost in AI models is extraordinary. Now, I don't think it means that the world's going to need any less AI hardware, because you bring the cost down and just the people are going to use it for a lot more things. The total number of dollars will go up. But that's a really exciting thing happening.
Welcome back. A couple of mid-caps doing extremely well. Yesterday, we told you about how ITC's cigarette volume growth surprised the street on the upside, right? Well, that stock is seeing a bit of profit booking, or perhaps, the sentiment of other things weighing down on the stock with regards to weak FMCG consumption, etc., is keeping that stock under pressure. The positive of ITC's cigarette volume growth is actually rubbed off on Godfrey Phillips. Over the last many quarters, some 8 or 9 quarters, Godfrey Phillips has actually grown faster than ITC when it came to cigarette volumes. So could that be the case this time also or not, is what the street is betting on. That stock up around 8% on a day when the mid-caps are doing a lot better as well. But the RBI policies done with the rupees weakened. What does all of that have to do with commodities? Manisha joins in on a roundup of that. And Manisha, you're also looking at gold.
Well, I am, yes. We've done an all-time high of 2880 an ounce, and we've come slightly off those kind of levels right now, but the markets are not really giving up because every decline has led to a buying opportunity in India and various other international markets as well. Well, the US president's aggressive trade policies is the major reason for that. And then the street is also looking at global central bank buying, which in the last 3 years has been above $1,000 and 1,000 tons rather. And if you look at the last 15 years, the global central banks have been net buyers in case of gold. The World Gold Council report also tells you that in 2024, the global gold buying has been at a record high. It has been up 1%, but 4,900 tons is what global markets have bought. And apart from that, there also was a Citi report overnight which says that they are preponing their $3,000 an ounce target for gold, and they expect the gold prices to hit 3,000 in the next 1 to 3 months itself. I also want to take you through on what various global central banks really have done in sense of revision in forecasts for their gold prices. When you look at HSBC, Deutsche Bank, Macquarie, well, all of them believe that gold prices could be between 2,600 to 2,800 on the higher side. 2,900 is what ANZ has put it out as well. JP Morgan believes 2,800 to 2,900 is where the gold prices could be trading within. And then you have this complete bandwagon which believes $3,000 per ounce is in the coming, and that is Citi, Goldman Sachs, UBS, Bank of America, which believe that there is more steam left in gold and you could be looking at higher highs from here.
Well, 3,000 doesn't seem so far away when you're already at 2864. Thank you, Manisha, for that. Get into a break. Before that, let's get you the Growth Code, a special initiative by Grow and CNBC-TV18 designed to provide you with valuable insights and strategies to navigate the market and make informed decisions. Today, we'll unpack the risks of speculative trading and the lessons learned in the aftermath of the infamous 2001 Ketan Parekh scam.
Speculative trading creates artificial demand and can inflate prices, often resulting in market bubbles. But one small prick and the entire illusion vanishes in an instant. Speculation is the reason 90% intraday traders end up with net losses.
Speculative trading dominates the market despite its risk is because of the lure of quick gains, lack of common sense, and there's obviously a lot of greed as well. Time after time we have seen this cycle repeating. Right now the money at stake is far higher and is of great concern at the moment.
The 2001 Ketan Parekh scam exposed the perils of unchecked speculation. Fueled by insider information and excessive leverage, Parekh manipulated stock prices to siphon off over 40,000 crore.
One of the biggest things that happened in Ketan Parekh scam was a kind of a narrative that got built. The hype was built so much that it ended up brainwashing the retail investors and traders. The biggest problem here was that while they were investing, the pump and dump scheme was happening simultaneously.
The crisis forced a reckoning, with the market regulator implementing sweeping reforms. Circular trading was abolished. A central fraud registry was created and stock options were introduced for the first time.
The scam definitely highlighted the risk of speculative trading and thereafter shifted the investors' focus to relatively safer and established companies. Investors became far more aware of the risks in speculative trading and the pump and dump schemes. Though the markets post-2020 also need similar kind of awareness.
While the scam helped correct systemic issues, traders also learnt about the risks of speculative trading. Learnings from the Ketan Parekh scam helped India build a stronger, more resilient market.
The MPC decided unanimously to reduce the policy rate by 25 basis points from 6.5% to 6.25%. The MPC also decided unanimously again to continue with a neutral stance and remain unambiguously focused on a durable alignment of inflation with the target while supporting growth.
Every leader, business, government, investment leaders, economists, we're all scrambling to adjust to a very new reality and a new approach, I think it's fair to say, from a US administration who seem very focused on American interests and are quite content to rewrite what have been thought to be kind of historical norms. So those historical norms started really earlier this week with the seeming tariffing of Mexico and Canada. Canada, obviously, a huge close ally of America, but that didn't save them from being on the list, at least for some period of time. Those tariffs subsequently didn't come to pass, at least for now. And to your question, yeah, the Middle East, like everywhere else, we're all looking, I guess, tweet by tweet, Truth Social post by Truth Social post as to what's going to happen next. And that would apparently include some historically astonishing proposals, at least.
Tensions between employees and management at Samsung's Sri Perumbudur plant just outside Chennai have surfaced yet again. For well over 24 hours now, over 100 employees, we're told, have been staging a sit-in protest at Samsung's plant just a few meters from where I'm standing. In fact, this line of company buses and these barricades have been erected by Samsung so as to prevent members of the public and observers, much like myself, to see what's been going on through the gates of Samsung's plant just a few meters from where I'm standing. Now, the issue is simply this. A few days ago, 3 members or employees rather of Samsung's plant were suspended after allegedly engaging in activities deemed detrimental to the interest of Samsung's operations in India. However, employees of the plant, a section of them, and members of the Samsung India Workers Union claim that this suspension was not on account of disciplinary action or disciplinary reasons, but simply because they were affiliated with the Samsung India Workers Union in the first place, also claiming that Samsung does not want any employee to be actively engaged with this recently established workers' union. Now remember, this isn't the first time that issues or a face-off between Samsung's management and employees have cropped up. In September, nearly 1,100 employees of this very plant staged a protest outside plant premises, claiming for better privileges, more representation, better pay, and also representation by way of a union which Samsung said all that while that it was averse to forming in the first place. However, following the Madras High Court's intervention, Samsung India Workers Union became a registered union under the Tamil Nadu Labour Department, thereby ensuring that some of these workers' demands pertaining to representation by way of a union was summarily met. However, these issues clearly...
Welcome back. Bharti Airtel is the top Nifty gainer, 4.5% higher on that, taking its one-year rally to nearly 50%. Quick positives in the numbers. One, the average revenue per user per month. This is basically the monthly bill of customers, and that's gone up 5% quarter on quarter and 18% year on year, and it now stands at 245. Remember, Sunil Bharti Mittal's aspiration is to take it to 300. We're at 245. Secondly, subscriber growth, which came down in the prior quarter because of tariff hikes, bounced back very smartly, 5 million added in Q3. Thirdly, the India mobile revenue. So on and whole, you take the revenues, you take the volumes, you take the realization or the ARPU, and revenues have gone up by 5.8% ahead of what peers have done. And also what the street is taking note of is that the price hikes took place in July. So Q2 and Q3 benefited from the price hikes, and we've seen a near 17% jump in the revenues, which basically means the entire benefit of the tariff hike has flowed through into the revenue. They've not lost anything due to down trading or just losing subscribers on the network. So that is a positive. The entire price hike seems to have been absorbed.
Take that point, and the stock is understandably up around 5% on that data. The other one on our radar is NCC. It's on the back of its third quarter numbers. Sudarshan, how did the numbers look?
So NCC has reported a weak set of earnings. It has missed EBITDA estimates by almost 10%. Margin has missed estimates by more than 100 basis points. But more than weak earnings, what has caught the attention is cut in FY25 guidance. Now, FY25 revenue growth now seen at 5% versus earlier guidance of 15%, and margin is seen at 9.25% versus guidance of 9.5 to 10%. Also on debt level, gross debt has seen a sharp increase. As of December 2024, gross debt was rupees 2,400 crore versus 1,700 crore that company had reported as of September 2024, and it's because of the delay in one of the payments related to JJM. And after this, JM Fin has come out with a note. It maintains buy call but has cut target to rupees 330. Also, it has cut FY25, 26, 27 EPS estimates by somewhere in the range of 12 to 27%. So weak earnings and guidance cut, and because of that, you are seeing a big fall in NCC.
Quite the accident of the day, 10% down on NCC now. But let's get to Upasana now for PG Electroplast. Stock is up 5%.
Well, the company's reported good set of numbers above street estimates, and mind you that the company has raised its FY25 revenue and profit guidance. Now, company says that the growth momentum in the product business continues to remain very strong, which has led to a strong performance, especially in the revenue. Now, company has reported a revenue growth of 82%, which was led by product business, which grew 1.4 times on a Y&Y basis. Now, company says that it is seeing a good momentum in RAC due to channel filling in the anticipation of strong summer season, and clocked a growth of over 1.8 times in Q3 FY25. Coming to the numbers now, revenue stood at 968 as highlighted earlier with an uptick of 82%. Gross margins expanded by 110 basis points at 21.6. EBITDA margins also stood above the street estimates at 8.8% with an expansion of 90 basis points. And lastly, PAT also saw an uptick of nearly 1.1 times at 40 crores. Now, coming to the guidance of the company for FY25, company has overdone a 7% upward revision in the revenue guidance at 4,550 crores now, and 12% increase in PAT guidance at 280 crores for FY25.
All right.
So all in all, strong set of numbers.
All right, Upasana, thanks a lot for that. But Reema, Indus Towers is also something that you're watching.
There's news.
Yes.
So the company has acquired 16,100 towers from Airtel and Bharti Hexacom, and they'll be paying about 3,300 crore rupees for this. Now, Citi says this transaction is favorable for the company. One, because the capital will be used for the core operations. Secondly, the company will be funding this by debt. So it does not in any way change the dividend payout plans. Remember, the street is hopeful now that the Vodafone Idea issue has been sort of resolved. They're getting money from Vodafone Idea. The company will pay a hefty dividend of 18 rupees in Q4. So that thesis remains intact. And plus, according to Citi, valuations are fairly reasonable, which is why they have a buy call. So they've acquired towers, which is core competence for the company, and it doesn't change the expectation of a dividend payout.
All right, we take that point. That's Indus Tower up around 3%. But the accident of the day, the other accident of the day is BKG. Why is that? Because inflation's eaten away the bhujia. Why is that? Again, if you look at the numbers, 14.5% growth in the company's top line, but that hasn't done much for the bottom line. The EBITDA is actually down by 26%. Gross margins have compressed around 257 basis points. And the underlying volume growth is just around 3%. So what explains this revenue growth? The company had to resort to price hikes. Remember, there was a fair amount of inflation that we've seen in edible oil and potato, as well as besan, which are the key ingredients of the bhujia that the company makes. And we have EBITDA margins down from 12% to sub 8%, and the net profit on the back of that down 40% itself. So inflation eating away the bhujia, and that in turn eating away the returns on the shareholders, down 11% for that stock. But we take a short break, come back, put the spotlight on M&M and LIC ahead of their third quarter numbers.
simply on account of the recent suspension of those 3 employees. Now, the issue is simply this. While these employees claim that they were suspended for their affiliation, Samsung in a statement has said the employees in question violated the company policy and have been suspended temporarily and will be subject to appropriate disciplinary action following a formal inquiry, end quote. Now, while it's a case of he said, she said between Samsung and its employees, the fact is that these outstanding issues between Samsung and its employees don't seem to be going away anytime now, given the fact that both the employees and the management seem to be heading in different directions with regard to what they expect of each other pertaining to both representation and a basic disciplinary expectation.
Did you know there's an asteroid headed towards Earth and there's a more than 1% chance of an Armageddon-style threat to the planet in 2032? In fact, NASA has said the chances that the asteroid 2024 YR4 will impact Earth in 2032 has risen from 1.6% to 1.9%. While it might sound surprising, it's not time to start panicking just yet. NASA was also quick to step in with some reassurance. Paul Choris, who heads NASA's Center.
Welcome back. Let's put focus on the numbers then. Today, the big one from the Nifty is M&M, expected to release its third quarter numbers. Sudarshan joins in to tell us what the street expects. Sudarshan, we already have the volume data and we also have the Vahan data that you painstakingly put out every month, much ahead of everyone else. Let's hear you talk about the numbers as well.
So if you ask anyone which are those two segments in the auto sector which have been performing well, and those two segments are in passenger vehicles, it's SUV, and second is tractor segment. So which company is the leader in both these segments? M&M. So you can see in the volumes, YOY for auto, volumes of M&M have increased by 16%, and for tractor segment, volumes are up 20%. So on the basis of strong volume growth, we are expecting a healthy set of earnings by M&M for Q3 FY25. profit is seen rising 29%. Revenue may increase by 21%. EBITDA too can see a rise of 37%, and margin may increase by almost 200 basis points. It may come at 14.5% versus 12.8% that company reported in the same quarter last year. Also, realization may see a rise on YOY, but sequentially it may see a minor dip. Now, talking about the commentary, what exactly we would be looking in the commentary. First, what is the status on overall demand if there is an uptick in the last few months, and what would be the target for FY25, basically estimates for FY25. For tractor segment, considering the demand growth in last few months, if there is any uptick in the estimate for FY25. And lastly, for EV, recently the company has made launches for 2 to 3 new products. So how has the demand been panning out over the last few months?
Thank you very much for that. And this dominance in SUVs and tractors is really showing up in the stock price. 85% up in the last 1 year, 250% up in the last 3 years. And even if you look at a CAGR return over the last 5 years, which is starting the time of COVID, it's been a 41% stock price CAGR for M&M. But we will get into a short break on that note. On the other side, we'll invite the management of Gulf Oil Lubricants. The stock is up 5% post Q3 numbers. We'll get chatting.
Study said, and I quote, "We are not worried at all because there's a 99% chance it will miss, but it deserves attention." The space rock that's between 130 to 300 feet wide was first spotted on December 27, 2024 by a NASA-funded station in Chile. It quickly made its way to NASA's risk list, which tracks any objects that could come close to Earth. While the chance of impact is still low, NASA continues to watch it closely. These probabilities can change as more data comes in, and many asteroids that have appeared risky at first have later been deemed harmless. Right now, no other large asteroids pose a threat with impact probability above 1%. So, while Asteroid 2024 YR4 is something to keep an eye on, you may not need to lose sleep over it. For now, NASA's Planetary Defense team is on the case, and we'll keep you informed whenever there's new information available.
I think the underlying innate technology is just right on the threshold, and we'll get there with the next models. But now people have got to go off and build all these services. So someone in this room hopefully will figure out what the AI tutor of the future looks like, and that'll be a population scale thing, and it'll think what that would do if every kid on Earth, this year got an AI tutor that was provided like a better education, or helped to provide a better education than anybody could get last year. Think what it would mean if we could have like an AI medical diagnosis system that was better than anyone could get last year. Think what it could mean if scientists could go cure every disease faster. And so, we've been waiting for this moment for a long time. I think we're gonna deliver something that can help with it, and now people have to go build with it. Other side of it, the cost for a given unit of intelligence 1 year later seems to fall by about 10x. Moore's law was a 2x every 18 months for the number of transistors on a chip, and that changed the world if you waited a few decades. But what's happening with the reduction in cost in AI models is extraordinary. Now, I don't think it means that the world's going to need any less AI hardware, because you bring the cost down and just the people are going to use it for a lot more things. The total number of dollars will go up. But that's a really exciting thing happening.
Welcome back. Gulf Oil Lubricants. The stock is now in an upper circuit, 9% only buyers, and the stock has crossed its 200-day moving average with the up move. Good numbers. Revenue growth up 6.5% quarter on quarter, nearly 11% on a year-on-year basis, and margins at 13.6%. Ravi Chawla, CEO and MD of the company, is now with us on the show. So for the 9 months, Mr. Chawla, you've done about an 8.5% top-line growth. Correct me if I'm wrong. You had earlier shared a guidance of 12 to 14% for the full year. So, how is Q4 likely to shape up for you? And can you achieve at least a 12% to 14% revenue growth for the year?
Well, for us, we try to grow 2 to 3x the market. And as you know, the last 6 months have been challenging. We are seeing, of course, some headwinds, but also some recovery happening. The macroeconomic conditions in Q3 have been quite challenging, but happy to share that, we are going 2x the market. And we have, as you reported, 8.5% in revenue. Our AdBlue, which was going slightly soft, is now picked up in the third quarter. And overall, I would say our growth trajectory is continuing to be good, as you can see in the Q3 results, which is an all-time high for us in terms of revenue and in terms of our EBITDA, which is 122 crores. So overall, the demand conditions, in spite of being slightly, coming back, I would say, but we've been able to do well. And we continue to 2x the market, at least in terms of our revenue and volumes.
All right, that's incredible. You've been guiding for 2 to 3x, Mr. Chawla, and now you've done 2x in tough conditions as well. So let's get some other details out as well. If you could give us a sense of volume growth in the third quarter, and also if you could break that down up for your consumer business and your industrial B2B businesses.
Yeah, so we have 10% of our business which comes from factory fill, which is the new vehicles, commercial vehicles. So as you know, that is going through a bit of a, I would say, low in terms of that. So that has got impacted. If we take out that, we are actually growing close to 9-10%. And the balance 90%. And if we take our overall, our B2B, B2C ratio is about 55% and 45 is B2B. So that's intact. And if you look at that, yes, we've seen segments like, for us, the motorcycle segment is doing well. That's high double digit. And the industrial and what we call the infrastructure segment, these have started picking up again, double digit growth. So overall, I would say the factory fill has impacted us, but we are seeing some shoots coming in, and hopefully with all the, the budget announced, middle class and others gaining, and we see the trajectory going up. And the fourth quarter for us is generally a strong quarter because we have, though we have achieved our highest ever, we hope that the fourth quarter this continues. And this is usually where our distributors and other such, promotions end and a lot of push happens. And of course, the brand is also very strong. So distribution things come to play. And overall, our B2B businesses are doing well, and OEM is also going to pick up. So I think it augurs well in terms of our fourth quarter.
So what was the absolute volume growth for you in this quarter? And did you gain market share? Where does it stand at?
Yeah, so I forgot to mention it. You started with that. We did 38,500 in terms of lubricants, which is a 7% growth year on year. And this is the highest ever we have done. And sequentially, earlier used to be about 37,000 in most quarters, the best quarters so far, now 38,500. And I think that's the volume growth we have. And AdBlue also has picked up, I would say around 36,000 is what AdBlue is. So that's again a good growth for us, 13% odd. So overall, I think 13% year to date in AdBlue. So overall, good numbers coming in Q3. And I think what we've also shown that how resilient our business model is in spite of, the headwinds and of course, happy to see early signs of demand recovery.
So 7.5% volume growth in Q3. Considering Q4 is stronger, what could be the volume growth in Q4? And also you've said exports have done well. What was the growth?
Yeah, so exports is quite high. I would say more than 20% growth in exports. And that's good for us. We're exporting to more than 25 countries for our 4 or 5 of our OEMs. And yes, 2x of the market. Whatever happens in Q4, if demand conditions are 3 to 4%, we are hoping we can do well on that and try to do better than that also.
What is the export contribution now? 20% growth, and is that sustainable, or do you see it with rupee depreciation? We should see higher growth.
So exports is mid-single digit. It's not that high in terms of volume, but doing well. And yes, good prospects on that. As we see the Indian OEMs going, and also a few other, we would announce a few more partnerships with OEMs for export shortly. So I think that also augurs well for us, looking at India as a good supply place also.
Where does your market share stand at right now versus the start of this year? Since you've been growing faster than the market, we just want to get that number out.
So normally, we have different segments, so it would be segment wise, but as a benchmark, if we are growing 2x the market, we would generally gain about 0.5% market share or, 0.4, 0.3%. Certain segments, obviously, we try to do better. Industrials and others, we are less than 5% market share. So segments like diesel engine oil, motorcycle, we have higher share, close to 9-10%. And of course, amongst OEMs in the private sector, we are a lead player. So it varies, but benchmark wise, if we are doing 2x the market growth, we would gain about 0.3, 0.4% market share.
Any price decision?
Yeah, sorry.
Any price decision taken in Q3 or you plan to in Q4?
Well, we have to wait and watch on the foreign exchange because we do import our base oil and low crude we expect it to be steady. I think we have some adjustments we do in our trade schemes, etc. But we'll have to wait and watch the next couple of days to see what is going to be the impact on the forex.
Right. Are there any downside risks to your margins or any upside triggers? Because the downside risk would be your base oil being imported, and the upside risk would be premiumization along with the crude oil prices itself being range bound.
Yeah, so we've been saying 12 to 14%. Happy to share last quarter was towards the higher end. And of course, it's affected. We have a lag time on the increase in the base oil. Forex, of course, also impacts us. But we've also been focusing a lot on our premium product ranges, which are less than 10 today. But we are trying to grow that 2 times. So if we are growing 7%, we would like to grow 2 times that, and that's happening successfully. So I think it's a mix of managing that. But I think we are quite committed to the 12 to 14% band as of now. And of course, we'll have to wait and watch unless there's something which is going to really, but there's a lag time, and then the recovery also happens in the B2C market. The prices go on. Then the B2B business is more, PVC led and also contract led. So I think we are good for that 12 to 14%. Happy to do more, but obviously depends on the competitive scenario also.
All right. On your battery business, you were looking at around 300 crore in the next couple of years. Where does that stand at? And Tyres as well. You were expecting to, double that revenue and turn EBITDA positive. So what's the update on that before we let you go?
So on Tyrex, which is primarily into DC chargers, the fast chargers for the EV market, happy to share that, as you mentioned, we are looking at doubling the turnover and more. We are well on course with that, but it's they've got 8-10% market share, and we're happy to say we're 1,800 DC chargers installed. So we are on track to double that in terms of turnover, and obviously the market is going to grow. On the battery business, happy to share that again we are growing, but we do have the 300 crores. I think is more of a longer term vision for us. We are at about, I think, around 75-80 crores annually on that. But last quarter has been good. We've also, we used to import most of the batteries. Now we are getting some local sourcing done. And that is a business which also helps us in terms of our synergy of our distribution. And that's really where we are. And that's more of a medium-term vision, the number you gave. Yeah.
Take that point. Thank you, Ravi. Always a pleasure speaking with you. Wish you good luck for the remainder of this year as well. And 2 to 3x is your guidance, always above the market, gain market share and stay margins between 12 to 14%. Take a short break, get you more on the markets on the other side.
कुछ लोगों को अब जब एआई की बात होती है, कुछ लोगों को अब ये शब्द फैशन में है तो बोला जाता है, लेकिन मेरे लिए सिंगल एआई नहीं है, डबल एआई। भारत की डबल ताकत है। एक एआई आर्टिफिशियल इंटेलिजेंस, दूसरा एआई एस्पिरेशनल इंडिया। हमने स्कूलों में 10,000 टिंकरिंग लैब्स शुरू किए और आज उन टिंकरिंग लैब से निकले बच्चे रोबोटिक्स बना करके लोगों को चकित कर रहे हैं। और इस बजट में 50,000 नए टिंकरिंग लैब्स उसका प्रावधान किया गया। भारत वो देश है जिसके इंडिया एआई मिशन को लेकर के पूरी दुनिया बहुत आशावादी है और विश्व के एआई प्लेटफॉर्म में भारत की मौजूदगी एक महत्वपूर्ण स्थान प्राप्त कर चुकी है।
This was the third consecutive year that the BMC budget was presented to an administrator and not to a standing committee. Why? Because the term of the corporators ended in March 2022 and the elections for the new term and the new corporators are yet to be held. Now this 74,427 crore rupees budget, out of this an allocation of 43,162 crore was made for capital expenditure, 5,100 crore rupees for roads and traffic department, 5,807 crore rupees for Mumbai Coastal Road project, 3,039 crore rupees for storm water drain department and 650 crore rupees for sewage operation department. For key public services, rupees over 4,000 crores were allotted to education department, over 7,000 crore for health department, 261 crore rupees for fire department, 309 crore rupees for disaster management and 220 crore rupees for the garden department. BMC announced that it's going to start 250 new public clinics, also known as Apla Dawakhana, all over the city. One interesting initiative announced by the BMC was the introduction of cyber awareness program for students. It will serve two key purposes. One will be to ensure that the students learn how to use the internet in a safe manner and to keep them safe from cyber fraud. BMC also focused on environment.
Well, we are seeing some recovery for the Nifty right now, up around 50 odd points, 90 points up for the Sensex. Trent is one of the stocks which was under pressure in yesterday's trading session post their numbers, but now showing some bit of recovery from the lows. The auto pack is doing extremely well. So we have Bajaj Auto, M&M ahead of its numbers, as Sudarshan said, Hero MotoCorp doing well too. So we'll wrap up on this edition of Trading Hours. Stay tuned. Halftime report comes up next, but it's not just halftime report. You're also looking at the RBI presser or the press conference of the new RBI governor. We'll get you all that and more in just a bit.
And projects like promoting eco-friendly cremation and proper disposal of residue from idle immersion. These are the projects which will take place under environmental related initiatives in the next few months. We also spoke to Bhushan Gagrani, the BMC commissioner himself. This was the first time that he presented the BMC budget. Listen to what he has to say about this BMC budget. So your budget also mentioned that you guys are planning on imposing a tax on the commercial properties in slum areas.
That's right.
If you can elaborate that. So from when this new tax will be levied, sir?
It is actually not a new tax. In fact, we are enhancing our assessment net. Under the assessment net, the properties which are in the slum, however, which are being used for the purpose of commercial, they were not covered. So this is for the first time we are doing the survey and bringing them in the tax net. Not necessarily that we will be imposing huge tax. It's a normal tax. It's not a very huge tax. However, the coverage will be given to our commercial properties.
So BMC has not introduced any new project this time. In fact, you have focused. Correct.
Yeah.
But sir, does it mean that is there any cause for fiscal concern, sir?
No, there is no fiscal constraint. We have enough adequate cash flow as well as resources.
informed decisions with comprehensive analysis on the go.
Strengthen your portfolio with real-time market updates on the go. Create effective strategies with insightful expert opinions on the go.
Grow on the go with CNBC-TV18, now streaming live 24/7 on YouTube. How about listening to global market maestros before crafting your investment strategy? How about getting deep insights into their businesses from top Indian honchos before putting your money on the line? How about making every trading day profitable with strategies from the market masters, macro pundits and chart wizards? Only one show gives you a head start to your trading day. Get ready to profit. Get ready for business with Bajar at these times on CNBC-TV18 and CNBC-TV18.com.
What does it take to build India's largest startup platform? It takes a journey of starting out as an unknown and ending up as unforgettable. It takes more than 2 decades of celebrating the most influential and influencing the most celebrated entrepreneurs. From chronicling the stories of India's startup universe to becoming a success story in itself, as India's longest-running show on startups and entrepreneurship, celebrating 21 action-packed years of building India's biggest startup community. Young Turks at 21, only on CNBC-TV18 and CNBC-TV18.com. CNBC-TV18's most comprehensive and award-winning news show, India Business Hour, drops first on YouTube. So get the first access to the most influential architects of policies and politics, the key newsmakers of the day. Discover the big themes as we decode the business of markets, macros and more. Be the first to go to the heart of all.
Hello and welcome to Halftime Report. The Reserve Bank of India has just announced its monetary policy, and the Reserve Bank of India top brass, including the new Governor Sanjay Malhotra, are all set to address the media after the announcement of that 25 basis point rate cut, widely anticipated by the market. The markets were expecting a bit more on the liquidity front, where RBI has chose to play cautious given the uncertainty in the global macroeconomic environment. We've also seen the CPI forecast for next year slightly lower than this year's 4.8% at 4.2%. The GDP forecast for next year is seen at 6.7%. So lots of cues to watch out for. We have the Reserve Bank of India governor that will shortly be addressing the media on various questions. I think we'd also want to know more on what the governor says about the LCR, the ECL, the project finance rules, all these guidelines that are about to kick in over the course of the next few months that require banks to keep aside additional capital. Whether or not that is deferred, we'll have to watch out for. But take a look at the governor.
Shri M. Rajeshwar Rao, Shri T. Ravi Shankar, and Shri Swaminathan J. We also have with us executive directors Dr. O.P. Mal and Dr. Rajiv Ranjan and other colleagues from the Reserve Bank. To begin with, as is the practice, I'll request Governor to make his opening remarks. After that, we'll have the question answers. Governor, sir.
Well, good morning, good afternoon, and welcome to this press conference. I already made my statement, which we have also uploaded, and I'm sure you would have already gone through it. I do not have anything more to add. The MPC resolution, the rationale for it, and some of the other additional measures that we have brought in are very clearly communicated over there. So I think we can directly move towards the Q&A. I think that will give more time for all of you to ask additional questions. So we can begin, I think, with the Q&A directly.
Thank you, sir. Just before we begin, a couple of announcements as always. I'll request you all to please wait for your turn. and restrict to one question per person. And if time permits, we can always go back for the other one. So you can see my colleagues on the aisle with mics in their hands, so they will give the mics to you. So please speak in the mic so that people outside can also hear you. So there are 27 participants from the media today, and with your permission, I'll call out their names. I'll request Lata from CNBC to ask her question.
Thank you, Governor and Deputy Governors. Sir, I just want to first clarify a language part and then my question. Because in Para 7, where you are announcing the rate cut, you say that the MPC remains unambiguously focused on durable alignment of inflation while supporting growth. So inflation first, then growth. In the immediate next paragraph, you are saying the growth inflation dynamics open up policy space for the MPC to support growth while remaining focused on aligning inflation. So should we read this as deliberate or casual? And the question I have is, rate cuts normally get passed on when liquidity is surplus. So would your stated policy be to keep liquidity surplus in the interbank system or just adequate? Thank you.
So let me come to your second question first. I think that was attempted in the statement also that we made. And you would have observed in the last couple of months and even before that, that it has been the endeavor of Reserve Bank to provide as much liquidity as is required. And when we say liquidity, as I also mentioned in my statement, it is both, overnight as well as durable liquidity. We have taken a number of steps. You are aware, that we introduced, perhaps for the first time, a regular pre-announced, every day overnight repo rate operation. So this was primarily to give confidence to everyone that this window is always available insofar as the transient or the overnight liquidity is concerned. Even for the longer term durable liquidity, we have announced steps of about 1.5 lakh crore, some of it which have already been put into operation. 20,000 crore of OMOs have already been done, another 40,000 crore later on. Today, we are going to have a 56-day VRR for 50,000 crore. We are always watchful. We'll be nimble. I want to assure that we'll be very, very proactive in providing whatever liquidity requirements are needed. That's one of our jobs, and we will do it. Coming to your first question, I really did not, understand as to what you are. Everything, every statement, every word that is mentioned in the MPC statement, and especially, the resolution, because you were pointing at the resolution, is very, very well crafted, thought out, and deliberate.
Thank you, sir.
Thank you.
Thank you, sir. Next will be Swati from Reuters.
Thank you so much, sir. So your growth forecast for next year is at 6.7%. This is yet again at the upper end of the government's range. They've given us a 6.3 to 6.8. And as we saw last year as well, RBI had to lower their projection towards the end. What gives you so much optimism on growth, especially when you're saying that, you remain neutral purely because inflation risks could come up again with the heat waves, etc. So what gives you the optimism on growth, sir? Thank you.
See, all the parameters we analyze very regularly, the high frequency indicators that we have. And whether one looks at agriculture with good reservoir levels, and I've made detailed assessments even in my MPC statement. You can go through them as to what are the reasons actually. They are all given over there. So in interest of time, I am just shortly, very briefly indicating them. So whether it is in terms of agriculture, whether it is in terms of consumption. Now, you also, recently had the Nielsen survey, the consumption numbers over there, at 7% plus, augur very well. And this is the kind or the range, of projections that we too have. for personal consumption. And similarly, the manufacturing activity, is also kind of picking up. The PMI levels that we got were very comfortable over there. So all this gives us the optimism that we will have what the numbers we have projected. I also mentioned in my statement that we will continue to improve, our macroeconomic models, our nowcasts and forecasts, so as to be able to give as precise a number as possible. Please bear in mind that these are just forecasts. Every day, situations change, and as people say, as your facts change, your opinions also change. So those, it's subject to that. Thank you.
Thank you, sir. We'll move to Mr. Manojit from Business Standard.
Thank you, Governor. Thank you, Vinci. Is it fair to say that at this point in time the priority is growth over inflation? And what could be the real rate at this juncture of growth inflation dynamics?
See, the RBI Act has given us a very, very clear mandate. Our primary objective, see, for some countries, you are aware, it's a dual objective, where very explicit dual objective to have both price stability and growth. In our case, the primary objective, that is not to say, the other objective is not important. The primary objective is inflation, is price stability, keeping in view the growth objective. So we will continuously, focus on that, trying to meet, these objectives. We will try to align the inflation with the target that has been given to us, at the same time supporting growth. At present, as the resolution also says, we felt that time has come that we can be more supportive of growth because inflation is coming down. It is expected to go down. However, it also says that we will maintain a neutral stance so that we are able to proactively respond to the evolving macroeconomic conditions. Thank you.
Sir,
Thank you.
Real rate. What could be the real rate according to you, given the current growth inflation dynamics, the real interest rate?
See, today we are at 6.25%, and the inflation is 5.2%. That is the CPI inflation. The WPI is lower, so that would give you, a real rate of about, let's say, 1.5% or so. That's what it is at present.
Thank you, sir. Moving on, we'll have Mr. Anup from Bloomberg.
Sir, coming back to the inflation forecast, inflation target again. We have 2 to 6% inflation band. You have that convenience of that band also. You mentioned that of the flexible inflation targeting. And at the same time, your original target is 4% for the medium term. So, just wondering, will you be comfortable if inflation remains within the 2 to 6% range, or you will want to see inflation durably settling around 4%?
Sorry, what did you say your name is?
Anup Roy from Bloomberg.
Anup Roy. I'll ask you, when you go to an exam, in that exam, the maximum marks are let's say 100. The passing marks are 40. What do you aspire for? Do you aspire to pass, or do you aspire, to do extremely well? Well, some may, like to just pass. In RBI, we like to we like to be on top of everything.
Thank you, sir. May I have Mr. Ankur from ET Now?
Ankur Mishra from ET Now. While economic
survey says that 6.3 to 6.8% is the growth forecast for the next financial year, and you have taken the upper end. When I asked this question to CEA, that is there a possibility of 7% plus growth, he said yes, it is possible. I want to ask you now, as per your assessment, is there an optimistic possibility of that? And one more question, sir. Regarding the ECL provisioning and project financing norms, you have mentioned in the statement right at the front, but you also said phased implementation. Now, these implementations are as soon as from next month or 1st of April. As per the draft norms, of course, the final norms are yet to come. In project financing norms, it was mentioned that it should be 2% in the current financial year, and then in FY26 and FY27. Similarly, for LCR norms also, 1st April 2025 was the tentative date which was given. I want to understand, where do we stand here? Is there going to be a deferment, or these will be implemented? Thank you.
Your first question, whether 7% is achievable. See, these are difficult questions to answer, but nevertheless, I would like to stick my neck out and say that certainly India can, achieve 7% and plus growth rate. We should certainly, aspire for that. Coming to your second question, which is related to some of the guidelines, that we have issued, LCR, ECL, project financing norms, etc., etc. I made it very, very clear, that we will be doing a balancing act. It is not only about stability. It comes with a cost. We will be very, very conscious of the costs that it brings in, so that, we make efficient use of our resources. I want to also clarify, because you asked specifically about LCR, and we did make a mention over there that we will give sufficient time. I do not think 31/3/2025 is giving sufficient time. So certainly they will not be implemented, before, at least, before 31/3/2026. That's the kind of timeline that is needed at the minimum. The draft regulations were circulated. We have got comments. We are examining them. It will take time for us to examine. You see, liquidity is important for everyone. Let's please, try to appreciate that why we are doing this. We are doing this primarily, so that there is no run, on the banks. You would have witnessed it, in 2023, there was a run on some of the US banks because they do not have, such kind of regulations. Now we have those regulations. But whether the liquidity that we have, provisions that we have, whether they are sufficient or not, that and they need to be always, continuously need to be improved. So that's why, we had provided for certain more liquidity to be kept vis-a-vis some of the deposits which we felt, would perhaps, have a higher runoff. That has been provided in these draft regulations. At the same time, we have got now comments from other stakeholders that there may be lower liquidity requirements for some of the other deposits. So we are examining that also. As soon as we are able to examine all the suggestions. And I'm very happy, to note, having come here to the Reserve Bank, that we do, an impact analysis over here. So that impact analysis will be done, has been done to some extent, but come, with the suggestions that have now come in, we are revising our estimates, our impact analysis, and we will give, a time frame as to when one can expect LCR. Similarly, the other guidelines also we will give sufficient time frame. You can rest assured, that they will certainly not be implemented as quickly as 31/3/2025, because that will certainly not be sufficient time. We do not want to cause, any disruption. We will ensure a smooth transition. Thank you.
Said not until March 26.
Yes. Thank you, sir. Please, let's go with the flow. Let him ask a clarificatory question only with regard to this. Please speak in the mic.
26. It will not be before 25.
Be very, very clear. It's more than 1 year.
2 months, less than 2 months is too short a window for the banks. We realize that. And so, we will give at least 31, at least. Doesn't mean it has to be 31/3/2026. We'll aspire for that. But we want to make it very smooth, and it will also be phased. It will not be, that all the regulations, all the norms kick in from day one, which will be at the earliest 31/3/2026.
Thank you, sir. Next is Hamsini from Money Control.
Hi, sir. I'll stay put on this part around regulations. Your language also today seemed to indicate that there will be a lot more consultative process in the way that you would go about building regulations. You did clarify on LCR, but what we've also seen, especially in the last 4 years, and more so in the last 1.5 years, is certain banks and NBFCs facing ban on businesses, certain aspects of businesses. There are 2 large banks still waiting to come out of restrictive business policies. Would you rethink your approach on how you would want to target banks or work with them to rectify some of the follies? And as a clarification, you did mention about LCR, but what about on project finance and investment guidelines that banks are permitted to take in subsidiaries, etc.? Would you want to defer, or there has been request for a deferment on that as well? Would you want to consider those proposed policies also favorably, sir?
See, ECL was only a discussion paper. Even the draft is not out. So there is no time frame for implementation of ECL guidelines. Similarly, project finance, you can rest assured, I think they will need more time. 31/3/2026 is the earliest. Moreover, they need to be seen in conjunction with each other. There is a certain amount of overlap between ECL and project finance. So we are examining, because for project finance, the draft regulations were certainly published, comments have been received, suggestions have been received. We are examining them, and we'll come out with something, I want to assure all of you, that which balances the interests of the public, the depositors, the financial stability, which is very, very important for our country, and at the same time, the concerns of the banks, keeping in mind the efficient use of resources. And what was your second question? Sorry, is on, two banks, where we have cease and desist measures. See, these measures are taken after great consideration, after great thought, after giving opportunity to these entities, whether it is these banks or others. I'm not, making reference to any particular entity. And these are measures actually, of last resort. We would not like to use them, too often. This is a measure of last resort to be used in the rarest of the rare circumstances, when all other measures have actually failed. And they are again, in the interest of the public. And we'll keep, this policy going forward as well. Thank you.
Thank you, sir. Next will be Ms. Gopika from the Mint.
Thank you, Puneet. Thank you, Governor. My question is on inflation forecast. You've retained the inflation forecast for this year and next year. But have you taken into account the impact of rupee depreciation while accounting, or have you factored in the impact of rupee depreciation while calculating or looking at the forecast? And my second question is on the new Deputy Governor. For monetary policy, when can we expect the appointment?
Second question you have to ask the government, it's not for me. Your first question, yes. The latest rupee to dollar rate was taken into account while making all our projections. So and we also do various sensitivity analysis. So yes, a brief answer to your question is yes, that was certainly considered while making our projections.
थैंक यू सर. अब मैं जी बिजनेस से एकता सूरी को आमंत्रित करूंगा.
गुड आफ्टरनून सर। सर हमने आपकी स्पीच में सुना कि आपने फ्रॉड्स के ऊपर बात की कि .in होगा बैंकों का डोमेन नेम, लेकिन बहुत सारे इश्यूज हैं जो कस्टमर्स फेस करते हैं फ्रॉड्स की। अगर हम बात करें, सबसे पहले कोई रिपोर्ट करता है फ्रॉड तो उसे पैसा जल्दी वापस नहीं मिलता। दूसरा, पेस्की कॉल्स बहुत ज़्यादा आते हैं नॉर्मल मोबाइल नंबर से। बहुत बार आपने बोला है कि आप टॉपअप लोन्स जो होम टॉपअप लोन्स है उसे पर्सनल लोन्स की तरह एडवर्टाइज मत करें, अभी भी वो हो रहा है। 1600-140 नंबर्स भी आपने बोला है ट्रांजैक्शंस और मार्केटिंग के लिए होंगे, लेकिन वो भी कोई नहीं सुन रहा। तो ऐसे सिनेरियो में क्या आरबीआई कोई स्ट्रिक्ट एक्शन लेगा बैंकों के ऊपर ताकि ये कस्टमर का बचाव हो इन सब सिनेरियोज में?
निश्चित रूप से हमारा पूरा प्रयास रहेगा कि जो भी हमारे ग्राहक हैं, जो जनता है, उनको अधिक से अधिक सुविधाजनक तरीके से बैंकिंग की समस्त सेवाएं उपलब्ध हों, चाहे वो बैंकिंग फ्रॉड से संबंधित हो जैसा कि आपने कहा, या आपने कहा पेस्की कॉल्स उनको आते हैं, उसमें किस प्रकार से जो है हमें उसमें कार्य करना चाहिए, किस प्रकार से हमें उन्हें हिदायत देनी चाहिए और क्या हमें उसके खिलाफ एक्शन लेना चाहिए, वो निश्चित रूप से इस संदर्भ में लिया जाएगा। और अधिक आपने कई सारी छोटी छोटी चीजें पूछी हैं, विस्तृत जानकारी के लिए मैं अनुरोध करूंगा हमारे डीजीज को कि वो आपको इसके बारे में कुछ और, क्योंकि हमने कई कदम इसके बारे में ऑलरेडी लिए हैं, तो संक्षेप में मैं रिक्वेस्ट करूंगा स्वामीनाथन जी को और राजेश्वर राव को कि वो इसके बारे में बताएं। और आप यू कैन स्पीक इन
Yeah, thank you, sir. Thank you. I'll take the liberty of responding in English.
I know you
avoid any ambiguity.
Yes.
To avoid any ambiguity, thank you, sir. I think just to supplement on that, yes, you also mentioned about the steps that we have already taken. So as far as the regulated entities are concerned, instructions are already in place to use certain series of 140 or 1600. We also do a lot of awareness campaigns to educate the consumers how to stay away from pesky or fraudulent calls. As it is also put in place from a regulation perspective, limiting the liability of customers in unauthorized electronic banking transactions is in place. The provision to give us shadow credit pending full investigation is also kept in place. And adherence to this is also examined when we do the on-site supervision. But oftentimes there are also pesky calls that emanate from unregulated entities and apps and platforms. This is something which only an active collaboration of the government, regulator and the law enforcement we will be able to work on. But this is something which we are conscious of, and we will take every possible step to ensure that the consumer's interest is protected. And wherever there has been a loss, it is our endeavor to work towards an early redressal.
Sir, I know you've mentioned a lot of things that are already in place, but since banks, even if RBI continuously keeps on saying that you have to do this, banks do not listen. Till the date, banks have advertised home top-up loans as personal loans, saying take the loan, use it for your marriage, use it for travel, or when you go for a loan, they insist on taking, you have to take an insurance or a credit card. Mis-selling is on rampant. So on these issues, any supervisory action?
See, there are 2-3 issues that you mentioned. Each of them, of course, the framework is certainly in place. Oftentimes, as the owner also mentioned, many of this behavior which is not consistent with the regulations, we resolve through dialogue. A supervisory action which gets publicized is only in the rarest of the rare cases where there are egregious violation or the most outlier behavior. Otherwise, oftentimes, the supervisors engage with the entities on a bilateral basis and ensure that the regulatory guidelines are adhered to. So that shall be our endeavor. You may not get to read them in the media, but wherever there is a non-compliance, on an annual basis and also on an ongoing basis, we deal with the entities, and oftentimes they all are complied with over the course of time.
Just to add to DG Swaminathan, the
guidelines are already in place regarding top-up loans, what are the end use, etc. If it is given for unauthorized different purposes, it would be taken as an unsecured lending and will have to be dealt with accordingly by the bank. That is one point. As regards this mis-selling and forced insurance, RBI guidelines are already in place regarding this mis-selling issues, and we are also looking at comprehensively reviewing these guidelines. We should be trying to come out with some guidelines shortly on this area also, on the conduct of the banks in various areas.
थैंक यू सर्स. अब मैं अनुराग शाह से आग्रह करूंगा कि वो अपना प्रश्न पूछें.
थैंक यू पुनीत सर. थैंक यू गवर्नर. सर, जिस तरह से आरबीआई ने भी कहा था कि जो बैंकों के द्वारा इंश्योरेंस कंपनियों में निवेश किया जाता है या फिर जो दूसरी सब्सिडरीज में निवेश किया जाता है, उसके निवेश से जुड़ी हुई गाइडलाइन जो है वो आरबीआई की तरफ से कब तक आ जाएगी, और क्या उसमें हम ये भी देख सकते हैं कि जो बड़ी इंश्योरेंस कंपनी है कोई बैंक के अंदर मेजॉरिटी हिस्सा खरीदने का भी उस तरह का प्रावधान होगा? और सर, अभी जब जिस तरह से कुछ वक्त पहले वित्त मंत्री ने भी बैंकिंग प्लेटफॉर्म के जरिए मिस सेलिंग की चिंता जताई थी, चीफ आईआरडीए के चेयरमैन के द्वारा भी चिंता जताई गई थी, स्पेशली इंश्योरेंस के संदर्भ में, तो क्या आरबीआई का डेटा भी उसको सपोर्ट करता है या फिर आरबीआई का क्या कहना है?
नहीं, देखिए, जैसा कि अभी आपको स्वामीनाथन डीजी ने बताया कि मिस सेलिंग के हम लोग बिल्कुल सख्त खिलाफ हैं. कोई भी इस प्रकार का यदि वाकया होता है, इस प्रकार का कोई भी इंस्टेंस हमारे ध्यान में आता है, तो निश्चित रूप से उसके विरुद्ध सख्त से सख्त कार्रवाई की जाएगी. आप इस बात के बारे में बिल्कुल 100% निश्चिंत रहें कि किसी भी ग्राहक के विरुद्ध यदि मिस सेलिंग की कोई भी शिकायत है तो रिजर्व बैंक उसके लिए उसके साथ में नहीं है और उसके विरुद्ध में उस बैंक या रेगुलेटेड एंटिटी के विरुद्ध में कार्रवाई होगी. कार्रवाई किस प्रकार से होगी, जैसा कि टीजी स्वामीनाथन जी ने भी आपको बताया, वो हमारे को उसके लिए ऐसा नहीं है कि हम उसको बैंक को बोलें कि हम आपका रजिस्ट्रेशन ही बंद कर देते हैं, लाइसेंस बंद कर देते हैं. ऐसा तो नहीं किया जा सकता, आप भी ये समझेंगे. लेकिन हम इसके लिए बहुत ज़्यादा गंभीर हैं और इस प्रकार की अगर कोई घटनाएं होती हैं तो उनको गंभीरता से लिया जाएगा. पहला आपका जो प्रश्न था वो था कि किस स्वरूप में जो बैंकिंग कंपनियां हैं और उन्होंने कई सारी अपनी सब्सिडरीज वगैरह बनाई हुई हैं, एनबीएफसीज हैं, इंश्योरेंस कंपनीज हैं, उसके बारे में एक मसौदा जो नियम का है, रेगुलेशंस का, वो हमने प्रकाशित किया है और उसके बारे में कई सारे सुझाव हमारे पास में, टिप्पणियां, सुझाव हमारे पास में आए हुए हैं, उनका हम अध्ययन कर रहे हैं. देखिए, जैसे मैंने आपको बताया, ये सब चीज़ों को हम ध्यान में रखते हुए उनके सुझावों को पूरा से गहनता से अध्ययन करने के बाद में ही कोई निर्णय लेंगे. मैं इतना ही इसके ऊपर में आपको बताना चाहूँगा कि अगर कोई कंपनी या बैंक एक और सब्सिडरी के मार्फत से वही बिजनेस, वही व्यापार करती है, तो उससे जो है दो प्रकार की हमारे को समस्याएं सामने आती हैं. एक, कॉन्फ्लिक्ट ऑफ इंटरेस्ट रहेगा, क्योंकि वो सेम कंपनी है तो इस कंपनी में व्यापार हो या उसमें हो तो एक कॉन्फ्लिक्ट ऑफ इंटरेस्ट है. दूसरा जो इसके अंदर में समस्या है वो ये है कि एक रेगुलेटरी आर्बिट्राज है. बैंक्स एक अलग कानून के ढांचे में कार्य करते हैं, एनबीएफसीज एक अलग कानून के ढांचे में करते हैं, तो उसकी वजह से जो रिस्क्स हैं एनबीएफसीज के वो बैंक्स के ऊपर में न आए, इसके पीछे में ये जो हमने जो मसौदा प्रकाशित किया है उसके पीछे में ये है, ये उसके पीछे में विचार है. ये बात भी हमें ध्यान है कि कई सारी कंपनियां, कई सारे बैंक्स ऑलरेडी इसमें लेगेसी इश्यूज हैं, तो वो ऑलरेडी जो हैं उन्होंने इस प्रकार की कई सारे एनबीएफसीज, कंपनियां, सब्सिडरीज स्थापित की हुई हैं. तो उनके बारे में अब हमें क्या करना होगा, क्योंकि हमने ही उनको इस प्रकार की पहले अनुमति दी. तो अब इन सब चीज़ों को सोच करके और विचार करके किस प्रकार से हम आगे इसमें एक सब मिलजुल करके, ताकि लोगों के जो डिपॉजिटर्स हैं उनके भी ध्यान को, हित को ऊपर रखते हुए, और साथ ही साथ जो हमारे अन्य जो हितधारक हैं जिनमें बैंक भी सम्मिलित हैं, बैंक के ओनर्स सम्मिलित हैं, तो उनको सबको ध्यान में रखते हुए ही हम कोई कदम इसके बारे में लेंगे.
धन्यवाद सर. Next will be Mr. Vishwanath from NDTV Profit.
Good afternoon, Governor. Thank you so much, Minister. Governor Vishwanath Nair from NDTV Profit. Two things that made sort of a debut in your speech. First was the less restrictive monetary policy, which I think a lot of people expected a rate cut but weren't sure how long this is going to last. So I just want to understand from you, when you say that the MPC feels a less restrictive monetary policy is appropriate in the current juncture, is it limited to this policy, or are we talking about the next few quarters? And the others, like second part which made a debut, and that's in continuation with these regulatory moves, is the cost of regulation, which I've never heard the RBI talk about. At least the RBI always talks about the need for regulation, not so much the cost for regulation. Yes. I just wanted to understand from you, so far a lot of my colleagues here have written about how the RBI is a no-nonsense regulator, sort of an iron fist type of regulator. Are we changing that face at all?
No, I can't talk, about the past. It will not be correct on my part, to sit on judgment. But I would certainly say that RBI as an institution has been able to, over the years, carry out the mandate that has been given to it. And I would also like to say that I do think that the cost of regulation may not have heard of it is a different thing. But I think back, consciously or unconsciously, I think consciously, this would certainly have been a factor in determining what, they are going to do. You may not have heard it, that's a different thing. So I can't say about that. But what one can see, having been outside the RBI and having interacted with the RBI, been on board of the RBI, is that certainly, all these factors are certainly, considered while making any regulations. It's not only, about financial stability, it is also, about the cost at which, these things come in. I only made it very, very clear so that everyone is, assured about that. So this is one. And second, you said, whether this is policy only for this. Well, obviously, when we are keeping a neutral stance, and as was mentioned, the rationale for that is the tremendous uncertainties, that we are facing today. That does not call us, to change our stance. So our stance remains neutral. This less restrictive policy is only, for this particular MPC meeting, and not, going forward. This stance continues to be neutral. Thank you.
Thank you, sir. Next, we'll have Mr. Chris from FT.
Hi there. Thank you very much. I was wondering how concerned you are about the recent pressure on the rupee going forwards, and are you also worried about imported inflation?
Well, see, the rupee is the rate, that the rupee settles at is a function, of the demand and supply, number one. Number two, I would also like to say, that we should really, not be looking at, but that's, perhaps our job, and so we do it. We should not really be looking at, a day-to-day kind of a volatility. It is, more the long-term rate, that we should be looking at. And when I say this, I say this, not only for the rupee, but also for other asset classes, whether it is the Sensex or the Nifty, or whether, it is the gold prices or the asset prices. Day-to-day movements may not be, all that, important. As I mentioned, this was certainly factored in while deciding on the rate cut and the stance that we are maintaining. It was certainly factored in. That's one thing I would like to say. And the second thing is, of course, as you are aware, that a higher or a lower, or depreciated rupee certainly, puts pressure on inflation. But at the same time, global uncertainties are also, I think, a higher worry, for us would be the global uncertainties as to how, that pans out. So global uncertainties, even if, the trade wars, the tariff trade wars were not to carry out, but just the uncertainty in itself is something, which is worrisome. And that, because, that has direct impact on growth, that has direct impact on investment decisions, that has direct impact on consumption expenditure decisions, which get deferred. So let's keep in mind, that and a lot of, the appreciation of the dollar and the depreciation of the rupee is actually linked, to this uncertainty. So this uncertainty being the underlying cause, to a great extent, of the dollar strengthening, rupee depreciation is not good for growth, and it's not good for imported inflation. So that is something, which we all need to be cognizant about. Thank you.
Thank you, sir. Next would be Mr. Siddharth from Informist.
Thank you, sir. Afternoon, Governor.
Good afternoon.
So, just a question on liquidity. The government's high cash balances in recent years has made the RBI's job of managing liquidity difficult. In the FY26 budget, the WMA limit has been increased substantially to 5 lakh crore. The Economic Affairs Secretary also said the government will aim to keep a lean cash position.
Which limit you said has been increased to 5 lakh?
WMA. The recourse, total recourse for WMA.
Okay.
And the Secretary also said that they'll try to keep a lean cash position, but much of the cash holdings is drawn to states' surplus and their investments in 14-day T-bills. I think end of FY24 it was in excess of 2.5 lakh crores. Is there anything happening between the government and the RBI to discourage states from holding such large surpluses, maybe reduce the interest on these T-bills further, allow them to park it with banks, their money with banks maybe? Second, just on, you mentioned tremendous uncertainties. Does this that we face today, does this make a case for the RBI to perhaps increase its contingency risk buffer over 6.5% recommended by the Jalan Committee? Thank you.
See again your second question and first question. I'll ask DG Rajeshwar Rao to come in, because there has been some engagement with the state government which he's better aware of. So he'll answer that.
I'll take
or
that.
Mr. Ravi Shankar, he will take care of your question. Coming to your second question, see, the Bimal Jalan committee has given 5.5% to 6.5% ratio of the balance sheet to be maintained as a buffer for us. We are at 6.5%, 31/3/2024. That is, the overall framework is being reviewed, and basis that if the committee feels that there is any change, could be up or downward. I'm not suggesting that because of uncertainties it needs to be increased. I'm not suggesting that. That is under process, and basis that we will take a decision as per the recommendations of the committee which is reviewing this. For your first question, I request Mr. Ravi Shankar to answer it.
Thank you, sir. I'll start off with a clarification. The 5 lakh crore number you are referring to is probably the usage. That is, every time something is withdrawn, it's cumulatively added. So that doesn't give an idea of the limit. The limit has remained where it is, quite consistent first half and second half, and that has been adequate so far. But depending on how government's cash position evolves, those limits will be fixed going forward for the first half and second half of the year. Transient liquidity, day-to-day liquidity, is changes because of many reasons, but the larger changes there happen mainly because of government cash balances. So managing day-to-day liquidity is essentially managing the impact of government's expenditures and revenues and the resulting cash balances. That is a job that we do. That is a job that we will continue to do on a day-to-day basis. As far as how state government surplus affects central government's cash balance and therefore has an impact on liquidity in the system, this is something that we have always been sensitizing state governments whenever we interact them. As you would know, we are the debt managers for state governments as well. We discuss with them on ways to manage cash as efficiently as possible, but at the end of the day, their expenditure decisions are their decisions, and the resultant cash surplus is something we have a system under which it is currently managed. Some of it comes into auction, treasury bills that are auctioned in the non-competitive section. Some of them go as ad hoc treasury bills. So that arrangement has worked fine, and we believe that as we go forward, state governments also will be able to manage their liquidity more efficiently. Thank you.
I may supplement over here that, this is our job. We are not looking, the state governments and the central governments should be, and many of them are, managing their liquidity efficiently. And whatever support, we can give to them, that we are providing. But we are not looking at liquidity being provided by government. No, they have to do their job. They have to manage their cash balances efficiently. And we, taking that into account, we will provide as much liquidity as is required. We are not looking at the government really, to be providing that liquidity. That is not their job. That is our job, and we will continue to do that job.
Just a clarification from my first answer. You said it's being reviewed. You don't know whether the CRB will be...
I think every 5 years or so.
I think the Jalan Committee recommendations were for the period till 31st of March, 30th June 2019 to 2024. Internally, we are reviewing the whole thing and seeing whether any changes are warranted, etc. Then internally, we'll take it up appropriately through the process, and then if we need to engage with the government or the board, we will do it at a later point in time. But the internal review is on in the process.
So this is the entire economic capital framework which is being reviewed?
Yes.
Okay.
Thank you, sirs. I'd request Ms. Sangeeta Mehta from Economic Times.
Thank you, sir. Sir, given that rate cut will immediately bring down the home loans and all the loans that are linked to EBLR, that is given. In your assessment, when do you see the transmission of rate cut in deposit rates and lending rates, the MCLR and the other rates in the system? By when do you see that happening?
See, many of these deposit rates, etc., they are, those deposits which are already there, they are already fixed. New deposits that are going to come in, it is only, with respect to those that these changes will actually take effect. So obviously, many of them are 5-year deposits, so there will be no change, with respect to those people, who have already taken those deposits. So it will take some time, depending on, the tenor, the average tenor that the deposits already have. But it will be our effort, that we provide whatever support and liquidity is required, that this transmission happens as quickly as possible.
Non-lending, MCLR?
MCLR, I think, happens, on a 6-monthly basis. Yes. So the last one, I suppose, most of the banks would be doing it in June and December to make it effective from January and July. So the MCLR, I think most of the banks, I think the policy is mostly to do it 6-monthly. And so come June, one should see some revisions.
Thank you, sir.
You want to add? Yeah, please.
No, I just wanted to,
please,
supplement on that. Essentially, the external benchmark linked rates are about 40% on the loan book, on which
we will see more immediate impact. In respect of the book linked to MCLR, which is almost equivalent to the EBLR book, it typically takes about 2 quarters for the effect to play out, basis our past experience, because the reset periods are mostly 6 months, but there are also loans that are linked to 3 months or 1 year benchmarks as well. So typically our experience is that it takes about 2 quarters. And as Governor clarified, the existing deposits will have to be carried on the contracted rate. Only new deposits, the rates will change. So in terms of monetary policy transmission to the deposit rates, it again takes at least about 2 quarters. So that's a general trend that we have observed.
Thank you, sir. Sir, with your permission, last 3 questions.
Yes.
Thank you, sir. Next, I'll request Mr. Ben from New Indian Express.
Thank you, Puneet. Thank you, Governor. My question is about the 1 trillion tax giveaways in the budget. And if that really takes those who are benefiting from the tax exemption limits, if that really gets translated into consumption, what could be the impact on inflation that? Of course, the budget, from the fiscal point of view, budget is not expansionary, so that makes your job easier. But from a consumption point of view, of course, consumption is only if those 1 crore or 50 lakh beneficiaries would be mostly from urban areas where the consumption has been lagging. So what could be the impact? Have you taken into account, or as some reports say that okay, the benefit is not 1 trillion, but it is at best it could be 25,000 crore. So it is not big enough to take into account the monetary policy, or you have looked at it and taken a call on the interest rate now?
All factors, as I said, have been considered by the Monetary Policy Committee in making its judgment. Obviously, the budget was announced, it was out in public, it was known, it was analyzed, and that was also taken into account in deciding about the repo rate cut. Overall, I think the budget is an excellent budget, both from growth perspective as well as I would say from the inflation perspective. Especially as you also mentioned, given that the deficit has been curtailed at 4.4 and not even at the glide path rate of 4.5%. And I am especially very, very pleased to note that agriculture, you are all aware that 46%, about 46% of the CPI basket actually is comprised of food. Agriculture gets the prime focus, in this. Of course, it will help not only on growth, but in the medium to long term, it will also help us in controlling inflation. Especially like to drive your attention to the program on vegetables and fruits. Vegetables, please keep in mind, has a 6% contribution in the CPI. Fruits has a 2.9% contribution, 8.9%. There is a scheme, there is going to be a program for food and for fruits and vegetables specifically. I think the inflation pertaining to fruits and vegetables would certainly have, I'm not privy to what would have gone into their minds, but I feel that would certainly have played in their minds. Similarly, I am very happy to note that a mission on pulses again I think has a weight of about 2.5% or so, 2.4 I think if I remember correctly. And pulses also has played a major role in the inflation that we have seen in the recent months. So there is a program there's a mission now which has been announced for pulses, and there are a number of other programs which have been announced for agriculture. I do not think, that this 1 lakh crore of tax relief, I think it was very much desired. Everyone was wanting it. Now that it is there, now counter questions are being asked whether, it will increase inflation, this, that and all. I don't think, those questions are really apt. And I don't think, that this is going to have personally, an impact, an upward impact, in inflation. There is sufficient productive capacity that we have today. Also, the capacity utilization levels are 75%, and with this tax relief, it will only help us in our growth, and it should not have any major impact on inflation.
So can I have one clarification on the economic framework for Jaran committee? Jaran committee was an external committee where RBI had members. But this RBI is reviewing, internally reviewing, or there is an external committee that is reviewing it?
Internal. It's an internal review. It's an internal review which was required to be done, which we will do because that is the time period, as DG Rajeshwar Rao mentioned, the time is over, so it was in for a due, so that will be internally.
Thank you.
Thank you, sir. Next we'll have Ms. Shyama from Doordarshan.
Hello, sir. Sir, my question is, does Trump's pro-crypto stance worry India? And if it does, then what will be the RBI's approach to it?
RBI's thinking on cryptocurrencies has been articulated very clearly, and there is no change in that thinking, because that thinking is based on what our understanding of crypto is, and our understanding of cryptos will not change because some policy has been taken by some country on it. So that remains unchanged. That is our stance. Having said that, as some of you may be aware, that there is a group which is looking at what the country's approach to cryptocurrencies will be, and that group will give its recommendations based on which decisions will be taken by the government, and we'll all follow that. Thank you.
Thank you, sir. And the last question would be for Mr. Sachin Kumar from Financial Express.
Good afternoon, Governor. After RBI hiked risk weights on unsecured loans in 2023, there has been a significant moderation in growth of personal loans. So, is RBI satisfied with the moderation in growth of personal loans, or more moderation is desired?
I think the short answer is yes, we are satisfied. I don't think more moderation perhaps is required, but I'll request one of the DGs, in case they would wish to, supplement.
I think that answer you have given already. Just to give a rationale behind it, it was an intended impact. Regulatory measures were taken when certain amount of outlier growth was seen in a few segments. As we had anticipated, it is the very same segments which are witnessing additional stress or slippages at this point in time and year related. So the measures were well thought out, and it has had its intended impact. And as Governor clarified, this moderation is all right at this point in time. But as a regulator, we keep our watch on the incoming data, and if that warrants a measure, we will take it, taking into account materiality and proportionality. Otherwise, at this point in time, this moderation was expected, and it's playing out on the same lines.
So, is it correct to assume that now banks can resume higher lending on these segments?
It's primarily the business model that will be pursued by the business entities. It is not our intention to prescribe any particular rate of growth or a product mix. This varies from entity to entity, and there are well-informed boards that guide the management in terms of what should be their growth aspirations. All that what we see is that whether they are in tune with their risk appetite framework, whether any excess eating happening in the system, or any possible risk build-up is occurring, or a concentration risk appearing in any particular area. That is where we would like to intervene. Otherwise, it is not our intention to prescribe any model. And just to use this opportunity to supplement to what Vishwanath as well asked. So every measure that there is an impact and cost analysis that we do, and we take decisions accordingly. So it is not that we will prescribe something which is not felt necessary.
Let me just supplement that we had not stopped, we had not prescribed or mandated or asked the banks or the regulated entities to stop lending. No. The risk weights, I believe, were prior to COVID, they were 125%. They were brought down post-COVID, and we saw, that there is now sufficient and perhaps more than the desirable level of credit growth. The risk weights were brought down to what they existed prior to COVID. So it's not as if, we have done something which is kind of abnormal. It is just bringing it back to what the risk weights were in normal times.
Sir, if I can ask a question in continuation to that. While I understand this 125 on unsecured is normalization, what about on NBFCs, sir? Because there was a proactive increase in risk weight in order to sort of curb NBFCs also concentrating in the sector. And today when we're talking about a growth-oriented approach, and they play a very important role in last mile credit dissemination, would you relook at risk weights on NBFCs? There as well, growth is really getting hurt.
No, maybe I can clarify, sir. See, essentially that particular segment was brought in because of the interconnectedness risk that was building up. See, NBFCs have essentially three types of resources: their own equity, their market borrowings, and then bank finance. Bank finance, which used to be about less than 30%, had gone almost close to 47% of their balance sheet as a resource. So, as I mentioned, we saw a concentration risk building up, resulting in an interconnectedness between two financial entities. So, we brought certain additional risks so that gets moderated. Now, if you look at it, the resources for NBFCs is more or less now distributed as 1/3 each. So, again, it had certain purpose, which may not be which is something which is holding good even today at this point in time. So I don't think there is a reason as to review any of these measures at this point in time. But as we clarified, that we'll keep watching the incoming data at any point in time. It's not our intention to stop any particular form of lending or business. It's our intention only to moderate, to ensure an orderly growth, keeping in mind financial stability.
Well, very important comments coming there. Apart from the policy, the big headline coming in is that the liquidity coverage ratio, or the LCR norms that were to kick in from the 1st of April will not be kicking in anytime soon. In fact, not until 31st March 2026. So FY27 is the earliest that we may have the revised LCR norms kicking in, which had proposed an additional 5% liquidity buffers to be maintained by banks to consider for the runoff effect because of the digital nature of banking in these days' time. So that is a huge relief coming in for financial entities, for banks. Apart from that, the governor also making it very clear that the expected credit loss guidelines, the draft for which is yet to come out, and the project financing norms, which again had proposed higher provisioning for infrastructure projects. The two are aligned, and again, FY27 is the earliest that the RBI may even look at that. But for now, the big overhang of LCR guidelines kicking in from the 1st of April, that completely goes away. So that is one of the big takeaways coming out of this press conference. The RBI governor making it very clear that they will give banks and financial entities ample time to transition when it comes to these big guidelines and big revisions in the framework. Apart from this, the very last answer again, making it clear that there's no rethink on the higher risk weights that were assigned for unsecured loans, whether that was for bank lending to NBFCs or for unsecured loans themselves. So no change there. Two big headlines coming in there. With that, let me invite our guests who are with us, Mr. Dinesh Kara, former chairman of State Bank of India. We also have Pranjal Bhandari, chief economist at HSBC, and Ashish Vaidya, the managing director and head of treasury and markets at DBS Bank India. Thank you very much to all of our guests for joining it. Mr. Dinesh Kara, first reaction from you on the LCR guidelines being deferred. How much of a relief is that, at least another year given to banks?
I think it's a very welcome move, which has been announced by RBI governor, and particularly, when it comes to LCR will actually warrant banks to invest into certain defined securities. So I think this kind of a headroom which has been given to not to implement it before 31st of March 26 will also give enough elbow room to banks to really ensure that they can orient their treasury investment policies accordingly, so that there should not be a shock at all. I think it's a very welcome move, and also in the current kind of a situation where the liquidity was at a system level, liquidity was a bit of a concern. So I think it will ensure that there is enough liquidity in the system, which will help in supporting the growth initiatives of the economy.
Mr. Khara, did you get the sense that there may be a rethink on this increased provision requirement itself, apart from deferring the deadline by another year? What was your reading of what the governor and the deputy governor said on LCR?
I think they have very clearly mentioned that they have invited the responses from the regulators, and they are actually evaluating all those responses. So I expect that it is going to be some kind of an inclusive policy which will keep in mind the responses of the regulated entities, and if at all it helps in achieving what the RBI is looking for in terms of achieving through implementing this LCR, if at all that can be achieved through some other means also, I think they are quite open for that. So this is very welcome, I would say, from the regulated entities standpoint. But yes, of course, they are having in mind the kind of changing realities, and also with the kind of digital coming into play and how the money can move in no time. So I think that's something which is the guiding factor when they are thought in terms of implementing LCR. So they will try to strike a balance between what is required for this kind of paradigm change which has happened over the years, and what ensure the stability of the system.
Mr. Khara, quickly before I move on to some of the other topics, the project financing guidelines, we of course know there's been a lot of pushback from the banks on this additional provisioning requirements for infrastructure projects. The indication again from the governor seems to be that they will be released along with the expected credit loss guidelines, where the draft has also not been formed yet. So you think that is out of the picture until ECL guidelines are drafted and consulted upon? Project finance, the additional requirements will no longer be, put on banks at least until FY27.
Yeah, because there are overlaps as it is between the provisioning which is done through the ECR and also ECL, and also with the project financing additional provisions which are required to be done. So I think they are trying to really ensure that there should not be any overlap and there should not be any excess of the provisioning which should be there, because eventually, all said and done, all these kind of provisions will have an impact on the credit cost and will eventually show up in terms of the cost of lending also for the banking system. So I think it's again, I think it's a very, very pragmatic step which has been taken, and I'm sure it will go a long way in terms of supporting the project finance initiative and the growth initiative.
Well, Pranjul, thank you all for standing by. Pranjul, what were your key takeaways, from the policy announcement? Were you at all disappointed to not hear more on liquidity? What did you make of the comments?
Yeah, I think, what stood out for me in the press conference was when he spoke about marks, do we attempt to get just pass marks or full marks? And I think in that context, I would actually give full marks to this governor, because at the end of the day, he's been able to tread this very fine line of bringing about more flexibility in existing frameworks in order to give you better growth outcomes, but not really junking all of these frameworks, working within the very frameworks. And I think that was really the master stroke. If you look at what's happening with monetary policy, he spoke about working on the flexibility embedded within the policy. So you don't really have to get to 4% inflation before you start cutting rates. But as long as your models show you that you're in the right track and you're getting to 4%, which his forecast did show eventually, you can start cutting rates already. So that flexibility, I think, will give very positive growth outcomes. And I think the similar thing we've seen for the regulatory front as well, right? He's not junking all the LCR and all of these norms that they were talking about, but he's trying to postpone them a little bit and also staggering their implementation, giving the markets better time to basically come to terms with all the big changes that are going to happen. So I would say on the whole, very positive. This is very important, because if at this point of time he had given a signal that he is not going to stick to previous old frameworks, then I would have said that people would start putting questions to the macro stability of his actions. But I think he's given us the best outcome.
All right. Ashish Vaidya, you think this is the best outcome we could have got, deferring the LCR guidelines, saying that they will be, proactive when it comes to liquidity, giving some, as what we're hearing, more realistic sort of projections as far as growth is concerned at 6.7% and delivering that 25 basis point rate cut that the markets had asked for. Ashish?
Yeah, I quite agree. Actually, this is probably the best possible outcome which the governor has actually delivered. It's really not important to look at today's market moves because that will be actually driven by more of opportunistic position by traders. But I think a lot of decisiveness which the governor has already displayed before in the last 1 month while he took the liquidity measures, and the way he has gone about explaining as to what kind of forward-looking thinking and the nimbleness with which he is looking to operate within the parameters that have been defined for the RBI, I think is an excellent outcome. So I think we are really looking at it positively, and it will actually bring in a lot of stability and continuity in the market.
Okay, Mr. Soumya Kanti Ghosh, what was very interesting is the governor alluding to the flexibility provided by the inflation targeting framework, not repeating what we've been hearing through the year about getting to that 4% CPI mark before the Reserve Bank of India can act. So the RBI is going to be forward-looking. What do you make of his comments and what we can expect, going forward from here in terms of further rate cuts?
Thank you, Ritu. I think there are a couple of paragraphs in the policy that are very well communicated to the market. I think this is the paragraph on inflation targeting which you are talking about. And I think this is basically a excellently and well-crafted communicative statement to the market, and it puts to rest about the market cacophony or the cacophony about not sticking to the current inflation targeting regime, tweaking it or otherwise, because it gives a sense to the market that the stability and continuity in macro policy, which has been the hallmark of the monetary policy in the last 3 to 4 years, remains in force. And that's why repeatedly you will see that in the press conference, the governor also pointed out his financial stability has an overarching aspect of this monetary policy. And that is possibly the reason why all these regulatory measures are now kept in abeyance, or they will be implemented as and when the time comes. So from that point of view, it's a sense of continuity, stability to the and flexibility to the policy, operating policy framework. And I think that a statement on inflation targeting, even on exchange rate, if you actually go through the footnote on the exchange rate, you will find that the 3.2% depreciation on exchange rate, which the governor talks about since the American election, that is almost synonymous with a 2.4% dollar appreciation. So what he's trying to say that the recent disturbance in the exchange rate is more a reflection of the market forces and the global uncertainty. So from that point of view, I think the policy is more about well communication and also importantly more about footnotes, which you need to go in detail to get into the nitty-gritty. And regarding the future trajectory that you have seen with inflation at 3.8% next year, growth at 6.7%, I think that opens up further space for rate cuts. And if the inflation continues to surprise on the downside, this month's inflation number could actually be a significant downside as the vegetable prices have corrected significantly. We can see more rate cuts in the offing, and that could be more than the consensus if the global geopolitical uncertainty stabilizes a bit in the next couple of months.
And what is that consensus, Mr. Soumya Kanti Ghosh? We've been getting differing views ranging from 50 basis point rate cuts to 75 to 100 basis point rate cuts in this cycle. What is your view?
No, I think if the global geopolitical uncertainty stabilizes, I think 50 basis point rate cuts, which was mostly the consensus across the market domain, I think that could become an outlier in the coming days if we go by the inflation forecast.
Okay, and Pranjul, what is your base case in this cycle, given the 2% kind of an inflation outlook for the coming year?
Yeah, so look, we are expecting another 25 basis points rate cut in the April meeting, so making this a 50 basis points rate cutting cycle. And to the extent liquidity is sufficient, I think that on itself will also give a 25 basis points rate cut. So effectively a 75 basis point rate cut, if you also include what happens via liquidity. We don't think it's going to be more than this because at the end of the day, you really have to also look at global volatility And I think our BOP and balance of payments, current account don't really support a very deep rate cutting cycle at this point of time. I also think there's going to be more liquidity measures that will be announced, in fact, as early as end April, so basically 2 weeks from now, because my sense is otherwise in March, liquidity will go back into, a substantial deficit. So my sense is that, more liquidity steps will also be announced. They won't announce today, but that doesn't mean they won't be announced because the promise of sufficient liquidity is there. And finally, many of the things and frameworks that are going into review, I think will be very interesting. I think the economic framework will be extremely interesting because over time, it will also tell us about how much dividends can the government get from the RBI.
Okay. Thank you very much, turning in. I just wanted to ask Ashish. Ashish, what did you understand about the liquidity? Did it give an impression that where they see a deficit they will give, or did you get a feeling that hence, because he said that we are looking at liquidity not just interbank but also durable, including the government's liquidity, or what is it, the government? Is it giving a sense that henceforth largely banks will be lending in SDF rather than borrowing, they will ensure that much surplus?
So Lata, good question. So let me give you my take as to what exactly I have understood. Clearly, I think he has drawn a distinction between durable liquidity and the transient liquidity. And that's actually very important. And if you look at his actions in the past, like last 1 month, I think RBI has come out very decisively in terms of giving liquidity to the market. I think broadly what he is really committing, and I think people will have to start to take him at real value. And that's where people will find clarity emerging as they go ahead. Not to look for immediate liquidity actions just because there's a policy or something. I think the way the RBI is conducted, very decisively, despite rupee weakening, the liquidity measures, both in terms of OMO, swap windows, I think that's great. I think markets, to my mind, should factor in about 60-70% of durable liquidity and about 30-40% of transient liquidity. Eventually, I would think that the liquidity will move towards a surplus, like the other panel members are saying, and which I completely agree. You probably get a rate cut next, and with probably a stance shift, and that really tilts the liquidity into a positive territory. So that's what broadly my understanding is. I think the governor and the RBI is completely in control and decisive in terms of how they're going to manage the liquidity.
Okay, fair enough. May I ask, therefore, Mr. Khara, so you think, therefore, that the rate cuts will get passed on? And secondly, he made a lot of reference to asking banks to lend in the interbank call market. The statement said that we are not restricting any such lending because interbank call has hardly 15,000 crores. Sometimes the volume is very low, whereas in the tripartite repo it is in lakh crores. So is he removing any trepidation banks may have, borrow from repo and lend in call? He's removing that trepidation. Do you feel that way, that it was positive? So 2 questions. Do you think it will get passed on quickly? And will there be more flow in the money markets?
I think the intention of banks to participate more and more into the interbank call money market is essentially from that point of view that more and more flows should happen. And when it comes to the trap market and the call market, there is whatever differences are there in these 2 markets, they would get evened out. That is what the intention seems to be. And your second question relating to, the passing down the interest rate benefit reduction in repo. Repo, of course, is something which is one of the determinant, because when it comes to external benchmark linked interest, there, of course, it will get passed on. But if at all external benchmark was essentially linked to repo, then only it will get passed on immediately. Otherwise, if at all it is linked to MCLR, etc., then...
Mr. Khara?
Yeah, sorry.
No, Mr. Khara, he is also promising liquidity. And therefore, my question is a little medium term. Do you therefore expect that this craze for deposits, the banking competition for deposits will slow down a bit because Reserve Bank is committing to giving more liquidity, and therefore it's not like in 1 month, in a couple of months deposit rates will start falling?
See, actually, when you look at the banking business, they look at RBI as not at the first port of call when it comes to the deposit or the liquidity. They actually look at the bank RBI as perhaps the last port of call for augmenting their liquidity. They need to have the deposit base. Unless and until they have a stable deposit base, they cannot really plan out their loan strategies, etc., etc. So I think when it comes to deposit, eventually, the interest rate on the deposit will eventually be the function of the overall liquidity, which is stable liquidity in the system. It will not be the transient liquidity as it has been mentioned. So durable liquidity only will influence the interest rate. That is what my take is.
Okay. No, the reason why I'm asking you is a lot of bankers in our Ritu's and mine preparation to the monetary policy, bankers were saying that, if they tell us, give us some comfort that, okay, now we are happy with the credit deposit ratio, then we can start chasing credit. If they give us some comfort that liquidity will be there and that we are not constantly going to them to borrow, then we will have greater confidence in cutting deposit rates. This is what bankers told us in the run-up to the monetary policy, and he seems to have given both. They seem to give confidence that, okay, now the credit deposit ratio is fine. And they seem to give confidence that we will proactively give liquidity. That was the word they used. So I'm asking, will credit growth improve?
I think credit growth will improve depending upon the opportunities which are available for lending in the market. And lending in the economy, if at all there is an overall economic growth, there would be certainly, banks would be happy to lend and also generate income. That is what I would say that all bankers will think like.
Ritu?
Well, there's one more thing I wanted to highlight, Mr. Khara, was, the very last question on the higher risk weights on unsecured loans. Clearly, the indication is, yes, the RBI is satisfied with the pace of, growth in unsecured segment coming down drastically from 2 years ago. But it doesn't look like there is a rethink on, reverting back to the risk weights that were before they were increased. Mr. Khara, is that the expectation, these higher risk weights, especially for bank lending to NBFCs, are to continue so there's no relief on that front?
No, I think considering the fact that the kind of delinquencies which are seen in the unsecured portfolio of the various banks, but I don't expect that there would be any kind of a relaxation when it comes to the RWA for the unsecured loans.
Very much the messaging from the Reserve Bank of India as well. Quickly, Lata, you had another question to add.
Well, not question as much as a takeaway which we got, because the governor also spoke to us off the press conference, off the auditorium. So before we wind up, I just wanted to say that the first or the second paragraph, I think, where he speaks about flexible inflation targeting, I think that was an important point he made. The question was, why are you taking it up at all? There were statements, if you remember, in the previous economic survey, where the request was that food should be excluded from the target. So it appears that that statement was there to commend the flexible inflation targeting, to say it has worked well, because it's about 10 years, 9 years to be precise, and they wanted to praise the flexible inflation targeting framework. So I think that's very important. The framework is not in question. That was a key takeaway we got off the auditorium when the question was asked to him, why did you raise it at all? And he said, I raised it to commend what is a framework that has worked very well through COVID and through turbulent times. I thought that that's an additional information that was needed. Thank you very much, Mr. Khara, Pranjul, Ashish, and Shaumyu for being with us. Thank you, Ritu, as well, for going through this monetary policy framework, monetary policy analysis. It looks like it's an extremely well-balanced policy, giving inflation coming down its due share and at the same time retaining most of the caution that is merited because of the uncertain global environment. Thank you very much for watching our monetary policy special.
That
drive the day's agenda. Catch the award-winning India Business Hour live every night on YouTube with me, Shireen Bhat.
India Business Hour live on YouTube at CNBC-TV18 weeknights at 7 p.m.
This growth inflation dynamics opens up policy space for the MPC to support growth while remaining focused on aligning inflation with the target. At the same time, the MPC felt that excessive volatility in global financial markets and continued uncertainties about global trade policies, coupled with adverse weather events, pose risks to the growth and inflation outlook. This calls for the MPC to remain watchful. Accordingly, it decided to continue with a neutral stance. This will provide MPC with the flexibility to respond to evolving macroeconomic environment. The MPC decided unanimously to reduce the policy rate by 25 basis points from 6.5% to 6.25%. The MPC also decided unanimously again to continue with a neutral stance and remain unambiguously focused on a durable alignment of inflation with the target while supporting growth.
Every leader, business, government, investment leaders, economists, we're all scrambling to adjust to a very new reality and a new approach, I think it's fair to say, from a US administration who seem very focused on American interests and are quite content to rewrite what have been thought to be kind of historical norms. So those historical norms started really earlier this week with the seeming tariffing of Mexico and Canada. Canada, obviously, a huge close ally of America, but that didn't save them from being on the list, at least for some period of time. Those tariffs subsequently didn't come to pass, at least for now. And to your question, yeah, the Middle East, like everywhere else, we're all looking, I guess, tweet by tweet, Truth Social post by Truth Social post as to what's going to happen next. And that would apparently include some historically astonishing proposals, at least.
Hello and welcome to Midcap Radar. We welcome you with M&M's Q3 numbers. The company's top line has seen a growth of about 18%. This is driven by a 20% jump in the company's auto business. The EBITDA has come largely in line with street expectations. EBITDA number at about 4,400 crore rupees, and profits too have gone up by 20.8%. These are very slightly lower than street expectations, at least on the bottom line. On the bottom line, the CNBC-TV18 poll was for a growth of about 29%. Compared to that, the company's delivered about a 21% bottom line growth. But again, these are very strong numbers and the stock is holding up in the green. Margins in line at 14.4%. So top line growth 18%. Margins at 14.4%, and this is an expansion versus the 12.8% clocked in the comparable quarter of last year. So margins for the company are up 160 basis points, and that is driving a 21% increase in the company's profitability. Revenues in line, margins in line. Profits too are very healthy at 21%, but again, you would say maybe slightly lower than street expectations. M&M has been one of the best performing stocks. I think last year it was up close to about 80-85%, and in 3 years, the stock has given a return of close to about 250% because their SUV portfolio has been doing very well. Tractors, they've always been the dominant player, and that has been driving growth. So the volumes for the company have been very strong. I think in Q3, Sudarshan was telling us that volume growth was 16% in auto and about 20% in tractor. These are the internals. We've got the auto business numbers up 20% growth on a year-on-year basis. So, at least these are the few internals that we have right now. Auto business EBITDA seems to have seen an expansion because the top line growth is 20%. EBIT growth is close to about 37%.
Absolutely interesting numbers surely coming in, and there are going to be a lot of factors that one should watch out for in terms of commentary also, right? Like you were mentioning, volume 17% is what Sudarshan has highlighted. So keep an eye out on that. We'll also want to watch out for the ramp up that one could see coming in from the XUV 400. So what is that? Strong volumes is surely something that we're seeing coming in from the company. Auto segment, the EBIT that we're seeing is good. Agri-business EBIT is at 42% up YY, 30% uptick on a quarter-on-quarter basis. The stock is seeing some bit of a gain and momentum coming in, and auto business EBIT also is at 9.7% versus 8.5%. So we're seeing an improvement even coming in on the EBIT front of individual segments as well. So yes, largely when we are seeing in terms of estimates, margin has met the estimates of the street, revenue is in line with the street estimates as well, and overall versus the poll, even the EBIT performance has been good. Interesting to watch out for in terms of that front.
The stock is now moving up. Yes. It was up 0.5% when the numbers came out. It dipped a tad bit, but now again it's up close to about 1.5%. That's M&M for you. Pull up a 3-year chart of M&M or 2-year chart, and you would see the kind of outperformance M&M is clocked in vis-a-vis peers, because its portfolio is doing very well. You know, the XUV 500, 700 has been sold out. There's a very, very long waiting period. Tractors, it's tractors has also had a pretty good run, given the monsoons have been normal. So M&M has been on the front foot, 85% up in the last 1 year, 250% in the last 3 years. And if you look at a 5-year CAGR on M&M stock price, it's given a return of 40%. So true wealth creator in the large cap space. Gurmeet Chadda, managing partner, CIO at Complete Circle, is now with us to discuss the numbers. Gurmeet, your initial thoughts on M&M?
Hello.
Yes, Gurmeet, we can hear you. Did you have a chance to go through M&Ms at least?
Yeah. So, I think a good set of numbers. I think if you see revenue, they've crossed 30,000 crore mark. EBITDA is, I think, in my view, again, an all-time high at almost inching in at about 4,500 odd crores. And there is a bit of a margin expansion. I think what is, good here is the fact that they've been focusing on, they've regained their market share in SUVs. It's back at about 20%. I think the new EV launch has happened. They've started the bookings. The response has been pretty good. I have a few clients who are very large dealers of M&M in North. I think there's a lot of excitement there. Tractors, they are gaining market share. And the best thing has been since Anish came over Hello? Yeah.
Yes, we can hear you.
Anish came in. I think the focus on capital allocation has been pretty solid. They have cut down on loss making. JVs they had clear allocation towards how business is to be done. There was one bit of a blip when they bought some stake in RBL Bank, which Street did not like. But I think that clarification came that it was just an investment and they had no plans as such. So I think pretty constructive, and valuations I would say are modest, would not say reasonable. But I think the new EV and an uptick in rural demand could still give some legs to M&M.
Okay, so Gurmeet, do wait on with us. We do have Sudarshan who's joining in with us, who's done some number crunching in terms of the M&M's Q3 performance. Sudarshan, what are they looking like versus the CNBC-TV18 poll? Any more highlights that you could shine on these numbers?
From the first look, it's looking a very strong set of earnings. Even expectations were elevated. Company has managed to meet estimates on all the fronts, whether you take auto segment or farm segment. So overall revenue was 30,500 crore against our expectation of 30,600 crore odd. So it's almost in line. EBITDA is coming at almost 4,400 crore. Again, in line with estimate. Margin company has managed to hold on to the levels above 14%. It has come in around 14.5%. That is also almost in line. If you talk about the segments, for auto business, revenue has increased 20% year on year, and even sequentially, if you look at, it's up 6%, and even EBIT is up 37% year on year and 8% sequentially. Agri business, again, 21%. YY 26% sequentially. EBIT for agribusiness 42% up YY and 30% sequentially. So it's telling you, as in morning we were talking about the two segments, basically SUV and tractor. Demand has been strong for both these SUV and tractor, and the leader is M&M. So led by healthy volumes, company has managed to report a very strong set of numbers for Q3. But we have to see exactly what does company say on the demand front, if the demand is sustainable, and how is the demand going on in current quarter, and how the demand has been for the recently launched electric vehicles. So these two, and last is the considering the demand for tractor segment, if there is a pickup or if there is an increase in FY25 growth estimates, because currently it has been like mid-single digit growth. So if we'll have to see if M&M says that there is an uptick expected as well. So considering all these things, first Q3 very strong set of numbers, but all eyes would be on company's commentary related to demand.
I remember earlier this month only, right, Sudarshan, they had launched those two, native electric, purely electric born vehicles. I think it was 6BE, something on those lines.
6BEV.
6BEV, yeah. And there was so much excitement around the stock price, on the prospects and what it will do. And it was also fairly competitively priced versus peers. So have they given any indication of the bookings for that?
So I'm yet to see exactly what the company has commented about bookings, but both those products were feature-rich products, and one advantage that all the brokerages were talking about those two products are not only feature-rich, but the pricing part was very important, and company has managed to announce the price, and basically prices were very attractive. So considering these two factors, and I feel the demand obviously would have been strong.
Okay, thank you very much for that. The key positive is that growth continues for M&M, 18% top line growth, and both the auto business and the tractor, the farm equipment business is doing well, and there is margin expansion. Margins for the company have expanded from 12.8 to 14.4% on a year-on-year basis. That's a 160 basis point margin expansion, and that is something that the street likes. I think the question now is, because of the run-up, how do the valuations stack up?
Absolutely. And let's go across to Gurmeet on that front as well. And Gurmeet, like Rima was saying, how is it going to be in terms of valuation? M&M numbers have been good. Commentary is what everyone is watching out for. But on the valuation front, does it make a good bet right now?
I think it should be more like, something which is very consistent in the large cap space. It's not stretched, it's not cheap. It's 25, 30 times. And this is one auto stock which hasn't really corrected, along with Maruti. Actually has done well in the crisis. See, other thing is, if you look at its powertrain a few years back, pre-COVID, it was 72% diesel. Right now, if you look at it now, the diesel is almost 50-55%. There is EV which they are launching. There is CNG which they have included. So even the powertrain now is catering to different segments, which I think augurs well. Depending on how the landscape is changing as far as clean energy goes. And I think this new EV launch, as I said, few of the distributors who are clients went for the launch in Chennai in their R&D center, and some had some great feedback on that. So I think they've just started the bookings. I think immediate trigger could be how strong the bookings are. Remember when they did this all four SUVs back to back, which is XUV 700, Bolero, if the bookings pick up, there could be some, although I'm not commenting on near-term movement, but there could be a bit of momentum in the near term because of that.
Okay, Gurmeet, thank you so much for joining in with us and giving us insights in terms of M&M's number, what we should be expecting in terms of the stock going forward as well. But key is going to be the commentary that we're keeping an eye out on. As of now, M&M is trading almost near the day's highest point, so keep an eye out on that. Let's move on, and the battle for control over regulator continues. Supreme Court of India directs the Berman family's open offer will not close today as scheduled earlier. Ashmit is joining.
Well, clearly the confusion as far as control of Religare continues. The open offer that had been issued by the Bermans was expected to close today, which was expected to give some finality to the matter. But bear in mind that the US-based, the Florida-based businessman, the investor Digvijay Gaikwad, had moved the apex court. That hearing was today, just concluded a few moments back. And importantly, in that hearing, the Gaikwad had essentially said that, why are we asking the minority shareholders to settle for 235 rupees a share when I, Gaikwad, am offering 275 rupees a share? From therein, there were questions on technicality, and on the basis of that, essentially what the Supreme Court has directed as an interim direction is that, number one, the Berman open offer will not close today as was scheduled. The tendering process was expected to close today. That will not happen. Number two, The Supreme Court has directed for Gaikwad to deposit an earnest money deposit of 600 crore rupees by Feb 12th. That's Tuesday of next week. So they have time till Tuesday to make that earnest money deposit of 600 crore rupees. Third, and this is critical, the open offer that was issued by Burmans will remain open till the earnest money deadline of Tuesday next week, which is February 12th. Till Gaikwad makes that deposit on February 12th, this open offer will continue to remain open. The tender process will continue to remain open. And what happens in a situation that Gaikwad coughs up that amount of 600 crore rupees? In that case, the Supreme Court has added a fresh stipulation that this Burman open offer will remain open till SEBI takes a final decision on the Gaikwad application for an open offer. So clearly, there are a number of moving parts here. No finality yet, but for now, the Burman offer to remain open. But at the same time, the Supreme Court did make an observation that this open offer, they're doing it at their own risk, the Burmans, because should the issue get decided in favor of Gaikwad's, the words of the Supreme Court were, they'll have to cough up a lot of money.
Okay, Ashmit, thank you so much for giving us the latest update on Religare. But let's just mark the flashes at the bottom of your screen. We have Ola Electric that has reported the numbers. Revenue seeing a decline of 19%. Losses have widened further for the company. EBITDA loss at 460 crore versus last year of 301 crore. Losses also are somewhere at 564 crores versus 376 crores. So clearly we are seeing that losses are widening. There's a bit more pressure coming in, and revenues also are seeing a decline. Stock has slipped in trade and is down almost 2% as of now.
I was just going through the Ola numbers. In Q1, the company's top line was 1644 crore. Yeah. In Q2, it came down to 1214 crore. So even in Q2, there was a sequential decline in the company's revenues, and that has further come down to 1045 crore. So we've seen a significant moderation in the absolute revenue number. 1644 in Q1 comes down to 1214 crore in Q2, and now down to 1045 in Q3. The Ola Electric stock price too has taken, a bit of a tumble. Right now it's down close to about 2.5%, but its 52-week high was close to 157 that it hit on the 20th of August. So from that level, 157 down to 70, the stock has more than halved in the last, 5-6 months. And the numbers are a bit disappointing. I remember even Q2 was a disappointing quarter, but losses have widened for the company, and the absolute bottom line loss is 564. And remember, shareholders, investors are going to have another option to play the pure electric two-wheeler space, because Ather Energy has also filed its DRHP and it's readying its plans for an IPO. So, you're going to get another choice, right?
Option
if you want to
there,
play for the entire EV penetration, you want to play that story, now you have an option there too.
Absolutely, but as of now, we're seeing pressure coming in on the stock. Numbers not looking that great. On that note, we're going to slip into a very short break, but don't go anywhere. After the break, we have more numbers to talk about. Aadhar Housing Finance, they've reported their numbers. What are the outlook of the company going forward? We do have the management waiting back.
Tensions between employees and management at Samsung's Sriperumbudur plant just outside Chennai have surfaced yet again. For well over 24 hours now, over 100 employees, we're told, have been staging a sit-in protest at Samsung's plant just a few meters from where I'm standing. In fact, this line of company buses and these barricades have been erected by Samsung so as to prevent members of the public and observers much like myself to see what's been going on through the gates of Samsung's plant just a few meters from where I'm standing. Now the issue is simply this. A few days ago, 3 members or employees rather of Samsung's plant were suspended after allegedly engaging in activities deemed detrimental to the interest of Samsung's operations in India. However, employees of the plant, a section of them, and members of the Samsung India Workers Union claim that this suspension was not on account of disciplinary action or disciplinary reasons, but simply because they were affiliated with the Samsung India Workers Union in the first place, also claiming that Samsung does not want any employee to be actively engaged with this recently established workers' union. Now remember, this isn't the first time that issues or a face-off between Samsung's management and employees have cropped up. In September, nearly 1,100 employees of this very plant staged a protest outside plant premises, claiming for better privileges, more representation, better pay, and also representation by way of a union which Samsung said all that while that it was averse to forming in the first place. However, following the Madras High Court's intervention, Samsung India Workers Union became a registered union under the Tamil Nadu Labour Department, thereby ensuring that some of these workers' demands pertaining to representation by way of a union was summarily met. However, these issues clearly have not been laid to rest, simply on account of the recent suspension of those 3 employees. Now the issue is simply this: while these employees claim that they were suspended for their affiliation, Samsung in a statement has said the employees in question violated the company policy and have been suspended temporarily and will be subject to appropriate disciplinary action following a formal inquiry, end quote. Now while it's a case of he said, she said between Samsung and its employees, the fact is that these outstanding issues between Samsung and its employees don't seem to be going away anytime now, given the fact that both the employees and the management seem to be heading in different directions with regard to what they expect of each other pertaining to both representation and a basic disciplinary expectation.
Welcome back and thanks for staying tuned into CNBC-TV18. You're watching Midcap Radar. Now let's talk to the management of Aadhar Housing. They reported their Q3 numbers. Disbursement saw good growth. AUM growth also seems to be healthy. To discuss more about the outlook of the company, also what these RBI MPC minutes decisions actually mean for the company, we do have Rishi Anand, Managing Director and CEO at Aadhar Housing Finance, joining in with us to talk to us all about that. Thank you so much, Rishi, for joining in with us this afternoon on CNBC-TV18. You know, let's just start before the earnings and talk about RBI's decision for the 25 basis point rate cut. What does that mean for you? What does it indicate for you? As well as we did have the budget that just ended recently. So the IT cuts that we saw, income tax cuts that we saw coming in the budget, do you think that is going to be spurring the demand?
Hi, Vinny. Good afternoon. Thank you very much for having me. Okay, first thing first, let's talk about the cut. Good news coming in after a gap of, if I'm not mistaken, about 4 or 5 years. This was on expected lines. I think the industry was expecting a cut of about 25 bips. That has happened. How is it going to impact our borrowings? We have approximately about 15,000 crores of borrowing, which are based on either MCLR or repo rate. Approximately about 10 to 12% of our borrowing is based on repo rate, which will have an immediate impact of the 25 bips cut. The balance funds that we have borrowed on MCLR will take anywhere between 3 to 6 months for us to look at the cuts. Eventually, as you know, last time also I briefed that close to about 80% of our consumers are on floating rates. So whatever cut comes into us is going to be passed on to the consumer. So it is obviously good news for the consumer. You touched a topic on the budgets. On the budgets, couple of good news that came in. One was the income tax slab, zero tax up to 12 lakhs. This is eventually going to propel the demand because the loan eligibility in home loans typically will rise by about 3-4 lakh rupees. Apart from that, what didn't come out in the budget and was announced about, I would say, 15 days prior to budget was something called the Mortgage Guarantee Fund, which was targeted for the EWS LIG segment. So the Mortgage Guarantee Fund, the gadget has been rolled out. It has now become a policy that's going to further propel the demand. Adding on to it, the Swami 2.0 fund.
Rishi, hi. Rima here. Good to chat with you and good to see you. So I think you'd given a guidance of a disbursement growth of 18 to 20% for FY25 and an AUM growth guidance of 20 to 22%. One, does that hold for a full year? And secondly, for FY26, given the tailwinds, do you think FY26 you could do better than FY25?
Oh, hi, Rima. Good to see you and talk to you again. We stand by our guidance number for the year at 18-20% disbursement growth and 22 to 24% AUM growth, which will translate to about 20% growth in PAT. As regards the next financial year that's in question, I think similar numbers we would stand by and give a guidance on, which is about 20 to 24% AUM growth.
Right. Rishi, one more point that I want to just pick up on is in terms of NIMs. They seem to be a bit under pressure during this quarter as well as your spreads. They've contracted. So I'm just trying to understand what is the outlook behind this and what actually impacted both of these factors.
I think I would say yes, there is about 30 bips. If you look at the NIMs, there is a decrease of 30 bips from a 9.5 to about 9.2. It was a combination of incremental yield. So the yield on the book falling by about 10 bips and the cost of fund impact of about 30 bips. I think combination of both impacted the NIMs that we're talking about.
And what is the outlook for the NIMs going forward then? What will be driving them? What are you keeping as a target?
So the way we look at it, Vinny, it is going to be in the range of 9.1% as we move ahead in the next financial year.
Okay. Gross NPAs, I think, are closer to 1.4%. What is the outlook on the asset quality? Do you think in Q4 things improve?
Yes, Rima, the way our industry works is generally in Q3, because of the festivities, you would see anywhere between 25 to 30 bips drop in the GNPA numbers as we hit Q4 and March end. So from here on, we're looking at about 1.1% kind of GNPA numbers of March 31st.
Okay. Just getting back, is there any number on NIMs and spread that you shared? I kind of missed it if you did.
I indicated NIMs to be in the range of about 9% even as we move ahead, Rima.
And this will be 9% as an exit for FY25 or what will be sustainable going ahead?
Sustainable for the next 1 year as well. And current spreads, we are in the range of about 5.8. And, the way we look at current year, we should be exiting about 5.75 and stable state next year, 5.7.
Okay. And, Rishi, one more thing that I want to know in terms of provisions also. Sequentially, they're seeing a bit of an increase. What is it that we are expecting over there and in terms of provisions, as well as how do you see the credit cost trending going from here on?
So credit cost, Vinny, should be, we've always guided, will be in the range of 25 bips to 27 bips, provisioning 35%. And we stand by those numbers for the current year and for the next financial years in terms of guidance.
Correct me if I'm wrong, but I think the share of your non-housing loan book is about 26%, and that's a number which has been trending. That's a number which has been trending up.
So Rima, the way it works is, we work under something called the principal business criteria, which says 60% of your book has to be individual home loan at the balance sheet level, which would translate to 70-30 on a standalone basis, home loan, non-home loans. I would say we still have room. We are 74-26 as we on the book level as we see today, and we still have a room about 3-4%. Having said that, 75-25 kind of number is what we are looking in the long term.
Okay.
Home loan to non-home loan.
Sure, and also, what is the impact of this also? Because salaried versus self-employed, the mix over there also has been changing over the years, right? I believe salaried the mix was around 65 in FY18. Now it's come down to 56, if I'm not wrong. Yeah. So how does that mix also change? And do you see this changing further and salaried mix reducing going forward?
Vinny, I would say, yes, you're right. 2018, we were at about 64-65% salaried. I think it is more by design every year, and we've indicated this multiple times. Every year by design, we will increase the self-employed portfolio by 1.5%, and the salaried obviously substantially drops. So as we go ahead, couple of years down the line, let's say 1.5% per year, the self-employed portion will increase. And we should I would say, balance out at about 50-50%.
Thank you very much for that. I remember the IPO price was, I think, about 300, 315, thereabout. Stock is down well. It's now above 400 rupees. That's Aadhar Housing Finance. Get into a break. On the other side, the management of Motherson Sumi Wiring joins in to discuss their Q3 earnings.
Did you know there's an asteroid headed towards Earth and there's a more than 1% chance of an Armageddon-style threat to the planet in 2032? In fact, NASA has said the chances that the asteroid 2024 YR4 will impact Earth in 2032 has risen from 1.6% to 1.9%. While it might sound surprising, it's not time to start panicking just yet. NASA was also quick to step in with some reassurance. Paul Choris, who heads NASA's Center for Near-Earth Object Studies, said, and I quote, "We are not worried at all, because there's a 99% chance it will miss, but it deserves attention." The space rock that's between 130 to 300 feet wide was first spotted on December 27, 2024 by a NASA-funded station in Chile. It quickly made its way to NASA's risk list, which tracks any objects that could come close to Earth. While the chance of impact is still low, NASA continues to watch it closely. These probabilities can change as more data comes in, and many asteroids that have appeared risky at first have later been deemed harmless. Right now, no other large asteroids pose a threat with impact probability above 1%. So, while asteroid 2024 YR4 is something to keep an eye on, you may not need to lose sleep over it. For now, NASA's Planetary Defense team is on the case, and we'll keep you informed whenever there's new information available.
I think the underlying innate technology is just right on the threshold, and we'll get there with the next models. But now people have got to go off and build all these services. So someone in this room hopefully will figure out what the AI tutor of the future looks like, and that'll be a population scale thing, and it'll think what that would do if every kid on Earth, this year got an AI tutor that was provided like a better education, or helped to provide a better education than anybody could get last year. Think what it would mean if we could have like an AI medical diagnosis system that was better than anyone could get last year. Think what it could mean if scientists could go cure every disease faster. And so, we've been waiting for this moment for a long time. I think we're going to deliver something that can help with it, and now people have to go build with it. Other side of it, the cost for a given unit of intelligence 1 year later seems to fall by about 10x. Moore's Law was a 2x every 18 months for the number of transistors on a chip, and that changed the world if you waited a few decades.
Welcome back. Motherson Sumi Wiring is the next company on our radar. The stock is under a bit of pressure because the margins disappointed the street. Margins of the company have come off quarter on quarter and on a year-on-year basis. Mahendra Chabra, CFO of the company, and Anurag Gehlot, COO at Motherson Sumi Wiring, are with us on the show now. Gentlemen, thank you very much for joining in. Mr. Chabra, if I may start with you. First, explain to us the margin performance. What led to the sequential and year-on-year drop in EBITDA margins to 10.3%? And will the pressure persist? Because there are some startup investments that you're doing. So will that continue to be a pain point? Will Q4 margins be at similar levels? Do they go reduce further from here?
Yeah, so first of all, thanks for getting us on CNBC. So as far as margins are concerned, like we have clarified, we are putting up 3 new plants. And whenever there are new plants, the initial ramp-up costs in terms of manpower, retaining and training the manpower, and those costs are directly charged off to the P&L, and that's the reason we see margins looking in this shape. But if we exclude the impact of the new plants that we are putting up, our margins from the existing plants are up by 6% year on year. And as far as future outlook is concerned, so like we are putting up 3 plants, out of which 1 would be operational within this quarter completely, and the other 2 will get operational in Q1 and Q2 of next financial year. So as and when plants keep on getting operational, we should get better revenue from those plants in line with the customer forecast, and profitability should get better.
Oh. So just to complete the point on the margins, and Mr. Gehlot, if you could come in, what was the extent of the investments that you made in your new facilities? Trying to understand that if it wasn't for that, what would the EBITDA margins look like? And again, if you could give that number and tell us in Q4 or in Q1 of FY26, what would be the incremental investments that you need in your new facilities?
Okay, thank you. First of all, thank you very much for taking us on CNBC. As Mahendra has said, that these 3 new greenfield, if we are excluding those, and if we see the EBITDA, it is already 6% year on year. The good news is that these 3 new greenfields are in line to the expansion plan of the customer, and these models which we have won, they are new models. They are not a replacement or mid-year update of any of the vehicles. So these are the new volumes, and one of the plant has already under ramp up, and the other 2 plants are going to be ramp up in next coming 2 to 3 quarters. Now, these volumes, it's all subject to what customer is going to make, but we see a very positive side that we are expanding ourselves in line to the customer expansions.
Right. Good afternoon, gentlemen. This is Vinny joining in the conversation as well. Mr. Chabra, just to follow up, is that then when will they start normalizing the 12 to 13% range, which you all had in terms of margins? If your plant setup is going to get completed by the second half of FY26, post that, could we see those margins starting to see that improvement back?
Yeah. So see, as an organization, we focus on growth. That's how we measure the overall financial health of the business. And we have a guidance that we should be delivering a ROAS of more than 40%. And that is what we have been delivering in the last 2 years. And even in the current year, if we get the orders for the Q4 as in line with the customer forecast, we should be able to deliver more than 40% ROAS. And as far as EBITDA margins are concerned, as and when these plants get into ramp-up mode, the ramp-up mode is over and the production starts, the EBITDA margin should also get better.
Okay. Anurag, what I also want to understand is that what some data points are suggesting that in Q3 seems like the EV contribution has seen a bit of a reduction. Is that a fact? And if yes, how much has it seen a reduction by?
Yes, if you are seeing that there is a reduction in EV or the electric vehicle, that is correct. And we are seeing that bit also in our revenues as well. But you have to understand that this year it's remained to be very exciting for the automotive sector because OEMs has launched many new models across EV as well as ICE, and keeping a lot of it's a heavy feature, rich feature content vehicles. So when these launches are happening, and as you have seen in our press release also, that in this quarter and the next 2 to 3 quarters in the new plants, there are both ICE and EV both. So I think it's just a matter of time. We have to see how the consumer is going to react to the new launches. And we are very hopeful, because we don't never doubted our customer, and whatever they are putting the volumes to us. So I think it's going to take some time, but you will see a very positive results in coming times.
Mr. Chhabra, the 3 greenfield plants that you spoke about, which are at different stages of completion, I believe have a revenue potential of 2,100 crore rupees. Is that right?
Yeah, that's right. So when these plants reach at their optimum level in terms of their production, and if the orders are in line with what the forecast we have received from the customers, on an annualized basis, these 3 new greenfields should give us 2,100 crores turnover.
So realistically, how much of that can come in FY26 to your mind?
So it depends on the time when these get actually ramped up. So by H2 26, we expect this to kind of get at those levels, depending on the customer orders.
Okay, so is it okay to estimate that at least 50% of the potential, we're talking about 1,000 crore of incremental revenues in FY26 because of these greenfield?
Well, if other things remaining the same, yes.
Okay, Mr. Chhabra, I just wanted to understand one thing. Right now, I'm looking at the growth rate over this year, right, in FY25. For the first quarter, it was 17%, moving on to second quarter, 10%, and now the growth rate has been around 8-9%. I just want to understand, we've seen a bit of the growth rate slowing down. What is the outlook in terms of the growth that one should watch out for? Any growth guidance or number that you would give for Q4 as well as for FY26?
Yeah, sure. So as far as growth is concerned, I mean, the growth is a factor of a couple of factors. It's a matter of a couple of factors. So for example, the product mix that is there and the content in the wiring harness. So today we know that customers are preferring feature-rich models, and those feature-rich models have a high amount of content and more revenue for us. So a lot would depend on the product mix that is there, that gets sold to the consumers. And if you look at, we have been ahead of the industry. So if you look at Q3, we are 9%. We have 9% growth, whereas the PV industry grew by 3%. So we outpaced the market by 6%. Likewise, if we look at 9 months, we have grown by 12%, whereas the PV industry has again grown by 3%.
So 9-month revenue growth is about 12%. And will you, based on the early indications, Anurag, do you think you can end the year with about this 12-13% top line growth?
I think it's all subject to the volumes what the customer has forecasted. We are very positive. The way we are going in 9 months, it's already 13%. So we have to see, as Mahendra suggested, that what sort of consumer are buying the models. So the higher the model, the higher the content, and the sales value for MSL goes high.
Okay, and just the last one, I just want to understand raw material trends and the raw material prices. They have been quite stable, right? Anurag, is there any change and any concern on that front?
I think, raw material costs are, you have seen there is not a very big change, or there is no abnormality into that.
Thank you, Mr. Chhabra and Mr. Gehlot, for joining in, and wish you all the very best. Look, enjoyed chatting with you today. We'll slip into a very short break on that note. We'll come back with more on the market. It's in the red now for all the benchmark indices. The Nifty is closer to 23,500, down 80 points. Sensex down 360.
But what's happening with the reduction in cost in AI models is extraordinary. Now, I don't think it means that the world's going to need any less AI hardware, because you bring the cost down and just the people are going to use it for a lot more things. The total number of dollars will go up. But that's a really exciting thing happening.
कुछ लोगों को अब जब एआई की बात होती है, कुछ लोगों को अब ये शब्द फैशन में है तो बोला जाता है, लेकिन मेरे लिए सिंगल एआई नहीं है, डबल एआई। भारत की डबल ताकत है। एक एआई आर्टिफिशियल इंटेलिजेंस, दूसरा एआई एस्पिरेशनल इंडिया। हमने स्कूलों में 10,000 टिंकरिंग लैब्स शुरू किए और आज उन टिंकरिंग लैब से निकले बच्चे रोबोटिक्स बना करके लोगों को चकित कर रहे हैं। और इस बजट में 50,000 नए टिंकरिंग लैब्स उसका प्रावधान किया गया। भारत वो देश है जिसके इंडिया एआई मिशन को लेकर के पूरी दुनिया बहुत आशावादी है और विश्व के एआई प्लेटफॉर्म में भारत की मौजूदगी एक महत्वपूर्ण स्थान प्राप्त कर चुकी है।
Welcome back and thanks for staying tuned in to CNBC-TV18. You're watching Midcap Radar. Quickly, let's just look at Alchem Labs. They reported their numbers a short while ago. Doesn't seem like a great set of numbers that has come in from the company. For the quarter gone by, the growth has just been of 1.5%. Domestic sales have seen a growth of around 5.9%, 6% approximately. And international sales, they have seen a decline this time of 6.2%. Margins, yes, some bit of an expansion that they're seeing coming in terms of margins. But overall, the sales growth hasn't been that good, and expectation was much higher in terms of the domestic formulation growth as well as the international business growth for the company. So obviously it's important to watch out for what is going to be the outlook of the company. As of now, concerns are coming in terms of the growth factor. Alchem Labs, that's as of now, is trading at the day's lowest point. That's a weak set of numbers from Alchem Labs. You have Century Ply also that has reported their numbers just now. Net profit is seeing a decline of 7.3%. Keep an eye out on Century Ply. Revenue seen a growth of 22%, and Century as of now is of the day's highest point. We'll wait out for more internals coming in for Century Ply. But let's move on and talk about NCC, because that's a stock that's in focus as well on the back of its numbers. They reported a weak set of Q3 FY25 numbers. So Darshan is joining with us to give us those details.
So NCC has reported a weak set of earnings. It has missed EBITDA estimates by almost 10%. Margin has missed estimates by more than 100 basis points. But more than weak earnings, what has caught the attention is cut in FY25 guidance. Now, FY25 revenue growth now seen at 5% versus earlier guidance of 15%. And margin is seen at 9.25% versus guidance of 9.5 to 10%. Also on debt level, gross debt has seen a sharp increase. As of December 2024, gross debt was rupees 2,400 crore versus 1,700 crore that company had reported as of September 2024, and it's because of the delay in one of the payments related to JJM. And after this, JM Fin has come out with a note. It maintains buy call but has cut target to rupees 330. Also, it has cut FY25, 26, 27 EPS estimates by somewhere in the range of 12 to 27%. So weak earnings and guidance, and because of that, you are seeing a big fall in NCC.
Absolutely, a 12% fall as of now for NCC. Now let's move on, and it's actually time for Growth Code, which is a special initiative by Grow and CNBC-TV18, designed to provide you with valuable insights and strategies to navigate the market and make informed trading decisions. Today, we'll unpack the risk of speculative trading and the lessons learned in the aftermath of the infamous 2001 Ketan Parekh scam.
Speculative trading creates artificial demand and can inflate prices, often resulting in market bubbles. But one small prick and the entire illusion vanishes in an instant. Speculation is the reason 90% intraday traders end up with net losses.
Speculative trading dominates the market despite its risk is because of the lure of quick gains, lack of common sense, and there's obviously a lot of greed as well. Time after time we have seen this cycle repeating. Right now the money at stake is far higher and is of great concern at the moment.
The 2001 Ketan Parekh scam exposed the perils of unchecked speculation. Fueled by insider information and excessive leverage, Parekh manipulated stock prices to siphon off over 40,000 crore.
One of the biggest things that happened in Ketan Parekh's scam was a kind of a narrative that got built. The hype was built so much that it ended up brainwashing the retail investors and traders. The biggest problem here was that while they were investing, the pump and dump scheme was happening simultaneously.
The crisis forced a reckoning, with the market regulator implementing sweeping reforms. Circular trading was abolished. A central fraud registry was created and stock options were introduced for the first time.
The scam definitely highlighted the risks of speculative trading and thereafter shifted the investors' focus to relatively safer and established companies. Investors became far more aware of the risks in speculative trading and the pump and dump schemes. Though the markets post-2020 also need similar kind of awareness.
While the scam helped correct systemic issues, traders also learnt about the risks of speculative trading. Learnings from the Ketan Parekh scam helped India build a stronger, more resilient market.
Consecutive year that the BMC budget was presented to an administrator and not to a standing committee. Why? Because the term of the corporators ended in March 2022 and the elections for the new term and the new corporators are yet to be held. Now this 74,427 crore rupees budget, out of this an allocation of 43,162 crore was made for capital expenditure, 5,100 crore rupees for roads and traffic department, 5,807 crore rupees for Mumbai Coastal Road Project, 3,039 crore rupees for Storm Water Drain Department and 650 crore rupees for Sewage Operation Department. For key public services, rupees over 4,000 crores were allotted to Education Department, over 7,000 crore for Health Department, 261 crore rupees for Fire Department, 309 crore rupees for Disaster Management and 220 crore rupees for the Garden Department. BMC announced that it's going to start 250 new public clinics, also known as Apla Dawakhana, all over the city. One interesting initiative announced by the BMC was the introduction of cyber awareness program for students. It will serve two key purposes. One will be to ensure that the students learn how to use the internet in a safe manner and to keep them safe from cyber fraud. BMC also focused on environment initiatives and projects like promoting eco-friendly cremation and proper disposal of residue from idle immersion. These are the projects which will take place under environmental related initiatives in the next few months. We also spoke to Bhushan Gagrani, the BMC commissioner himself. This was the first time that he presented the BMC budget. Listen to what he has to say about this BMC budget.
So your budget also mentioned that you guys are planning on imposing a tax on the commercial properties in slum areas.
That's right.
If you can elaborate that. So from when this new tax will be levied?
It is actually not a new tax. In fact, we are enhancing our assessment net. Under the assessment net, the properties which are in the slum, however, which are being used for the purpose of commercial, they were not covered. So this is for the first time we are doing the survey and bringing them in the tax net. Not necessarily that we will be imposing huge tax. It's a normal tax. It's not a very huge tax. However, the coverage will be given to our commercial properties.
So BMC has not introduced any new project this time. In fact, you have focused. Correct.
Yeah.
But sir, does it mean that is there any cause for fiscal concern, sir?
No, there is no fiscal constraint. We have enough adequate cash flow as well as resources.
Make informed decisions with comprehensive analysis on the go.
Strengthen your portfolio with real-time market updates on the go. Create effective strategies with insightful expert opinions on the go.
Grow on the go with CNBC-TV18, now streaming live 24/7 on YouTube. How about listening to global market maestros before?
Welcome back. Bharti is undoubtedly the big mover today, and that's because their Q3 numbers were actually pretty good. Now, if you go by just the pure numbers, on the P&L, they're not strictly comparable because now Indus Towers is a subsidiary of Bharti Airtel, and there was a line-by-line consolidation. So numbers are not strictly comparable, but let me run you through some of the key pointers in the numbers. One, the average revenue per user. That's basically your monthly bill. It's the amount a customer pays per month. And that has been steadily inching up. 5.1% quarter-on-quarter, 18% on a year-on-year basis. It stands at 245 rupees, very close to Sunil Bharti Mittal's aspiration that this number needs to hit 300 rupees for the industry to be sustainable. So it's at 245, and there's been a steady progression in that number. Secondly, the number of customers. We call them subscribers. Now, subscribers declined in Q2 because of the tariff hike. It was a sudden increase of 15-16%. Some customers fell off the network. But this quarter, subscribers have bounced back up 5 million on a sequential basis. That's positive.
So that's an important point
That's
coming
very
in, especially
important
for these
Exactly.
companies.
So despite the tariff hike, subscribers on a 2-quarter basis are higher. Thirdly, it's better than its peers. So the India mobile business, because Bharti has Africa, it has homes, enterprises, many businesses, but purely the mobile business for Bharti Airtel has done better than Reliance Jio. In terms of revenues, 5.8%. And fourthly, and the more important one, that the tariff hikes by the industry took place in July. So effectively, Q2 and Q3, both of them had the benefit of tariff hikes. Why even Q3? Because sometimes you have a 3-month plan, you have a 6-month plan, you have a 12-month. So that pass-through takes time. But in Q2 and Q3, the company's revenues went up 17%, which basically means that the full tariff hike has been absorbed. It's not that because of the tariff hike, they lost some, customers, there was down trading, they moved to lower price. That pass-through full benefit of the tariff hike has largely taken place, and that also is a positive.
Absolutely, that's why Bharti Airtel is managing to hold on to good gains of 3 to 4% in trade. But let's move on, and LIC also is something that we're keeping an eye out on. They're set to report their Q3 numbers today. Yash is joining in with us to tell us what are we expecting this time from LIC. Yash?
Yes. Well, as far as the stock is concerned, it's corrected significantly. It's about 32% off its 52-week high. The numbers expected for the third quarter are on the weaker side. As far as new business premium is expected, that is expected to see a decline of about 23%, coming in at about 42,406 crore rupees. Total APE, that is expected to see a decline of about 18% at about 10,789 crore rupees. Retail APE is expected to decline by about 18%. Again, it's about 7247 crore rupees. Importantly, value of new business, that is expected to see a decline of 30%. At about 1836 crore rupees. Margins expected to see a contraction of about 298 to about 300 basis points. Expected at about 17.02% versus 20% on a year-on-year basis. It becomes particularly important because if the numbers do come on the weaker side, then the management's guidance for FY25, that will be questioned, and it will be very important to see if they plan to stick to that guidance of APE guidance of 15%, VNB guidance of 18%, and margin guidance of 19 to 20%. Or is there any change that comes through as far as FY25 guidance is concerned? Apart from the guidance, what will be important to see the increase in non-par share of the business, any movement in management's plan to acquire a health insurance company, and finally, the impact of surrender value regulations on their VNB margins.
Thank you, Yash, for that. By the way, markets have slipped. We've given up 23,500. The Nifty is down to 23,450. Yes, we did get that 25 basis points rate cut, but that perhaps was so widely anticipated that it's not had any impact on the markets. The Nifty Bank is now down a full percentage point. We're going to take your leave on this show. Thank you for watching. Don't go anywhere. Last 1 hour of the week coming up with our closing bell anchors.
strategy? How about getting deep insights into their businesses from top Indian honchos before putting your money on the line? How about making every trading day profitable with strategies from the market masters, macro pundits and chart wizards? Only one show gives you a head start to your trading day. Get ready to profit. Get ready for business with Bajar at these times on CNBC-TV18 and CNBC-TV18.com.
What does it take to build India's largest startup platform? It takes a journey of starting out as an unknown and ending up as unforgettable. It takes more than 2 decades of celebrating the most influential and influencing the most celebrated entrepreneurs. From chronicling the stories of India's startup universe to becoming a success story in itself, as India's longest running show on startups and entrepreneurship, celebrating 21 action-packed years of building India's biggest startup community. Young Turks at 21, only on CNBC-TV18 and CNBC-TV18.com. CNBC-TV18's most comprehensive and award-winning news show, India Business Hour, drops first on YouTube. So get the first access to the most influential architects of policies and politics, the key newsmakers of the day. Discover the big themes as we decode the business of markets, macros and more. Be the first to go to the heart of all the top stories that drive the day's agenda. Catch the award-winning India Business Hour live every night on YouTube with me, Shireen Bhatt.
India Business Hour live on YouTube at CNBC-TV18 weeknights at 7 p.m.
This growth inflation dynamics opens up policy space for the MPC to support growth while remaining focused on aligning inflation with the target. At the same time, the MPC felt that excessive volatility in global financial markets and continued uncertainties about global trade policies, coupled with adverse weather events, pose risks to the growth and inflation outlook. This calls for the MPC to remain watchful. Accordingly, it decided to continue with a neutral stance. This will provide MPC with the flexibility to respond to evolving macroeconomic environment. The MPC decided unanimously to reduce the policy rate by 25 basis points from 6.5% to 6.25%. The MPC also decided unanimously again to continue with a neutral stance and remain unambiguously focused on a durable alignment of inflation with the target while supporting growth.
Every leader, business, government, investment leaders, economists, we're all scrambling to adjust to a very new reality and a new approach, I think it's fair to say, from a US administration who seem very focused on American interests and are quite content to rewrite what have been thought to be kind of historical norms. So those historical norms started really earlier this week with the seeming tariffing of Mexico and Canada. Canada, obviously, a huge close ally of America.
Welcome to India's #1 budget headquarters. Decoding key policies, delivering market-shaping insights, and unlocking the potential of India's growth blueprint. Beaming live from the CNBC-TV18 Motilal Oswal Budget Headquarters.
The Hang Seng trading with gains of just around 0.4%. The Taiwanese index, after the outperformance through the week, is now trading at the flat line.
Late last afternoon, she had moved the Delhi High Court. The Delhi High Court, however, had rejected her application.
You know, a 25 basis point cut is in the price. Markets are absolutely expecting it. Nifty 23,652. We've got the Sensex, which is starting at 78,240.
Then Japan looked more interesting, and also China is looking more interesting at this point in time.
Unanimously to reduce the policy rate by 25 basis points.
Nifty is marginally in the green after ending marginally in the red in yesterday's trading session.
Keep liquidity surplus in the interbank system or just adequate?
The endeavor of Reserve Bank to provide as much liquidity as is required.
Hello and welcome to a fresh edition of Closing Bell. We are down to the last hour for the day, that's today, and of course for the week, and it's turning out to be a bit of a disappointing hour for the bulls, you'd have to say. Though the RBI has delivered along expected lines, we've got that 25 basis points rate cut. But I guess, Nigel, for the bulls, it was ye dil mange more. And they didn't quite get it, so some disappointment playing out today.
Well, that's right. And I think we got a couple of other big cues, right? This evening, you'll have the jobs report. And this one's going to be important to understand what's the trajectory with regard to the Fed. And the other big cues over the weekend. And the street was believing that the BJP is going to do much better, which should be the case. But can they come out trumps is going to be important. So I think two big cues is what we're looking forward to. So maybe some bit of jitters ahead of that.
You know, absolutely, I take that point. But the markets completely looked through even some of the other positives that came in from the RBI policy. Let's pull up the Nifty and the Bank Nifty. Nifty is down about 0.6%. Bank Nifty is actually falling far more. It's down about 1%. And we're not too far off from the lowest levels of the day on these indices. So that's another sort of factor of disappointment. Will there be some reversal, some recovery by the end? Let's see, we have an hour to go. Why I'm saying the markets refuse to look through any positives is that there were some positives. The RBI governor promising, number one, the fact that this was a unanimous decision. It was, a uniform call by all members of the MPC. The stance has remained neutral. Maybe some will argue that the market would have wanted to see a change in stance to more accommodative. But there was commentary on providing adequate liquidity to the market as and when it was needed, but the market has ignored that. And for banks specifically, something that the banks have not cheered is the fact that the governor has very clearly stated that any change in regulation with respect to those ECL norms, expected credit loss, or even the LCR norms, or even the new sort of norms on project financing, all of that is getting pushed. There will be more consultation around it. So nothing is getting implemented starting the 1st of April. But clearly it's not been enough. And we're seeing the market down and out at this point in time. So the banks are down for sure. But it's not only the banks. Let's look at some of the other names as well. So Nifty losers, maybe we should just pull up the whole list of Nifty losers out there. Big stocks like ITC, SBI, TCS, ICICI Bank, a lot of your big heavyweights, Reliance, Infosys, L&T. So while it's easy to blame the banks, the fact is that you can't, only blame the banks because none of the other big boys are standing up. They're not getting counted at all. So there's a lot of downside pressure coming through. ONGC is the biggest loser on the index right now. The counterweights are actually, there we go. That's the contribution chart. So that's telling you it's not only banks which are on the negative side of that list. The counterweights are coming in the form of Bharti Airtel, obviously because of the good numbers. Trent is seeing a bit of a relief rally. And then there are some global facing stocks, metals in particular, that are doing pretty well this afternoon. So names like Tata Steel, Hindalco, they're holding up, as are global markets. But yeah, it's been disappointing for the bulls.
Indeed. Well, let's get in Mitesh Thakkar. Mitesh, what are you making of today's action? Would you hold on to that positive stance or is it breaking down? And also give us a couple of picks.
Yeah. Good afternoon, Ajay. So, I've been advocating that some kind of positive bias should be maintained on the index. And also mentioned that in case there's volatility with the event coming up, we could even see Nifty, head and test 23,400 odd levels, close to that. Now, there was this gap which happened on Tuesday, with that positive announcement, which is between levels of 23,380 to about 23,420. That's the support pivot which I was talking about. And if that gap is not filled, then I think we should again bounce back. Maybe it'll take a few more days, but we should again try and test to 23,800. So I think this is a level which should be the final threshold, 23,400, 380 zones. And as long as that doesn't break, I think, I will maintain a positive bias. The levels of the Bank Nifty are slightly lower because the Bank Nifty gap is at about 49,400, which is roughly about 500 points lower from here. So therefore, focusing on the Nifty as an index.
Okay, all right. What about individual stocks?
On the stock side, again, I have one buy and one sell call. On the sell side is Atul Limited, continuously making newer lows. Sell here with a stop at 61.30. Look for a target of roughly around 59.50 to begin with, and maybe even lower levels. This is one stock which has been underperforming, as well as the chart structure remains slightly on the weaker side. And on the buying area is Bharti. It's come off the day's high, but the structure is much better over here. So Bharti can be bought with a stop at 1657 for targets of 1700, and then above a close above 1700 would be even better.
Okay, all right, got that. Thanks very much, Mitesh. We'll come back to you for some more trades and some ideas in a bit. Let's now also welcome in Dilip Bhatt into the conversation. Dilip, great to have you on. Speaking after a while, good to have you on Closing Bell. So let's get your stance on banks and financials straight away. I mean, the market's clearly disappointed, but I don't know if it was that bad a policy. Your thoughts, and what would you do with financial stocks? Any buys?
Good afternoon, Surbhi. I think as far as the financials and the banks go, I think we still remain pretty neutral even after the budget after the policy announcement by the RBI. Very frankly, I think, as what we all know, that this 25 basis point was factored in. But in my opinion, apart from the fact that the liquidity is the need of the hour, which is very, very loud and clear, and there was a very nice article written by Mr. Puri, the ex-CEO of HDFC Bank, on how to improve the liquidity. I think that, of course, that point is very well taken. But in my opinion, the disappointment for me would be that RBI also feels that next year the GDP growth will be around 6.7%. In my opinion, Surbhi, that if it is going to be around sub 7% or even just closer to 7%, it's not going to bring back the corporate earnings in any serious or in any big way. So we will be back to those pick and choose, and by and large there will be pace, and to use my very common word, it will be schizophrenic in nature, the economic performance. So coming to banks and the finance, I would still say that, yes, they look defensive from the current levels, but not too ready to commit to the banks or financials, or rather even to the markets at the moment. I would say that we will have next 5 to 6 weeks, which possibly will see more volatility and possibly will give some good opportunities.
Okay, that's as far as the take on banks is concerned. Dilip, then let's get your view on perhaps what has been the biggest debate of the week, and the stock of the week for me has really been Trent. Whether the best is over and done, whether it's time to unload positions and move out, or whether these are the kind of dips which you should buy into if someone is looking at keeping Trent in the portfolio from a medium term. What would your advice be? I'm sure lots of people have exposure to the stock, whether in their mutual funds or even directly.
So I think going by the performance and going by the way they are going to fare over this year and over next couple of years, clearly they are trending upwards without any doubt. And I think that momentum will be maintained. But challenge, Surbhi, of course, will always remain the valuations. How do you value the stock, especially at these valuations? Of course, it has corrected. It has seen a lot of volatility right now. And if you personally ask me, I will stay away from Trent for the time being. I would not be in a hurry to buy, because for me, I think the valuations look pretty exorbitant, pretty expensive. And despite the fact that the momentum will be maintained, the growth rate will be maintained, but not the valuations continue to remain very challenging. And so I would prefer not to look at the stock at the moment.
Okay, all right. Dilip, I wanted your view on ITC. That's one of the big drags on the word go itself. The stock has gone through that split where you have the separate listed ITC hotels, and that will be excluded from the Nifty. So we'll see some kind of outflow towards the end of trade today. But what's your view at around 430? Everyone thought that maybe no negatives in the budget. Valuation-wise, it's pretty okay. Things should look up, but actually it's seeing a lot of selling pressure.
Nigel, surely ITC is one of those stocks which probably has had a very good run-up, and maybe in the last 6 months or so, it has not done anything great, or maybe more than that, a little more than that. And possibly, I think over the next 6 to 8 months, possibly will not do much. Because if you see that the ROCs are good, the cash flows are good, without any doubt, all those things are in place. But once again, when it comes to valuation, I think the growth is a factor, because the growth is not going to be all that robust, especially if you see the cigarette growth. This time the cigarette growths were a little more healthier than what we normally expect. But on an overall basis, if you see some of the other verticals of the company, I don't think that they will really push the momentum of growth northwards in any decisive way. So for me, ITC, personally, I would say that one should hold on to the stock, keep on eating all the dividends that they give, and possibly wait for some more, the things to improve internally on the company's front as well as on the external front.
All right, Dilip, I request you to stay with us. Let's get the management of solar industries. The stock is quite nervous, post the con call. So let's clarify a couple of issues. We have with us Mr. Manish Nuwal, the managing director of the company. Hi, Mr. Nuwal. Good afternoon, and thanks a lot for joining in. Well, the street has got very, very nervous post the con call. Give us a couple of numbers. Your volume growth now you're guiding for around 8 to 10%. Could you confirm that? And also, could you tell us, on this base, what kind of growth are you looking at for FY26? And what does it mean in terms of revenue growth? So let's get this out of the way. Volumes and revenues for this year and for the next.
If you talk about the revenue, if you look at my Q1 numbers, we grown by only 0.7%. And after the Q1, in Q2, we grown by 27%. Q3, we have delivered 38% growth. Q4 also, we are going to deliver 30% plus growth. So if you take all these quarters together, so our growth will be around 23% in revenue terms.
Okay, revenue. And what about the following year? 23% revenue terms, 8 to 10% volume terms for FY25. For FY26, yes, what kind of growth can you deliver? And also give us an understanding about margins, because that's held around 27%, 26, 27%. So can you maintain this?
So if you talk about the margins, then at the start of the year, we said that we are going to achieve better margins, which means that in last year, we did 23.3% EBITDA margin. This year, we were expected to deliver around 25% something percentage in EBITDA margin growth level. And we said that we will do 25-26%. Actually, we are delivering around 27.5% as of now. And we believe that the same traction will continue in the next quarter and next year as well.
You didn't give us the revenue number, sir. So we'll say that from 26.5% you'll improve, but revenue growth for FY26, we missed that number with the volume growth?
Yes, for the next year, we are firmly believing, and based on our current statistics, we believe that next year the volume should grow more than 15%. And on revenue terms, now defense is unlocking, international subsidiaries are doing better. We should do 30% growth in the next financial year.
30% growth in top line in FY26 and 15% growth in volume terms in FY26. So those are the two big numbers to focus on. Can you, since you're talking about defense and the export market opportunities opening up, let's talk about this Pinaka multiple launch rocket system order, because this is what's generated so much of buzz, right? Now, the total quantum obviously is large. It's huge, over 10,100 crores, but this is over many years, I'm guessing. So how does it start flowing into the P&L? When do you book revenues? Just give us some more details around this. And apart from Pinaka, you had also very, very recently announced, a big MOU with the Maharashtra government, again, for defense projects. So I don't know if there's some linkage between Pinaka and this, or if they're separate. Just tell us a little more on how the revenue booking will be.
So in last 12 years, we were spending a lot for defense vertical, and we have expanded our product portfolios, which includes Pinaka as well. So after so much of hard work, we have received the contract yesterday, and the total contract is worth 6,084 crores. And it has two varieties of Pinaka. And for each variety, there are different timelines for deliveries. So we believe that based on the contract, 80% of the value should be delivered in next 8 to 9 years, and rest all we will deliver in next 5-6 years. So in P&L side, it will start giving impact in the next financial year.
Next financial year, if you...
26.
Okay, so I'm just repeating the numbers. The total value that will come your way, you said over 8-9 years, is about 6,084 crores, correct?
No, the total contract is 6,084 crores. Out of that, almost 80% will be delivered in 8 to 9 years.
No, is that entirely your share, or is it being split between? That's entirely your share, right? 6,084.
That's Solar's share.
Okay, got it. So, to what extent will the revenue recognition be in FY26? I'm guessing it starts slow and then kind of builds up. And if you could just clarify on this Maharashtra MOU as well on the defense side.
I think based on the contract in next financial year, we are expecting that it will be slow start in the first 1 or 2 quarters. From Q3 will pick up, and we should do around 300 crores in next years. And then from 27 FY, we should be doing around 500 crores plus every year for 8-9 years. And as far as the MOU with the Maharashtra government is concerned, like you are aware that our company has participated in many development programs. We are developing programs or products on our own. And recently we have successfully tried to a very large extent Bhargavastra. So we are working on anti-drone systems. We are working on variety of rockets to meet all those upcoming demands for next 5 to 10 years. The company has thought that we should expand our facilities, and that's why we have signed an MOU with Maharashtra government, which is around
just a quick question on defense. I believe defense is about 21% of your total sales mix right now. Now, with all these high-profile orders coming in, Pinaka, the other stuff you're doing with Maharashtra government, what will defense be as a percentage of your revenue, say in FY26? And then what does that do to the margin? I'm interested in knowing whether with these high-profile defense orders, whether your margin improves from 27% or is it margin dilutive, these large government orders?
So last year, our defense sales was only 7%. And in this year, now it is 17%. And as a result, the margin has increased to 27.3%. As we move forward, as defense sales goes up, definitely contribution from defense will be much better. And our international subsidiaries are also doing quite better than what we were doing in a couple of years back. So I believe that 27 to 28% EBITDA margin should not be a problem for our company.
Final question, Mr. Noval, before we let you go. The problem for the company is that the market capitalization has become so huge, right? So then justifying valuations becomes an issue. But I'm looking at an ICICI Securities note, and they are saying by the end of this year, you'll do around 1,250 crores, very approximately. But then because of this ramp up in business, they are expecting that in the next 2 years, that's by FY27, they are factoring in more than 2,000 crores of net profit. Is that gettable?
Sir, if you just connect these two dots, what I said, that in next year, our defense will pick up from the current level of say around 1,500 crores on annual basis level. If it picks up and expand more than 2,500 crores in next year, and our domestic and international market doing better. So if you club these two things with EBITDA margin of 28% approx, then definitely our profits will be around those levels, what you have said just now.
All right. You know, Mr. Noval, normally we would connect the dots, but since we have you on the channel, we rather confirm about that. So thanks a lot for joining in. You've clarified on a couple of issues. The stock had come off from the top because, you know, the street's expectation was you would grow far higher in FY25, but you're saying FY26 will be even better than FY25. For the time being, the stock is more or less flattish. We'll watch out for these revenues, margin scaling up, and the big number, 2,000 crores of profitability possible in the next 2 years. That's FY27. Dilip Bhatt is still with us. Dilip, any view on this one? Solar Industries, you know, the stock the last few years did very, very well, but from the top, actually, it's corrected a little bit.
Nigel, I think first and foremost, this company is really very well managed. And I mean, Mr. Manish Noval and his father, I think both of them have really managed the company exceedingly well without any doubt. And I think full credit goes to them. But I think, Nigel, valuations remain a challenge. But if one were to, I mean, we'll have to do a little more research on that. But if it's really talking about from, say, they're going to achieve 2,000 crores over next 2 years, I think this stock definitely merits a buy because their defense share is going up. the EBITDA is the blended EBITDA is also going up, and they're also showing a very smart growth. So possibly that will justify some kind of increased valuation. So I would say yes, this stock certainly looks pretty good, pretty interesting, and one can have it in the portfolio.
Okay, all right. On one hand, one would say that on a trailing basis, multiples actually are expensive. Even at 2,000 crores, I think it trades at around 40 times. But return ratios are good, and it appears that business potential as well is there. So the verdict, we'll have to see. But Dilip believes that maybe he's fairly positive on this one. Thanks a lot, Dilip, for joining in and giving us your take on all the stocks that we just discussed. Well, it's now time for the Growth Quote, a special initiative by Grow and CNBC-TV18 designed to provide you with valuable insights and strategies to navigate the market and make informed trading decisions. Today, we unpack the risk of speculative trading and the lessons learned in the aftermath of the infamous 2001 Ketan Parekh scam.
Speculative trading creates artificial demand and can inflate prices, often resulting in market bubbles. But one small prick and the entire illusion vanishes in an instant. Speculation is the reason 90% intraday traders end up with net losses.
Speculative trading dominates the market despite its risk is because of the lure of quick gains, lack of common sense, and there's obviously a lot of greed as well. Time after time, we have seen this cycle repeating. Right now, the money at stake is far higher and is of great concern at the moment.
The 2001 Ketan Parekh scam exposed the perils of unchecked speculation. Fueled by insider information and excessive leverage, Parekh manipulated stock prices to siphon off over 40,000 crore.
One of the biggest things that happened in Ketan Parekh scam was a kind of a narrative that got built. The hype was built so much that it ended up brainwashing the retail investors and traders. The biggest problem here was that while they were investing, the pump and dump scheme was happening simultaneously.
The crisis forced a reckoning, with the market regulator implementing sweeping reforms. Circular trading was abolished. A central fraud registry was created and stock options were introduced for the first time.
The scam definitely highlighted the risk of speculative trading and thereafter shifted the investors' focus to relatively safer and established companies. Investors became far more aware of the risks in speculative trading and the pump and dump schemes, though the markets post-2020 also need similar kind of awareness.
While the scam helped correct systemic issues, traders also learnt about the risks of speculative trading. Learnings from the Ketan Parekh scam helped India build a stronger, more resilient market.
Save them from being on the list, at least for some period of time. Those tariffs subsequently didn't come to pass, at least for now. And to your question, yeah, the Middle East, like everywhere else, we're all looking, I guess, tweet by tweet, Truth Social post by Truth Social post as to what's going to happen next. And that would apparently include some historically astonishing proposals, at least.
Tensions between employees and management at Samsung's Sriperumbudur plant just outside Chennai have surfaced yet again. For well over 24 hours now, over 100 employees, we're told, have been staging a sit-in protest at Samsung's plant just a few meters from where I'm standing. In fact, this line of company buses and these barricades have been erected by Samsung so as to prevent members of the public and observers much like myself to see what's been going on through the gates of Samsung's plant just a few meters from where I'm standing. Now the issue is simply this. A few days ago, 3 members or employees rather of Samsung's plant were suspended after allegedly engaging in activities deemed detrimental to the interest of Samsung's operations in India. However, employees of the plant, a section of them, and members of the Samsung India Workers Union claim that this suspension was not on account of disciplinary action or disciplinary reasons, but simply because they were affiliated with the Samsung India Workers Union in the first place, also claiming that Samsung does not want any employee to be actively engaged with this recently established workers union. Now remember, this isn't the first time that issues or a face-off between Samsung's management and employees have cropped up. In September, nearly 1,100 employees of this very plant staged a protest outside plant premises, claiming for better privileges, more representation, better pay, and also representation by way of a union which Samsung said all that while that it was averse to forming in the first place. However, following the Madras High Court's intervention, Samsung India Workers Union became a registered union under the Tamil Nadu Labour Department, thereby ensuring that some of these workers' demands pertaining to representation by way of a union was summarily met. However, these issues clearly have not been laid to rest, simply on account of the recent suspension of those 3 employees. Now the issue is simply this: while these employees claim that they were suspended for their affiliation, Samsung in a statement has said the employees in question violated the company policy and have been suspended temporarily and will be subject to appropriate disciplinary action following a formal inquiry, end quote. Now while it's a case of he said, she said between Samsung and its employees, the fact is that these outstanding issues between Samsung and its employees don't seem to be going away anytime now, given the fact that both the employees and the management seem to be heading in different directions with regard to what they expect of each other pertaining to both representation and a basic disciplinary expectation.
Welcome back. Well, the markets have recovered a little bit from the low point of the day, so I think we should get the intraday chart up there. I think we are 50 points off the day's low, and the good news is the mid-cap index is almost in the green as well. So you like that in terms of a screen movement. Also, ITC is under pressure, but ITC hotels, keep an eye out on that one. We've been making this point briefly on closing bell itself that the volumes are very, very high. It appears those sellers, that got the stock by default, they appear to have cleared out, and that stock has now moved to the high point of the day. As I said earlier, it will be excluded from the Nifty as well, effective today. So some outflows, but it appears for time being, it's already getting lapped up. Let's focus on another, a big news point that came in today. SEBI has cracked down on Finfluencer, Ashmita Patel. Yash joins us to fill us in with more details on that. Yash.
Nigel, the order after the FAQs were released last week has come practically in no time. This particular order again is a crackdown when it comes to influencers and their unregistered investment advisory. The person involved here this time is Asmita Patel, or as she would call herself, the she-wolf or the options queen as well. This is an interim order come show cause notice from market regulator SEBI against Asmita Patel as well as Asmita Patel Global School of Trading along with 4 proprietary entities. The order comes after about 42 complainants send their complaints with SEBI. All these 42 people had taken the courses which were sold by Asmita Patel and their proprietary entities, felt cheated, reached out to SEBI with everything that happened to them, after which SEBI has taken this big crackdown on another influencer. What are the allegations? Unregistered investment advisory and research analyst services. Second, violation of prevention of fraudulent and unfair trade practices, which is known as PFUTP regulations. Defraud in connection with dealing with securities and mis-selling of services related to securities market. Imagine the extent of money which was being taken from all these people who subscribed to the courses. The money which was being collected was to the tune of about 8.5 lakhs, including GST, for a course which would span across 7 months, which gave them training in the securities market. As far as the order itself is concerned, SEBI has said that an amount of 54 crore will have to be impounded by Asmita Patel and the related entities. Importantly, the show cause notice doesn't end there. It takes the order a step forward by saying that please tell us and show us a cause. Why should we not ask you to disgorge an amount of 104 crore rupees? So an important step by SEBI as far as the Finfluencer regulation and unregistered investment advisory is concerned.
Okay, all right. It's quite an amount as well that needs to be given back. Thanks, Yash, very much for that. With that, let's get back to the market. We have our next guest joining in. Rupen Rajguru, Head of Equity Investment Strategy at Julius Baer, is with us now. Rupen, great to have you on. So the market's been kind of, it's been a slightly disappointing day for the bulls because we had a flurry in the middle of the week where the market was taking aim at higher levels. We had 23,000, almost 700 on the screen. But there's not been much follow through. And now we've got both the, the stimuli, the fiscal as well as the monetary today. Where does it leave the market trajectory? What's your call?
Yeah, hi. Good afternoon, Subi. In fact, as I spoke with you last time around, this would be the year of consolidation and contra. So we would want the stock market, which was in a relentless bull run between 2020 and 2024, to take a pause. So earlier what was happening is that every positive news used to get amplified and used to get rewarded, and people used to ignore negative news. As we speak, what's happening is that any negative news gets amplified and any positive news gets easily forgotten. Why is this happening? Two reasons. One, if you look through, at the end of the day, what does market look into? Market look into the earnings growth, and then it looks into valuation. So on both the accounts, we definitely require a pause, and hence I said consolidation. While you're absolutely right that the economy, which is witnessing, I would say, a little bit of cyclical slowdown with all the measures, be it on the budget side, to boost the consumption as well as by the RBI by a rate cut today, will help the earnings grow, but it will happen probably after a lag of 4 to 6 quarters. Till such time the earnings growth doesn't catch up, I think we would be into the zone wherein probably at every rise there will be some bit of selling which would be happening, and that's why probably market will remain in this range.
Okay, all right. Hi, Rupen. Good afternoon. Good to see you, Vin. What are the top sectors, though, you're betting on? I think you were fairly positive on financials, banks, insurance. Tell us more. And try to give us a hint in terms, if you're talking about banks, then what do you like from the banking space? The larger names?
So, hi, afternoon, Nigel. In fact, if you look through the entire correction which we witnessed in January, banking and to some extent IT were the sectors which were probably, so to say, the best performing sector. And from a standpoint of valuation, definitely banking is the sector which is trading at a valuation which is much lower than its historical average, and also vis-a-vis the Nifty, it is trading at a much lower level, both on the earnings and the price to book side. And we saw through the results, I think a lot of the big boys, be it the largest private sector or the largest public sector banks, they have demonstrated that the margin pressure is there, but not as much as what street has expected. And at the same time, the asset quality, specifically on the retail side, I was also very positively surprised by the way the largest public sector bank, the retail credit stood out. So the underwriting skill also is far superior. So in uncertain times wherein growth is difficult and the credit cycle is probably not on your side, we would stick to the largest players out there, in that segment. So that's the segment. Secondly, yes, insurance is a sector which we like. And, the life insurance companies, while there was a lot of regulatory noise over last probably many quarters, we believe majority of the regulatory noise is now behind us. And the growth numbers have been pretty strong. And here, what are the type of companies we like? Companies which have a good, decent product set, has a very wide distribution network. So a lot of the insurance companies which have a strong banker partners. And at the same time, now if you look through, the non-par products, which is a high margin product vis-a-vis the ULIPs, with this rate cut, which we have seen, the relative attractivity of those products will come back. And we believe that, over next year, a lot of these companies will have some of these products which might kind of contribute meaningfully to their revenue, which will be aiding their margins as well. And also the protection growth is pretty strong. So all in all, insurance is a sector we like. And finally, I would say consumer discretionary, particularly after, the kind of fillip which we have seen. And if you look through in the budget, the maximum delta will come to people who are earning between 12 lakh and 25 lakhs. And that's the bracket wherein, will be having more money at their disposal. While they can consume, they can also save and invest. Here, the companies which are in that segment, be it the hotels, be it, the QSRs, and to some extent jewelry companies, all will benefit from that. So I think consumer durables as well. So that's the segment which we like, particularly after the budget boost.
Okay. All right. So, that's a thought. So, Rupen, leave us with some ideas. It's a difficult environment, slightly confusing, tough market. What would your biggest overweights be? And if you were to deploy some money now, first of all, would you go all in? Would you stagger it? And then the themes that you're most confident on for, say, the medium term, at least the next 6 months to 1 year.
So, Surabhi, in the current context, frankly, if you ask me, is there like a no-brainer buy or a sector or a theme which kind of looks completely like, decimated and, worth warranting a buy? The answer is no. But at the same time, within the sectors also, and hence when I said the two themes, one is consolidation and second is contra. So within each sector, there would be stocks which are trading, probably at like within banking also, there are a lot of private sector banks which are now trading at, say, a 1P multiple, one price to book multiple over next FY27 book, closer to that. So when the environment improves, historically, those were, trading at closer to two multiple, now at 1. So those are attractive. Within pharma also, if you see, there are some companies on the CDMO side which are looking pretty interesting, very high growth. That looks good. And, difficult to pinpoint a particular sector per se, but one segment, which is beaten down, probably seeing some recovery, I would say, is chemicals. So post-COVID, I think, all these stocks had a variety of issues, be it issues around higher raw material prices, higher inventory, China dumping, and all those they have seen through those cycles. And probably this quarter we have seen the earnings probably growth to be pretty good for them. And that segment is something which we believe can see a little bit of re-rating because it has seen a significant de-rating over the last 3 to 4 years.
Okay, all right, Rupen, appreciate you joining in. Thanks a lot for giving us your view on markets and all those stocks and sectors that we did discuss. Have a good Friday evening, good weekend, and we'll catch up with you rather soon. Well, let's focus on the other sector that's bounced back in today's trading session and tell you why metal stocks are shining yet again. First up, the RBI cut rates, the repo rates, that's likely to help the economy. So that's point number one. The second factor is the indications are that the rupee is slipping a little bit and it'll be allowed to find its own fate. A depreciating rupee actually is not so bad news because it restricts some imports and it helps the metal industry actually. So that's point number two. Point number three is ArcelorMittal, the listed stock overseas. Well, that one was up close to around 12-13% overnight. And their commentary was very, very good. They have mentioned that the steel industry is at cyclical lows. They're also forecasting that, that demand ex of China, well, that could grow by around 2.5 to around 3.5% in 2025 in comparison to 2024. And for India, they were factoring in 6 to 7% growth. So that's good news. They believe that demand will be much better in 2025 in comparison to 2024. So that's the third point that we're talking about. Point number four is, again, there is these reports that are coming up that China is going to do something about their property market that has been very, very weak. And the commentary that came out there is that they're looking to get the real estate investment momentum back to speed as soon as possible. So that optimism on China is another point out there that worked in their favor. And finally, there is hope of some kind of protection that's coming in there for the steel industry. Some kind of anti-dumping duty, some kind of protection from imports as well. We have had Mr. Sajjan Jindal talk about it. We had Mr. Jayant Acharya that voiced his opinion as well. And the hope is that somewhere in the middle of February, we could hear something. So because of that, the steel stocks are doing well. So a few short points out there. If there is some duty that comes in there, you could see a price increase that comes about. In January, prices were still more or less flattish. In February, there's an attempt to push up prices. And keep in mind, global steel prices as well will have to recover from here on, because those Chinese producers that are not integrated, at these sort of spreads, they can't make any money. So the hope is, both globally and domestically, things should look up, which will result in an EBITDA per ton expansion as well. Explains why metal stocks are twinkling today.
Green, plenty of green on those names, Nigel. Thanks for that explanation and context as well. For the timing, let's focus on Mahindra & Mahindra. Good show, steady quarter. Let's go across and listen into the management.
Needed price correction. We took something on 3XO, which was the first increase we took after launch. We also took something on XUV 700. So, we had a couple of price increases and we didn't really discount. Apart from that, as Amar said, there are multiple initiatives that we always do to get cost out, including material cost, and then that starts playing out. So it's a combination of all of these. Plus, of course, operating leverage, because it's a strong volume growth.
How's the discounting scenario now in Q4, the first month?
But there's no difference in the discounting, except that we always have to run something on a 2024 win, which is a standard thing anytime as you get into January. So if dealers are carrying some inventory of 2024, which is bound to be some inventory, so obviously there will be discounts running on that, but there's no other material change in discounting.
Understood. If I can squeeze in one more question.
Yes, please.
Mr. Barua, you mentioned that commodities have been benign, but steel, especially steel, now the government of India is looking for some kind of protective measures for the Indian industry. At least a study is going on. If that happens, just trying to understand steel as a cost of your overall expenses, what would your exposure be?
So I don't have an exact percentage, but what I can tell you is within steel also there are multiple grades, right? And the measures that might come into might not be as relevant from an overall, because there's a overall steel oversupply situation right now. So what is meant for more construction activity might not necessarily be the impact that we'll see in the automobiles. But I don't know, Rajesh, if you have a different...
I'll add something to that. 93% of our steel is procured from within the country. And
right, so I think I should clarify what I meant by the question is, if some duty measures come in and steel prices in the Indian markets also correct on the upwards trajectory, just trying to understand to that scenario, what kind of exposure would you have?
Yes, and I was getting to that second part later, which is our sense is the government will look at the impact on all user industries of steel, which will be across the board, and ensure that the specific problem which is around dumping, which is being looked at, is addressed, but the dumping problem shouldn't really translate into higher prices that impact all industries, because that will essentially take inflation up and take away some of the good work that's been done right now to provide a demand stimulus for the industry, for the economy overall. So that's the expectation that we have in terms of that balance, and we shall see how that plays out.
Thank you, sir. Mr. Jejurikar, if you can just help me with a number in terms of steel as a constituent of your bill of materials.
I think it'll firstly be very different for auto and tractors. Yeah. For on the auto side.
On the auto side. Yeah. Thank you.
Swaraj, you had a question, and Hormaz also you have a question.
Thanks. The rate at which M&M is growing in the PV segment, it looks like you'll be fast running out of capacity.
That's a good problem to have.
Any plans of hiking it further from here on?
Yeah, so just to Swaraj, recap what we've said so far. We were at 49, we said end of last quarter, then we said we're increasing it by 5 for rocks. So that took us to about 54. Then we've added the capacity for electric SUVs, which takes us to whatever, let's say another 8,000-10,000, so mid 60s. And I think that now that is a good number as an overall SUV capacity. Now, like I said earlier, we have some specific product / aggregate capacities to debottleneck. So we definitely need more gasoline capacity on 3XO than what we have. We do need to increase some capacities on Thar and the 3XO portfolio. And these are small incremental capacity enhancements we'll do over the next 3 to 6 months. But right now we're not looking at any significant expansion capacity till we really see what is the balancing that will happen between ICE and EV volumes. We'll get a feel of that over the next 3 to 6 months.
And the arrangement, the contract manufacturing arrangement between MEAL and M&M, does this mean that M&M standalone will not make or sell electric passenger vehicles, and that will be, all such products will be the exclusive business of MEAL from here on? No electric EVs will be made within M&M?
No, the electric EVs will be manufactured within M&M and sold to Mahindra Electric. That's the contract manufacturing. So Mahindra Electric is outsourcing manufacturing to M&M on a contract manufacturing basis. They will be sold exclusively through MEAL, through the dealer network. Does that clarify?
Yes, okay. And just last question on the long stance that M&M has held on hybrids. Are we still sticking on to it, and that as and when the opportunity, if there is there, we can look at it? Or has there been a change of stance on that?
We are still sticking to it.
Thank you.
Hormaz, Nihal will come back to you. There are quite a few. Yeah?
No, XUV affordable right now is still in M&M AD. Is not being sold through MEAL at this point of time. In Q4 as well. It's in M&M, not in MEAL. Hormaz?
Hormaz, do you have a mic? We'll come back to you after that. Yeah, thanks.
All right, that's Mahindra and Mahindra, the management there. Mr. Geopolitical fielding lots of questions. It's been a steady quarter for the company. Okay, let's go forward and quickly review the situation as far as the screen is concerned. It's not that bad. There's actually a good recovery in the market, you'd have to say. Look at the Nifty. It's trying to get back towards the positive side of the screen. This is not something to write off just like that. When we started the show, we were at the lowest point of the day. Bulls are fighting back. They want to have a good Friday. Let's take that break. Come back with more in just a bit.
Did you know there's an asteroid headed towards Earth and there's a more than 1% chance of an Armageddon-style threat to the planet in 2032? In fact, NASA has said the chances that the asteroid 2024 YR4 will impact Earth in 2032 has risen from 1.6% to 1.9%. While it might sound surprising, it's not time to start panicking just yet. NASA was also quick to step in with some reassurance. Paul Choris, who heads NASA's Center for Near-Earth Object Studies, said, and I quote, "We are not worried at all because there's a 99% chance it will miss, but it deserves attention." The space rock that's between 130 to 300 feet wide was first spotted on December 27, 2024 by a NASA-funded station in Chile. It quickly made its way to NASA's risk list, which tracks any objects that could come close to Earth. While the chance of impact is still low, NASA continues to watch it closely. These probabilities can change as more data comes in, and many asteroids that have appeared risky at first have later been deemed harmless. Right now, no other large asteroids pose a threat with impact probability above 1%. So, while asteroid 2024 YR4 is something to keep an eye on, you may not need to lose sleep over it. For now, NASA's planetary defense team is on the case, and we'll keep you informed whenever there's new information available.
I think the underlying innate technology is just right on the threshold, and we'll get there with the next models. But now people have got to go off and build all these services. So someone in this room hopefully will figure out what the AI tutor of the future looks like, and that'll be a population scale thing, and it'll think what that would do if every kid on Earth, this year got an AI tutor that was provided like a better education, or helped to provide a better education than anybody could get last year. Think what it would mean if we could have like an AI medical diagnosis system that was better than anyone could get last year. Think what it could mean if scientists could go cure every disease faster. And so, we've been waiting for this moment for a long time. I think we're gonna deliver something that can help with it, and now people have to go build with it.
Welcome back. Well, as we have been saying, the markets have seen some bit of a recovery. Let's get in Mitesh back on the show. Mitesh, good recovery is what you're seeing. That 23,400 mark that we were talking about, that's got protected at least for today. Give us a couple of stock picks.
So, Nigel, I think that remains a very important level, and I think, I still hope that that level kind of manages to sustain. As long as that happens, good chance that we will have seen some volatility and we will be ready for some kind of move next week. On the stock side, BTST on Eicher Motors with a stop at 53.60 for targets of 54.20, and Colgate Palmolive is on the negative side. It's trading near the day's low as well. So STVT here. Keep a stop above levels of 26.30 and a target of 25.80 can do.
Hey, all right. Got that, Mitesh. By the way, the top volume traded stocks in the last 20-30 minutes is ITC Hotels. Massive volumes, more than 3.5 crore shares getting traded out there. And it's going to be excluded from the Nifty today. That's the changes that will take place. The passive index adjustments, that's already been completed. But Nuvama, they have put out a note and they're saying, according to Nuvama alternate research, the outflow is expected to be approximately 90 million USD, which is approximately 46 million shares. And that's close to around 2 days volume impact. So for the time being, the volumes have gone berserk, but it seems as of now, at least all of that is getting absorbed because the stock, pull up the intraday chart of the stock, you'll see that it went up, I think, to around 177 odd mark, and then quickly it went to 170 as well. So bulk of this volatility is because it's going to get excluded today. So that's why there is that adjustment that's taking place. Slip into that break, come back, we'll wind down the markets for you. Don't go anywhere.
Other side of it, the cost for a given unit of intelligence 1 year later seems to fall by about 10x. Moore's Law was a 2x every 18 months for the number of transistors on a chip, and that changed the world if you waited a few decades. But what's happening with the reduction in cost in AI models is extraordinary. Now, I don't think it means that the world's going to need any less AI hardware because you bring the cost down and just the people are going to use it for a lot more things. The total number of dollars will go up. But that's a really exciting thing happening.
कुछ लोगों को अब जब एआई की बात होती है, कुछ लोगों को अब ये शब्द फैशन में है तो बोला जाता है, लेकिन मेरे लिए सिंगल एआई नहीं है, डबल एआई। भारत की डबल ताकत है। एक एआई आर्टिफिशियल इंटेलिजेंस, दूसरा एआई एस्पिरेशनल इंडिया। हमने स्कूलों में 10,000 टिंकरिंग लैब्स शुरू किए और आज उन टिंकरिंग लैब से निकले बच्चे रोबोटिक्स बना करके लोगों को चकित कर रहे हैं। और इस बजट में
Welcome back. You're with us as we enter the last leg of closing bell, and it's turned out to be a remarkable fight back by the bulls, but well, still red is the color. That's what we have. We have Sudeep Bandyopadhyay joining in to take us through the last leg. Sudeep, great to have you with us. Let's talk about the best result reaction on the Nifty tally today, and that has to be Bharti Airtel. Stock's doing well. Bharti Hexacom, which reported numbers, is also doing very well, 11% up over there. So what do you make of it? Finally, the tariff hikes have happened and they're showing up in those ARPU numbers, Sudeep. What's the call on the stock?
No, absolutely, Surabhi. I think it takes some time to flow into the P&L, and it has started flowing in, and it's very heartening to see that ARPU hike and ARPU is giving to a better P&L for the telecom operators. Of course, I think in the commentary they were very clear that more hike in pricing is required to ensure long-term sustainability of the industry, and so which is a very clear signal that more hikes may be around the corner. That second thing which I noticed about Bharti is that the subscriber numbers which they are gaining, last quarter was not good for them, but this quarter the number of customers, incremental customers which they have got is very interesting, good number. So all the parameters, you look at any of the parameters, they have performed well. So of course, market is cheering the results. Also, I must say that the strategy of Indus Tower and moving assets back to Indus Tower is a good strategy because it keeps businesses clean and gives Indus Tower and Bharti also flexibility. So I think overall it is a good set of numbers, good corporate action, and even the commentary was pretty good. So all in all, I think is a good set of numbers. And to conclude, Bharti Airtel, even at current price, does look good considering all the components have started performing.
Okay, all right. Sudeep, short chat. Thanks a lot for giving us that take on Bharti Airtel. By the way, before we wind up, we just need to pull up Kotak Mahindra Bank. I think in the last 5 years, the stock has not even moved 20% in all of 5 years. And just take a look at the stock. In the last 1 month, it's up closer to around 10%. As we speak, that one is flying away, firing all cylinders. So that one, in fact, is calling for attention. There's a massive volume burst out there. That's the stock you should be keeping on your radar. Big move on Kotak Mahindra Bank, and it's helped the Nifty as well cut some of those losses. So that's the stock of the final hour. But let's run you through about market action today. ONGC is under the weather. Mr. Trump is talking about keeping a lid on crude oil prices. That's not very good news for them. That stock was down close to 3%. ITC valuations attractive, but no respite out there. SBI yesterday got away with a cut of only around 1%. Today the markets, were the Nifty Bank was underperforming actually, and that one participated on the downside. Britannia as well, not such a good day. The stock was down close to around 2%. What did well? There's optimism. Something is going to come for the steel industry from the globe or from India as well, and that's why you have Tata Steel that's up close to around 4%. JSW Steel was higher in today's trading session. Hindalco, not ferrous, non-ferrous, but maybe in fact liquidity will drive that stock up as well. So that as well did well. And a couple of good earnings reactions. Bharti Airtel, Mahindra & Mahindra, thumbs up, and Trent, after getting beaten yesterday, bounced back in trade.
Absolutely. On the mid-cap screens, some of the stocks that have really soared today include a Bharti Hexacom. Godfrey Phillips had a great outing. I don't know if it's just a rub-off on those good volume numbers from ITC or something else, because there's too much happening otherwise at a corporate level as well with this company. JM Financial, 6.5% higher. So that was up and about as well. Then you had names like Astra Micro doing well, Gulf Oil Lubricants reacting to numbers in the commentary, about 8.5% higher on that stock as well. Actually, even Castrol had a great day yesterday and a good week. So some of these lubricant stocks have had a good week, so to speak. However, on the losing side, First Cry saw a deep gash today. Brainbees Solutions, 9.5% gone from First Cry. Emcure Pharma, a stock we don't talk about too often, down about 6% as well. Bikaji was definitely not tasting too good today, 10% lower over there. And NCC was another big result disappointment that was playing out today. To complete the picture, Zomato about 2% higher, Swiggy about 2% higher, 2% lower, and PG Electroplast, great numbers, but how much is already in the price? That was the question. Stocks ending with a gain of about 3%. So the bell has gone. The week has ended with the Nifty around the 23,560 mark. A week of consolidation, digesting big events like the budget as well as the RBI monetary policy. That's where the team of Closing Bell will take your leave, but don't go anywhere because we have Editors Roundtable coming up after a quick break.
नए टिंकरिंग लैब्स उसका प्रावधान किया गया। भारत वो देश है जिसके इंडिया एआई मिशन को लेकर के पूरी दुनिया बहुत आशावादी है और विश्व के एआई प्लेटफॉर्म में भारत की मौजूदगी एक महत्वपूर्ण स्थान प्राप्त कर चुकी है।
This was the third consecutive year that the BMC budget was presented to an administrator and not to a standing committee. Why? Because the term of the corporators ended in March 2022 and the elections for the new term and the new corporators are yet to be held. Now the 74,427 crore rupees budget, out of this, an allocation of 43,162 crore was made for capital expenditure, 5,100 crore rupees for roads and traffic department, 5,807 crore rupees for Mumbai Coastal Road project, 3,039 crore rupees for storm water drain department and 650 crore rupees for sewage operation department. For key public services, rupees over 4,000 crores were allotted to education department, over 7,000 crore for health department, 261 crore rupees for fire department, 309 crore rupees for disaster management and 220 crore rupees for the garden department. BMC announced that it's going to start 250 new public clinics, also known as Apla Dawakhana, all over the city. One interesting initiative announced by the BMC was the introduction of cyber awareness program for students. It will serve two key purposes. One will be to ensure that the students learn how to use the internet in a safe manner and to keep them safe from cyber fraud. BMC also focused on environment initiatives and projects like promoting eco-friendly cremation and proper disposal of residue from idle immersion. These are the projects which will take place under environmental related initiatives in the next few months. We also spoke to Bhushan Gagrani, the BMC commissioner himself. This was the first time that he presented the BMC budget. Listen to what he has to say about this BMC budget. So your budget also mentioned that you guys are planning on imposing a tax on the commercial properties in slum areas.
That's right.
If you can elaborate that. So from when this new tax will be levied?
It is actually not a new tax. In fact, we are enhancing our assessment net. Under the assessment net, the properties which are in the slum, however, which are being used for the purpose of commercial, they were not covered. So this is for the first time we are doing the survey and bringing them in the tax net. Not necessarily that we will be imposing huge tax. It's a normal tax. It's not a very huge tax. However, the coverage will be given to our commercial properties.
So BMC has not introduced any new project this time. In fact, you have focused. Correct.
Yeah.
But sir, does it mean that is there any cause for fiscal concern, sir?
No, there is no fiscal constraint. We have enough adequate cash flow as well as resources.
Make informed decisions with comprehensive analysis on the go.
Strengthen your portfolio with real-time market updates on the go.
Create effective strategies with insightful expert opinions on the go.
The Wall Street posts minor gains this week, ending higher for the second week in a row. Pharma, metals back for the bulls, but FMCG takes it on the chin. Well, on today's edition of Editors Roundtable, we'll take stock of the week's market action. We'll decode RBI's monetary policy and its market impact. And we'll tell you why QSR firms are making a comeback. I'm Reema. With me are Surbhi, Naichan and Mangalam. Hi. Hi, guys.
Hi, folks. Thank God it's Friday.
And you can finally say that because we couldn't say it last Friday. But let's also welcome on the show Ramesh Mantri, CIO, White Oak Capital AMC. Ramesh, hi.
Hi.
Well, what a week this has been, right? It's been extremely long. There was Saturday, and that Sunday felt like it was nothing. It was just...
Thanks to Donald Trump and the tariff news and the earnings.
To come back, and then so many earnings. I think about 15 or 16 Nifty companies reported their earnings this week.
And across all sectors.
I think the biggest debate this week has been about the Indian consumer. And I think Mangalam's going to talk about this, whether there's a slowdown, no slowdown, has the budget addressed it or not, has the RBI addressed it or not. I think that was a central
I don't know whether
focus.
who's addressed it or not. What I'll talk about is something a lot more delicious than just the consumer. It'll be specifically quick service restaurants, but the market.
Yeah, so let's take stock first of the market. You know, one positive that I've learned in life is if there is a problem, you need to address it. And I think that's precisely what the Government of India as well as RBI have done. The Government of India in Budget 2025, they have given that consumption boost. So the economy was in need of something and they've given that, point number one. Point number two is that in fact in the RBI, they were bracing for a 25 basis rate cut, and that's precisely what's happened. And in addition to that, they also had done those various liquidity measures. So both those two, they have addressed a problem out here. Next up, the bulls, I believe that in the near term, it appears that 22,800 odd mark, they believe that should get protected, which was the panic low that we saw closer on 7 to 8 trading sessions ago. The uncertainty really is going to be on Trump's tariffs, right? What is he going to do next? For the time being, the global markets, they believe that he's going to use it as a negotiating tool. Nothing big is going to happen, but it's going to be a negotiating tool. At least that's what the indications are. If you look at the dollar index, if you look at the way the global markets panned out as well, there's going to be uncertainty as well from the Fed as well as the Bank of Japan. What those two big central bankers are going to do, which will have repercussions for the global markets as well. And that's going to be important. The FIs were a pleasant surprise this week. After a while, after 23 sessions, they went ahead and they bought at least one out of one, but that's okay. At least one out of, and if you take the cumulative number for the week, it's much lower than the previous weeks on an average. So I'll take that as a positive as well. But a few stocks I just want to talk about, and there's no room for error on stocks that are trading at elevated multiples. Trent, the numbers didn't look that bad, but the stock got clobbered. For the week, in fact, it was down close to around 11% or thereabouts. Some of those stocks that have underperformed, suddenly they've started performing. If you look at Bajaj Finance, right, that didn't do much for the last few years. In this year itself, it's up close to around 8 to 10%. And in fact, in this week, it was up close to around 5%. IndusInd Bank as well. Big underperformer, maybe valuations are pretty okay. So that one as well was higher. And there's no room for these high flyers. Mangalam, you have Easy Trip, the one that, the big story that was playing out. Swiggy, from it listed, it went all the way to 600. Today, it's below the IPO price as well. So there's no room for error. I think in the near term, there is, we're in that broad band of 23,200 on the downside to around 24,000, which incidentally is the 20 as well as the 200 DMA. So, the markets saw a good recovery this week and we ended more or less flattish. Let's get in Ramesh Mantri and let's see how he's feeling. Hi, Ramesh. Good to see you on the show. What are you making of market setup right now? You have support coming in from the RBI as well as from the government of India. How are you feeling right now?
No, I think we've clearly seen a slowdown in the economy, in the earnings, and you have now two levels of support both on what's happening to the consumers and the RBI. So, and also you want to see now the capex that has not been spent this year, the orders that are not coming, need also to come in. So you need economic pickup, and I think some measures have been taken clearly in the last week to support the economy.
All right, so that's about the budget. But, after the budget, this Friday, we had the RBI policy as well. The street was hoping for a 25 basis points rate cut. That's exactly what came by. What do you made of that?
The street was still not happy enough, right? They wanted a tax cut, they got it. They wanted a rate cut, they got it. But the market's still kind of ambling along. So what does it tell us? I mean, on the RBI policy, I kind of listed out actually 6, positives, which were there, but the market was still not happy enough. And I think largely because it was a ye dil mange more kind of a policy. You've got 25 basis points, but there was no immediate hint of further policy action. There was no sort of, barrage of dovish commentary that's telling you next cut is short on its way, or, that there is a big liquidity bonanza that the RBI is handing out. However, here are the positives, and we should not lose sight of that. Number one, the fact that the decision was unanimous. So there's no discrepancy between the MPC members. All 6 voted in favor of a rate cut. Number 2, the governor is pointing sufficient liquidity support to the market as and when needed. Number 3, look at the inflation projections. For FY26, CPI inflation is projected at about 4.2%, which is so much better than 4.8. That's the revised estimate for FY25. Number 4, the GDP forecast at 6.7%, which is towards the higher end of the forecast that we had from the from the economic survey, which the upper end of that band was 6.8%. So GDP forecast for FY26 not too bad. And last but not the least, the market's been very nervous about a couple of these regulatory changes that have been pending. LCR guidelines and of course implementation of ECL norms, project financing. What did the governor say? In clear terms, he said that all of this cannot be implemented in a rush. In fact, on LCR, he's made it very clear that it's not coming in till FY27, 31st of March 2026. It's not happening before that. And similarly, the others are more, a consultation process right now, which is the ECL norms. And again, that seems to be off for at least another 1 whole year. Yet the market was not pleased. Why? And now I come to the so-called negatives, and negatives in quotes. What do I mean by that? The stance, number one, is still neutral. So if people expected a shift to accommodative, that didn't happen today, and there was no hint of that. And largely, from a stock market point of view, the immediate trigger, look at what the governor and the deputy governor have said on unsecured lendings and also risk weight to NBFCs. Remember, a lot of these stringent norms came in a couple of quarters back to sort of regulate the lending happening in the unsecured place. I just want to highlight these 2 quotes. What did the RBI governor say? The RBI governor went on to say that we're satisfied with the slowdown in unsecured loan growth as of now. the DG, Mr. Swaminathan, he said that we don't think there is any reason to review any measures on unsecured loans at this point in time. Doesn't get clearer than that. And even on NBFC lending, remember the risk weights had gone up. The loans that banks are giving to NBFCs. Is the RBI going to change that so quickly? I don't think so. If you go by the commentary, look at the RBI governor's statement, and I quote, "We've raised risk weights for bank lending to NBFCs due to concentration risks." So he's going into the reasons and why he still thinks, that was a valid move. So I guess this was a bit of the disappointment that played out. But let me take this to Ramesh. Ramesh, at times the market can be a little nearsighted, short-sighted. How would you classify the policy and your take on financial stocks from here on?
First, interest rate movements, there are no correlation with markets. What matters is significant surprises. This is policies as per expectations. So expectations generally don't impact markets. What is broadly expected? I think the deferment of some of the tightening and regulatory measures is a good thing. You need to support the economy now. And I think particularly the steps that RBI had taken on unsecured lending, I would say they were pretty visionary. They looked like conservative a year ago, but they have made sure that the risks in the financial system has been contained. So I think in some ways, RBI has been an extremely prudent regulator, unlike a lot of other central banks. So I think all credit to RBI for that.
Okay. Ramesh, hi. So Trend was the top Nifty loser today. It rebounded on Friday, but still ending the week down close to about 11-odd%. So it's a part of your fund, your flexi cap fund, a part of your mid cap fund, etc. What is your thought on these, companies which were considered sexy till like just a few months back, but now have seen some growth deceleration? Numbers are fine, 35% top line growth, but it's just slower than what the market was used to in the prior quarters. What is your approach to these stocks?
Yeah, see, first of all, when these kind of stocks, expectations are a treadmill, right? So if you miss a little bit of expectation, there is often violent reaction, both on the upside and downside, right? And here, let's understand there is a slowdown in the economy. And, in India, 35% growth, when growth is difficult to find, is still extraordinary. In fact, an absolutely outlier in the consumer space in India. So we can focus on what the market did in the last week. But I think the growth that some of these companies are delivering is still very stellar, right? And in fact, very rare in this Indian consumer space in India.
Right. Speaking about consumption itself, Ramesh, you do have Zomato in your portfolio. It's a left field question because it's a left field development. They've named their company Eternal. What do you make of that? And, what do you make of Swiggy's numbers? Do you think that there is a valuation discount play here?
Now, first, the rebranding, I think they want to grow beyond the Zomato brand, which is one of their offerings. They believe the company is bigger than one of their offerings, which was, of course, their core offering where they started. So I think it's thoughtful to rebrand it because now Zomato is much more than the food delivery business it is. I would not comment specifically on any company's results, but I think the quick commerce is a uniquely Indian retail solution. It is going to be very large. And because the total addressable market is large in India, everybody is jumping into this. So it's going to be a difficult 2025 for the space. It is going to be heightened competition in this space. There is going to be red in P&Ls. This is assured in 2025. But because the market opportunity is large, still the ultimate winners will create a lot of value. So we have to stay focused on companies that are executing well. The numbers, the P&L is going to look red in this year for sure. It's going to get reversed actually as we go by.
All right, we take that point. In fact, I'll take a cue from that itself because, we've been talking about out here that over the period of time, burgers were falling out of favor and as were pizzas. Yeah. And we had people playing the platform companies. But with a shot in the arm that the government has given for consumption, the question is, where is that extra money going? Could that go to quick service restaurants? Something tells me maybe, because we've seen that in the numbers. So I'll just walk across the wall and tell you that if you look at the government giving 1 lakh crore as a boost to consumption during the budget, and look at quick service restaurants itself, And you look at, some of the numbers that have come by so far in the third quarter. We have Westlife, the one who operates McDonald's. Look at this. We've seen the same-store sales growth decline for about 4 quarters until the third quarter, where there was an uptick that we saw. Similar is the case for Sapphire Foods, which operates KFC and Pizza Hut. So you look at Sapphire Foods, you'll have KFC as well, which is reporting a negative like-for-like growth, but it has shown an improvement in the third quarter. You look at Burger King, which is listed under Restaurant Brands Asia. There was decline, and then there is some improvement. This decline was obviously on a high base. The improvement comes on a higher base as well. Earlier, we were talking about pizzas versus burgers. Looks like pizzas are making a big comeback as well. From Sapphire Foods itself, we saw Pizza Hut. Pizza Hut, was reporting negative same-store sales growth. It's been on an uptrend, and this quarter, it turned positive 5%. Domino's, the leader out there, for the longest time, it was negative or feeble numbers. This quarter, it's actually reported a 12.5% like-for-like growth in its pre-quarter update itself. And all of this, tie that down with Zomato. Earlier, the narrative was that maybe platform companies are growing faster than quick service restaurants. Actually not. Platform companies have seen their gross order value decline. Zomato's gross order value in the food delivery business, growth was 16.8%, much lower than we've seen earlier in the past itself. So let's address what the problems were earlier and what the trend is now. The problems earlier for quick service restaurants was normalization after the post-COVID boom. Secondly, there was structural decline in dine-in revenue. People weren't going into these restaurants. Then there was competition coming in from the aggregator apps, competition from local chains itself, Lapinos, etc. Many people springing up, and stocks had run up, and valuations had surged to record highs as well. Now, after the underperformance, what has changed? Inflation has shifted urban consumption towards affordable treats. Companies have increased their value offers on dine-in, so that has arrested the same-store sales decline that we're seeing in dine-in. The companies have also rationalized their stores from earlier dine-in to now delivery only. Add to that, new store additions are happening not only in metros, but they're happening in towns beyond Tier 2, so that has a lot of latent demand itself. Companies have their own delivery fleet. Jubilant FoodWorks always had that. McDonald's has added that as well. That waves off delivery charges. And then everyone's been talking about high markups on platforms like Zomato and Swiggy. All of them have innovated on menu launches. There's McSpicy chicken, McSpicy paneer, cheese volcano pizzas, etc. And 80 to 100 local pizza outlets in Ahmedabad have closed in the last 10 months. There are multiple news reports talking about that. So local competition is also abating. And they say you buy these stocks when they're off their highs. Are these stocks off their highs? Yes. Restaurant Brands down about 35% of its highs, 20% down for Devyani. Jubilant FoodWorks itself, after a 62% rally from its lows, is down 14%. What are the analysts saying? Look at what the analysts are saying. On Restaurant Brands, 50% of them have a buy rating. Sapphire Foods, 8 out of 10 analysts have a buy rating. Devyani, 69% have a buy rating. Jubilant FoodWorks and Westlife, because they've seen a rally already and haven't fallen as much from their highs, not all analysts have a buy rating, but still you have an upside potential basis their consensus prices of anywhere between 10 to 22%. And if these stocks, start to re-rate because of growth uptick coming in the next few quarters, who's to say QSRs may make a big comeback?
Very interesting data, and I must say the pictures look so.
It's whet my appetite completely.
Manglam, you're hungry.
Anything, Manglam, whatever you say.
I was taught, ask and you shall receive. So what I did was whether QSRs come back into fashion or not. I've done my bit. So what we'll do is. Just grab a couple of burgers. Equal opportunity offenders. So there's pizzas and
amazing. Now we're talking. Wow, thank you. Thank you.
I love this.
I'll tell you what, I think what we should do
we
is...
have to take
we
a
need
break
to take
now.
that break right now.
Well, yes, what we'll do is, while we munch onto these pizzas, burgers and fries, we'll just take a quick break, come back, we continue our conversation on Editor's Roundtable.
Grow on the go with CNBC-TV18, now streaming live 24/7 on YouTube. How about listening to global market maestros before crafting your investment strategy? How about getting deep insights into their businesses from top Indian honchos before putting your money on the line? How about making every trading day profitable with strategies from the market masters, macro pundits and chart wizards? Only one show gives you a head start to your trading day. Get ready to profit. Get ready for business with Bajar at these times on CNBC-TV18 and CNBC-TV18.com.
What does it take to build India's largest startup platform? It takes a journey of starting out as an unknown and ending up as unforgettable. It takes more than 2 decades of celebrating the most influential and influencing the most celebrated entrepreneurs.
Welcome back. You're watching Editors Roundtable. We have with us Ramesh Mantri from White Oak AMC. As you can see, we were just talking about QSRs. We're eating them. We're talking them. Ramesh, unfortunately, we can't share it with you, which is why you need to come. You need to come down to our office so you could be a part of this feast. But tell us, QSRs, are they a part of your portfolio? Is it time to look at it more aggressively if you already own it, or if you were shunning it so far because of the kind of weakness in the numbers? Are you going to take a look at it?
So one, QSR is a large structural opportunity in India. But in India, this is not so structural. It is cyclical within a secular opportunity. And I believe because of the advent of these large food delivery platforms in India, a good portion of value has shifted from QSR or restaurants to actually these platforms. So I would say the better way to participate, at least that's our view, is through the food delivery platforms rather than investing directly in some of these QSR chains.
But Ramesh, I want to kind of zoom out to a larger question, going back to that Trent example, or for that matter, staple stocks. My question is very, very simple. For stocks that have traditionally traded at really high multiples because you're getting better growth, and Trent was a classic example of that, right? You can go up to 80 times forward earnings, 100 times forward earnings, but you're getting that kind of compounding growth. Similar could be applied to the EMS space as well. But now, given the market environment that we are in, which are the kind of companies or the sectors or the stories for which you would still be comfortable paying, maybe 70, 80, 90 times, if at all?
So clearly you want to see first very large markets, whether it's, food delivery, branded apparel, a variety of sectors on the consumer side. Number two, you want to invest in market leaders. Clearly people who already demonstrated the track record of execution. That's the kind of multiple that's only you can pay only for a market leader or someone who's significantly gaining market share. And please understand, in 2021, 22, 23, actually broad-based economic growth came back in India after many years. Now in the last 6-7 months, growth has again become scarce. When growth becomes scarce, actually growth stocks become more valuable.
All right. Ramesh, just before we let you go, in the result season so far and the environment that we are in right now, what is it that you like? The couple of ideas which you believe that, are worth holding on to even in this environment, and perhaps stuff that will make you money over the next couple of years?
I think this is a time to go back to more quality businesses, more sustainable businesses. So I would say, I think financial services continues to deliver very stable performance. There are still no broad-based credit quality issues. Valuations are very reasonable. So I would say frontline banks, even within that, if you look at NBFC, maybe affordable housing, where growth is still very strong, valuations are reasonable. And then also look at some very high growth opportunities, let's say in the digital transformation space, where India still started the journey. Those are the attractive spaces. I'm always a perennial bull on pharma and healthcare because I believe it's a sector that's more stable than even consumer staples. People never cut back on pharma or healthcare consumption. So these are the spaces that I find very interesting today.
Okay. All right, Ramesh, that's really helpful advice. Thank you so much for joining us on the show today.
Nigel is still eating.
And,
he said pharma and health. The minute he said pharma and health, the people I was
Nigel, last word from you?
The consumption story is strong.
You asked him for the last word, he'd be like, I can't do it.
And thank you, Manglam, for making it very exciting.
Special.
You should come more often on here. All right, folks.
Imagine if he does a story on trend.
We're good
What
with
will we
food.
get?
We're good with food.
Let's call it. It's a wrap. Nigel.
I think it's time to go.
On that note, I'll tell you guys, we'll wrap up on this edition of Editors Roundtable. Thanks a lot for watching. More news and updates on the other side.
Tackling the stories of India's startup universe to becoming a success story in itself, as India's longest running show on startups and entrepreneurship, celebrating 21 action-packed years of building India's biggest startup community. Young Turks at 21, only on CNBC-TV18 and CNBC-TV18.com. CNBC-TV18's most comprehensive and award-winning news show, India Business Hour, drops first on YouTube. So get the first access to the most influential architects of policies and politics, the key newsmakers of the day. Discover the big themes as we decode the business of markets, macros and more. Be the first to go to the heart of all the top stories that drive the day's agenda. Catch the award-winning India Business Hour live every night on YouTube with me, Shireen Bhatt.
India Business Hour live on YouTube at CNBC TV18 weeknights at 7 p.m.
This growth inflation dynamics opens up policy space for the MPC to support growth while remaining focused on aligning inflation with the target. At the same time, the MPC felt that excessive volatility in global financial markets and continued uncertainties about global trade policies, coupled with adverse weather events, pose risks to the growth and inflation outlook. This calls for the MPC to remain watchful. Accordingly, it decided to continue with a neutral stance. This will provide MPC with the flexibility to respond to evolving macroeconomic environment. The MPC decided unanimously to reduce the policy rate by 25 basis points from 6.5% to 6.25%. The MPC also decided unanimously again to continue with a neutral stance and remain unambiguously focused on a durable alignment of inflation with the target while supporting growth.
Every leader, business, government, investment leaders, economists, we're all scrambling to adjust to a very new reality and a new approach, I think it's fair to say, from a US administration who seem very focused on American interests and are quite content to rewrite what have been thought to be kind of historical norms. So those historical norms started really earlier this week with the seeming tariffing of Mexico and Canada. Canada, obviously, a huge close ally of America, but that didn't save them from being on the list, at least for some period of time. Those tariffs subsequently didn't come to pass, at least for now. And to your question, yeah, the Middle East, like everywhere else, we're all looking, I guess, tweet by tweet, Truth Social post by Truth Social post as to what's going to happen next. And that would apparently include some historically astonishing proposals, at least.
Tensions between employees and management at Samsung's Sriperumbudur plant just outside Chennai have surfaced yet again. For well over 24 hours now, over 100 employees, we're told, have been staging a sit-in protest
at Samsung's plant just a few meters from where I'm standing. In fact, this line of company buses and these barricades have been erected by Samsung so as to prevent members of the public and observers, much like myself, to see what's been going on through the gates of Samsung's plant just a few meters from where I'm standing. Now, the issue is simply this. A few days ago, 3 members or employees rather of Samsung's plant were suspended after allegedly engaging in activities deemed detrimental to the interest of Samsung's operations in India. However, employees of the plant, a section of them, and members of the Samsung India Workers Union claim that this suspension was not on account of disciplinary action or disciplinary reasons, but simply because they were affiliated with the Samsung team.
Hello and welcome to Business 360. I'm Shireen Bhan. The headlines that we're tracking for you this evening. The Monetary Policy Committee unanimously agrees to cut the repo rate by 25 basis points for the first time in nearly 5 years, maintains the neutral stance. Governor Sanjay Malhotra makes a pledge to ensure adequate liquidity in his debut policy. RBI trims its growth forecast for the current fiscal to 6.4% from 6.5%. Projects 6.7% growth rate in FY26, expects inflation to ease to 4.2% in the next FY. In a bid to provide liquidity cushion to banks, RBI delays the implementation of the new liquidity coverage ratio and project financing rules. The new LCR rules delayed at least till April 2026. The governor promises sufficient time frame for banks to avoid any disruption. The Sensex and the Nifty post minor gains for the second straight week. This, even as a roller coaster ride on Friday ends in the red. The rupee gains some lost ground against the dollar. Strong demand for SUVs and tractors aid M&M in Q3. The auto major reports an inline set of numbers. The management remains bullish about the agri sector, sees tractor industry growth at 7%. A dramatic twist in the battle to control Religare. The Supreme Court rules that the Burman family's open offer will not close today, directs the US investor Danny Gaikwad, who wants to make a counter-offer to deposit 600 crore rupees as the earnest money within 5 days. The Apex Court also pulls up SEBI, asks why shareholders are being forced to pay prices prevailing 18 months ago. SEBI cracks the whip on Finfluencer Asmita Patel after receiving over 40 complaints in pounds 54 crore rupees for running an unregistered investment advisory, unfair trade practices, mis-selling services, among others. Patel has more than 500,000 followers on YouTube. The US imposes sanctions on a number of entities and individuals for allegedly facilitating the shipment of Iranian oil to China. An Indian company named Marshall Ship Management among those blacklisted. The clampdown comes days after Donald Trump signed a memorandum sanctioning a maximum pressure campaign on arch-rival Iran. Congress leader Rahul Gandhi alleges irregularities in the Maharashtra elections, which saw BJP and allies win a commanding majority. Claims the number of people who voted is more than the state's adult population. The Election Commission promises a full factual response. The Union Cabinet is likely to take up the new income tax bill this evening. The legislation is likely to be introduced in Parliament next week. The global CEO of Nivea maker Beiersdorf is betting big on India. Vincent Warnery says 2025 is India's year, hopes to double sales and make it one of the top 5 markets for the company. That's an exclusive. Well, the big story this evening, the Monetary Policy Committee of the Reserve Bank of India has unanimously cut the repo rate by 25 basis points for the first time in 5 years. In his debut policy decision, RBI Governor Sanjay Malhotra said the Monetary Policy Committee has also decided to keep the policy stance neutral, adding that such a stance will provide RBI the flexibility to respond to the environment. The central bank trimmed its growth forecast for the current fiscal to 6.4% from 6.5% earlier. For FY26, the RBI is projecting a growth rate of 6.7%. While warning about potential headwinds from geopolitical tensions and protectionist trade policies. The RBI is expecting inflation to ease to 4.2% in the next financial year. It's betting on a good Kharif season to drive food prices lower, and in a bid to provide liquidity cushion to banks, RBI delayed the implementation of the new liquidity coverage ratio as well as the project financing rules. Now, the new LCR rules have been delayed at least till April 2026, so almost a year of a reprieve there. And here's the RBI Governor Sanjay Malhotra speaking after his first monetary policy.
This growth inflation dynamics opens up policy space for the MPC to support growth while remaining focused on aligning inflation with the target. At the same time, the MPC felt that excessive volatility in global financial markets and continued uncertainties about global trade policies, coupled with adverse weather events, pose risks to the growth and inflation outlook. This calls for the MPC to remain watchful. Accordingly, it decided to continue with a neutral stance.
It's more than 1 year. 2 months, less than 2 months is too short a window for the banks. We realize that. And so, we will give at least 31, at least. Doesn't mean it has to be 31/3/2026. We'll aspire for that. But we want to make it very smooth, and it will also be phased. It will not be, that all the regulations, all the norms kick in from day one, which will be at the earliest 31/3/2026. ECL was only a discussion paper. Even the draft is not out. So there is no time frame for, implementation of ECL guidelines. Similarly, project finance, you can rest assured, I think, they will need more time. 31/3/2026 is the earliest. For project finance, the draft regulations were certainly published. Comments have been received, suggestions have been received. We are examining them. And we'll come out with something, I want to assure all of you, that which balances the interests of the public, the depositors, the financial stability, which is very, very important for our country. And at the same time, the concerns of the banks, keeping in mind the efficient use of resources.
Well, that's the RBI Governor Sanjay Malhotra. Lata is here with her take on the RBI's policy. Lata, so that 25 basis point cut coming in and the additional 1 year or perhaps even longer reprieve on the LCR as well as project financing norms.
Actually, I would say the policy clearly gets an A+, or whatever you want to call it, AAA+. And it's not just my opinion, that's the broad swathe of opinion. Primarily for its appropriateness. 25 basis was what the market expected, and the policy stopped over there, didn't try to be exuberant, especially in the way in which they handled liquidity. The policy said, both in the statement and the governor in his Q&A, said that we proactively will promise as much liquidity as required. He didn't say that I assure you surplus liquidity all the time. Anything extra can be used to short the rupee. So I think the appropriateness was very important. One, because the rupee is a little wobbly, and also because there is a lot of uncertainty. We don't know how things might go in terms of tariffs and make, items expensive. The best tribute to the policy came from the rupee. Normally, when you cut rates, the rupee falls. The rupee rose today. It is ending higher than where it ended yesterday. So that itself is a tribute that, the RBI went only as far as expected. The bond yields didn't move at all, actually. The 10-year bond yield remained at 6.69, 6.7, because that much of a cut was factored in. The important point is, as you pointed out, the postponement of those three regulatory measures, LCR, liquidity coverage ratio, expected credit loss accounting system, and higher provisioning for infrastructure, it was expected that they would defer. You don't have structural reforms, however robust, when there is a wartime. And, the way the rupee and the way the tariff war has kind of gotten sparked off, you don't try to do extraordinary things at such times. It was always expected. But the grace with which it was done should be appreciated. While the governor did say that, there is a cost involved in regulation in terms of efficiency, he quickly said that the Reserve Bank does take into account the cost. I'm only stating it up front. So there was a lot of grace that he extended to the Reserve Bank. And a takeaway for all of us, the creation of that bank.in domain name that will be attached to all messages from any bank. So it's like State Bank of India at bank.in. If you get messages from that, only that is not a fraud. Now, that is a very good innovation, I think, among the non-policy statements. And, well, it's coming from a computer engineer governor, so maybe he gets some brownie points for that. I also like the way in which he defended the flexible inflation targeting. It came out of nowhere. No governor does that because we take the flexible inflation target framework for granted, but probably because he's coming from the finance ministry, and previous economic survey had said that maybe the target should exclude food, probably wanted to just remove all doubts, and saying upfront that it is a commendable job was, I think, a very generous and important statement to make, appropriate statement to make, confidence-generating statement. So all told, I would think the governor, by the way in which he quoted the weights of several items in the CPI, the jargon that he used, like for instance, when he was asked about the rupee, from Bimal Jalan onwards, what do the governors say when you are asked about the rupee? The Reserve Bank intervenes to smooth out volatility. We have no target for the rupee. Repeated that sentence verbatim. So I think really mastered the skill in a very short time.
All right, Lata. Many thanks for joining us. That's the first policy being delivered under the watch of the new RBI Governor, Sanjay Malhotra. Now, earlier this week, the Financial Services Secretary, M. Nagaraju, spoke about the new LCR rules. He made the government's position clear. The government did not want money locked up, and that was the view that had been conveyed to the Reserve Bank of India. And it looks like the Finance Ministry's view has prevailed, because as we heard there from the RBI Governor, at least a year, if not more, for the banks to transition to the new rules. Take a look.
Not going to second guess the RBI, but RBI has issued the draft, and we have conveyed our views on that. Now they have not issued the final draft, the regulations. We want to more. We don't want to lock up a lot of capital into this kind of ideal situation. So we have expressed our views based on the feedback we received from the industry. Okay. Now the RBI has not issued. So let us put a full stop there.
Well, a full stop clearly, at least for the next year, has been put by the RBI on the LCR and the project financing rules. The rupee did regain some lost ground after monetary policy. The rupee gained about 15 paise against the dollar, but it remains above the 87 mark. The 10-year bond price is declining in trade and the yields hardened to 6.7%. That's the money market snapshot for you. In the stock markets, the Sensex and the Nifty managed to check out minor gains for the week. It was a roller coaster ride on Friday that ended with marginal losses. The Sensex lost about 200 points. The Nifty was down by about 40. The mid-cap index was up just about, and the bank Nifty closed about 0.5% lower. So that was the story as far as the stock markets were concerned. And in the commodity markets, oil prices up marginally, but remained on track for a third straight week of decline. This is US President Donald Trump's renewed trade war on China, and threats of tariff hikes on other countries weighed on sentiment. Trump's maiden sanctions package targeting a handful of vessels carrying Iranian oil has also put pressure on prices. In earnings corner, shares of M&M up in trade today after the company reported a good set of numbers for Q3, meeting street estimates on most fronts. Net profit up 21%, revenue up 20% on an annual basis. Sudarshan is standing by with the M&M report card. Sud.
It's a healthy set of earnings from the auto major Mahindra & Mahindra for Q3 FY25, led by healthy volume growth. Both the segments have seen healthy growth. Auto segment has seen volume growth of 16%, and tractor segment has reported volume growth of almost 20% in Q3. And because of this, revenue growth has increased 20%. Even EBITDA was healthy, and it has come at 4,468 crore against our estimate of 4,425 crore. Margin remains healthy. It has come at 14.6% versus 12.8% that company had reported in the same quarter last year. Talking about the segments for auto business, revenue was up 20% year-on-year, and on a sequential basis, it has increased by 6%, and margin has reached to 9.7% versus 8.5% in the same quarter last year. Agri-business revenue has increased 21% year-on-year, and on a sequential basis, it's up 26%. And for agri-business, EBIT margin has increased to 18.1% from 15% that company had reported in Q3 of FY24. Now, talking about the guidance, company says for agri-business, the growth is seen at 7% versus earlier guidance that company had given for industry that was in the range of 6 to 7%. For passenger vehicle, growth is seen in mid-single digit. Now, talking about the market share, in SUV, revenue market share is now at 23%, which is an increase of 200 basis points. For tractor, market share has increased to 44.2%. That is an increase of 240 basis points. And in electric three-wheeler, market share stands at 41.8%. So on earnings front, it's almost in line to slight beat for Q3 FY25. Even guidance, especially for tractor segment, is looking healthy by M&M.
Sid, many thanks for joining us. And more earnings. Ola Electric has reported a weak set of numbers for Q3. Losses for the quarter widened to 564 crore rupees on an annual basis. Revenue dropped more than 19%. Ola has also reported an EBITDA loss of 460 crore rupees on a yearly basis. The stock down today. We will take a break, but coming up next, SEBI cracks the whip on Finfluencer Asmita Patel after receiving over 40 complaints. More on that when we get back.
First place, also claiming that Samsung does not want any employee to be actively engaged with this recently established workers' union. Now remember, this isn't the first time that issues or a face-off between Samsung's management and employees have cropped up. In September, nearly 1,100 employees of this very plant staged a protest outside plant premises, claiming for better privileges, more representation, better pay, and also representation by way of a union which Samsung said all that while that it was averse to forming in the first place. However, following the Madras High Court's intervention, Samsung India Workers Union became a registered union under the Tamil Nadu Labour Department, thereby ensuring that some of these workers' demands pertaining to representation by way of a union was summarily met. However, these issues clearly have not been laid to rest, simply on account of the recent suspension of those 3 employees. Now the issue is simply this: while these employees claim that they were suspended for their affiliation, Samsung in a statement has said the employees in question violated the company policy and have been suspended temporarily and will be subject to appropriate disciplinary action following a formal inquiry, end quote. Now while it's a case of he said, she said between Samsung and its employees, the fact is that these outstanding issues between Samsung and its employees don't seem to be going away anytime now, given the fact that both the employees and the management seem to be heading in different directions with regard to what they expect of each other pertaining to both representation and a basic disciplinary expectation.
Well, a dramatic twist in the battle to control Religare. The Supreme Court has ruled that the Berman family's open offer will not close today, directing US investor Danny Gaikwad, who wants to make a counter offer. He's been directed to now deposit 600 crore rupees as the earnest money within 5 days. The top court also pulled up the market regulator SEBI. Ashmit joins us now with more. Ashmit, take us to what the Supreme Court has said.
Well, the battle for control for Religare continues. Bear in mind that on one hand you have the Berman open offer. On the other hand, Digvijay Gaikwad, a little-known commodity, a US-based investor, looking to come in with his own open offer at a higher price. And importantly, Gaikwad had moved the top court, the highest court of the country. The entire issue about higher pricing being offered by Gaikwad, the approval process coming with a delay, all these issues were debated at length. And importantly, the long and short is the Supreme Court has passed an interim order, and that order has 4 important elements. Number one, Gaikwad, to show his bona fides, will have to deposit an earnest money of 600 crore rupees by February 12th, and that is Tuesday of next week. So that's part one. The second is Berman open offer, which was expected to close today. The tendering process closes today, will not happen. That's element number 2. The third key element here is the Supreme Court is directing that until the earnest money deadline, which is of February 12th, the Berman open offer will remain open till that date. And subject to, if Gaikwad does bring in the money of 600 crore rupees, what happens in that case? Well, the Supreme Court has accounted for that, has passed the 4th direction, which is that if Gaikwad brings in the money, then until SEBI decides on Gaikwad's application, the Berman open offer will remain open. So again, that confusion, that question mark still remains. But there are important observations to also keep in mind. Number one, the Supreme Court observing that this entire open offer being conducted by the Bermans is being done at their own risk, that tomorrow if this issue gets decided in favor of Gaikwad, they'll have to, number one, cough up a lot of money. And number two, the observation that the Supreme Court made, and this was something where they were critical of SEBI, saying that this open offer was publicly announced at 235 rupees a share by the Bermans in September of 2023, which is 18 months back. What Supreme Court opined is that effectively SEBI is asking shareholders to pay a price that existed 18 months back in September of 2023. And this is something the Supreme Court said SEBI should be more mindful of, should be more careful of.
All right, Ashmit, appreciate you joining us. Now, the regulator, SEBI, has cracked the whip on Finfluencer Asmita Patel. After receiving over 40 complaints, it's issued an interim order to impound over 53 crore rupees for running an unregistered investment advisory, also for unfair trade practices, mis-selling services, among others. Patel has more than 500,000 followers on YouTube. Yash is here with the details. Yash, a significant order there coming in from the regulator.
Well, Shireen, significant order, and just last week we had the FAQs which were released by SEBI when it comes to Finfluencer and unregistered entities and the relation with SEBI registered entities. And here the very next week we have an order against one of the influencers, Asmita Patel. She was popularly known as the She-Wolf or the options queen on social media circles. As far as SEBI's order is concerned, it's an interim order and a show cause notice against Asmita Patel and Asmita Patel Global School of Trading, along with 4 other proprietary entities. Now, this order was passed after 42 complainants, reached out to SEBI with their complaints of being cheated in terms of buying a course from Asmita Patel, and all of them had registered for this particular course, where they were asked to pay about 8.26 lakh with GST per person for a course. As far as SEBI's allegations are concerned, it is with respect to unregistered investment advisory and research analyst service, violation of fraudulent and unfair trade practices, which is known as PFUTP regulations, defraud in connection with dealing in securities market, and mis-selling of services related to securities market. You spoke about the followers she had. Quite a wide and a popular following. YouTube about 5.26 lakh, Instagram about 2.9 lakh, Facebook 73,000, LinkedIn about 1,900, as well as Twitter about 4,200. The order is essentially asking Asmita Patel to disgorge an amount of 54 crore rupees as unlawful gains. The show cause notice takes it a step ahead, asking Asmita Patel to justify why she shouldn't be asked to disgorge an amount of 104 crore rupees, which is the entire illegitimate gain which she's made by selling these courses, as I said, being charged at about 8.26 lakh per person, spanning across 7 months.
Well, that's a significant order there that's coming in from the regulator, SEBI. Yash, many thanks for joining us. And with that, it is time for us to wrap up this edition of Business 360. The news will continue on CNBC-TV18. Stay right there. We're back in a moment with more.
Did you know there's an asteroid headed towards Earth and there's a more than 1% chance of an Armageddon-style threat to the planet in 2032? In fact, NASA has said the chances that the asteroid 2024 YR4 will impact Earth in 2032 has risen from 1.6% to 1.9%. While it might sound surprising, it's not time to start panicking just yet. NASA was also quick to step in with some reassurance. Paul Choris, who heads NASA's Center for Near-Earth Object Studies, said, and I quote, "We are not worried at all, because there's a 99% chance it will miss, but it deserves attention." The space rock that's between 130 to 300 feet wide was first spotted on December 27, 2024 by a NASA-funded station in Chile. It quickly made its way to NASA's risk list, which tracks any objects that could come close to Earth. While the chance of impact is still low, NASA continues to watch it closely. These probabilities can change as more data comes in, and many asteroids that have appeared risky at first have later been deemed harmless. Right now, no other large asteroids pose a threat with impact probability above 1%. So, while asteroid 2024 YR4 is something to keep an eye on, you may not need to lose sleep over it. For now, NASA's Planetary Defense team is on the case, and we'll keep you informed whenever there's new information available.
I think the underlying innate technology is just right on the threshold, and we'll get there with the next models. But now people have got to go off and build all these services. So someone in this room hopefully will figure out what the AI tutor of the future looks like, and that'll be a population scale thing, and it'll think what that would do if every kid on Earth, this year got an AI tutor that was provided like a better education, or helped to provide a better education than anybody could get last year. Think what it would mean if we could have like an AI medical diagnosis system that was better than anyone could get last year. Think what it could mean if scientists could go cure every disease faster. And so, we've been waiting for this moment for a long time. I think we're gonna deliver something that can help with it, and now people have to go build with it. Other side of it, the cost for a given unit of intelligence 1 year later seems to fall by about 10x. Moore's law was a 2x every 18 months for the number of transistors on a chip, and that changed the world if you waited a few decades. But what's happening with the reduction in cost in AI models is extraordinary. Now, I don't think it means that the world's going to need any less AI hardware, because you bring the cost down and just the people are going to use it for a lot more things. The total number of dollars will go up. But that's a really exciting thing happening.
Let's talk money.
Hello and welcome to the post-budget special edition of Let's Talk Money. I'm your host, Surabhi Upadhyay. So it's finally happened. The magic has been unleashed. The FM has decided to give a bonanza to the middle class with the much talked about reduction in personal income tax rates and slabs. The whole change in the new tax regime. That throws up a lot of questions. Of course, it throws up the question of how much you and I are going to save, but also the bigger question. A lot of us have still been with the old regime because we love our deductions, whether it is, ATC, 1.5 lakhs, whether it's Mediclaim, housing, etc. But now, with the new slabs and the new rates and the new relief on rebate, is it time to move to the new income tax regime? Well, to answer this and a lot more, we have with us two experts. We have Feroz Aziz, Deputy CEO at Anand Rathi Wealth, and Sonu Iyer, who's the tax partner and people advisory services leader at EY India. Ladies and gentlemen, great to have both of you together with us on the show. So thank you very much for joining in. Sonu, I think you are wearing the colors of the season, right? It's all green. Suddenly taxpayers are actually seeing green because this is a meaningful relief that's come in this budget, right?
Thanks, Survi. First of all, thank you for having me on Let's Talk Money. And yes, it's right time to talk money, given the green bonanza that's coming our way. All of us literally are impacted or have something to cheer about this budget. Of course, the particular focus has been on the low-income earners or the middle-income earners, but a lot to cheer in the budget from a personal tax standpoint.
Absolutely. And Feroz, let me get some opening thoughts with you as well before we dive into the tax calculations. What did you think of the budget? At least there was no change on capital gains, and this income tax relief seems fairly real.
Yes, it is, of course.
And substantial.
Absolutely substantial. I had about 3-4 demands. I think inadvertently they've been heard. One is consistency, simplicity. The other was parity. These were the three things I was asking for. Consistency, taxes haven't been changed. Just in 8 months, we had all asset classes being touched on the capital gain front. Of course, we are waiting for the bill to come in, and I'm reasonably sure that the tax rates won't be changing. That's point one. In terms of simplicity, there's one very strong nuance, which exemplifies simplicity, is the tax rates and slabs have become multiples of 4 and 5. You see 4, 8, 12, 16, 20, 24.
Yes,
I've never been able to remember these because
and
every
now we can,
and the rates are 5, 10, 15,
20.
25, 30. So that's simplicity. Parity. See, consultants used to have section 44A. Okay, if there was a salaried guy, he would have no headroom at all. He would pay 30% marginal tax rate. A consultant, if you just redesign my agreement, and if I'm below 75 lakhs, and if I can go for presumptive, as a consultant, I would bring down my tax to 1/5. Right? And that was such a big disparity. A consultant also works as much. An employee works more. But employees have zero headroom. You're going like a train. And then you have consultants who are like auto. They can change lanes anywhere. So I think that also has that disparity has been reduced.
Oh, absolutely. I mean, and those are some of the big salient features of the tax relief that has been ushered in. So let's straight away dive in. So, what we want to understand is get into the nitty-gritties and not only look at the slabs and the rates that Feroz mentioned, but let's start by understanding why this is good news, even if your income is just slightly over 12 lakh rupees, right? The reason we are saying nil tax is because the rebate has gone up. The first tax slab is still kicking in at 4 lakhs, but the rebate has gone up to 60,000, so therefore there's relief. But tell us why even someone whose total income, taxable income is coming to, let's say, 12 lakh 10,000, 12 lakh 30,000, why do these individuals also have reason to cheer?
Okay, let me take a step back. As you said, this is the change in the rebate available under Section 87A. So what this means is that starting April 2025, 1st April 2025, effective financial year 25-26, anyone whose total taxable income is up to 12 lakh will pay no tax because of this rebate under Section 87A. Total taxable income has to be, again, which is taxable at slab rates and not income that's taxable at special rates like your long-term capital gains or listed equity short-term capital gains, which are taxed at different rates than the slab rate. And this rebate under Section 87A is there even in the existing law, which is up to 7 lakhs, which is now going up to 12 lakhs. And even in the old tax regime, you have it up to 5 lakhs. And then the concept of marginal relief, wherein you are talking about someone who earns 12 lakh 10,000 also doesn't end up having to pay much more tax than someone who's paying at 12 lakh. The concept of marginal relief simply is that any tax that is payable on incremental income over the income threshold, which is eligible for nil tax, like 12 lakhs in this case, is, anyone who gets over 12 lakhs doesn't end up paying the full tax that would be calculated at the slabs. So I'd say that it is really a comparison between any tax payable on income to the extent it is more than 12 lakhs and what the income increase over 12 lakhs. So you do a comparison of two and go with the lower amount as the tax to be paid. That's the marginal relief. And that's what we can see in the tables as well. So
okay, but Sonu,
when you talk about rebate...
But Sonu, on the marginal, we understand the concept, right? That if you're earning slightly above that 12 lakh, threshold where you get the rebate, you shouldn't be penalized. You shouldn't have to pay tax on the entire amount where your income is only slightly higher, marginally higher than the relief threshold. But up to what level is this relief available? 12 lakh, 5,000, 10,000, 20,000, 25,000. At some point, it has to stop, right? And you have to come in the tax slabs. So how does it work?
Right. Okay, so when you, if you could maybe bring back the tables, it's easier to sort of explain from the tables.
Yeah, we have them on.
Yeah, so we are saying that at different levels of income, you're going up to up till 12,70,000. There also you're getting a sort of a relief on marginal relief, because if you do a comparison between tax payable and increase in the income. So when your income is 12,70,000, your increase in income is 70,000. The tax payable is 70,500. Marginal relief is the comparison between the increase in income and the tax payable. And therefore, we found that the tax payable is more than the income. So the relief is 500. So the individual at 12,70,000 pays only a tax of 70,000 and not 70,500, and is getting a relief of 500. If you do just to show you another extreme, when it sort of ceases to exist. If someone is at an income of 12,75,000, the increase in income is 75,000 over 12 lakhs. The tax payable computed on 12,75,000 is 71,250. Because the tax payable computed is lower than the income increase over 12 lakhs, the marginal relief is no longer available. So, somewhere between 12,70,000 to 12,75,000, it sort of ceases. The exact number would be 12,70,588, where this marginal relief ceases to exist.
Got it. So that's how it'll work, and it's beneficial going all the way up to 12,75,000. By the way, those are rates we've taken, including standard deduction. After standard deduction, what is your taxable income? That's where the marginal relief actually kicks in. Feroz, that brings us to the other big question that I'm sure a lot of your clients also must be wondering or thinking. I mean, the ones that have been, following the old regime till now, whether now with this level of a tax regime in terms of the slabs, the rates, whether it's just simpler and easier to move to the new regime itself. I mean, what's the kind of first cut analysis, or what's the advice that you're giving out there?
No, it's very, very clear that you don't have to do the old tax regime at all unless you're married to it and there's some emotional attachment you have. Okay, because Nirmala ma'am has done something very smart. Okay, when you do the back of the envelope calculation, the perceived value of the gift is greater than the actual value of the gift. When you look at how the tax payers are there, if you give 80,000 benefit to such a large universe, she would have actually ended up spending 2,62,000 crores. But in this budget speech, she said 1,10,000.
That is how much she has to let go.
But actually perceived value is 80,000 per head for those many taxpayers. That's because a lot of them are actually using the old tax regime and getting a lot of jugaad wala paisa. Right? Now so its perceived value is greater than the actual value. So it's not going to benefit so much consumption as much as people are saying it is. Second, ULIP is a write-off. ULIP, there was an intersection between ULIP buyers and the old tax regime guys, almost 90%. If old tax regime is gone, ULIP as a Jan, Feb, March product is written off.
Correct.
So that's the long-term impact of that. The third, so I personally tell everybody to go into the new tax regime. Don't invest in debt, which is forceful debt. If you have to ask me, my clients come from an HNI and ultra HNI backdrop.
That's right.
So I'm getting their PPFs and EPFs also withdrawn because there's no point being in there. You can rather have debt because marginal tax rates have come down. Capital gain tax also is beneficial. The third thing, which is very important, is jugaad will stop in this country.
How do you say that, or why do you say that?
Because 3 jugaads used to be done by salaried guys also. Because India ke blood mein hai. Ek to what he would do, he would fudge rent receipts. That was one of the biggest data point which ministry has. Rent ki time aa gayi, rent receipt fudge kar raha hai aadmi, de raha hai salary. Because that's the only thing he was left with. Second, people who donate to political parties, they will donate to NGOs and they're taking some kickbacks. So all this will stop because the new tax regime doesn't allow that.
Correct.
That's the most important message for me. Ethical professionals will be rewarded in the new tax regime.
Correct.
So that I think is getting missed out completely. And the last bit is the old tax regime has anyways become defunct for everybody who earns. There are 1,350 people who earn more than 10 crores. The surcharge cap of 37 down to 25 is only applicable in the new tax regime.
Correct.
these 1,350 people, none of them were in the old tax regime.
Yeah.
Because
they had anyway moved on because they were
moved
getting a lower surcharge rate in the new regime.
So that's why I'm saying the perceived value is greater than the actual one.
So Feroz is all for the new tax regime, got that, but we still need to understand the maths. I'm going to quickly head back to Sonu. Now, Sonu, help us understand this because when we see the numbers, we'll believe it, right? Because as salaried individuals, we loved our deductions. We loved, the whole sort of piece on home loan, Section 80C, 50,000 NPS, then Section 80D for Mediclaim. We love to hold on to that. That was our, effort of saving. But is it pointless now to calculate and tabulate all of that? Is it still just better to move to the new regime?
Okay, no, you still have to do your comparisons. Between new tax regime, existing new tax regime to the proposed new tax regime, it's almost everybody can think of moving because there will be a saving. But those who are holding on to the old tax regime, although data suggests, as per the government, that in the media reports, almost 72% of the people had already moved to the new tax regime. But I think, Madam Finance Minister has created a situation where everyone will be almost compelled to do a comparison and make a decision. And we'll find a lot of people moving. The reasons that Feroz called out, whether it's an HRA reduction, ATC benefit, ATD medical benefit, all of these, require some sort of administrative work in terms of keeping and managing your receipts, etc. So you want to get rid of all of that because you're getting the same benefit, or in fact, actually saving more money under the new tax regime because of the widening of the tax slabs and lowering of the tax rates. So you will see people move. In fact, the government on its income tax portal, the www.gov.taxin, actually does have www.incometax.gov.in has a calculator that helps you do a comparison. And it actually throws up it's a basic calculator which tells you if this was your total annual income, these are the deductions you've been claiming, this is your saving, and it tells you which regime is better. So that is something that's easily accessible to all. And there's, of course, an advanced calculator also available on the income tax portal that can help you come to an exact benefit in terms of the making the decision on whether to switch to new tax regime. But maybe, it's best explained by in an example that in terms of the deductions people were claiming, that if you look at the old tax reduction, if your total deductions were about 500,000 rupees, you are going to be able to you can actually go up to 800,000, that's where the break even is coming in terms of, where you would want to be able to move to new tax regime, as simple as that. So, income up to 24 lakhs, the income varies at different levels. So, there is a specific calculation. But beyond 24 lakhs, if you have deductions more than 8 lakhs, you will stay on with the old tax regime. But if your deductions are less than 8 lakhs, then you will switch to new tax regime.
Okay, so 8 lakhs is that magic number. You have to see if all of your deductions put together are going above 8 lakhs, then maybe you're still better off in the old regime, right? And this would mean that you have to include HRA, because otherwise, without HRA, I don't know if there are other deductions significant enough that will total up to over 8 lakhs, Sonu?
No, so that's where it is. Unless, Feroz mentioned if you have, making donations to political parties, if you're doing ATG deductions to charitable institutions, etc., or, you have some deductions on account of disabled dependents, etc., those will become very exceptional situations. If I look at the large mass of population that typically takes deduction, say for, LIC, tuition fee, etc., which under ATC adding up to 1.5 lakhs, then you have your ATCCD deduction in case of additional contribution to NPS, or interest on housing loan, which is up to 2 lakhs. If you're claiming deductions in that part, typically come up to 8 lakhs is a bit of a stretch. So yeah, that's why most people will move.
Got it. So remember that number, 8 lakhs, go back, check your calculations, maybe talk to your CA. If the deductions are going over 8 lakhs, only then maybe there's some merit in staying in the old tax regime. Have to take a break, but this is not the only thing. Lots of other things have happened in the budget. Some relief when it comes to the tax that's being deducted at source on the interest income that we are earning on, say, our bank deposits. So we'll talk about that, plus a bunch of other reliefs that have come in. Fine print, budget 2025. The discussion will continue.
Let's talk money.
कुछ लोगों को अब जब एआई की बात होती है, कुछ लोगों को अब ये शब्द फैशन में है तो बोला जाता है, लेकिन मेरे लिए सिंगल एआई नहीं है, डबल एआई। भारत की डबल ताकत है। एक एआई आर्टिफिशियल इंटेलिजेंस, दूसरा एआई एस्पिरेशनल इंडिया। हमने स्कूलों में 10,000 टिंकरिंग लैब्स शुरू किए और आज उन टिंकरिंग लैब से निकले बच्चे रोबोटिक्स बना करके लोगों को चकित कर रहे हैं। और इस बजट में 50,000 नए टिंकरिंग लैब्स उसका प्रावधान किया गया। भारत वो देश है जिसके इंडिया एआई मिशन को लेकर के पूरी दुनिया बहुत आशावादी है और विश्व के एआई प्लेटफॉर्म में भारत की मौजूदगी एक महत्वपूर्ण स्थान प्राप्त कर चुकी है।
This was the third consecutive year that the BMC budget was presented to an administrator and not to a standing committee. Why? Because the term of the corporators ended in March 2022 and the elections for the new term and the new corporators are yet to be held. Now this 74,427 crore rupees budget, out of this an allocation of 43,162 crore was made for capital.
Let's talk money.
Welcome back. You're with us on Let's Talk Money, and we are decoding the budget fine print and figuring out if this indeed is the budget that makes most of us move from the old income tax regime to the new income tax regime. And before the break, you heard Sonu give us a bit of a thumb rule that if your total deductions are going above 8 lakh rupees in a year, then perhaps, only then perhaps, you might be better off in the old regime. But even then, you have to do your own math and your own sort of calculations. Just a point here, when we talk about deductions, for us, for most of us, we'll exceed 8 lakhs if we're paying a high amount of rent and claiming HRA. So just some examples and some numbers over here. Now here, look at the assumption that we have taken, that the person is earning 35 lakhs and the rent, he or she is paying 50,000 per month, which is what a lot of us end up paying in cities like, Mumbai or Delhi or Bengaluru, etc. Now, even here, you can say these are all, and then the other deductions are there, ITC, etc. Even for a person like this, the person is better off in the new tax regime. You can see the total tax payable is about 6.3 lakhs in the new regime versus 6.7 lakhs in the old regime, even if you're paying 50,000 rupees of rent. Now, finally, looking at someone who's earning even more and living in an even fancier house, the example here talks about someone who's earning 65 lakhs and the rent paid is 1 lakh. Only in this sort of an example, when you do the math, the numbers total up to the fact that maybe you're better off in the old regime. So that's the point that Sonu was making earlier. Feroz, your thoughts on this whole old versus new debate. Help us out. Generally, I mean, you said directionally you're better off in the new. But is this the rough break-even level that you concur with?
Like you rightly said, because the ones which are the common ones is 4.5 lakh summation, even if you use the NPS 50,000 limit, unless you're doing those exceptional ones like
donating to political parties, donating to charity,
parents,
and all of that.
4.5 lakhs, and then leaves you with another 3.5 lakhs. Like Sonu said, 8 lakhs is the break-even. So if you look at a metro city, because HRI is also a complex one, right? It is 50% of your basic. There are 3 rules, and the worst off is how it is calculated. So 82 to 83,000. So I think whatever example you gave, 1 lakh, I completely endorse that. And I personally think you should never swim against the tide. Now, kitna bacha loge? 20,000 2 saal ke liye. Come swim with the tide. It's always a good thing to do. That's my opinion. Now, you can do second decimal mathematics to save 12,000 rupees. You can work a little harder and get that 50,000 rupee extra bonus as a professional.
Okay, one more thing that I want both of you to clarify on. When we are filing our income tax return, so that could include all kinds of income, right? There's income from salary, there could be income from interest, there's income from capital gains. different, varied heads of income. So when we are saying that rebate is, as much as 60,000, if total income, taxable income is less than 12 lakh rupees, then that is what? That's only salaried income?
So total taxable income, which comprises of income which is taxed at slab rates. So you could have maybe, like the debt mutual funds, etc., which are now taxed at slab rates included in this income. But supposing you had, say, taxable income of 12 lakhs, out of which 8 lakhs is your salary income, interest income, all of them which are taxed at regular slab rates, but you have 4 lakhs of long-term capital gains. You will not get the rebate for the total 12 lakhs. You'll get the rebate for 8 lakhs, but for the 4 lakhs, you'll have to calculate tax as per the slab rates and then pay tax on it. So you'll have to be careful. This is very specifically, the government has inserted a proviso in the law this time, which is proposed, wherein they're saying this is only eligible, rebate that's eligible for income which is taxed at the slab rates, not income which is already taxed at some discounted rate of 12.5% or 20% as is the case in some short-term capital gains.
Okay, that's an important point as well.
Does that answer your question?
Yes.
Yeah. Feroz, you want to add to it?
So what Sonu explained, for its application, where's the good news? The good news is for debt funds.
Okay.
Right? If a guy has 1 crore rupees in a debt fund, he's going to earn 7 crores, 7 lakhs, right? If you're earning 7 lakhs, it's anyways taxed at marginal tax rate, so there will be zero capital gain because there is a rebate.
Okay.
So this is very good for senior citizens who were very upset that you're now pushing me back to deposits because both are now marginal tax rate. So it's a great news for all products who are at marginal tax rate anyway.
Whatever is taxed at slab rate is clubbed in this limit of 12 lakhs.
Absolutely.
That is the important takeaway. Okay, I think we're down to the last 30 seconds. So very quickly want final advice from our guests. Feroz, in terms of our mutual fund investments, though of course nothing has changed in terms of capital gains, but the market started believing that now with this big income tax cut, consumption will do well, consumer stocks will do well. You should not have manufacturing and capex too much in your portfolio. I know market can also go to excesses, but from a mutual fund portfolio perspective, would you change anything, add or subtract anything?
So I personally think these are narratives built. Somebody actually told me the same narrative in one of those panels on the budget day. I asked him, what are the top 3 expenditures of the government apart from interest? It is transport, defense, and railways, right? So all of it has some degree of capital gain, right? So it can be consumer spending, which can be propelled. Of course, I have for the last 6 months been saying ABC is the theme. Automobile, banking and consumption are the themes which fund managers should also skew. But you need not buy a specific thematic scheme to get the benefit of this ABC. And this ABC got reinforced in this budget, thankfully.
Okay, got it. So no reason to rush and quickly start sort of rejigging your portfolio. So no final advice, tip, anything else you'd like to leave with? We didn't get a chance to discuss, but there's relief also on the interest income on deposits, right? There's some good news that's coming if you want to remit money overseas for funding higher education. So quick summary of the other highlights that stood out for you.
So very quickly now, the TDS, which is applicable on interest income typically kicks in if your interest income is over 40,000 rupees and for senior citizens at 50,000. What has happened in this budget is that the TDS threshold for senior citizens has gone up from 50,000 to 1 lakh rupees. That means that, sometimes what the challenge which senior citizens face is that they have to file tax return to get back the refund of TDS, which is deducted because their income is not within the taxable ambit. Now, so that administrative hassle is saved. So the TDS relief there is no change in the taxability of the interest income, but the threshold at which the TDS kicks in has gone up to 50,000 for everyone. And for senior citizens, that is people over 60 years of age, it is at 1 lakh rupees. So that's the benefit. TCS, which is applicable on remittances under liberalized remittance scheme, that in case of education loans taken by students to finance their education overseas, that's been completely taken away. There's no TCS on remittances relating to education if it is been financed from a loan taken from a specified financial institution. The big change for all remittances, the TCS will come in at a threshold of 10 lakhs instead of the existing 7 lakhs. So that's also going to be a measure of relief for people when you look at it from the budget perspective.
Okay, all right. Quite a whirlwind session, this one, but I think very helpful because we've finally got all the fine print out and we've understood why moving to the new tax regime almost is a certain for most of us after Budget 2025. Thank you so much, Sonu, as well as Feroz, for joining in and helping us demystify some of these finer aspects. With that, it's a wrap on this edition of Let's Talk Money. See you again, same time, same place next week.
Let's talk money.
5,100 crore rupees for roads and traffic department, 5,807 crore rupees for Mumbai Coastal Road project, 3,039 crore rupees for storm water drain department, and 650 crore rupees for sewage operation department. For key public services, over 4,000 crores were allotted to education department, over 7,000 crore for health department, 261 crore rupees for fire department, 309 crore rupees for disaster management, and 220 crore rupees for the garden department. BMC announced that it's going to start 250 new public clinics, also known as Apla Dawakhana, all over the city. One interesting initiative announced by the BMC was the introduction of cyber awareness program for students. It will serve two key purposes. One will be to ensure that the students learn how to use the internet in a safe manner and to keep them safe from cyber fraud. BMC also focused on environment initiatives and projects like promoting eco-friendly cremation and proper disposal of residue from idle immersion. These are the projects which will take place under environmental related initiatives in the next few months. We also spoke to Bhushan Gagrani, the BMC commissioner himself. This was the first time that he presented the BMC budget. Listen to what he has to say about this BMC budget.
So your budget also mentioned that you guys are planning on imposing a tax on the commercial properties in slum areas.
That's right.
If you can elaborate that. So from when this new tax will be levied?
It is actually not a new tax. In fact, we are enhancing our assessment net. Under the assessment net, the properties which are in the slum, however, which are being used for the purpose of commercial, they were not covered. So this is for the first time we are doing the survey and bringing them in the tax net. Not necessarily that we will be imposing huge tax. It's a normal tax. It's not a very huge tax. However, the coverage will be given to our commercial properties.
So BMC has not introduced any new project this time. In fact, you have focused. Correct.
Yeah.
But sir, does it mean that is there any cause for fiscal concern, sir?
No, there is no fiscal constraint. We have enough adequate cash flow as well as resources.
Make informed decisions with comprehensive analysis on the go.
Strengthen your portfolio with real-time market updates on the go.
Create effective strategies with insightful expert opinions on the go.
Grow on the go with CNBC-TV18, now streaming live 24/7 on YouTube. How about listening to global market maestros before crafting your investment strategy? How about getting deep insights into their businesses from top Indian honchos before putting your money on the line? How about making every trading day profitable with strategies from the market masters, macro pundits and chart wizards? Only one show gives you a head start to your trading day. Get ready to profit. Get ready for business with Bajar at these times on CNBC-TV18 and CNBC-TV18.com.
What does it take to build India's largest startup platform? It takes a journey of starting out as an unknown.
Hello and welcome to News Center. I'm Parikshit Luthra. The Reserve Bank has slashed its benchmark lending rate by 25 basis points. This is its first such move in 5 years and paves the way for banks to curb loan rates. This comes days after Finance Minister, during a budget speech, announced that income up to 12 lakh rupees would be tax-free under the new regime. India Inc. has lauded the rate cut, saying that it will complement the budget decisions announced by the government to boost consumption. It was a unanimous call to cut the repo rate by the Monetary Policy Committee, the RBI's rate-setting panel. The big question, will India now be encouraged to buy more vehicles and purchase a new home very soon as well? Joining us now to take this forward, we're joined by Sai Giridhar, Vice President, Federation of Automobile Dealers Association, Gumiram Reddy, Secretary at CREDAI National. He's also the Chairman and MD at the ARC Group. Also on the program with us is Devendra Kumar Pant, Chief Economist at India Ratings and Research. Gentlemen, thank you very much for joining us. Devendra Pant, if I can begin by asking you, overall, how do you feel this will help in boosting the consumption in the economy, which had been a big worry all of last year?
Well, Parikshit, unlikely that it will give a big boost to the consumption, both the budget as well as this. So if we're talking about the budget, we are talking about the people, those who have got the benefit are top 3% or 5% of the population. And the consumption demand slowdown mainly originated from the people at the lower rung. Having said that, there will be some impact. But if you look at what is going to happen by this move, RBI's move. Again, consumption response to, if you look at the theoretical form or the empirical evidence, consumption response is more to how the stability of wages, because that is more is the bigger concern. Yes, the way if the inflation trends down the way RBI has projected, certainly that lower inflation will increase the real wage growth. But the worrying point in today's numbers is what many of us may have not looked at it. The first quarter of next fiscal year, that is April-June 2025, RBI's expectation is a higher inflation than the December policy and lower growth compared to the December policy. And that is what is going to have some impact. No doubt, in totality, yeah. If they continue to maintain the liquidity in the right form, like whatever is required, not going to the loose or the very ample liquidity in the system, then the transmission which happens to the interest rate, the benchmark interest rate and other interest rate, your easy liquidity will have a bigger impact. But if the rate cut, if the liquidity doesn't ease, it remains in the deficit mode, then unfortunately one may say that this 25 bips repo rate cut will not yield result.
All right. So you're saying that the impact and the result of this rate cut is debatable and will have to be watched over the next few months. Let me also go across to Gumiram Reddy of CREDAI. Mr. Reddy, how do you see this helping home buyers? What would be your outlook now?
Yeah, definitely it's going to help. I mean, we were expecting more actually, 50 BPS, but definitely it's a positive move. So it's we have been waiting for almost 5 years. You know how after the COVID, how the things have gone up. Before COVID, what was the rate of interest? Home buyers especially, even project funding also. Now everything is gone up. So now this definitely it's going to give a positive note. And we are expecting even next quarter also, we are going to, we are expecting at least under 25 BPS will be reduced. So this is a positive note. In a real estate home buyer, their EMI will go down. So definitely we are, very, very positive. But even during budget also, whatever the decisions have been taken by the finance minister in this thing, definitely they are going to help the home buyers. They are up to 12 lakhs, there is no tax. And even second home also, earlier only one home they were considering, now second home also people can buy. So where some tax cuts are there. So definitely it is a welcome move. We are really thanking the RBI to take this decision.
Okay, let me go across to Sai Giridhar of FADA. Sai Giridhar, over the last few years, entry-level car sales and also entry-level commuter bike sales have been under strain. Do you see some improvement on the horizon after the tax sweeteners in the budget and the rate cut?
So, Parikshit, see this in totality, if you talk about the budget and the rate cut by the RBI today, it signals a constructive policy shift that prioritizes the economic growth. So it's in the right direction, I should say. And you're absolutely right. With auto loans set to become more affordable, we expect a stronger demand, especially in the price-sensitive two-wheeler segment and in the entry-level car segments. So these two segments, which were actually lagging behind, I think they will get some boost from both these steps in totality. Though the only worrying point is that it should not be neutralized by the price increase by the industry. So, and the price increase happens on the attribute of the higher input cost and also the depreciating INR. So that's the only worrying point. But I think it's the it's the move in the right step. And though it will take some time for these rate of interest to step in, because technically this helps in making the interest rates reduction. However, it takes some time as the immediate impact on the cost of deposit does not happen. But right in the step in the right direction, and it's going to help the industry overall.
All right. Let me go back to Mr. Devendra Pant. Mr. Pant, on the whole, what is the big message that you pick up from the RBI governor's speech? Now, this rate cut had been called for by people in the government, by top ministers and the industry as well. Everyone had been requesting and hoping that a rate cut will happen. What does this show in terms of the RBI stand right now and the big challenges that you're looking out for? Inflation is one of them, as you pointed out.
Yeah, another big challenge is which Mr. Girdhar has also pointed out, like the input cost. So how we being a net commodity importer economy and the way the currency is behaving, like some of it, the recent depreciation was the pent up of the past last year or this fiscal year, where the rupee was fairly stable. See, the biggest unknown in this entire scheme of things is whether there will be any tariff imposition by US on India. As of now, they have US imposed tariff on Canada, Mexico, and China. Now, if it is imposed on India also, now it could be a double whammy. There's the tariff, and on top of that, the currency weakening. Yes, no doubt, some of it we may be able to recover in the form of services export, because there we are the leader, and we have surplus on the services export. Now, one thing, although the inflation and the growth forecast is on the assumption of a stable or good Rabi harvest. Now, if all of us know the temperature situation in the month of January, though he talked about the climate and other things, so climate change impact is taking place on the economy. Agriculture is very vulnerable to that. And if the Rabi output, because of excessive heat or higher temperature, is not in line with the expectation, then we may see a situation where the food inflation doesn't come down to the expected level, or the way it is thought of, that it will lead to 4.2% inflation in the fiscal year FY26. Now, if that happens, and we don't see the commensurate increase in the nominal wages, because if you look, nominal wages are barely growing at a rate higher than the overall inflation, and that real wages, that's a major challenge for the economy and so forth. So as far as consumption is concerned, because 1 percentage point or 100 bips increase in real wages translates into 110 basis point increase in consumption growth. So the inflation doesn't come down or doesn't behave the way it is expected to behave, then that will be a challenge for the monetary authority. And it will look very odd that they will go back and take some step which is contrary to what they had done today. Only hope is Gardner, though he hasn't put in any number, but he has mentioned in his briefing that they will provide sufficient liquidity in the system. If the sufficient liquidity is provided, then the adverse impact, then the rates may come down, right? The external benchmark rates, all those with repo, T-bill, and all those, they will see coming down first compared to the other rates.
All right. Let me get in Sai Girdhar once again. Sai Girdhar, by when do you expect to see some changes on the ground? Still too early. The rate cut has just taken place. Yes, the budget had announced sweeteners, tax relief for the Aam Aadmi. By when do you expect to see some changes in sentiment?
See, as I said earlier also, see, it takes some time for the impact to be seen, at least on the bank side. And only when the impact, say, on the deposit cost for the banks, only then we see the banks actually translating this benefit to the consumers. But we are expecting it to probably happen by somewhere around April. So we expect that from April onwards, the rates should soften, and the kind of money which the consumers will be having, the disposable income which they'll be having in their hands, and it should probably be reflecting into more sales, at least in the entry level vehicles and two-wheelers segment for us.
Sai Girdhar, when we speak about lower rate for loans, give us a sense of which is the salary bracket or the customer salary bracket which has been avoiding or postponing their decision to buy cars because of high cost of living, inflation, stagnant wages, and which is that segment where you hope there will be some revival in sentiment?
See, though we probably expect the major impact would be in the lower end segment, in the people who are wanting to buy a two-wheeler, taking a loan of approximately 50,000-60,000 rupees, or even a lakh of rupees, or probably even an entry segment car wherein the loan would be less than 5 lakh rupees. But on a broader line, if you see, the impact would be across board, because the rate cut would not be limited only to the auto loan. So the rate cut would be even in the home loan, in the business loan, in the personal loans. So even if a salary class or a business class will have more disposable income, he'll probably be he can afford more EMI, you should say, from April onwards. So that would be in a nutshell. So that's what I'm saying, that it's a step in the positive direction. And yes, probably even we were looking at a much bigger rate cut than 25 basis point, but I think it's the first step taken. In coming few months, or probably by next financial year, we should be expecting more rate cuts, because if you compare the rates today with the pre-COVID era, there is a jump of approximately 1.5 or even up to 1.75% in real terms, which translates into a big jump as far as monthly EMI is concerned. So what we are talking here is approximately on a per lakh basis, on a home loan, it should be 1,000 rupees, 2,000 rupees. So it makes a major impact for consumers overall.
All right. Thank you very much for joining us, Sai Girdhar, Mr. Reddy, and also Mr. Pant. Let's see what happens as far as the state of the economy goes, and the consumption boost and the sentiment revival on the ground goes as well. On that note, we're taking a short break, but coming up on the other side, the United States has blacklisted an Indian company named Marshall Ship Management for facilitating the shipment of Iranian oil to China. Details when we return.
And ending up as unforgettable. It takes more than 2 decades of celebrating the most influential and influencing the most celebrated entrepreneurs. From chronicling the stories of India's startup universe to becoming a success story in itself, as India's longest running show on startups and entrepreneurship, celebrating 21 action-packed years of building India's biggest startup community. Young Turks at 21. Only on CNBC-TV18 and CNBC-TV18.com. CNBC-TV18's most comprehensive and award-winning news show, India Business Hour, drops first on YouTube. So get the first access to the most influential architects of policies and politics, the key newsmakers of the day. Discover the big themes as we decode the business of markets, macros, and more. Be the first to go to the heart of all the top stories that drive the day's agenda. Catch the award-winning India Business Hour live every night on YouTube with me, Shireen Bhatt.
India Business Hour live on YouTube at CNBC-TV18 weeknights at 7 p.m.
This growth inflation dynamics opens up policy space for the MPC to support growth, while remaining focused on aligning inflation with the target. At the same time, the MPC felt that excessive volatility in global financial markets and continued uncertainties about global trade policies, coupled with adverse weather events, pose risks to the growth and inflation outlook. This calls for the MPC to remain watchful. Accordingly, it decided to continue with a neutral stance. This will provide MPC with the flexibility to respond to evolving macroeconomic environment. The MPC decided unanimously to reduce the policy rate by 25 basis points from 6.5% to 6.25%. The MPC also decided unanimously again to continue with a neutral stance and remain unambiguously focused on a durable alignment of inflation with the target while supporting growth.
Every leader, business, government, investment leaders, economists, we're all scrambling to adjust to a very new reality and a new approach, I think it's fair to say, from a US administration who seem very focused on American interests and are quite content to rewrite what have been thought to be kind of historical norms. So those historical norms started really earlier this week with the seeming tariffing of Mexico and Canada. Canada, obviously, a huge close ally of America, but that didn't save them from being on the list, at least for some period of time. Those tariffs subsequently didn't come to pass, at least for now. And to your question, yeah, the Middle East, like everywhere else, we're all looking, I guess, tweet by tweet, Truth Social post by Truth Social post as to what's going to happen next. And that would apparently include some historically astonishing proposals, at least.
The United States has imposed sanctions on a number of entities and individuals for allegedly facilitating the shipment of Iranian oil to China. The clampdown comes days after US President Trump signed a memorandum sanctioning a maximum pressure campaign on Iran. India-based Marshall Ship Management is among the companies that have been blacklisted. Sriram Iyer is here with more.
So the US government has blacklisted a bunch of entities for carrying Iranian crude oil to China. And one such company is Marshall Ship Management, which is based in Mumbai. So here's what we know about this company from all the information that's available online. Marshall Ship Management was founded in 2019 with two directors at that time. One of them is Ryan Xavier Aranya, who has been put on this US government's blacklist today. The other is Mark Andre Gardner, who is not on that list for reasons best known to the investigators. They started this company in 2019 with a capital of about 37 crore rupees, and it's been a spectacular run since then. In the year ending March 2023 alone, the company's revenue and profit more than trebled, and the net worth increased more than fourfold. What they do is quite simple. They recruit and train sailors who are then sent on to ships. One such ship with folks from Marshall Ship Management took oil from Iran to China. They didn't quite own the ship, but they were working on it, which the US doesn't like one bit. What is worse, they are accused of taking extra efforts, like going that extra distance to obscure the origin of the oil. They didn't want to show, if anybody caught them on the way, they didn't want to show that this oil was coming from Iran and going to China. And that's why they've been put on a list of people who aren't allowed to do business with the Americans. And if they do have any property in the US, that would be frozen too. More interestingly, Ryan and his company Marshall Ship Management find themselves on a list that has ISIS outfits from different parts of the world. Overreaction much? The Trump administration feels it's fair, if anyone would like to take it up.
IT major Infosys has said that the company has fired 337 trainees for failing internal evaluation tests thrice and not 700 as claimed by nascent information technology employees Senate. As per the website, NITES claims that to work for the welfare of IT professionals. Rachna Dhanrajani joins us now with more. Rachna.
Well, according to the nascent Information Technology Employees Senate, the NITS, Infosys has laid off around 700 campus recruits who joined in October 2024. A bunch of these trainees are from the 2022 engineering batch who had already faced a 2-year delay in onboarding before being terminated just months after they joined. NITS President Harpreet Singh Saluja has condemned this move as shocking and unethical, and the organization has even filed a formal complaint with India's Labour Ministry demanding an intervention. However, Infosys, in response to CNBC-TV18, said that the number of trainees is at 337 and not 700 as NITS has alleged. The reason for these 337 trainees being terminated is because it's a part of their employment contract that if within 6 months of joining they don't clear the assessment test, they will have to be terminated. Now, Mysuru campus is the training campus of Infosys where freshers are onboarded and trained, and the confirmation letters are given to them after they clear 3 attempts of this assessment. Infosys has also told CNBC-TV18 that this practice has been going on for almost 2 decades now and is routine to every year. Almost 1 to 2% of the total trainees end up not clearing this assessment post 6 months or within 6 months of training, and that's exactly what has happened this year as well. However, in October, the company had onboarded about 1,000 employees who were actually hired in 2022 but received the joining letters only in 2024. Now, many reports also allege that there were bouncers on campus, which also Infosys has categorically declined. While some employees allege that the assessment criteria and syllabus were modified during the process, making it harder to pass, NITS has now officially filed a complaint with both the Labour Ministry and Ministry of Corporate Affairs, urging them to take an immediate action against Infosys. Back to you.
All right. Thank you very much, Rachna Dhanrajani, for joining us on that important story. With that, it's a wrap on this edition of News Centre. More news and updates continue right here.
Tensions between employees and management at Samsung's Sriperumbudur plant just outside Chennai have surfaced yet again. For well over 24 hours now, over 100 employees, we're told, have been staging a sit-in protest at Samsung's plant just a few meters from where I'm standing. In fact, this line of company buses and these barricades have been erected by Samsung so as to prevent members of the public and observers, much like myself, to see what's been going on through the gates of Samsung's plant just a few meters from where I'm standing. Now, the issue is simply this. A few days ago, 3 members or employees rather of Samsung's plant were suspended after allegedly engaging in activities deemed detrimental to the interest of Samsung's operations in India. However, employees of the plant, a section of them, and members of the Samsung India Workers Union claim that this suspension was not on account of disciplinary action or disciplinary reasons, but simply because they were affiliated with the Samsung India Workers Union in the first place, also claiming that Samsung does not want any employee to be actively engaged with this recently established workers union. Now remember, this isn't the first time that issues or a face-off between Samsung's management and employees have cropped up. In September, nearly 1,100 employees of this very plant staged a protest outside plant premises, claiming for better privileges, more representation, better pay, and also representation by way of a union which Samsung said all that while that it was averse to forming in the first place. However, following the Madras High Court's intervention, Samsung India Workers Union became a registered union under the Tamil Nadu Labour Department, thereby ensuring that some of these workers' demands pertaining to representation by way of a union was summarily met. However, these issues clearly have not been laid to rest, simply on account of the recent suspension of those 3 employees. Now, the issue is simply this. While these employees claim that they were suspended for their affiliation, Samsung in a statement has said the employees in question violated the company policy and have been suspended temporarily and will be subject to appropriate disciplinary action following a formal inquiry, end quote. Now, while it's a case of he said, she said between Samsung and its employees, the fact is that these outstanding issues between Samsung and its employees don't seem to be going away anytime now, given the fact that both the employees and the management seem to be heading in different directions with regard to what they expect of each other pertaining to both representation and a basic disciplinary expectation.
when you go to an exam, in that exam, the maximum marks are let's say 100. The passing marks are 40. What do you aspire for? Do you aspire to pass, or do you aspire, to do extremely well? Well, some may, like to just pass. In RBI, we like to be on top of everything.
Well, the Reserve Bank governor clearly was on top of his job. While announcing the 0.25% rate cut by the MPC, the governor didn't overpromise on any count. He didn't indicate continued dovishness, nor did he signal a surfeit of liquidity, just appropriate liquidity. So the question is the policy statement too restrained in its dovishness? The GDP forecast for next year, FY26, is at 6.7%, inflation at 4.2%. Is this too ambitious? Both inflation too low and growth a bit too high. The regulations on LCR, that is liquidity coverage ratio, and on expected credit loss, ECL accounting, have been postponed. But the higher risk weights on loans to NBFCs and unsecured borrowers has not been reduced. Is the RBI still too restrictive on credit? Well, to answer all these questions, I have with me an elite panel. Mr. C.S. Sethi, the chairman of the largest bank, the SBI chairman. Mridul Sagar, former member of the MPC and former ED of the Reserve Bank, now professor at IIM Kozhikode. B. Prasanna, the head of Global Treasury, Global Markets at ICICI Bank, and Samiran Chakrabarti, chief economist, Citi India. Gentlemen, thank you very much indeed for your time. Mr. Sethi, I'm aware that you are in a hurry, so I'll rush the first questions to you. The big point is there is a rate cut, and that will obviously get transferred to loans that are linked to the repo. But when will the first deposit rate cut come for the system, you think, considering that the RBI has also promised appropriate liquidity?
Yeah, thank you, Lata, for having me on your show. It's always a privilege. I think the loans, of course, will repo-linked loans, particularly EBL, are what we call, get repriced immediately. The liquidity measures what RBI has taken definitely improve the system liquidity. And the governor has also promised that he will ensure the durable liquidity. So which means that today, as we speak, while the situation has improved, it is still not in the positive territory. Still the deficit is there. And but a lot of effort on the part of the RBI to ensure sufficient liquidity availability reduces the concerns on the liquidity. Then the deposits, I think it will take a while. Maybe not in the current quarter. I don't think any banks will immediately cut the rates. Even if we, going forward, will cut the rates, there is a significant time lag in terms of repricing the deposits. Yes. Because most of the time, what we have seen in the recent times, people wanted to lock in the rates. So the largest growth of fixed deposits happened in the 1 to 2 year category, which means it takes some time for the deposits to get repriced.
Okay.
But the new deposits...
No, your incremental, yeah. New deposits, when do you think it will take a quarter to announce a lower rate?
I think this quarter being, Q4 is generally a busy quarter for everyone. Most of the banks would like to push the credit growth also is significant. So obviously at this time, everybody wants to raise the deposits also. Okay. My assessment is that the immediate rate cut on the deposits across the banking system may not happen. Some banks may choose to cut the rates, but not definitely across the banking system.
Okay. What about growth of credits? There were two green signals, I thought, from the governor saying that he's happy with the credit deposit ratio or something to that effect. And on the other side, the counter being that they have not reduced risk weights on anything. So do you think credit growth will start overtaking deposit growth quickly? I mean, it is overtaken in your bank. I mean for the system.
For the system, the narrative from the central bank also seems to be in tune with what government budgetary proposals have been, particularly the credit flow to the MSMEs and agriculture. So I'm sure the governor probably had in mind when he spoke about, the comfortable CD ratio, and even if credit growth happens in these two segments, maybe the central bank will be happy about that, because these are the two sectors which definitely needed to be supported, and from both in terms of job creation and job maintenance. So my view is that the sufficient liquidity will also ensure that the ability of the banks to fund will improve.
Yeah.
So
No, I mean, we are very crucially dependent on this credit growth, because at one point in time, credit growth was actually lower than nominal GDP. Only if credit growth is fueled and goes way above the nominal GDP, like goes to 11-12%, will we start getting economic growth? Can we be confident of growth? That's why I'm trying to pin you down on whether you see credit growth growing and by when.
Credit definitely will grow. I think our overemphasis on unsecured personal loans growth in the system probably overshadowed, the credit flow to other sectors.
Okay.
Now, definitely, with a lot of measures which have been taken in terms of MSME lending, the corporate credit growth will be moderate for some more time. I think we'll have to see how the demand, consumption demand, which is going to be spurred by the budgetary proposals, will it make private capex to pick up, and then they will also start borrowing, is something what we have to be, on the lookout for.
Okay.
But I believe that there is a good growth potential for credit, definitely in the current quarter.
Okay. Well, the hope, of course, for the whole world, I mean, stock market investors as well as corporate sector is looking for growth, and their liquidity and credit offtake are the two things. And both these are something bankers are in a better position to assess. Finally, Mr. Sethi, what about margins? I mean, here you have to talk only from your angle. Does it impact only a little because only repo-linked loans get priced lower, and you're saying it will take at least a quarter for the first cost of your raw material to fall, deposits. So margins will be under pressure for a couple of quarters for banks?
In our portfolio, of course, we have limited EBLR linked portfolio is about 29%. So the impact of this rate cut of 25 basis point will not have major movement in the NIMs. Even if on an annualized basis also, I don't think if the rate cuts become more frequent and deeper, then we'll have to see. Obviously, the deposits also will get, some transmission will happen on the deposit rates also. But this rate cut is not going to significantly impact SBI in particular, even in the banking system in general.
Okay. Finally, sir, before I let you go, any other takeaways that you found from the policy?
I saw a lot of takeaway from your shows from the morning, Lata. Definitely, I think the intent of the central bank seems to be, growth oriented, and there are a lot of nuances in the governor's speech and the press interaction. And one of the overhangs in terms of the policy in regard to LCR being removed, I think definitely it's a positive for the banking industry.
Oh, yes. I expected that bankers are extremely thrilled with not having to lock up liquidity, at least for the next 1 year. Mr. Sethi, pleasure having you with us. Thank you very much for making time for us. And I'm glad your flight landed on time and we could have you on the show. Thank you for joining us, sir.
Thanks.
Okay, let's now parse the policy in terms of economic and market impact. And we have our experts with us. Prasanna, to start with you, the yield went up actually by 1 basis point, the 10-year yield. You have got a rate cut and you go up from, I think at one point it was even 6.65 and then went up to 6.7 by the time it ended. Why? What did the market take away?
So I think, Lata, there are 2 or 3 things. One is the fact that the market had already kind of expected the repo rate cut. And there were sections of the market which was also expecting a change in stance, which didn't come through. And there were also people who were expecting further liquidity measures as a follow-up of what they had already announced in the previous 15, 20 days. So some of them didn't come. The change in stance and further liquidity measures didn't come. And that was 2 reasons why market took it negatively. But more importantly, I would say that the fact that what is really actually good for the real economy could have been bad for bond markets today. And I'm referring to the LCR norms, because there was some level of expectations that if the new LCR guideline were impacted, it would have been positive for the bond market because of the incremental 4 to 5 lakh crores of demand in the next year coming in from for HQLA assets coming in from the banking system. So if you remember, when the draft guideline came in, there was around 4 to 5 basis points of rally when that happened. So I guess some of it is just payback of that and giveaway of what rally which actually took place at that time. But the yields going up today, I would presume, has nothing to do with the stance of the policy, what the governor has spoken, what the policy has done. I think it's a great policy. And I think there are a lot of nuances which we can possibly discuss over the next 15, 20 minutes. But I think there are some positives for the bond markets as well. And they will come to, react to this over the period of time. Of course, always the global uncertainties remain, and we have to always, take that into account.
Keep that in mind. Absolutely, absolutely. Samiran, would you say the RBI is being a little too ambitious at 6.7%? We are heading into a very difficult geopolitical situation.
So, Lata, our sense is that we have to think about growth from a more holistic perspective. First, to start with, the December quarter GDP growth is already probably up to about 6% So the path to traverse from here to that 6.7 is not too far. And we have had at least 3 different things going in our favor. One is that at central government level, the public capex for FY25 itself has got accelerated quite significantly. The expectation is that for the Jan-March quarter, it would be 21% year over year if the revised estimate targets have to be met. Second is obviously the income tax cut announcement in the budget, which can spur consumption activity in the short term. And third is the overall package that the RBI has put in today with rate cut as well as promise for better liquidity and a more pragmatic approach towards macroprudential measures. So this whole policy nudge, both from the fiscal and monetary policy side, we think is good enough to push us up to that sort of a number. Our own forecast was even before the policy at 6.6, which is not too different from the RBI's forecast. So that way, I'm quite comfortable that we are on the right track on growth.
Okay. Well, I heard a large number of economists who are at 6.5 at best or south of it. But yes, you told me 6.6, and I think ISEC PD has 6.8. So there are some people who are willing to, bet on a better growth. Mridul Sagar, I wanted to ask you, what do you make of the governor's statements on liquidity? I personally asked him that the rate cuts will not get passed on unless you keep surplus liquidity. So what did you make? Will they keep it surplus, or was he shy of promising and stopped at appropriate and not ample liquidity?
Lata, we have to recognize that market expectations were running ahead of what was feasible and what was desirable in this policy. And I think the governor rightly chose to tamper that expectations, because it's very important to calibrate things and not commit too much forward, especially when you have high uncertainty. So from that angle, I think we have to read his liquidity statement with some nuances, in the sense that it's not that he's saying I will flush the market as the market expects. Neither is saying I would commit the same mistake what had happened over the previous quarter of very tight liquidity, which came on the back of forex interventions and stuff. So you have to see that the reserve money growth this year has been very dismal. At 3.5% year on year, I think this is something which one reminds of the Great Depression mistake of the Fed, where basically the monetary policy was kept too tight to defend the dollar. So as we go forward, they can use FX buy-sell swaps. They can do open market outright sales. That's
exactly why I'm asking, Mridul, why not promise surplus liquidity? Why only stop at appropriate?
So appropriate doesn't mean that you are in deficit necessarily. So appropriate is that you're not flushing the market as you're actually doing so in times of, say, extraordinary crisis like the global financial crisis or the pandemic. So he has said he will be proactive and he will look into it.
Okay, so you think...
I say open market bond purchases he'll make, and then he will obviously add to the liquidity as it may be required. We have to be cautious. See, if you have a more 2 trillion coming in form of RBI profit transfer surplus and the government spending pickups, you can make mistakes on the other side.
Okay. So yeah, especially when the rupee is, especially when, speculators may use the cheap money to short the rupee. Fair point. So the governor's appropriateness is better than being ample in his liquidity promise. We have to take a quick break, but lots of questions on, the new instruments that he has given on, what are you expecting in terms of the next rate cuts? All that coming in a jiffy after this break.
Did you know there's an asteroid headed towards Earth and there's a more than 1% chance of an Armageddon-style threat to the planet in 2032? In fact, NASA has said the chances that the asteroid 2024 YR4 will impact Earth in 2032 has risen from 1.6% to 1.9%. While it might sound surprising, it's not time to start panicking just yet. NASA was also quick to step in with some reassurance. Paul Choris, who heads NASA's Center for Near-Earth Object Studies, said, and I quote, "We are not worried at all because there's a 99% chance it will miss, but it deserves attention." The space rock that's between 130 to 300 feet wide was first spotted on December 27, 2024 by a NASA-funded station in Chile. It quickly made its way to NASA's risk list, which tracks any objects that could come close to Earth. While the chance of impact is still low, NASA continues to watch it closely. These probabilities can change as more data comes in, and many asteroids that have appeared risky at first have later been deemed harmless. Right now, no other large asteroids pose a threat with impact probability above 1%. So, while asteroid 2024 YR4 is something to keep an eye on, you may not need to lose sleep over it. For now, NASA's Planetary Defense team is on the case, and we'll keep you informed whenever there's new information available.
Welcome back. We've been discussing the monetary policy that was announced by the Reserve Bank, which cut the repo rate by 25 basis but didn't quite indicate whether there will be more rate cuts, because it said that we will look at every policy afresh with the new macroeconomic indicators, and that this less restrictive policy is for this one. That was a very clear statement the governor made. Speaking to me for the past 15 minutes in this show are Mridul Sagar, former MPC member, B. Prasanna, who heads the global markets at ICICI Bank, and Samiran Chakrabarti, the chief economist at Citi India. Gentlemen, thank you for your patience. Prasanna, you said there are a lot of positives. What did you take away?
So I think, Lata, the first thing is the fact that he did speak about the efficiency versus the stability trade-off. And he did at length speak about the cost of regulation and the fact that you can, I mean, he didn't say that, but that sometimes over-regulation can also lead to loss of efficiency, which is what is the inbuilt message in it. So I guess that's the first thing that I can think about, because a tightening regulation can also lead to a lower credit growth.
Okay.
And the second is the fact that I think there was a little bit extra emphasis on the flexible part of the inflation targeting. And while I think he did mention that it is more for this policy and it is more used as a justification for the current rate cut, I think reading between the lines or hearing between the lines in this case, I would assume that going forward as well, we have a little bit more bias towards growth than towards inflation in the past. So I think, and also the fact that we are now doing policy on expected inflation, and as long as we are comfortable with the inflation trajectory going towards 4, we don't need current inflation to be at or above lower than 4 for us to cut rates. Maybe all of these would have also happened in the earlier regime as well, because it is just now that the circumstances are becoming a little bit more positive. So I think these were the main positive from my side. And of course, the thing about liquidity that you spoke with and Mridul spoke about, it gives us a lot of confidence that even the fact that they have really been aggressive in their actions in the past means that while they could have done more this time, but I think they will react a little bit faster and more aggressively as and when liquidity needs comes up for the banking system as we go forward.
Okay. All right, yeah, fair enough. That's the comfort as far as a banker and a bond expert is concerned. Samiran, how many rate cuts are you expecting? How would you draw the macroeconomic indicators looking forward?
So obviously there are lots of uncertainties both globally and domestically. So what we can at best do is go on the basis of the forecasts that have been put in place. So if we trust the FY26 GDP growth forecast of 6.7% and the CPI forecast of 4.2%, then on that basis, one can say that another 50 basis point rate cut from here would probably take us to the kind of neutral rate that RBI has been comfortable with in the past on the basis of expected inflation. And if RBI at some point of time reconsiders that neutral rate range of 140 to 190 basis points and brings it lower, as some of the earlier MPC members have suggested, then you could see scope for more rate cuts beyond that 50 basis point also. On the growth side, it looks like even if we meet that 6.7, that's lower than the potential growth that RBI would be considering. So from that perspective, there is no real urgency to stop on rate cuts because of growth overshooting expectations. It will all boil down to what extent we are closer to that 4.2 forecast on CPI for FY26.
Okay. Thanks for that. That's well argued. So at the moment, let's only look in for 50 basis. Let's see how things pan out. Mridul, would you say that for a maiden policy and coming after such a lot of criticism that the Reserve Bank faced for tight liquidity, it's well delivered, not bending too much in terms of dovishness, and yet, giving reasonable amount as, if a person like Prasanna can be happy, must have delivered something.
No, absolutely. The script of the MPC resolution was very good, very well balanced. Even governor's statement was reasonably well balanced, though a couple of things were there which were a bit sort of different from one would have expected.
Such as?
So clearly he's sort of hinting at use of more flexibility, but he's also trying to reinstate the inflation target. I hope that target means it is 4% because that's the law.
Actually, Mridul, he was very clear that he will chase that target. In fact, after the press conference, I specifically asked him why did he bring up the flexible inflation targeting as the first paragraph in the statement, and he said to commend the framework, not to use that extra flexibility,
and he
but to
his
indicate
conference
support.
On that basis. So I fully recognize that he was having faith in inflation targeting, and he said that. My only downside was the press conference probably hinting a bit too much about regulation relaxations and postponement, which could have waited probably a more in-depth analysis of what are the risks and what needs to be done. Because on the LCR, you have to acknowledge that the world is changing. So it's not just the internet deposits. We'll soon have programmable deposits. And do we need to tighten the LCR rules for that? If we have to, we have to. But tracing them is fine, but one shouldn't really give up these regulations.
I'll tell you two things on that. The previous RBI regime, that is those who were already who are proponents of the LCR regime, told me that they would have postponed it. Because of the difficult times we are in, tight liquidity and rupee under pressure. So it would have come anyway. And to be fair, while he said that there is a cost, he also said, I'm sure the Reserve Bank takes into account the cost. So, there was a comeback statement as well. Unfortunately, out of time. Prasanna, I'm giving you only 10 seconds here. But tell me, this saying banks have to lend in the call market. Why are you not lending, egging them to lend? As well, this new derivative instruments, allowing brokers registered with SEBI to come in. Do you think the debt market is now in for a good time because of all this?
So we already had a product called Bond FRA, which was active. Now I think the Bond Forward will become attractive as well for companies like LIC and other insurance companies. So it's a very good development that can lead to more demand for longer term bonds and help these insurance companies to reduce the reinvestment risk. And as far as the first question is concerned, Lata, I think that the governor is basically edging banks to actually look at the arbitrage even on an intraday basis. There have been times when the rates are very high in the morning and low in the second half, and it's quite possible for banks to, lend in the morning and kind of borrow in the evening. And some of the banks, we just don't do these kind of, if you're either a borrower, we just stick to borrowing. If you're lending, we just stick to lending.
He wants you to do both.
Nudge. He wants us to do both, but I would say that that nudge should come actually on the collateralized market as well, not just the uncollateralized, which the governor spoke about. Maybe that was not intended to be only for that market, but we will see as well.
But there is going to be a committee which is looking at the timings of all the markets. So maybe that they've promised a committee which will look at the chrome market, the collateralized repo market, their timings, he said, but maybe it will look at other things as well that you are pointing out. All told, actually, it's a many splendored policy, though it looked like a brief statement. Gentlemen, out of time, but I think most of you are giving a thumbs up to the policy. On that note, wrap up on this special show. Let's leave you with the first government reaction we got to the Reserve Bank policy. Finance Secretary Tuhin Kantapande.
I think it's a very positive step, and it is taking the whole thing forward, pro-growth, and I think this is a very good step.
Right. The statement also appears to place growth over inflation. Is this something that the government would be more or less in sync with, given the current scenario?
I think it is not this or that. It's not growth versus inflation debate. I think keeping in view the inflation, as well as the growth imperative, MPC has taken the right call.
I think the underlying innate technology is just right on the threshold, and we'll get there with the next models. But now people have got to go off and build all these services. So someone in this room hopefully will figure out what the AI tutor of the future looks like, and that'll be a population scale thing, and it'll think what that would do if every kid on Earth this year got an AI tutor that was provided like a better education, or helped to provide a better education than anybody could get last year. Think what it would mean if we could have like an AI medical diagnosis system that was better than anyone could get last year. Think what it could mean if scientists could go cure every disease faster. And so, we've been waiting for this moment for a long time. I think we're gonna deliver something that can help with it, and now people have to go build with it. Other side of it, the cost for a given unit of intelligence 1 year later seems to fall by about 10x. Moore's law was a 2x every 18 months for the number of transistors on a chip, and that changed the world if you waited a few decades. But what's happening with the reduction in cost in AI models is extraordinary. Now, I don't think it means that the world's going to need any less AI hardware, because you bring the cost down and just the people are going to use it for a lot more things. The total number of dollars will go up. But that's a really exciting thing happening.
This was the third consecutive year that the BMC budget was presented to an administrator and not to a standing committee. Why? Because the term of the corporators ended in March 2022 and the elections for the new term and the new corporators are yet to be held. Now the 74,427 crore rupees budget, out of this, an allocation of 43,162 crore was made for capital expenditure, 5,100 crore rupees for roads and traffic department, 5,807 crore rupees for Mumbai Coastal Road project, 3,039 crore rupees for storm water drain department, and 650 crore rupees for sewage operation department. For key public services, over 4,000 crores were allotted to education department, over 7,000 crore for health department, 261 crore rupees for fire department, 309 crore rupees for disaster management, and 220 crore rupees for the garden department. BMC announced that it's going to start 250 new public clinics, also known as Apla Dawakhana, all over the city. One interesting initiative announced by the BMC was the introduction of cyber awareness program for students. It will serve two key purposes. One will be to ensure that the students learn how to use the internet in a safe manner and to keep them safe from cyber fraud. BMC also focused on environment initiatives and projects like
Hello and welcome to Business 360. I'm Shireen Bhan. The headlines that we're tracking for you this evening. The Monetary Policy Committee unanimously agrees to cut the repo rate by 25 basis points for the first time in nearly 5 years, maintains the neutral stance. Governor Sanjay Malhotra makes a pledge to ensure adequate liquidity in his debut policy. RBI trims its growth forecast for the current fiscal to 6.4% from 6.5%. Projects 6.7% growth rate in FY26, expects inflation to ease to 4.2% in the next FY. In a bid to provide liquidity cushion to banks, RBI delays the implementation of the new liquidity coverage ratio and project financing rules. The new LCR rules delayed at least till April 2026. The governor promises sufficient time frame for banks to avoid any disruption. The Sensex and the Nifty post minor gains for the second straight week. This, even as a roller coaster ride on Friday ends in the red. The rupee gains some lost ground against the dollar. Strong demand for SUVs and tractors aid M&M in Q3. The auto major reports an inline set of numbers. The management remains bullish about the agri sector, sees tractor industry growth at 7%. A dramatic twist in the battle to control Religare. The Supreme Court rules that the Burman family's open offer will not close today, directs the US investor Danny Gaikwad, who wants to make a counter-offer to deposit 600 crore rupees as the earnest money within 5 days. The Apex Court also pulls up SEBI, asks why shareholders are being forced to pay prices prevailing 18 months ago. SEBI cracks the whip on Finfluencer Asmita Patel after receiving over 40 complaints in pounds 54 crore rupees for running an unregistered investment advisory, unfair trade practices, mis-selling services, among others. Patel has more than 500,000 followers on YouTube. The US imposes sanctions on a number of entities and individuals for allegedly facilitating the shipment of Iranian oil to China. An Indian company named Marshall Ship Management among those blacklisted. The clampdown comes days after Donald Trump signed a memorandum sanctioning a maximum pressure campaign on arch-rival Iran. Congress leader Rahul Gandhi alleges irregularities in the Maharashtra elections, which saw BJP and allies win a commanding majority. Claims the number of people who voted is more than the state's adult population. The Election Commission promises a full factual response. The Union Cabinet is likely to take up the new income tax bill this evening. The legislation is likely to be introduced in Parliament next week. The global CEO of Nivea maker Beiersdorf is betting big on India. Vincent Warnery says 2025 is India's year, hopes to double sales and make it one of the top 5 markets for the company. That's an exclusive. Well, the big story this evening, the Monetary Policy Committee of the Reserve Bank of India has unanimously cut the repo rate by 25 basis points for the first time in 5 years. In his debut policy decision, RBI Governor Sanjay Malhotra said the Monetary Policy Committee has also decided to keep the policy stance neutral, adding that such a stance will provide RBI the flexibility to respond to the environment. The central bank trimmed its growth forecast for the current fiscal to 6.4% from 6.5% earlier. For FY26, the RBI is projecting a growth rate of 6.7%. While warning about potential headwinds from geopolitical tensions and protectionist trade policies. The RBI is expecting inflation to ease to 4.2% in the next financial year. It's betting on a good Kharif season to drive food prices lower, and in a bid to provide liquidity cushion to banks, RBI delayed the implementation of the new liquidity coverage ratio as well as the project financing rules. Now, the new LCR rules have been delayed at least till April 2026, so almost a year of a reprieve there. And here's the RBI Governor Sanjay Malhotra speaking after his first monetary policy.
This growth inflation dynamics opens up policy space for the MPC to support growth while remaining focused on aligning inflation with the target. At the same time, the MPC felt that excessive volatility in global financial markets and continued uncertainties about global trade policies, coupled with adverse weather events, pose risks to the growth and inflation outlook. This calls for the MPC to remain watchful. Accordingly, it decided to continue with a neutral stance. It's more than 1 year. 2 months, less than 2 months is too short a window for the banks. We realize that. And so, we will give at least 31, at least. Doesn't mean it has to be 31/3/2026. We'll aspire for that. But we want to make it very smooth, and it will also be phased. It will not be, that all the regulations, all the norms kick in from day one, which will be at the earliest 31/3/2026. ECL was only a discussion paper. Even the draft is not out. So there is no time frame for implementation of ECL guidelines. Similarly, project finance, you can rest assured, I think they will need more time. 31/3/2026 is the earliest. For project finance, the draft regulations were certainly published. Comments have been received, suggestions have been received. We are examining them, and we'll come out with something. I want to assure all of you that which balances the interests of the public, the depositors, the financial stability, which is very, very important for our country. And at the same time, the concerns of the banks, keeping in mind the efficient use of resources.
Well, that's the RBI Governor Sanjay Malhotra. Lata is here with her take on the RBI's policy. Lata, so that 25 basis point cut coming in and the additional 1 year or perhaps even longer reprieve on the LCR as well as project financing norms.
Actually, I would say the policy clearly gets an A+, or whatever you want to call it, AAA+. And it's not just my opinion, that's the broad swathe of opinion. Primarily for its appropriateness. 25 basis was what the market expected, and the policy stopped over there, didn't try to be exuberant, especially in the way in which they handled liquidity. The policy said, both in the statement and the governor in his Q&A, said that we proactively will promise as much liquidity as required. He didn't say that I assure you surplus liquidity all the time. anything extra can be used to short the rupee. So I think the appropriateness was very important. One, because the rupee is a little wobbly, and also because there is a lot of uncertainty. We don't know how things might go in terms of tariffs and make, items expensive. The best tribute to the policy came from the rupee. Normally, when you cut rates, the rupee falls. The rupee rose today. It is ending higher than where it ended yesterday. So that itself is a tribute that, the RBI went only as far as expected. The bond yields didn't move at all, actually. The 10-year bond yield remained at 6.69, 6.7, because that much of a cut was factored in. The important point is, as you pointed out, the postponement of those three regulatory measures, LCR, liquidity coverage ratio, expected credit loss accounting system, and higher provisioning for infrastructure, it was expected that they would defer. You don't have structural reforms, however robust, when there is a wartime. And, the way the rupee and the way the tariff war has kind of gotten sparked off, you don't try to do extraordinary things at such times. It was always expected. But the grace with which it was done should be appreciated. While the governor did say that, there is a cost involved in regulation in terms of efficiency, he quickly said that the Reserve Bank does take into account the cost. I'm only stating it up front. So there was a lot of grace that he extended to the Reserve Bank. And a takeaway for all of us, the creation of that bank.in domain name that will be attached to all messages from any bank. So it's like State Bank of India at bank.in. If you get messages from that, only that is not a fraud. Now, that is a very good innovation, I think, among the non-policy statements. And, well, it's coming from a computer engineer governor, so maybe he gets some brownie points for that. I also like the way in which he defended the flexible inflation targeting. It came out of nowhere. No governor does that because we take the flexible inflation target framework for granted, but probably because he's coming from the finance ministry and previous economic survey had said that maybe the target should exclude food, probably wanted to just remove all doubts, and saying upfront that it is a commendable job was, I think, a very generous and important statement to make, appropriate statement to make, confidence-generating statement. So all told, I would think the governor, by the way in which he quoted the weights of several items in the CPI, the jargon that he used, like, for instance, when he was asked about the rupee, from Bimal Jalan onwards, what do the governors say when you are asked about the rupee? The Reserve Bank intervenes to smooth out volatility. We have no target for the rupee. Repeated that sentence verbatim. So I think really mastered the skill in a very short time.
All right, Lata. Many thanks for joining us. That's the first policy being delivered under the watch of the new RBI Governor, Sanjay Malhotra. Now, earlier this week, the Financial Services Secretary, M. Nagaraju, spoke about the new LCR rules. He made the government's position clear. The government did not want money locked up, and that was the view that had been conveyed to the Reserve Bank of India. And it looks like the Finance Ministry's view has prevailed because, as we heard there from the RBI Governor, at least a year, if not more, for the banks to transition to the new rules. Take a look.
Not going to second guess the RBI, but RBI has issued the draft, and we have conveyed our views on that. Now they have not issued the final draft, the regulations. We want to more. We don't want to lock up a lot of capital into this kind of ideal situation. So we have expressed our views based on the feedback we received from the industry. Okay. Now the RBI has not issued. So let us put a full stop there.
Well, a full stop clearly, at least for the next year, has been put by the RBI on the LCR and the project financing rules. The rupee did regain some lost ground after monetary policy. The rupee gained about 15 paise against the dollar, but it remains above the 87 mark. The 10-year bond price is declining in trade and the yields hardened to 6.7%. That's the money market snapshot for you. In the stock markets, the Sensex and the Nifty managed to check out minor gains for the week. It was a roller coaster ride on Friday that ended with marginal losses. The Sensex lost about 200 points. The Nifty was down by about 40. The mid-cap index was up just about, and the bank Nifty closed about 0.5% lower. So that was the story as far as the stock markets were concerned. And in the commodity markets, oil prices up marginally but remained on track for a third straight week of decline. This is US President Donald Trump's renewed trade war on China and threats of tariff hikes on other countries weighed on sentiment. Trump's maiden sanctions package targeting a handful of vessels carrying Iranian oil has also put pressure on prices. In earnings corner, shares of M&M up in trade today after the company reported a good set of numbers for Q3, meeting street estimates on most fronts. Net profit up 21%, revenue up 20% on an annual basis. Sudarshan is standing by with the M&M report card. Sud.
It's a healthy set of earnings from the auto major Mahindra & Mahindra for Q3 FY25, led by healthy volume growth. Both the segments have seen healthy growth. Auto segment has seen volume growth of 16%, and tractor segment has reported volume growth of almost 20% in Q3. And because of this, revenue growth has increased 20%. Even EBITDA was healthy, and it has come at 4,468 crore against our estimate of 4,425 crore. Margin remains healthy. It has come at 14.6% versus 12.8% that company had reported in the same quarter last year. Talking about the segments for auto business, revenue was up 20% year-on-year, and on a sequential basis, it has increased by 6%, and margin has reached to 9.7% versus 8.5% in the same quarter last year. Agri-business revenue has increased 21% year-on-year, and on a sequential basis, it's up 26%. And for agri-business, EBIT margin has increased to 18.1% from 15% that company had reported in Q3 of FY24. Now, talking about the guidance, company says for agri-business, the growth is seen at 7% versus earlier guidance that company had given for industry that was in the range of 6 to 7%. For passenger vehicle, growth is seen in mid-single digit. Now, talking about the market share, in SUV, revenue market share is now at 23%, which is an increase of 200 basis points. For tractor, market share has increased to 44.2%. That is an increase of 240 basis points. And in electric three-wheeler, market share stands at 41.8%. So on earnings front, it's almost in line to slight beat for Q3 FY25. Even guidance, especially for tractor segment, is looking healthy by M&M.
Sud, many thanks for joining us. And more earnings. Ola Electric has reported a weak set of numbers for Q3. Losses for the quarter widened to 564 crore rupees on an annual basis. Revenue dropped more than 19%. Ola has also reported an EBITDA loss of 460 crore rupees on a yearly basis. The stock down today. We will take a break, but coming up next, SEBI cracks the whip on Finfluencer Asmita Patel after receiving over 40 complaints. More on that when we get back.
Eco-friendly cremation and proper disposal of residue from idle immersion. These are the projects which will take place under environmental related initiatives in the next few months. We also spoke to Bhushan Gagrani, the BMC Commissioner himself. This was the first time that he presented the BMC budget. Listen to what he has to say about this BMC budget. So your budget also mentioned that you guys are planning on imposing a tax on the commercial properties in slum areas.
That's right.
If you can elaborate that. So from when this new tax will be levied?
It is actually not a new tax. In fact, we are enhancing our assessment net. Under the assessment net, the properties which are in the slum, however, which are being used for the purpose of commercial, they were not covered. So this is for the first time we are doing the survey and bringing them in the tax net. Not necessarily that we will be imposing huge tax. It's a normal tax. It's not a very huge tax. However, the coverage will be given to our commercial properties.
So BMC has not introduced any new project this time. In fact, you have focused. Correct.
Yeah.
But sir, does it mean that is there any cause for fiscal concern, sir?
No, there is no fiscal constraint. We have enough adequate cash flow as well as resources.
Make informed decisions with comprehensive analysis on the go.
Strengthen your portfolio with real-time market updates on the go. Create effective strategies with insightful expert opinions. On the go.
Grow on the go with CNBC-TV18. Now streaming live 24/7 on YouTube. How about listening to global market maestros before crafting your investment strategy? How about getting deep insights into their businesses from top Indian honchos before putting your money on the line? How about making every trading day profitable with strategies from the market masters, macro pundits and chart wizards? Only one show gives you a head start to your trading day. Get ready to profit. Get ready for business with Bajar at these times on CNBC-TV18 and CNBC-TV18.com.
What does it take to build India's largest startup platform? It takes a journey of starting out as an unknown and ending up as unforgettable. It takes more than 2 decades of celebrating the most influential and influencing the most celebrated entrepreneurs. From chronicling the stories of India's startup universe to becoming a success story in itself, as India's longest running show on startups and entrepreneurship, celebrating 21 action-packed years of building India's biggest startup community. Young Turks at 21, only on CNBC-TV18 and CNBC-TV18.com. CNBC-TV18's most comprehensive and award-winning news show, India Business Hour, drops first on YouTube. So get the first access to the most influential architects of policies and politics, the key newsmakers of the day. Discover the big themes as we decode the business of markets, macros and more. Be the first to go to the heart of all the top stories that drive the day.
Well, a dramatic twist in the battle to control Religare. The Supreme Court has ruled that the Berman family's open offer will not close today, directing US investor Danny Gaikwad, who wants to make a counter offer. He's been directed to now deposit 600 crore rupees as the earnest money within 5 days. The top court also pulled up the market regulator SEBI. Ashmit joins us now with more. Ashmit, take us to what the Supreme Court has said.
Well, the battle for control for Religare continues. Bear in mind that on one hand you have the Berman open offer. On the other hand, Digvijay Gaikwad, a little-known commodity, a US-based investor, looking to come in with his own open offer at a higher price. And importantly, Gaikwad had moved the top court, the highest court of the country. The entire issue about higher pricing being offered by Gaikwad, the approval process coming with a delay, all these issues were debated at length. And importantly, the long and short is the Supreme Court has passed an interim order, and that order has 4 important elements. Number one, Gaikwad, to show his bona fides, will have to deposit an earnest money of 600 crore rupees by February 12th, and that is Tuesday of next week. So that's part one. The second is Berman open offer, which was expected to close today. The tendering process closes today, will not happen. That's element number 2. The third key element here is the Supreme Court is directing that until the earnest money deadline, which is of February 12th, the Berman open offer will remain open till that date. And subject to, if Gaikwad does bring in the money of 600 crore rupees, what happens in that case? Well, the Supreme Court has accounted for that, has passed the 4th direction, which is that if Gaikwad brings in the money, then until SEBI decides on Gaikwad's application, the Berman open offer will remain open. So again, that confusion, that question mark still remains. But there are important observations to also keep in mind. Number one, the Supreme Court observing that this entire open offer being conducted by the Bermans is being done at their own risk, that tomorrow if this issue gets decided in favor of Gaikwad, they'll have to, number one, cough up a lot of money. And number two, the observation that the Supreme Court made, and this was something where they were critical of SEBI, saying that this open offer was publicly announced at 235 rupees a share by the Bermans in September of 2023, which is 18 months back. What Supreme Court opined is that effectively SEBI is asking shareholders to pay a price that existed 18 months back in September of 2023. And this is something the Supreme Court said SEBI should be more mindful of, should be more careful of.
All right, Ashmit, appreciate you joining us. Now, the regulator, SEBI, has cracked the whip on Finfluencer Asmita Patel. After receiving over 40 complaints, it's issued an interim order to impound over 53 crore rupees for running an unregistered investment advisory, also for unfair trade practices, mis-selling services, among others. Patel has more than 500,000 followers on YouTube. Yash is here with the details. Yash, a significant order there coming in from the regulator.
Well, Shireen, significant order, and just last week we had the FAQs which were released by SEBI when it comes to Finfluencer and unregistered entities and the relation with SEBI registered entities. And here the very next week we have an order against one of the influencers, Asmita Patel. She was popularly known as the She-Wolf or the options queen on social media circles. As far as SEBI's order is concerned, it's an interim order and a show cause notice against Asmita Patel and Asmita Patel Global School of Trading, along with 4 other proprietary entities. Now, this order was passed after 42 complainants, reached out to SEBI with their complaints of being cheated in terms of buying a course from Asmita Patel, and all of them had registered for this particular course, where they were asked to pay about 8.26 lakh with GST per person for a course. As far as SEBI's allegations are concerned, it is with respect to unregistered investment advisory and research analyst service, violation of fraudulent and unfair trade practices, which is known as PFUTP regulations, defraud in connection with dealing in securities market, and mis-selling of services related to securities market. You spoke about the followers she had. Quite a wide and a popular following. YouTube about 5.26 lakh, Instagram about 2.9 lakh, Facebook 73,000, LinkedIn about 1,900, as well as Twitter about 4,200. The order is essentially asking Asmita Patel to disgorge an amount of 54 crore rupees as unlawful gains. The show cause notice takes it a step ahead, asking Asmita Patel to justify why she shouldn't be asked to disgorge an amount of 104 crore rupees, which is the entire illegitimate gain which she's made by selling these courses. As I said, being charged at about 8.26 lakh per person, spanning across 7 months.
Well, that's a significant order there that's coming in from the regulator, SEBI. Yash, many thanks for joining us. And with that, it is time for us to wrap up this edition of Business 360. The news will continue on CNBC-TV18. Stay right there. We're back in a moment. Ruiz Ford.
Catch the award-winning India Business Hour live every night on YouTube with me, Shireen Bhatt.
India Business Hour live on YouTube at CNBC-TV18 weeknights at 7 p.m.
Про кількість не скажу, не маю права, але це ті самі дати, про які ми домовлялись з президентом Макроном. Так, з'явились міражі, але якщо бути відвертим, ми чекали, щоб вони разом з'явились у нас, тобто додаткові F-16 і міражі, я би так сказав.
כפי שאתם יודעים, נפגשתי שלשום עם הנשיא טראמפ בפגישה היסטורית שהיא תפנית אדירה לעתיד ישראל. הוא העלה בפגישה הזאת גם את הרעיון שלו לגבי עזה, לגבי היום שאחרי חמאס. ואני חושב שכדאי להקשיב טוב טוב לרעיון הזה, שהוא הרעיון המקורי הראשון שעלה מזה שנים.
Hello and welcome to Startup Street. I'm Arundhati Ramnin and with me is Ritu Singh. These are the top headlines from the startup world. Ankit Nagori-led Cure Foods gears up for a Diwali listing, shortlists JM Financial, IIFL and Nuvama as bankers for its upcoming IPO, say sources. The Cloud Kitchen major looks to raise 1,400 to 1,500 crore rupees via primary capital and offer for sale. Payments firm PhonePe exits the account aggregator business to surrender NBFC AA license to the RBI. PhonePe says it will partner with other account aggregators to help enhance financial inclusion. Zomato rebrands as Eternal as the company aims to go beyond its food delivery roots. It now encompasses multiple businesses, including Blinkit, District and Hyperpure. Zomato's board of directors approves the change on February 6th, subject to shareholder and regulatory approvals. SEBI cracks the whip on Finfluencer Asmita Patel after receiving over 40 complaints, impounds 54 crore rupees for running an unregistered investment advisory, unfair trade practices, mis-selling services, among others. Asmita Patel has more than 500,000 followers on YouTube. Amazon shares dipped 3.3% in pre-market trade after the online retailer's cloud growth fell short of expectations. Amazon Web reports a 19% rise in revenues to nearly $29 billion, just shy of analysts' expectations. Amazon joins Microsoft Azure, Google Cloud to report weaker than expected cloud figures.
Well, payments company Cashfree Payments has raised $53 million, or about 450 crore rupees, in a funding round that was led by Korean digital entertainment giant Krafton to drive product innovation, market expansion, as well as global growth. Now, Cashfree currently processes about $80 billion annually and works with more than 800,000 businesses, from internet startups to public enterprises. On that note, let me welcome Akash Sinha, the CEO and co-founder of Cashfree Payments, to talk to us about the significance of this funding and what it means for the company. Akash, thanks very much for joining us here on Startup Street. Begin by telling us about where Cashfree is now valued at as per this latest funding round. We understand it's about $700 million, and it also establishes a strategic partnership between you and Krafton. What will that synergy sort of entail?
See, valuation, I think whatever is being reported is closer to where we are. So we haven't shared the actual number, but that's where I think we are in terms of valuation. Right, on the partnership, Krafton has a pretty large investment arm, right? So they do both financial and strategic investment. Obviously, they have been investing in India for the last couple of years across sectors like media, entertainment, digital goods and all. And payments means something which we're excited for them. And from our side, I mean, Krafton is a pretty large, group which do a lot of B2C business in digital content consumption space. And that is one segment we see India is also getting bigger and bigger, right? I think as a payments company, we have been doing, like supporting business like e-commerce, travel, financial services. But digital content, digital consumption is on rise in India. I think you can, look at the data for the last 3 years, right? There has been good growth in segment like OTT, media, entertainment. Right? And this segment is going to become bigger and bigger. And that way for us, it made sense to be closer to them, right? At least understand the market landscape from them and be ready for that market boom, which is going to happen in India in the next few years.
So Akash, how exactly are you going to deploy this capital for growth? What kind of market expansion are you looking at, and what kind of geographical expansion are you eyeing?
We have been investing in a business in 4 larger pillars, right? One is payment infrastructure. Second is merchant experience. Third is customer experience. And fourth is, on international expansion, right? So on payment infrastructure, we already went live with product like UPI Switch, BEPG. And we plan to do more and more such infrastructure-led development by being closer to the issuers and networks. On merchant experience, idea has been to how do we make it much easier for merchant to access cash free. So that's where product like instant settlement and secure ID, even cross-border, right? A lot of these products are launched to improve merchant experience for using cash free platform. For customer experience, product one-click checkout has become a phenomenal hit in the market that is targeting D2C merchants and their customers who are using D2C merchants. At the same time, we believe there are a lot more we can do to evolve customer experience, the ones who are using cash free platform. And that's where we are going to invest a lot more energy in the next 2 years. The fourth is international expansion, which is also pretty big, right? I think we have acquired a stake in a company in UAE like 3 years back. And this year the plan has been to scale it up, right? And be one of the market leader in that market. And that is where I think significant focus will also be spent as part of the financing round in expanding the international market, starting from UAE, going to KSA, and 4 other markets, which are part of Middle East region.
Cashfree had a period of slower growth while RBI had put new merchant onboarding on hold for you. And then, of course, you got your authorization for the payment aggregator license. How has business growth been since then? And at what pace are you able to add merchants now?
After getting the license, we took some time to be much more ready, right? And we have seen more than 130% growth when it comes to merchant count. Today, as a platform, we process close to $80 billion in terms of GTV. And we have close to 8 lakh merchants on the platform. So the platform is very sizable. We are handling very large scale. And just to give you more recent number, right, we get more than 45,000 leads every month, right, which is very high number of leads that any payments company get globally, right? It means I think platform is very much attractive. I think a lot of businesses of all sizes, be it smaller, mid-size or larger ones, right, are very happy with what we have built at Cashfree and the kind of products we are offering. And all of them are seeing Cashfree platform as a good enabler, for a growth in their business, right? So in the last 6 months, we have been able to onboard a lot of marquee, internet-first businesses which are there in the market, like Swiggy, BigBasket, Bajaj Finserv, Zepto, right? And that also shows the, testament of these merchants that Cashfree platform is helping them in their growth, helping them give best experience to their users. At the same time, making it operationally easier for them to manage payments on the platform.
So you're currently processing about $80 billion annually, you say, and working with 800,000 businesses. At what pace, tell us, is business growing here? How is both the domestic and cross-border payments as well as the PPI business individually growing for you?
Cross-border business, we got the license 6 months back. I think last of last year, like around December, Jan, we went live with 5 to 6 beta customers. I think this year will be big for cross-border because cross-border as a space which hasn't been explored a lot in the last few years, right? The license is new. A lot of things have been standardized, right? The regulation is also much clearer. And there's a strong interest, with both sides of the business community, right? As part of the new budget, right? India is supposed to be a big export, like powerhouse. And that is where we see a lot of scope for us enabling businesses which are very export oriented. At the same time, making, doing business with Indian consumers much more easier for international businesses who are not based out of India. So these are two flows which are very big in itself.
Akash, you'd earlier told us that Cashfree aims to cross 1,000 crores in revenue for this financial year, and a quarter of that will come from non-payment products. Are you on track for that, and what should we expect in terms of profitability?
We are very much close to that revenue. I think we may surpass that as well. In terms of profitability, as I said, we are very much on track. I think we have been doing our investment this year, but it's a matter of few months, I think, where we'll be back to profitability again. Just for the record, company has been profitable for 4 consecutive years, starting from 2018, 2022. So we know how to make business sustainable. And it's just a matter of a few more months where we'll be back to profitability after seeing growth in these products, that we just discussed about.
All right, Akash, thanks very much for your time here on CNBC-TV18. We wish you all the very best. Thank you.
Moving on the hot seat today, Namdev Finvest, a Jaipur-based non-banking financial company, has raised $38 million in debt funding. The funds were raised from leading development finance institutions like Developing World Markets, Blue Orchard Managed Funds and Mirova. This infusion of funds will allow Namdev Finvest to expand beyond conventional lending models. Joining me now to discuss this further is Jitendra Tanwar, the MD and CEO of Namdev Finvest. Jitendra, thank you so much for taking time out and being here with us on Startup Street. Let's start with this funding round of $28 million that you've raised in debt, right? Can you tell us why the need for this debt funding and what do you propose to do with the capital?
So debt funding, so we have raised in MSME secured lending, and also we do for the electric vehicles and then the solar as well. So we are catering in tier 3, tier 4 cities with 120 branches with 9 states. So the fund will be utilized will be in the underserved areas in like in 120 branches.
Right. And, through this funding, you're looking to go beyond the traditional domestic bank, NBFC lending models to serve the underserved and unbanked borrowers, right? If you could sort of elaborate on how you plan to do this and what's the plan on this front?
So as of now, so we are present in 9 states in North and Western India with 120 branches. And also we have entered in new states like Bihar and then UP as well. UP in like Western UP, right? So we are catering in the smaller shopkeepers and then also like FMCG stores and as well as like for farmers and then tractor loans as well as to like the electric vehicles and the solar loans.
Right. 90% of your portfolio comprises of secured loans to MSMEs, while the rest of it is lending towards green and renewable segments, right? What will be the mix going forward, considering you've entered new markets and all of that?
So our company USP is the 90% is the secured, so 100% are secured lending. So 90% in the MSME, it's micro, small, medium enterprise loans, and 10% in like green energy renewable loans, and EV and solars.
Right. So EV and solars, are you looking to enter any new markets in the year to come?
Already we have started in Bihar and Uttarakhand and UP.
Any new sectors?
No, for the MSME and then the green energy only.
All right. And, your assets under management exceeded 1,100 crore rupees. 90% of your portfolio comprises of these secured loans, while the rest is lending towards green and renewable segments. What will be the mix going forward? Take us through, how you plan to grow this even further.
So in future, our 90% portfolio in the secured lending in the coming 4 to 5 years. And also in 10% portfolio already we will maintain in the green energy loans.
Right. And how have the books performed in terms of gross NPAs, collections, etc.? What sort of margins are you working with versus, traditional NBFC competitors?
So as of now, as of December, our gross NPA is 1.7 and net NPA is 0.6. And also our collection efficiency is 92%, 0 plus par is 9%. So we are maintain our collection efficiency. So our customers paid on time on up to 90%, 90 to 90%.
Right. And, if you could sort of tell us what your growth targets are for this year. We've just started the year out. Are you looking to raise more funds? What are the big targets that you've set for yourself for this year?
So in this year, our total aim will be reach approximately 1,500 to 1,600 crores in this March 2025. And next year will be cross up to maybe 2,000 to 2,500 crores. Our aim will be reaching in up to 2026.
All right, Jitendra, thank you so much for joining us on the show today. But, we're completely out of time. Thank you so much for being here with us on Startup Street.
Thank you. Welcome.
On that note, it is time for us to head into a short break. But coming up, IPO-bound platform Zetwork is in talks with family offices for an investment of over $20 million. More details when we come back. Stay tuned.
This growth inflation dynamics opens up policy space for the MPC to support growth while remaining focused on aligning inflation with the target. At the same time, the MPC felt that excessive volatility in global financial markets and continued uncertainties about global trade policies, coupled with adverse weather events, pose risks to the growth and inflation outlook. This calls for the MPC to remain watchful. Accordingly, it decided to continue with a neutral stance. This will provide MPC with the flexibility to respond to evolving macroeconomic environment. The MPC decided unanimously to reduce the policy rate by 25 basis points from 6.5% to 6.25%. The MPC also decided unanimously again to continue with the neutral stance and remain unambiguously focused on a durable alignment of inflation with the target while supporting growth.
Every leader, business, government, investment leaders, economists, we're all scrambling to adjust to a very new reality and a new approach, I think it's fair to say, from a US administration who seem very focused on American interests and are quite content to rewrite what have been thought to be kind of historical norms. So those historical norms started really earlier this week with the seeming tariffing of Mexico and Canada. Canada, obviously, a huge close ally of America, but that didn't save them from being on the list, at least for some period of time. Those tariffs subsequently didn't come to pass, at least for now. And to your question, yeah, the Middle East, like everywhere else, we're all looking, I guess, tweet by tweet, Truth Social post by Truth Social post as to what's going to happen next. And that would apparently include some historically astonishing proposals, at least.
Tensions between employees and management at Samsung's Sriperumbudur plant just outside Chennai have surfaced yet again. For well over 24 hours now, over 100 employees, we're told, have been staging a sit-in protest at Samsung's plant just a few meters from where I'm standing. In fact, this line of company buses and these barricades have been erected by Samsung so as to prevent members of the public and observers, much like myself, to see what's been going on through the gates of Samsung's plant just a few meters from where I'm standing. Now, the issue is simply this. A few days ago, 3 members or employees rather of Samsung's plant were suspended after
Welcome back. You're still with us on Startup Street. IPO-bound B2B platform Zetwork is in talks with family offices for an investment of over $20 million. Aishwarya Anand is here with more details. Aishwarya?
IPO-bound B2B platform Zetwork is in talks with family offices for an investment between $20 to $30 million. Sources have exclusively told CNBC-TV18. Most of the conversations have closed and some are in advanced stages. The firm is also in advanced talks with more family offices, HNIs and ultra HNIs for investment before its IPO, sources added. Zetwork in December raised $90 million from Khosla Ventures, Indigo co-founder Rakesh Gangwal and others. The fresh capital infusion is aimed at strengthening the company's cap table as it prepares for public market listing. According to Bloomberg, Zetwork has picked banks including Axis Capital, Goldman Sachs, Jefferies, JM Financial, JP Morgan Chase and Kotak Mahindra Bank for an IPO that could raise at least $500 million at a valuation of around $5 billion.
Right, Aishwarya, many thanks for those details. Now, the Union Budget 2025 put a great impetus on propelling digital learning in India, focusing on AI-powered education, broadband for rural schools, multilingual textbooks, and enhanced digital skills training. So how is EdTech ecosystem gearing up to meet these demands? And what must India do to realize its digital learning ambitions? My colleague Aishwarya Anand does a deep dive. Take a look.
From a Center of Excellence in AI for Education, 5 new centers of excellence for skilling, introduction of digital language books, and 50,000 new Atal Tinkering Labs, Union Budget 2025 came with ambitious announcement for the education sector. But the question that remains, is India ready for the digital overhaul, and how are the EdTech players gearing up for that challenge? I'm here at ASU plus GSV and Emeritus Summit to find that out. In this Union Budget 2025, the government has announced setting up a new Center of Excellence in AI for education with an outlay of 500 crore rupees. How do you think it translates into some of the startups that could probably crop up in the sector, and what could it mean for GSV in terms of potential investments into this space?
I think, this feels similar to what we're seeing in major investments in something like Project Stargate in the US. I think it really demonstrates that India is poised to become a big AI powerhouse, especially if you look at the amount of startup activity in the ecosystem. If you look at just the developer talent that exists in this region, if you build that infrastructure, the startups will come. So I think that's overall very exciting as investors in major ed tech startups. Hopefully with that infrastructure, it means lower costs of models. It will mean that there's more options. So you might use a reasoning model, you might be able to use a base model. There might be India-specific models. I think that specificity will create better models for Indian-specific startups and therefore even feed into an ever-growing startup ecosystem.
The government has said that they're opening 5 new Center of Excellence for skilling and especially considering the new platform that you've launched, that is Border Plus. How do you think this will propel the growth further for you?
This budget at least has put the right impetus and initiative on skilling, not just from the AI Center of Excellence, but also from the Global Partnership for Skilling, which therefore opens up the market for Indian talent, not just to be trained for India, but Indian talent to be trained for international opportunities. Because if we could potentially become the talent capital for the world. If we could potentially become the biggest supplier of talent pool for global economy, and that's going to be a game changer for India. Because look, if you look at it, India has about $125 billion of remittance coming into India. And I think if we can leverage the skilling movement and help the Indian youth get trained, we'll see significant upside, not just for the economy, but for the workforce to find right opportunities in India and globally.
Two of the big announcements that I see fitting well with how Lead School what could impact Lead School going forward is firstly the expansion of Atal Tinkering Lab, and secondly, a push towards digital books under the Bharatiya Pushtak scheme. Do you think that's enough to bridge the digital literacy gap in India?
Historically, we have looked at investments in education by a very piecemeal approach. We'll improve books, we'll improve tinkering labs. I think what Indian education, especially at the school level, requires is a system approach. And for that, we need to have an enabling public-private partnership policy. Because unless we improve the operations in a school, all these inputs are not going to make a difference. Because I have been to schools where tinkering labs are in still lock and key. I've been to schools where you might provide the great books, but teachers are not in the school. So my sense is that we need to really make a concerted effort towards better school operations with better systems implementation. Then we can see a big improvement in Indian school outcomes.
Another big milestone that we will see in the sector is PhysicsWallah's IPO, which is slated for the first week of July 2025, with an aim to raise $500 million at a valuation of $5 billion. If successful, PhysicsWallah will become the first Indian pure-play edtech company to list on the National Stock Exchange. Not only that, upskilling platform Simply Learn is also expected to go for an IPO in FY26.
I think a lot of investors may have the perception that, in order for you to succeed, you have to be in Silicon Valley, or you have to serve the US market, or you have to be global, which I think is, we definitely want, inherently global businesses and brands. Something like Simply Learn has built a fantastic global brand, and PhysicsWallah as well. But I think PhysicsWallah represents a company that is India grown, India native, and serving the India ecosystem, and still able to build a fantastic business that people are eager to be part of.
While India's IPO market is definitely primed for greater growth and excitement, experts also believe India's education economy is ripe for AI-led transformations. In New Delhi, Aishwarya Anand for CNBC-TV18.
It is Friday and it's time to take stock of all the startup deals of the week. According to Venture Intelligence, this week saw 15 deals worth $110 million. First up, fintech company Cashfree raises $53 million from Krafton and Apis Partners. AI deployment platform True Foundry raises $19 million from Intel Capital, ENIAC Ventures, Peak 15 Partners, Jump Capital, and others. Next up, AI solution provider for enterprises Cognita.ai secures $15 million in Series A round from Nexus Venture Partners. while Hair Originals raises $5 million from Anicut Capital and 12 Flags Group. Women wellness brand Nua raises $4 million from Mirabilis Investment Trust and others. So far this year, 97 startups have raised $808 million. And with that, it is a wrap on this edition of Startup Street. More news and updates coming up on the other side. Stay tuned.
Engaging in activities deemed detrimental to the interest of Samsung's operations in India. However, employees of the plant, a section of them, and members of the Samsung India Workers Union claim that this suspension was not on account of disciplinary action or disciplinary reasons, but simply because they were affiliated with the Samsung India Workers Union in the first place, also claiming that Samsung does not want any employee to be actively engaged with this recently established workers union. Now remember, this isn't the first time that issues or a face-off between Samsung's management and employees have cropped up. In September, nearly 1,100 employees of this very plant staged a protest outside plant premises, claiming for better privileges, more representation, better pay, and also representation by way of a union which Samsung said all that while that it was averse to forming in the first place. However, following the Madras High Court's intervention, Samsung India Workers Union became a registered union under the Tamil Nadu Labour Department, thereby ensuring that some of these workers' demands pertaining to representation by way of a union was summarily met. However, these issues clearly have not been laid to rest, simply on account of the recent suspension of those 3 employees. Now, the issue is simply this. While these employees claim that they were suspended for their affiliation, Samsung in a statement has said the employees in question violated the company policy and have been suspended temporarily and will be subject to appropriate disciplinary action following a formal inquiry, end quote. Now, while it's a case of he said, she said between Samsung and its employees, the fact is that these outstanding issues between Samsung and its employees don't seem to be going away anytime now, given the fact that both the employees and the management seem to be heading in different directions with regard to what they expect of each other pertaining to both representation and a basic disciplinary expectation.
Hello and welcome to the Global Dialogues. I'm Shireen Bhan, and joining me today is a man who's trying to revolutionize a 140-plus-year brand and take it forward. Warnery, the CEO of Beiersdorf, joins us in India. For those of you who are watching this program Beiersdorf in India is most commonly associated with the brand Nivea, a brand that has made its presence felt in India for generations. Once more, many thanks for joining us here on the Global Dialogue. Appreciate your time. Let me start by asking you about your view and outlook on India. As I pointed out, for India, Beiersdorf essentially means Nivea. When can it mean more going forward?
You know, it means Nivea since 1913. It was the first time when, you know, we had a Nivea product which was sold in India. And since then, you know, we have been building year after year a very good, a very strong presence in India. Nivea is the most trusted skincare brand for the 4th year and consecutive year. So really happy with the development of Nivea, but a lot to do. We are present in many product categories, but we are not present in the most important product category, which is face care, which is 60% of the total skincare market. And this is why I'm very happy to come today to India, because we are launching right now our first, you know, Nivea face, you know, products, specially designed for India, called Luminous, and I'm expecting a lot from this product.
Well, that's great to hear on the Luminous launch, but if you can give us a little bit more color on what this new launch will specifically mean as far as you're concerned. What does it do for you in the India market? What are you hoping to do? Because it's a fairly competitive space, you know, what will be the key differentiator that will drive you here in India?
You know, it's very interesting to see that globally, you have 29% of the people who have an issue linked with hyperpigmentation. 29%. In India, it's 37%. And we are coming, you know, with an ingredient which is called thiamidol that we launched in the globe, in the world in 2018, which is the best anti-spot ingredient in the world. You know, we have been testing this ingredient over and over in all countries, and it's the most successful ever launch of Beiersdorf with Nivea. And we've been working in the last 2-3 years to develop a specific offer for India, using the same concentration that we have in the rest of the world in terms of efficacy, but having, you know, a packaging, having a product which is affordable, because Nivea is affordable. Nivea is a value for money brand, and we didn't want to make the mistake that others have done to come at the price which was too high. No, so we have a very good price. It's 500 rupees, you know, and you can find the product online, offline. And this is our first real entry into the face care market. So we're expecting a lot from the launch now with Nivea. We're also using the same ingredient, but with a different formula, different concentration for Eucerin, which is our Derma brand that we're introducing this week, you know, in the Dermacon in India. So we have a lot of hope, you know, linked to this hyperpigmentation consumer expectation, which is developing across the world and particularly in India.
You know, you talked about your strategy for the face care market here in India, but what are the trends that you're picking up on specifically as far as the Indian consumer is concerned? And I want to link this to your outlook on China. I remember you said that if you can succeed in China, you can succeed anywhere globally. So how different is India as a market for you, and what do you eventually expect to do here in India?
I mean, you know that what is very interesting when you look at Indian consumers, they move, you know, from a market of cold cream, face care cream, to a much more sophisticated offer. We're talking about serums, we're talking about ingredients, we're talking about efficacy, and we are surfing on this wave. You know, we're coming with the know-how of Beiersdorf, which is ingredients. You know, everything is based on ingredients, so thiamidol, also soon Epicelline on anti-age, and we are developing formula which are delivering a true efficacy. And you're right to mention China. China also is obviously a very important market for this hyperpigmentation area, and we were lucky enough in November to get the first ever anti-hyperpigmentation ingredient validated by the regulatory authorities. So this is the first ever. So we are also a lot of hope for China, but will become in 2026. So 2025, this is a year of India. We have a lot of hope in terms of growth for Nivea, the mother brand, but also the fact that over the next 4 months, we have already introduced Eucerin, but we'll come with La Prairie, which is the most luxury brand in the world, with Chantecaille, which is a very nice brand. So, in fact, between November 24 and June 2025, you will have the full portfolio of Beiersdorf launched in India, which proves, you know, the importance of the Indian market for us, and the fact that it is, you know, the most strategic market we want to succeed in after, as I said, 20 years of, you know, good build-up of the brand and good successes across the country.
Well, that's quite a statement, Bonso, you made there, that 2025 is going to be the year of India as far as Biostop is concerned. So again, give us more details on the strategy specifically that you intend to follow. You said that it will be both online and offline across different price points with different brands addressing those different price points. So what could that mean in terms of sales growth for you?
Today, India is already one of the top 10 countries for Biostop. And we have only 2 brands. We have, of course, Nivea. We have also Hansaplast. So we are missing the 3 other big brands, which is the one we are launching in India right now. So obviously, we are in the top 10 today. I'm expecting India to be in the top 5 pretty quickly. We have a fantastic ecosystem. We have an R&D center in India. We have a factory in India. So that's one of the only countries where we have the full, spectrum of activities. We have an extremely good team, with a strong leader. We've been also doing a pretty good job over the last 20 years. Often when you look at the history of a business, you see some mistakes, some failures. It's not the case for India. It was really a marathon. We've been growing every year. And now I think the fact that we are able to come with this new ingredient, and this is the first time we're coming with such a new ingredient with an offer which is designed for Indian consumers, is making us very optimistic because it's surfing on the wave of, sophistication of the market. It is clearly a big priority off and online. Online, we've been doubling the business since last year, and we have a fantastic, partnership with Nika, with a lot of e-commerce players. It's also about digitalization. We talk about influencer marketing. We are no longer doing the classical TV that we used to do in the past when I was myself in marketing. We are using influencers. We are using, digital media to talk to our audience. So I think all the things happening, in India, and particularly the fact that there is, this increase of the middle class, who wants to take care of their beauty, want to take care of their skin, is something which is a fantastic accelerator for us. I think we have never felt so ready for India that in 2025, and this is why we have this extreme dynamism in launching 3 brands, in 6 months.
Right. So, the full suite of your products soon to be launched here in India. But Bonso, you were talking about digitalization and how that is now going to be driving growth for you. What about here in India specifically? You talked about your partnership with Nika, for instance. Give me the levers, the growth drivers for Biostop here in India that you intend to focus on.
I think what I did, perhaps simply, is to go back to the history of Biostop. It's very interesting to see that Biostop, already 140 years ago, invented modern skincare. We invented the value for money brand, which is Nivea. We invented also Derma, the first dermatologic brand, Eucerin, was created by Biostop. And then over the years, we lost a little bit this edge. We lost a little bit this focus. We were a bit too distracted by other product categories. So the first thing I've done is to say it's great to have a lot of product categories, but there is nothing more important than skincare. And the focus on skincare has been absolutely clear for each and every country, for every brand. The second element, I mentioned that to you in the beginning of the interview, the R&D engine. We are a fantastic team, of 1,000 researchers, some of them based in Mumbai, some of them in Hamburg, in Shanghai, in New Jersey, which have a fantastic know-how in skincare R&D. And I was able, to put more money, obviously, but also to strengthen the organization, to be sure that we get back to what we used to be, the motto of Biostop. We find extraordinary ingredients, and we use them for our brands. So it used to be Thiamidol in 2018. You will hear soon about Epicellin, an anti-age ingredient that we're launching right now, which is a fantastic, anti-age ingredient. We have other things coming in the acne also. And acne is a very interesting story for Indian. That 70% of Indian people have an issue with acne, while globally it's 40%. So you imagine also the potential also for a company like us to enter this market. So back to ingredient, and last but not least, an appetite for growth, an appetite for entering white spaces. And India was a white space. We were good with some product categories, but with only a few brands, So being more daring, bolder in entering China, India, even the US, Africa, where, we have some business, but we are not as big as we should be. And I think this recipe, is working pretty well. We are in a very dynamic market. Also, the beauty market is a great market. In bad years, you grow 4%. In good years, you grow up to 6%. We've been able to overperform the market and all our competitors in 23, in 24. Hopefully, in the last quarter, we'll see soon the results of our competitors. But there is clearly a new growth appetite for this company with brands which are, as you mentioned in the beginning, super well known and super respected by consumers. So that makes a pretty successful recipe for us, and this is why we are pretty successful in 24, in 23, and hopefully in 2025.
Well, Wonsa, I think the appetite for growth is being reflected as far as your market cap is concerned, and we've seen the markets reward that. But you were talking about R&D and the focus on R&D. Let me understand from you, what is the percentage of R&D spends at this point in time? How do you create a culture of maximizing on your R&D returns? What are you doing differently today? Because you also talked about the fact that how, there was distractions that caused you to lose your way in the middle, but the focus is now sharply back on skincare. So how have you been able to do that?
That's a great question. In terms of investment, we spend 3% of our sales in R&D, which is the best in class. If you look at L'Oréal, they are exactly the same figures. So really, investing big and over there, and we never question these figures. Even in difficult years, I know the COVID year 2020, we spent 3% of our net sales in R&D. I think what we have done is to refocus first the R&D on this search for outstanding ingredients. Moving away from perhaps what we call marketing innovation, which is more concept and claims, into true R&D discovery of new ingredients, and then being sure that we leverage them, on all our brands. We call that brand cascading. There is with the same ingredient, you can have a totally different formula and totally different story on Nivea, on Eucerin, on La Prairie and Chantecaille, and it's a pity, to use only one brand to leverage one ingredient. So we've been doing that with Thiamidol, which has been launched under Eucerin, Nivea, La Prairie, and next month we'll launch it under Chantecaille. We'll do that also with Epicelline, and all our countries, all our business units are focusing most of the investment on the products, which are using those new ingredients, because this is where we make the difference, and this is pretty paying off.
Well, renewed focus on using new ingredients, many of which you have patented. Once we are going to take a quick break, but don't go back anywhere. We're going to be back on the Global Dialogue and talk about Beiersdorf, the Nivea makers' plans for India when we're back. Stay with us.
Did you know there's an asteroid headed towards Earth and there's a more than 1% chance of an Armageddon-style threat to the planet in 2032? In fact, NASA has said the chances that the asteroid 2024 YR4 will impact Earth in 2032 has risen from 1.6% to 1.9%. While it might sound surprising, it's not time to start panicking just yet. NASA was also quick to step in with some reassurance. Paul Choris, who heads NASA's Center for Near-Earth Object Studies, said, and I quote, "We are not worried at all, because there's a 99% chance it will miss, but it deserves attention." The space rock that's between 130 to 300 feet wide was first spotted on December 27, 2024 by a NASA-funded station in Chile. It quickly made its way to NASA's risk list, which tracks any objects that could come close to Earth. While the chance of impact is still low, NASA continues to watch it closely. These probabilities can change as more data comes in, and many asteroids that have appeared risky at first have later been deemed harmless. Right now, no other large asteroids pose a threat with impact probability above 1%. So, while asteroid 2024 YR4 is something to keep an eye on, you may not need to lose sleep over it. For now, NASA's planetary defense team is on the case, and we'll keep you informed whenever there's new information available.
I think the underlying innate technology is just right on the threshold, and we'll get there with the next models. But now people have got to go off and build all these services. So someone in this room hopefully will figure out what the AI tutor of the future looks like, and that'll be a population scale thing, and it'll think what that would do if every kid on Earth, this year got an AI tutor that was provided like a better education, or helped to provide a better education than anybody could get last year. Think what it would mean if we could have like an AI medical diagnosis system that was better than anyone could get last year. Think what it could mean if scientists could go cure every disease faster. And so, we've been waiting for this moment for a long time. I think we're gonna deliver something that can help with it, and now people have to go build with it. Other side of it, the cost for a given unit of intelligence 1 year later seems to fall by about 10x. Moore's law was a 2x every 18 months for the number of transistors on a chip, and that changed the world if you waited a few decades. But what's happening with the reduction in cost in AI models is extraordinary. Now, I don't think it means that the world's going to need any less AI hardware, because you bring the cost down and just the people are going to use it for a lot more things. The total number of dollars will go up. But that's a really exciting thing happening.
You're watching the Global Dialogues, and we're in conversation with the global CEO of Nivea maker Beiersdorf, Vincent Warnery. Vincent, you were talking about the patented ingredients and how those are driving growth for you. You also talked about Thermidiol, for instance, as well as the other anti-aging product or ingredient that you're launching. What is the patent pipeline looking for you at this point in time? What can we expect? And in India, the launch of Luminous, which is the new brand, what do you expect to do with that?
I mean, in India, the launch of Luminous, which is this new franchise, I think is really a revolution. We're going to move, I say, from a brand that Indians love and into a brand that they praise for the efficacy. Really, there is not a more interesting category than face care. This is really when you prove the efficacy of your ingredient, when you prove the efficacy of your R&D, and this Luminous range that you will start to see everywhere in India will be, I think, a strong moment of pride for the company and for Nivea. And then we have Eucerin. We are entering, this derma market. We are one of the first global brands, entering the Indian derma market. You know that you have in India 12,000 dermatologists. It is as many as in full Europe. And we are expecting those dermatologists to welcome Eucerin, to welcome this new Thiamidol ingredient. We have the Dermacon this week in India, where we're going to meet 7,000 out of the 12,000 dermatologists. So it's a fantastic opportunity. We're starting to talk with them. So also, I think Beiersdorf will become a referent company for dermatologists. And this is essential for Beiersdorf. This is, everything started by, a famous Professor Una, who was the dermatologist, working on the formula. And last but not least, we are super excited by the launch of La Prairie and Chantecaille. We struggled in the past because you didn't have a lot of department store, and we used to be very offline, very linked to department store. And now with all the new e-commerce players you have in India, starting with Nykaa, we have a great opportunity to make this luxury brand also accessible, and not only offline but also online. So I'm expecting a lot from India. I mean, we have a business which is still small for us. It's 2% of the total sales of Beiersdorf, but I have a strong appetite. I think seeing India becoming a 500 million euro business for us, in the coming years, is not a dream, and it's something I really want to achieve. And also learning from Indian consumers. The fact that we have this R&D facility in Mumbai, and they are responsible for the global skin of color research. So every time we are developing a specific formula for black skin, for Asian skin, for Indian skin, this is developed in Mumbai. It's also a fantastic business accelerator, not only for India, but for the rest of the world. So really a big hope for India, helping us being better also, not only in India, but also at the global level.
So once you said that 2% of global revenues currently is what you get from India, and you hope to take that number to 500 million euros over the next few years. Would it be fair to assume that that could be within the next 5 years?
That's my objective. That's the objective I will give to our general manager.
Right. You were also talking about how you've changed your communication strategy. You're much more active on social media. You've brought social media influencers into the mix as well. How hard is the Gen Z market to crack? What are the lessons that the Gen Z market is teaching you about skincare?
They are super demanding, and they know what they're talking about. You know, this is very interesting to see the expertise of consumers, and particularly this generation, you know, regarding ingredients, regarding what salicylic acid is doing, what retinol is doing, what are the pros and cons. So you cannot bullshit them. You know, you have to tell them the truth. You have to be true to your claims. You know, you cannot claim things that you are not delivering. So that's very interesting, because it's also raising the bar. It's also forcing us, you know, to have this good level of conversation with them, to also make them aware what we are doing. We do a lot of visit of our R&D center, for example, also for influencers, so they can see the people who are formulating the products. You know, so it's really, you know, a much more adult, I would say, exchange with them, where we can talk about formula, we can talk about ingredients, and we can really, and when they are happy, which is what happened, you know, with this ingredient I was mentioning, it's really paying off, you know, and we see this sophistication in India also because you have a lot of new brands also which are based on ingredients. You know, we see this sophistication, we see this need to raise the bar, and this is why we felt that it was the right time to come with a more sophisticated offer, not only on EVA, but also with the rest of the portfolio. That's the kind of challenge we like, and that's a kind of challenge where I think we have the good answer, you know, and we are able to convince them.
Right. I want to ask you a quick question as far as the global macros are concerned. I mean, today we're seeing trade wars escalate and de-escalate overnight. As a CEO running a global corporation, how do you brace yourself for the kind of uncertainty and volatility that we are seeing?
I mean, it's my daily life, you know, and might be a speech of the new president of the United States, which is suddenly asking us, you know, to increase a little bit, you know, the production out of Mexico before there are some tax increase. It's about also making some decision, you know, when you have a country at war with another one, you know, Russia, Ukraine, for example. I think we try to stay true to the history of this company. We try to be also loyal to consumers, you know, to ensure that, you know, our consumers and the loyal consumers who've been buying the brand, you know, since decades, can find their product, you know. So it's we are lucky enough to be in a market which is pretty resilient, you know. Even in COVID years, we declined, but not as much as other markets. People want to take care of their skin. People want to enjoy also the pleasure of a new texture of a brand, and this is what has been the motto of Beiersdorf since 140 years, and we stay true to that. So, okay, new wars will come, new problems will come. We try to stay, you know, focused on our consumers and bringing them what is perhaps making their life a little bit better. You know, we are not changing lives, but we are trying to make the life of our people, of our consumers,
well, speaking of white
better.
Spaces, you know, what about men? Today, a lot more aware, a lot more experimental. How about that white space? How much do you intend to build out the face care market for men?
You know, it's a bit tricky because men are much less sophisticated than women. We must admit that, you know. So we are good with Nivea. We know Nivea Men is a number 2 in the market in India. So we have a very good offer. But what we see more and more, which is very interesting, is that the most sophisticated men are buying products which are supposed to be for women. You know, so we're entering into something which is more unisex, you know, which is less men-woman. We have been launching this ingredient Thiamidol on Nivea Men, for example, and it's paying off, but it's even bigger. You know, the share of men is even bigger on the core franchise Luminous that we are launching in India. So coming with a new offer, which is more sophisticated, which is also simple. You know, we have to be also down to earth in the concept, in the way we sell the product. We have to use also influencers, and that's something which is interesting. You see also a lot of male influencers. You were mentioning China, for example, in China, in Korea. So it's a new way of talking to them. It's a new sophistication. And I think it's also a big business opportunity because obviously the penetration of skincare in the main population is much lower, much smaller than the population, the number of women we're able to target with our product.
Well, let me end then by asking you once about the top 5 trends that will decide or define your strategy, not just for 2025, but in the slightly more medium to long term as well.
I mean, we have a motto which I love, which is we want to be the best skincare company in the world. So in the word best, you have everything. It's about obviously being the best in terms of growth, in terms of success, but it's also being the best in terms of innovation. And it's also, which is for me extremely important, be the best in terms of people management. We have a very interesting culture in this company, caring culture. We call that win with care, where we take care of the people. We are developing people. We are not doing social plans, for example. That's something we're doing. We always try, to take care of our people and be sure that they feel happy in the company, that they feel they have the chance to develop, to grow. And that's something which is very important. So if at the end of my mandate as the CEO, which will be end of 2030, I've been able really to make of Beiersdorf the best skincare company in the world, respecting all these elements, I would be pretty proud.
Well, Wansao, it's been an absolute pleasure speaking with you. We wish you the very best of luck with your launch plans in India as well as your sales target, and we look forward to seeing much more of you.
Thank you so much for your time. It was really great meeting you.
Well, thanks very much indeed. And with that, it is time for us to wrap up this edition of the CNBC-TV18 Global Dialogues as we chat with the global CEO of Beiersdorf with the ambition of becoming the top skincare company in the world. We will take a break here on CNBC-TV18. The news continues. Don't go anywhere.
This was the third consecutive year that the BMC budget was presented to an administrator and not to a standing committee. Why? Because the term of the corporators ended in March 2022 and the elections for the new term and the new corporators are yet to be held. Now this 74,427 crore rupees budget, out of this, an allocation of 43,162 crore was made for capital expenditure. 5,100 crore rupees for roads and traffic department, 5,807 crore rupees for Mumbai Coastal Road project, 3,039 crore rupees for storm water drain department and 650 crore rupees for sewage operation department. For key public services, over 4,000 crores were allotted to education department, over 7,000 crore for health department, 261 crore rupees for fire department, 309 crore rupees for disaster management and 220 crore rupees for the garden department. BMC announced that it's going to start 250 new public clinics, also known as Apla Dawakhana, all over the city. One interesting initiative announced by the BMC was the introduction of cyber awareness program for students. It will serve two key purposes. One will be to ensure that the students learn how to use the internet in a safe manner and to keep them safe from cyber fraud. BMC also focused on environment initiatives and projects like promoting eco-friendly cremation and proper disposal of residue from idle immersion. These are the projects which will take place under environmental related initiatives in the next few months. We also spoke to Bhushan Gagrani, the BMC commissioner himself. This was the first time that he presented the BMC budget. Listen to what he has to say about this BMC budget. So your budget also mentioned that you guys are planning on imposing a tax on the commercial properties in slum areas.
That's right.
If you can elaborate that. So from when this new tax will be levied?
It is actually not a new tax. In fact, we are enhancing our assessment net. Under the assessment net, the properties which are in the slum, however, which are being used for the purpose of commercial, they were not covered. So this is for the first time we are doing the survey and bringing them in the tax net. Not necessarily that we will be imposing huge tax. It's a normal tax. It's not a very huge tax. However, the coverage will be given to our commercial properties.
So BMC has not introduced any new project this time. In fact, you have focused. Correct.
Yeah.
But sir, does it mean that is there any cause for fiscal concern, sir?
No, there is no fiscal constraint. We have enough adequate cash flow as well as resources.
Make informed decisions with comprehensive analysis on the go.
Strengthen your portfolio with real-time market updates on the go. Create effective strategies with insightful expert opinions on the go.
Grow on the go with CNBC-TV18, now streaming live 24/7 on YouTube. How about listening to global market maestros before crafting your investment strategy? How about getting deep insights into their businesses from top Indian honchos before putting your money on the line? How about making every trading day profitable with strategies from the market masters, macro pundits and chart wizards? Only one show gives you a head start to your trading day. Get ready to profit. Get ready for business with Bajar at these times on CNBC-TV18 and CNBC-TV18.com.
What does it take to build India's largest startup platform? It takes a journey of starting out as an unknown.
Welcome to Global Eye. Hello and welcome to Global Eye. I'm Parikshit Luthra. The top story we are tracking this evening. Prime Minister Narendra Modi will be travelling to France at the invitation of French President Macron from the 10th to the 12th of February. He will be attending and co-chairing the Artificial Intelligence Summit along with meeting the French President for bilateral talks. The Prime Minister will also head to the United States on an official visit from the 12th to the 13th of February. PM Modi will hold bilateral talks with President Trump and meet senior officials from the US administration. Modi is also expected to interact with key American business leaders and the Indian diaspora during his visit. Sources have indicated that the two leaders will have a discussion on a trade agreement with an agenda to lay out a roadmap to sign a deal in 7 to 8 months. This visit comes at a time when the US administration deported 104 illegal Indian nationals this week as part of Trump administration's crackdown on illegal immigration. Joining us now to take the discussion forward and put the Prime Minister's visit to the White House in perspective for our viewers is Atul Kesha, present at the US-India Business Council. Mr. Kashyap, thank you so much for joining us on the program. Let me begin by asking you, on trade, what do you expect? Will they set out a roadmap on a trade agreement?
Well, I very much hope so. Hi, Pariksha. Thanks for having me on. Look, we've been kind of stalled out for the past few years between the U.S. and India on trade facilitation and innovation. And these are two big, bold, ambitious leaders. So I hope that they will be ambitious for the trajectory of our two countries. And I absolutely hope they'll come up with something robust.
Right. Now, after the new administration was sworn in, what has been the recommendation from the U.S. Chambers of Commerce, from the U.S. IBC to the U.S. government, to the Trump administration on what to do with the trade agreement with India, and also how to reduce the trade deficit?
Well, let's take a step back, Parikshit, and just think about the moment. You know, President Trump just got sworn in. He had Minister Jaishankar here for that inauguration. They had a Quad meeting immediately thereafter with the 4 foreign ministers of the Quad. And now we are hurtling right into a visit by Prime Minister Modi. And this is indicative not only of the very warm and special relationship between President Trump and Prime Minister Modi dating back to the first Trump administration, but it's also indicative of the importance of India and, more importantly, of India-U.S. ties in helping propel economic growth, prosperity, and stability on this planet. If you think about all of the other, sort of quasi-great powers, they all have problems, but India and the U.S., while we also have problems, are much stronger. We are more robust. Our societies are more resilient. We are bursting with innovation because of our free people and the talent of our people. And our economic growth is strong, and it can become even stronger. If you look at what's been happening in the early days of this administration, they're looking at ways to transform and unleash the animal spirits of the American people and the American economy to boost our growth even more. And I think that's true about India as well. So USIBC has always been in favor of this. This is our 50th anniversary Golden Jubilee in 2025. For 50 years, we have advocated for the strongest possible strategic, economic, and technological collaboration between the people of the United States and the people of India. We put out a report 2 weeks ago that basically outlines 9 different areas where we ought to intensify our relationship: defense, fintech, digital economy, artificial intelligence, quantum computing, pharmaceuticals, you name it. The sky's the limit if we really focus. And I do think there's an air of ambition right now in what the two leaders want to try to achieve. That means that we can probably get a lot of good stuff done.
Right. Could you give us a sense of the kind of US CEOs, or which sectors would those CEOs be from, who will actually call on Prime Minister Modi? We believe that the National Security Council, the White House, is handling this visit very tightly, and there will be a business meeting with the PM, but we don't know who all will be there as yet.
Well, here's what I can tell you, and of course the two governments have to decide how they're going to structure the visit. But we at USIBC have dozens of top CEOs who are ready to engage with both the Prime Minister and the President. These are CEOs from the very top companies in e-commerce, financial services, banking, defense, new economy, digital economy, the life sciences. I mean, the list goes on and on. We've compiled a list of 30 CEOs who are ready to change their plans and fly in order to be part of this. And that list is growing, I might add, every minute.
Right, 30 CEOs. What about energy ties? Do you expect the president to urge Prime Minister Modi to buy more crude, buy more LNG from the US? And do you expect any sort of agreement on that front?
Well, I can't speak for President Trump, but I 100% would love to see India buy more LNG, more crude, innovate with us on nuclear, especially modular nuclear. I think there's an energy revolution that the US and India can drive. We've already got a pretty strong critical minerals working group. There's a lot else we can do. I'm very bullish on modular nuclear, but this is where governments have to make decisions. America has a proven track record of being a reliable partner and supplier for oil and gas. It will greatly help balance the structural trade deficit between Washington and Delhi if India buys more oil and gas. I think President Trump has also been very clear in his statements that he wants India to buy more defense articles. We, of course, fully support that. We support full defense collaboration to ensure the deterrence capability of India and the United States. I'd like to see more agricultural sales as well, soybeans and corn and whatnot. So there's quite a bit of ambition on the American side for what could come out of it. And I think there's also a desire to see India take steps to reduce tariffs further and reduce non-tariff barriers further, and to speed up business, including cutting down on red tape. We did a little internal survey of our companies, and while they're very bullish on India, they're investing like crazy in India. They're expanding in India, just like Indian companies who are also members are expanding heavily in America, paying taxes here, employing people here. There is a great desire to see India reduce its tariffs, its rather considerable non-tariff barriers, and bureaucratic red tape that slows down a lot of decision making. If that happens, I think India's GDP will grow, FDI will grow, and it'll be good for the Indian people.
Top 3 sectors where we need to reduce tariffs, according to the Trump administration and the US chambers?
Well, I think agricultural goods, certain consumer products as well. There's a whole list. I mean, India, not to put words in my mouth, but to say what former USTR Representative Bob Lighthizer said, India is the most protectionist large economy on earth. And that may be for solid reasons. I mean, you have to see what the Indian government does for its people. But I think it actually would serve to advance India, make it more dynamic, more globally competitive, enhance FDI flows and job creation, tax generation. If India were to drop these barriers and be a bit more confident about itself, And that's definitely I think something that President Trump and his team will be looking at.
Right. Elon Musk in the room. How does he impact Donald Trump's policies vis-a-vis India?
So, look, there's a lot that's said about him. Here's what I'll say. Elon Musk represents a new technology ambition of the United States. You know, think about NASA compared to SpaceX and the capabilities of SpaceX now. You know, I worked in the government for 28 years. Government doesn't have the monopoly on smarts and capability. And it's innovators like Musk, an immigrant who brought his native genius to our shores and has revolutionized the way we get the internet through satellites, the way we get into space, the way we drive cars and get around town, and so much else besides. I mean, I'm on Twitter, you're on Twitter. That is where the ideas of this world flow. So whether you like him or hate him, the fact is that he has completely reminded Americans that we can tap into our own genius to advance ourselves and that we shouldn't be content with 2 and 3% growth rates and a very sort of sclerotic advanced industrial state. That in fact, we can also be like India, growing very rapidly, that we can intensify the pace of change in our country for the betterment of our people, and that we can use technology. So I think this is a moment full of possibility in the United States. It is a wedding of government purpose and free citizens technologies. And I would like to see the Trump-Modi summit harness that and unleash the animal spirits of India and the United States in ways that are good for our countries, our people, and for the entire world.
Right. My last question. You know, right now there's a lot of discomfort in the Indian political side, especially with the manner in which the deported Indian nationals on that military plane were treated. They were all in restraints. Now, one understands that this is US protocol. This is how they deal with people who have broken laws in the US. Having said that, is there any scope for negotiation on how they are treated? Because India has expressed concerns about them being restrained, and this is likely to figure in conversations between the two sides next week as well.
Yeah, yes, it certainly could come up. I mean, look, Parikshit, I think that the two leaders are going to talk about the Indo-Pacific, where India and Washington have an enormous amount of strategic convergence. They're going to talk about the Middle East, where India and the United States are essentially helping our allies in the region to shore up stability and positive transformation in that part of the world. We have a giant agenda to talk about in terms of the Indian Ocean, Africa, the Pacific Islands, where even in Latin America, where India and the US have a global partnership on shared concerns. And so that'll be a big part of the conversation. The trade and economic will also be a giant part of the conversation, where I hope that we will see an enormous input of energy and ambition by both leaders in order to take us to the next level on trade. And then on this issue, I would say it's complex. There are many facets to it. You know, we haven't talked about skilled visas and things like skilled worker visas, but this issue certainly could come up. And this is where the governments need to have a friendly, frank, constructive conversation between two friends who trust each other.
All right. Thank you very much, Ambassador Keshav, for joining us on the program. We are going to take a short break here on Global Eye, but coming up, US President Trump plans to take over Gaza. Israeli Prime Minister Netanyahu gives his proposal a thumbs up, while Middle East countries and key US allies condemn the move. A special discussion with former Indian ambassador and Middle East expert Talmiz Ahmad when we return.
Ending up as unforgettable. It takes more than 2 decades of celebrating the most influential and influencing the most celebrated entrepreneurs. From chronicling the stories of India's startup universe to becoming a success story in itself, as India's longest-running show on startups and entrepreneurship, celebrating 21 action-packed years of building India's biggest startup community. Young Turks at 21. Only on CNBC-TV18 and CNBC-TV18.com. CNBC-TV18's most comprehensive and award-winning news show, India Business Hour, drops first on YouTube. So get the first access to the most influential architects of policies and politics, the key newsmakers of the day. Discover the big themes as we decode the business of markets, macros and more. Be the first to go to the heart of all the top stories that drive the day's agenda. Catch the award-winning India Business Hour live every night on YouTube with me, Shireen Bhan.
India Business Hour live on YouTube at CNBC-TV18 weeknights at 7 p.m.
Про кількість не скажу, не маю права, але це ті самі дати, про які ми домовлялись з президентом Макроном. Так, з'явились міражі, але якщо бути відвертим, ми чекали, щоб вони разом з'явились у нас, тобто додаткові F-16 і міражі, я би так сказав.
Welcome back. You're watching Global Eye. President Donald Trump has made a proposal for United States to take over the Gaza Strip. This comes after Trump hosted Israeli Prime Minister Benjamin Netanyahu in the White House. Now, this has led to concerns in the White House administration. Some officials have tried to walk back on this proposal. U.S. allies, Middle East countries have condemned it as well. So, what direction could this take? Currently, the Israel government is welcoming this. We're now joined by former Indian ambassador to Saudi Arabia, Talmiz Ahmed. Ambassador Ahmed, thank you very much. You have been tracking this region very, very closely. Let me begin by asking you, Donald Trump today is saying that US will take over Gaza. It's not so simple. What will be the reaction, and can he really execute what he's saying?
We are watching Donald Trump in action in his second term.